companies at least just meet or have some sort of call once every few weeks and just discuss any safety and security issues.
But why haven't you done that yet? I mean, you don't all like each other very much.
Yeah,
but you're not all. I mean, you're also all competing, right? You all want to be first.
Yes, but that's where I think the competitors can keep each other honest. So meaning like if I think it's quite difficult for someone in the government who doesn't have a deep technical understanding and isn't driving the frontier of AI to know whether something should be released or not. However, the competitors, I think, can, if given sort of a week or two to review a new model, can highlight issues and have an incentive to keep all the competitors have an incentive to keep the others honest.
That was Elon Musk in a sit-down interview with The Economist. And joining us now is Zanny Beddoes, editor-in-chief of The Economist, who conducted that interview. It was fascinating, Zanny. I thought you did an extraordinary job, and we were all, glued to the screen. I'm curious. I mean, you touched on so many things. You touched on the AI piece, the whole idea that he really thinks within 5 years AI is going to be even smarter, potentially even than him, and what that means to his own power. You got into some of the things that happened with Doge and his role in the government, USAID. What was the thing, what was the moment as you were sitting there where you thought, that really surprised me?
Oh, so many. I mean, he's an extraordinary individual, and there were lots of times when I was kind of slack-jawed, at least inwardly. I was really struck by his vision of the future, and actually the fact that he now thinks it is inevitable that, as you say, within 5 years, AI is going to be more intelligent than humans, and that within 10 years, he's painting this picture essentially where, we are like the kind of the Labradors to the AIs. Money will be irrelevant. It'll be such an era of abundance, but they will be in control. And, Andrew, his background. And this is a man who in 2015 said on a podcast that was one of the scariest things he could imagine. In 2023, he wanted to pause AI. And now he's right at the front of this. And I said to him, it sounds like you've given up on your concerns and you're going along for the ride. And he sort of said, yeah, I'm going along for the ride. And he admitted that within 1 day, he would go from exhilaration to terror. But I was very struck by the inevitability, he thought, that this technology and the speed with which it was progressing would mean that this extraordinary future would kind of come within 5 years. Really struck by that. And again, at the same time, he laid out, I think for the first time, and you showed that in your clip, a willingness to work with the other frontier model makers to have some kind of, and he wants it an informal, typical Elon, right? He wants them all to get on a call and talk to each other and test each other's models for a week. And, if they come up with security flaws, tell the model maker that's got them. And only then, if the model maker doesn't, do anything, then go to the government. But I was struck how similar that is actually to the proposal by Demis Hassabis last week for a FINRA-style public-private partnership. And I think this really now has legs. I think this is going to go somewhere.
He did seem to suggest that he'd be even open to talking to Sam Altman at some level.
Absolutely.
Sort of hinted at that.
More than hinted. He said that. No, yep. He absolutely said that, because I said, look, you are all massive, not just massive competitors. Many of you dislike each other, and you're, frankly, slagging each other off on social media quite often. And he said at the end, he explained to me why he disliked Sam Altman, but then he said at the end, maybe we should talk for the good of humanity. And so I think there is a sense of responsibility that he recognizes that, the leading model makers do have to do this. And I said, does this have to happen quickly? And he said, yes. And I said, well, yeah, people are telling me this has to be done within the next 6 months. He said, 6 months is a very long time. It has to happen now.
Right. I want to show a clip of another piece of this that's going viral. Has to do with, I think you might have used the word right-wing politics at some point, and he did not react well. Let's show that for a second.
It's just normal people. And and here are the principles. And tell me which of these sound terrible. That we should have secure borders, that we should have safe cities, that we should have sensible spending. Which of those three are far right
Those
fringe?
three? No,
And I would like to just admonish you and the media for the absurd characterization of the far right. It is false and misleading and nonsense. Please keep this part in.
We'll keep all of this in. But let me
Don't cut this part.
Let me push back on that. Let me push back on that
because it is
you have
nonsense.
Elon, you have, what is it, close to 250 million followers on X.
Yeah, because
you say things like,
popular guy.
Quote, civil war in Britain is inevitable. Just a question of when.
On the current trends, yes.
I mean, when were you last in the UK?
A few years ago.
Okay, so you obviously reacted in the moment, but now you've had even more time to react and think about that. You kept it in, so we all got to see it. What do you think?
Well, of course I kept it in because I think people should see the whole of the interview. I said to him that he supports not just the populist right in Europe, but the far right, fringe groups that are, nowhere near the mainstream and do actually propagate not just, the three characteristics he said, but really divisive far right politics. I think that's undoubted. And I think many of these politicians wouldn't be anywhere without Elon Musk's support. And I asked him why. And the reason I did that is because he also propagates a kind of caricatured view of Europe, that it is some sort of hellhole overrun with Muslim immigrants, incredibly violent. And as you heard him say, he has said that England is heading for civil war. And I wanted to know when he was last there, because I feel very strongly that this is a profound mischaracterization of Europe. And it's irresponsible for someone who has 240 million followers to propagate things that are simply not true. He put up, as you know, for 48 hours on X, a film, Citizen Vigilante, which is glorifying vigilante violence and has a completely dystopian picture of Europe. And this is having consequences, Andrew. There are many people I come across in the US now who are worried about coming to London, who are worried about allowing their kids to go to London because they think that Europe is a sort of dangerous place. It's just not true. On the facts, London is a safer place than major US cities. Europe is not the hellhole he's painting it to be. And I got exercised about it, probably more exercised than I should have done, because it seems to me that this is not just wrong, it's irresponsible, and it's having really serious consequences. And I think it's just unfortunate that someone who is so far-sighted and expansive and thoughtful, if slightly terrifying, on where AI could go, can kind of basically play in this sort of dystopia about Europe and say things that are just not right.
And you've known Elon for a long time. I've known Elon for a long time. And I think we both agree that in many ways he's very brilliant and very thoughtful. And so my question to you, to the degree that you disagree with him on about his assessment, where do you think that assessment comes from? Why do you think he thinks that?
So I think he has a very firmly held belief that if you have a large-scale migration of people from cultures that then don't integrate, it is going to have problematic consequences for a society. And, to some degree, one can agree with bits of that. Uncontrolled migration is sort of societally untenable. But that's not what's happening in Europe. And my issue with him is his, I think, erroneous and caricatured description of what's actually going on in Europe. And, the fact that he hasn't been here and the fact that he is reposting things and propagating things that are just not true kind of reinforces this negative spiral, particularly on X, which I think paints a picture of the continent which isn't accurate and which is in turn feeding, the whole MAGA view that, there's civilizational erasure in Europe. We're all, it's a dying continent that's in a catastrophic shape. Of course, there are problems. And I'm the first person to admit that there are problems. There are free speech issues in this country. There are problem areas in this country. There are problems definitely some problems with migration. But it is not what he paints it to be. And nor, frankly, is he's being disingenuous when he says that all he is in favor of is, secure borders and limited spending and safe cities. Because on two of those three, Europe does better than the US.
You also got into a bit of a fiery exchange with him over Doge and USAID.
We did that. He got fired. I was really just asking him, and he mentioned that his view that Doge was just the USAID was a political organization, and he said there had been 0 deaths as a result of shutting down USAID, and I simply pushed back and I said, it happened overnight. USAID was a very big, provider of healthcare funding in Africa. I find it very hard to believe that there were no deaths and no suffering. And you heard him, he just said 0, right. 0 deaths. And I think that's, you can agree that USAID needed reform or perhaps even needed shutting down, but the way it was done clearly, to my mind, and I think indisputably has led to unnecessary suffering.
When you think about SpaceX, the IPO just happening, and Tesla, we keep having a sort of a parlor game about whether he ultimately buys that business. What do you think? Does it all become one?
We didn't talk about it explicitly, but my strong sense from the way that he described his vision was that it was one set of businesses. And when he talked about the reason for his control, and this was really interesting, because I said, you have whatever it is, over 80% of voting shares, and you essentially, you can go crazy and you still can't be removed. And he talked about why he needed this control. And he spoke about it in a 5 to 10 year time horizon. He said, I need it for the next 5 to 10 years because we have to, extend consciousness to the universe. And he described all the elements, which included elements from SpaceX and from Tesla.
You could tell, I think, that he has a lot of respect for you, but you guys had a lot of debate. I want to know how it ended.
Oh, I think you saw it at the end. It ended perfectly amicably. He said, at least I'm not boring. And then we carried on talking for another 15 minutes while he had his pictures taken. I mean, look, I think he's an extraordinary individual. I am not a Musk hater. I think he's an extraordinary, extraordinary individual who is done probably more than any other person to build the future. So I love talking to him. It was an incredible privilege to have, 90 minutes talking to him. And, we ended perfectly amicably. I hope he'll talk to me again. We'll see. It was really interesting, but I think it was important to push back on these areas where, I think he deserves being pushed back on, because I just think it's not right what he's saying.
What are we getting? I don't want to say we. What are the bulls out there getting wrong about AI? Because you've made no secret that you don't see any there.
Yeah. So I think people are conflating a semiconductor rally with an underlying successful business, which doesn't really exist. Anthropic's current revenue growth, which is deeply questionable in the fact that they leaked profitability, manipulated by Elon Musk, of course, their growth is coming because people cannot measure how much an AI task actually costs. And a couple months ago, Anthropic started charging their enterprise customers the actual token rates. What this has led to is suddenly businesses are going, oh, how much money are we spending? I think it was Uber's COO, Andrew McDonald, said that they're having trouble justifying the AI spend based on the actual return, that one can actually measure it. So you've got a thing where you can't measure the costs and you can't measure the return on investment. What do you call that? You call it a thing without an ROI.
Isn't it, though, safe to say, Ed, I think about this, I agree, that there is going to be, when there's any new technology, there's a lot of money thrown at something, right? A hot new idea, whatever it is. And that ultimately, we've talked with some experts in the AI world, they're saying all of these large language models, not everything's going to exist, because right now it doesn't cost you anything to use it. But at some point there will be a cost, and people will start to select what they want to play with. And so is it a case of right now, at some point there will be some winners, some losers, and we'll see some things filter their way out, and that there will be some return on investment for some of the larger players when it comes to AI? Do you not see some winners and losers in this, or some winners in this?
I think the winner is Jensen Huang, and the winner is the construction firms who have got prepaid for all the data center construction. Maybe Sam Altman and Dario Amodei who've become billionaires through this. But when it comes to the actual businesses, you can't find anyone who can measure the ROI because you can't do it. So when it comes down to the model companies themselves, they're all horrifyingly unprofitable. I think OpenAI lost $20-something billion last year. Anthropic's probably not far behind this.
We don't have access to their books.
Of course. But this is based on
file for an IPO.
Yeah, and that's the thing. When we see these S1s, I think it's going to be kind of a massacre, because I think that people have this view that these companies are becoming more profitable or even have a path to profitability, and they don't have one.
But, somebody could say, and Carol, we talk about this all the time, Amazon for years didn't really have profits.
Well, that's the thing.
Now it's a behemoth, and now it's then AWS came along, and now it's this juggernaut that, has made a lot of people very wealthy.
But the thing with Amazon is between 2003 and 2017, Amazon Web Services, actually all Amazon CapEx, was around $57 billion normalized for inflation.
Between that whole time?
In that entire time. Wow. And they were cash flow positive in 9. The classic thing with the dot-com reconciliation thing is, well, things went poorly, but after that there was useful infrastructure. No such story exists here. GPUs, AI GPUs specifically, have very few other use cases. And on top of that, if you're talking about incomplete data centers, it's going to cost just as much money to finish them today as it will in 10 years. And similarly, a Blackwell, a B200, GB200 rack, NVL72 rack, for example, will cost just as much, if not more, in electricity 10 years from now. There is no pick up and fix this story. Perhaps there'll be some on-device large language model use, but we are talking an industry that has absorbed over $1 trillion in the last 3 years. The media attention from everyone, and these continual stories about the magic of AI. But when you say, hey, is it making any money? They go, oh, no. Oh, we couldn't possibly. We don't do that yet. But don't worry, Uber lost a lot of money. Uber burned about $32 billion, which is less than half of what Anthropic has raised in the last 6 months.
So I think it's safe to say there's a lot of smart investors who are in this, smart companies who are in it, right? Pick your big hyperscaler. They obviously want to be around for a long time. So I'm just like, how do you explain their bets on all of this?
So I have this theory called the .com bubble, which is the hyperscalers are out of hypergrowth ideas. We haven't had a new iPhone. We haven't had a new cloud computing. We haven't really had a new platform that would turn into the next the next Google search or Amazon Web Services. So they thought that large language models were going to be the panacea, that they were going to be creators of API growth, that they were going to be the new infrastructure play, load up the GPUs, sell access to everyone. The problem is no one checked to make sure any of this was profitable. And we still don't know if GPU compute is actually margin positive, which is crazy considering the amount of money going into it. And when we look at the companies that actually are selling it, CoreWeave, for example, they burn billions of dollars, 20-something billion dollars worth of CapEx this year, about the same amount in debt, and their customers are NVIDIA, OpenAI through Google, OpenAI through Microsoft, and Meta, who does not have an AI strategy. It's very strange, like that Twilight Zone episode with the scary child. Like, we're all trying to pretend that Meta actually has a plan here. They don't have one.
So is Apple kind of smart? Because we've talked with our Mark Gurman about this. Have they kind of been relying on Google, right, and Gemini, and not necessarily doing that big spend?
And they're not doing any CapEx on.
No, exactly.
Well, I think what happened with Apple is they released Apple Intelligence, which may be the largest scale anti-tech radicalization in history. My non-tech friends, I've heard nothing about AI from them. Moment Apple Intelligence comes out, they're like, this is the worst thing I've ever used. And I think that made Apple go, maybe not. Maybe we should take a step back. But their CapEx is minimal. They're spending about as much in CapEx, ironically, as Amazon was spending on AWS way back when. So I think Apple is cautiously holding back and kind of absorbing the headline after headline, the ridiculous headline of Apple's behind in AI. Behind in a losing proposition, more like.
We're speaking with Ed Zitron. He's the founder and CEO of Easy Primary Research. He's got the Better Offline podcast. He writes the Where's Your Ed at newsletter. Ed, just so everybody's aware, do you have skin in the game? Are you shorting any of these companies? Do you have a financial interest in what you're talking about?
I invest in words. I love doing the newsletter I do. I think I'm spreading a great deal of financial literacy and of how to pull apart the narratives of these companies. But no, I don't, because the market is irrational. And the market is inherently invested in something that I think is destructive, especially the SpaceX IPO. And OpenAI and Anthropic should not be allowed to go public. They are dangerous, lossy companies that are going to be added to indices that will sink 401ks.
You know, it's interesting that you say this, because I got a text on a group chat today from a friend of mine who's like not happy about the idea that he's, as an index fund investor, he's going to be forced to have to buy SpaceX, for example, which is the sort of the subject of yesterday's big take. Everybody should check it out on the Bloomberg terminal. There's a lot we want to get to with you. We only have a couple more minutes. You got to come back and do some more with us. Before you go, what happens If markets, you said markets are irrational right now. If markets become efficient, and I think a lot of people think markets are efficient. If markets view this the way that you're viewing this, what are the repercussions of that bubble bursting?
I think the majority of gains based on AI success are going away. I think the neo clouds like Iron, CoreWeave, Cypher Mining, and the TerraWolf as well, all of them perhaps not going to zero, but they're going to be shells of the corporations they used to be. I actually don't know how CoreWeave survives this. I think NVIDIA is looking for the most aggressive haircut you've ever seen, for example, because they currently are not. The way based on research I've done, it looks like it's taking about 6 to 12 months to install a single quarter's worth of GPUs from NVIDIA. They've yet to put out any kind of guidance about this. They clearly know. But if you go and look at Microsoft, for example, none of the data centers that they have announced have broken ground since 2023 have actually been finished. The Fairwater data centers, they've said that was fully complete. It's not even half complete. It's one of the strangest things I've seen in history. And I think what it is that these companies know that they can get away with it. They know that the SEC scrutiny isn't there. And they also know that the froth is big enough that everyone kind of loses together. It all comes out in the wash when it's proven that there is not a there.
Do you get calls from these companies?
No, I don't hear back from Microsoft or OpenAI or any of them.
But you reach out?
I do. I asked for comment, and they just, I guess my email gets lost. Sam Altman, Dario Amodei, there's PR people have mentioned coming on my show, but then they go quiet, probably because I'm quite critical of them. They know I'd ask the questions they don't want to answer.
Why do you think, I want to poke at something that you mentioned earlier, why do you think OpenAI and Anthropic shouldn't be allowed to go public?
Because they are lossy companies. They do not have a path to profitability. Anthropic, they leaked, or however, that they were profitable. They were profitable in 2 months when Elon Musk, they gave them a discount on their compute through SpaceX. Clearly planned leaks, clearly planned financial engineering. No normal profitable company does things like this. OpenAI and Anthropic are both horribly unprofitable, and they are not getting better. They have the information reported a few weeks ago, OpenAI had a negative 122% non-GAAP operating margin in the last quarter.
But again, just because a company doesn't make money doesn't mean it shouldn't go public. Just because a company is not profitable doesn't mean it shouldn't go public.
Let me reframe this then. I don't think these companies will survive.
Okay.
And I think that investors they're doing exit liquidity for venture capital. And I think that these are dangerous, unstable companies that have faced basically no real scrutiny for most of the years of their investment. You have journalists and analysts who are actively cheering them on. This is a dangerous precedent, and it's a dangerous thing for retail investors who are being conned by this. And I mean, the whole ROI conversation, that is a result of most people experiencing AI via subscriptions that are subsidized, meaning you can burn anywhere from $3 to $13.50 for every dollar of your subscription. So people don't know how much this stuff actually costs, and they are investing and believing in it and creating workflows around it based on services they likely cannot afford long term.
Just got 20 seconds here. So we have a story. Uber has set usage caps on some AI-powered tools used by its staff to manage costs after blowing through its AI budget earlier this year. We're going to increasingly see these stories, in your view?
Yes, we will. And we've already heard a similar story coming out of Walmart. I think Bloomberg reported yesterday.
There's really nothing new under the sun, and that's because human nature doesn't change. The characters change, the names change, but it's fear and greed. We can go back to the South Sea bubble, Dutch tulip bulb mania. History repeats itself over and over again.
Put AI into that context here, because people have been positioning AI. Other than electricity, there's been nothing more important than AI. How do you think about just this whole concept writ large?
I'm not bearish on AI per se. I'm sure we're all going to use it. Many of us are using it already. The question is, what's the ROI on the AI? It starts out, the way these bubbles all start, there's a kernel of truth that captures the imagination of the individual, whether it's the South Sea bubble, or it's Dutch tulip bulbs, or it's .com, which I've lived through.
Yep.
And it starts out as a good idea, but what happens is the price changes immeasurably. And the best definition, I've actually heard of a bubble. There are many definitions. The best one I've heard is something that changes human behavior, that people do things that they wouldn't do otherwise, whether it's because of FOMO, fear of missing out, or otherwise. And I think that's kind of where we are with AI. I mean, I'm happy to change my mind, but show me the money. Where's the ROI? And I don't see it. And I don't see it coming either.
It doesn't seem to be deterring capital from flowing to that business. We've seen extraordinary amounts of equity raised. Now we're seeing tech companies that never even thought about the bond market raising tens of billions of dollars in the investment grade bond market. We've got a Korean company listing its ADRs today here in the U.S. I mean, that I've been on global Wall Street for 30 years. I've never seen this amount of money flow.
The things I read the same sources you do. I file that under my category on X of things you don't see at the bottom. We've seen this movie before with Japanese subtitles, housing subtitles, tech subtitles. Go back to .com. I actually think this is much worse than .com simply because the sums involved are that much greater.
This is really important because, the fossils sitting around the table, we talked about Will Danoff a couple of days ago. I remember being in meetings at 60 State Street, .com and all that. What's the distinction right now versus 98, 99, and then what we enjoyed in 01?
Again, I want to elaborate on the sheer magnitude of this. Julian Garrett of Macro Strategy Partners in the UK, erudite economist I've known many years, has made a calculation that this bubble, this malinvestment is 17 times what we saw in the era of .com. And what's allied to that, what's really important is the sums involved are so much larger relative to the real economy. The fallout from this could really be much more significant.
For Global Wall Street on this Friday, a real treat. George Noble with us, of course, definitive at Fidelity with Mr. Lynch a few years ago at his Noble Capital Advisors. He's been on fire out on LinkedIn and Twitter with his criticism of the moment at hand. Paul Sweeney with George Noble.
Again, another definitive part in this market was the IPO of a company called SpaceX.
Oh, my. Thought you'd never ask.
What do you make of that? I mean, I can't imagine sitting in a Fidelity office conference room and, the bankers bring Elon Musk in to make this pitch. I would have loved to have been a fly on the wall. What do you make of that?
History shows that buying companies at over 10 times revenues usually ends very badly. We all recall Scott McNealy famously in some microsystems. What happens? What your return is going to be if you buy something 10x. This is 120 times revenues, and it's even if you look at the company's projection. I mean, they're already borrowing money. You look at the company's projection; they'll be cash flow negative for years to come. And here's the worst part of SpaceX, which I don't want to engage in the Captain Obvious thinking, but the thing everyone should consider, and that is the staggered lockup the unlock that we're looking at.
Yeah.
Okay, starting from next month when the quarterly earnings come out, 20% of the shares come unlocked shortly thereafter, and then there's a whole series of unlocks, 7% every 20 or 30 days. By December, 100% of the shares will be freely floating. The important point that investors should understand is even without any change in the fundamentals, when you go from a 5% float to 100% float.
George, in the old days, when you would take a 2-hour lunch at Lockober's and you used to hold court there off the bar, but in the old days, when a company went public, it took its shares public and maybe they had a little stub they kept private. Now we're unloading 5% of the public. To me, it's manipulative. Should regulators step in and get the initial public offering market back to a normal segmentation?
100%. It's not a question of what's legal or illegal. It's just not right. Society is not well served by allowing this. Grandma's 401k is the exit liquidity for this manipulation. And I think the regulators are asleep at the wheel. They only usually jump into action after the car crashes occur.
Gensler has sat in this chair recently, and I said to Gary Gensler, I said, okay, you let Bitcoin in, I get it, it's a free market and all that. But what do you say to retail that enjoyed BitDog at 110 and it's now down at 60? SpaceX, okay, it's back to 150. I'm watching the debt of SpaceX. To be blunt, it can't find a bid.
And allied to that, Tom, I promise you that once it goes under the offering price and the unlocked shares come to market, the insiders who are in at 1/10 of the current price, they're going to hit the bid so fast it's going to make your head
I got to make some news here. To be honest, Fidelity was way out front with Mr. Musk on this. Would you recommend that Abby Johnson and the team sell their SpaceX?
They know the company better than I do. Let's just say if I was handed a portfolio, if Philly were to rehire me, I would sell it right away.
Elon Musk, you have to, I'm not sure we've seen anything like this in terms of the value that gets ascribed to Mr. Musk relative to the earnings, relative to the cash flow. We've seen it for years in Tesla. and you look at the Tesla analysts, the auto analysts all have holds or sells on it and they've been wrong. And the tech analysts have all been saying, just buy it. It's Elon. It's autonomous robots and all that kind of stuff. Have you seen that in the past where one individual can have such an influence on valuation?
No, I think Tesla is probably the biggest misallocation of capital at scale in the history of stock markets, perhaps only surpassed by SpaceX. I was one of those wrong analysts. I'm a fossil. I happen to be the auto analyst for Peter Lynch in 1981. We went to Detroit to visit Chrysler, Ford, and GM, so I know of what I speak. Fundamental work has not guided one in the case of Tesla. I think, however, though, he's bitten off more than he can chew now. Everyone's speculating whether or not SpaceX may merge, take over Tesla. I have no special insight on that. But if I had to gamble, if I had to speculate, not that I ever speculate, I would say it's a reasonable speculation.
Let me reintroduce here, worldwide, including overseas and across America, George Noble with us for years, definitive in the business of overseas investment at Fidelity. Thrilled he's in our studio today. Controversial, to say the least, on the euphoria at hand. Paul Sweeney.
So, George, where do you see opportunity these days? I'm sure you look at various markets, various geographies. Where do you see value these days?
It's a market of stocks. As Peter Lynch always used to say, don't try to call the market. I think there are outstanding opportunities right now in energy. I'm actually quite concerned about the energy picture. I think we're sleepwalking into the biggest energy dislocation in history. You look at the disparity between the divergence between the financial market for oil and the physical market for oil. We're between a rock and a hard place. The energy stocks, crude has sold off significantly the last few weeks, as have the energy stocks. I think the risk reward is very appealing. There's very little downside and potentially a lot of upside. I like reflation generally speaking. Gold stocks, I think, are a huge buy right here. SSRM as an example. 7 times earnings, not cash flow, 7 times earnings, all right? So gold stocks, energy stocks, other commodity names like some of the copper names, they're all very interesting to me.
Part of this AI story, to the extent people are looking for other ways to buy it other than the chips, has been some of the picks and shovels. One of them has been energy.
Yes.
How are we going to power all these data centers that are being built in everybody's backyard? I mean, are they going to stick little nuclear reactors next to each one? How are we going to do that?
He took thermodynamics.
Exactly.
Well, the one thing you shouldn't do is buy Oklo, which is one of the biggest frauds out there on the market right now. But that's a whole other story. OKLO. We've been short that for a year. The problem with it was some of the names you mentioned, some of the utility stocks. If the AI trade comes unstuck, and I believe it will, I think a lot of those derivative plays are going to take on water. Crude's a little different, it's on a slightly different orbit. But a lot of the derivative power plays, I think, are going to have a big problem. One last joke, it was a great line someone used a few weeks ago on me. They talk about, you got to buy the picks and shovels. I said, yeah, but what happens if you buy the picks and shovels and there's no gold in them hills?
George, I got to get 2 things in here that I think our audience is really interested in. On overseas, in the huge ups and some of the challenges you had at Teton as well, are you correlated on overseas to what the dollar does? Like, do you have to have a weak dollar to make overseas work?
No, you don't. But it's a very good question. You don't need a weaker dollar. What you need to keep in mind is the economic cycles across different geographies varies enormously, and that's what you're trying to anticipate. You need to have somewhat of a top-down perspective, not just bottom-up when you're investing internationally. However, one thing I will say, the dirty secret they don't tell you anymore, way back when I was a young and in the early 80s at Fidelity, there was much less correlation between the markets. Now, given the increasing interlinkages between markets, the correlation is much higher. I like to joke, why do I need to be up at 10 o'clock at night trading the Japanese market or get up at 5 a.m. to watch the London market? I can lose money just as well between 9:30 a.m. and 4 p.m. Eastern time, and I can get
I hold the high ground on that. And of course, on private credit, I know you've been in the dump known as the St. Regis. The old St. Regis in Beijing was an absolute dump, folks. I'm sitting there in the 90s listening to CDO squared stuff and Bankers Giddy and the whole thing. Are we doing the redux there on private credit and private equity where there's some shadows, to say the least?
You couldn't have said it better. My father always used to like to say there's 2 ways of learning things, either by precept or by experience. It's much more economical to do it by precept. We're all human. We all think this is brand new. It's deja vu all over again, as Yogi would say.
The 3 B's of public speaking and writing are be brief, be bright.
Axios.
Be
Nick
gone.
Johnson did that at Axios. Okay. Microsoft.
Microsoft, we think, has this war chest of cash. Microsoft has proven through the years that they can monetize these new things that they take on. I think Microsoft, in particular, of all of the, you want to call it a hyperscaler or software company, has been unjustly beat up. And as you've seen, the spending's not going to go away. But in terms of how, and on AI, by the way, but how they've been able to continue through a longer term perspective, manage these properties. That's why we own Microsoft. And we're going to continue. Microsoft was down in the second quarter, hurt our portfolios. We still had great performance in the second quarter. But at the end of the day, we're longer term investors, and we believe in the management there, and we believe what they're doing.
It just comes down to what I find challenging, I think, as you think about these software stocks and software as a service stocks is, yes, I can see a case where AI could disrupt a lot of their business, but I don't even know what AI is going to do. I can't figure that out. And so much less than to say Microsoft's going to be hurt or ServiceNow is going to be hurt or soft, but I guess the market's just saying we're selling now and we'll figure it out later.
Yeah, I just like the meta news is confounding to me. I know everyone was excited about it. Stock was up double digits, but now they're spending on cloud, and now they're pivoting this way, and now they're trying to chase this, building it versus spending on it. I just think that Microsoft's been much more consistent in its operations, and I want to stick with the consistent deliverers.
Jim Chanos with Bloomberg Money here 2 weeks ago nailed the meta thing. He calls it the Neo Cloud. We can't figure out what to do with AI, so we're going to compete with Amazon on the cloud. Nadella, in major shout out, Bradley Olson and Tina Lee at the Wall Street Journal with this definitive Nadella interview. I read his bio. Nadella's not normal. I think a huge body of the investment public doesn't understand his internal drive.
I don't think so. And remember, too, when he took over, that company was, after Steve, and no one liked Steve. And I remember I was at both at Piper and Merrill during those days, and we had huge presence in the Pacific Northwest. Pacific Northwest in particular owned a lot of Microsoft stock, and they did not like him. And so the private wealth perspective of that really started to, when he came in and brought more process and discipline and how they were monetizing these new properties and moving away from the subscription service into more of the deliverable software and all of that kind of stuff. That's where it really took off. So I'm a believer. We're there. I think of a stock that now it's becoming more of a value stock. You take a look at the balance sheet and the price to free cash flow on that company. It looks pristine. So we really like it. It's much more contrarian, Paul, I would say, than trying to pick the bottom and be a hero in Salesforce or Adobe. We just don't think that they're in the same league, and that's why we're sticking with it.
We had a small mid-cap portfolio manager come in this week and finally with a smile on her face because her performance, the Russell 2000 is 2x that of the S&P 500 this year, which is, doesn't happen very often.
No.
How do you think about small mid-cap stocks?
No, we've been believers for a while, and we've been wrong, aside from the second quarter. And the way that we look at it is we look at the small mid-cap indices within the S&P 1500, and if you take a look at the mid cap and the small cap, the SML dramatically outperformed the mid cap by like 500 or 600 basis points. And the reason why the Russell 2000 outperformed the S&P 600 is because you have a lot more companies in the Russell 2000 that don't own money. So there was JoJo, the juicier companies. But if you take a look at the S&P 600 small cap SML, price to cash flow, balance sheet, earnings discernibility, better than large cap, and the growth rates for the second half of the year are better too. So I think in this world of the need for liquidity, and people love private equity, they love private markets, all these private equity, private market companies are smaller companies. So I think they're going to seek liquidity in small cap.
Brian Belsky with us here before Jobs Day, 20 minutes away. Lisa Mateo to follow on here in a bit, but thrilled to have the gentleman from Humilus with us. I look at July 2-ish, and it tells me, and people know where I am on rebalancing, sell your winners. I'm like, really? Rebalancing this time around?
Violent, because think about what Micron did to a lot of the indices. Now, full disclosure, we don't own Micron.
Do you rebalance?
Yes, you do, because we did a lot in June, June 1, because of what happened in May. And so we had a couple positions that doubled in May, and then we rebalanced back. We don't own Micron, but it messed up some of the indices. For instance, if you take a look at the Russell 1000 value technology sector,
okay,
it was up over 100%. And come on, man. And Micron is a value stock. I didn't get that. But I mean, we underperformed the value index by 200 basis points. We were still up double digits. I mean, it's crazy. So yeah, you have to rebalance. We use drift in our portfolios, as you should, because you never try to outsmart the market. But
so
you
what's
need
drift?
Drift is you just let the positions kind of go over time. So if my core position XYZ is 4% and it goes to 4.75%, I'm not going to rebalance back to 4.
So when you rebalance, you don't sell the whole position?
No, because I think the biggest problem with institutional portfolio managers, and some of them took over our prior job, that own 200 stocks, guys, right? They have 200 stocks in these big fancy portfolios. When you run separately managed account portfolios, you're catering to Paul Sweeney, high net worth individual right here, and he's got taxable gains in all of these companies in these 50 stocks. If you blow out XYZ stock by owning it for 10 years, he's not going to be happy with you because you have a taxable gain. Well, if you're an institutional person and you blow out positions, you don't have that same thing. So on an SMA, like we run 40 to 50 stocks, period, we have low turnover, and you say if a position goes up to 6%, and you cut a half, you still own the position.
What you just heard there, folks, bronze it. We will have Belsky on Bloomberg Money, because what you just heard was the clearest discussion of the madness of selling all of a winner with the memory of Benjamin Edwards III right there. Bronze it on selling the top positions up. Let's go. When they talk about high net worth, they never look at me. They look at you. I don't know what that's about. Paul Sweeney with Brian Belsky.
What is your positioning in AI? How are you trying to play it right now? Is it still just own the chips or the picks and shovels, as people talk about? How do you think about it?
We've had the very honor of owning NVIDIA in various portfolios and various jobs since 2018 or so. So we're sticking with that. And we love the AMD. We love the Broadcom, Qualcomm for more value. But that's it. The key thing to investing is that you don't have to own everything. Right. You don't have to own everything. Have conviction and stick with it. But you know what I think people are missing is we're building out these data centers. So how do you build a data center, man? Well, people talk about Caterpillar.
Yeah.
Well, we like this company called Acuity. We own it in our small mid cap. And they make the tiles that go on top of the buildings between the ceiling and the top of where the tiles are, because in between that are the wires. The wires heat up. So Acuity makes these tiles that are cool enough to keep the heat. I mean, it's really, but people aren't thinking like that, right?
Yep.
And so stuff like that, or old school power companies like Nextera, because you got to plug in the power, or Southern Company. And so that's I think the next derivative down. I think the biggest theme though that some play is cybersecurity, because I just don't think people understand it enough. And that's why we own Palo Alto by far, I think, from our view, the best company in there. They've integrated in a couple of new acquisitions, one of them CyberArk the last year or so, that kind of took some time to get going, but they certainly got paid for owning CyberArk the last month or so.
No, but I do think rates are going higher, Tom, for a whole host of factors, a higher inflation risk premium, the need at some point for Treasury to raise more supply, and the fact that the market has really only priced about one tightening, and I could see potentially a series of tightening, so yields go higher.
Okay, Paul's got 8 questions. I'm going to get this one in quickly here. If yields go higher, price down, it can be ambiguous, good or bad. Orzag and Posen say you're going to see a higher wage, a higher real wage. Do you buy that optimism, or is it going to be stress?
It's possible. I mean, the AI, the productivity story could translate into much higher wages. The corporate share of income is high, so hopefully at some point that does flow to workers. I was very bullish on the economy and was talking in my prior role of a disinflationary boom, which seemed very reasonable until the Middle East war started, because I think that completely changed the dynamic. So yes, I'm bullish on I was bullish on growth in terms of being low and non-inflationary and rates coming down and the Fed easing. All that's kind of thrown by the wayside. In terms of what level of yields crack the system, we don't really know. It's really a liquidity and confidence story. Could be 475 on 10s. It could be 5% on 10s. And there's so many other dynamics at play. And as you're well aware, the narrowness of the market, the equity market, has been a handful of companies. And at some point, that exuberance may itself be stretched. So if the Fed's tightening, financial conditions suddenly tighten, risk appetite changes, and it can unravel quickly.
Joe, in your notes, you say inflation is a problem. I think most of our viewers and listeners would agree with you. How long is it going to be a problem, do you think?
That's a great question. I mean, when's the war going to end and how quickly can these bottlenecks stop? I mean, the way to think of this is it's a mini COVID. And I think that's what most investors don't understand, which makes me think yields go higher. When I say mini COVID, there's major supply chain disruptions. Yep. It's not just energy, it's nitrogen, which relates to fertilizer, different material that go into plastics, other sensitive commodities. And what we learned during COVID is you just can't turn wells off. You just can't shut this on a much, much smaller scale, but you can't just turn the system off and like a light switch, it automatically goes back. And the market is, I don't think the bond market isn't fully appreciative of that.
Joe Lavorgna, SMBC Nikko Securities, thrilled he could be with us today. And we continue here, I guess, with the arch idea, and you live this at the White House. This is a president who likes joint stimuli all the time. We've got a nominal GDP popping 5% plus, persistently there. We've got, inflation well above the Fed target and all that. Are we just living in a new stimulus-driven milieu and it goes until it goes?
We might, Tom, but if that's the case, then, inflation expectations need to be reset and you need a higher term structure rates to reflect the environment you just described. So it's either one or the other. Either the economy is going to produce non-inflationary growth, and eventually the Fed can get rates to neutral, or
that worked
we're
out.
in a regime where you've got rising debt to GDP, higher inflation relative to where the Fed's target is, and that would be, and the Fed's not cutting, and that's a higher rate regime.
Do you perceive that model as 100 basis point shift? Sorry, folks, jargon. A 1 percentage point shift up in the curve, or can it be more 60s-like and be a real shift into pre-Volcker?
Well, in the 60s, it was very, as you know, Tom, it was very gradual. You had cyclical, the floor on inflation saw higher cyclical floors as you move through the 60s into the 70s. Best guess, it's the latter, that it would be like maybe, let's say, 100 basis points repricing. It's a nice round number. But, could it be something longer? It's possible. I mean, in the last couple of years, inflation is running about 75 basis points above the Fed's target. We're going to go higher than that in the next few months. When could it end? Maybe by the fall. We'll see. I mean, I guess the question is, how disinflationary is AI in the short term? May actually be contributing to the problems we have through the data center build out and energy usage. Longer term is probably disinflationary.
We've got a new Fed chairman. Presumably he feels a little pressure to get rates down, but boy, the data doesn't seem to...
Great question, Paul. I'm going to make some news here. Are you interviewing for a position at the Fed?
No, I'm not interviewing for the position at the Fed. No, by the way, and I've gotten to know them. I think they're a bunch of Fed people. That was one cool thing about the job. There's a lot of super talented people there. Kevin Warsh will do a great job. I'm very confident of that. However, I don't see how Kevin's going to make a plausible case for rate cuts.
Yeah,
it's just not there. And if the market continues to price tightening, maybe he just pushes back against the committee that's certainly becoming, at least from the president's, more hawkish. Maybe he pushes back a bit, gets it more center, and then kind of hope for the best. Things maybe unfold in a positive way in the back half of the year. But right now, look at like the prices paid series in the ISMs. Yep. The New York Fed's got this global pressure supply index. I'm not sure exactly how they put it together, but the picture certainly shows these supply chain disruptions. That's all pro-inflation in the system.
So, again, is this inflation? I don't know. It just feels stickier to me than just the price of oil.
It is sticky. Well, you could see it if you look at like the San Francisco Fed. They've got the acyclical and cyclical price trends. You look at the Atlanta Fed sticky price index. Yeah, you're seeing it. Absolutely sticky. And by the way, it's been above trend. So, we've been well above, too, in a lot of these components. The super core that the former chair, Jay Powell, likes looking at has been running about 3.5%. Definitely sticky.
So, I mean, there's nothing the Fed can do, right? I mean,
no, there's nothing the Fed can do other than at some point potentially raise rates to try to slow demand. And the problem with raising rates to slow demand to bring inflation back to target, which right now it's probably going to be at least a point, if not a point and a half above target, is generally a recession. The question is, does the Fed want to do that? If the Fed doesn't want to do that, they implicitly change their target. You're going to be in a world then where rates are higher. You're going to have a steeper curve and higher yields.
Real treat for you across this nation and worldwide. Joseph Livornia with us today with this SMBC. Nico here with his service to the nation in the first Trump administration. Lots of good work, including serious fixed income chops with Deutsche Bank a number of years ago, also with the American First Policy Institute. What happens to the world you parachuted into after the president?
When you say that, you mean after the midterms?
Is there no? Not. Thank you. I should have made that clear. No, after his term. How does Trumpism carry forward after what you witnessed in the hallways?
The shift. There's been a real shift in the base, Tom. And we look at the polling numbers, and not a lot of very good pollsters. Richard Barris of the Big Data Poll, People's Pundit, actually is an excellent pollster. There's some others out there. And it does show a huge compositional shift in the base, where a lot of independents and others are not identifying
New
with
York
the
Times
Trump.
showed that in the last 24 hours.
And Rich actually made a very good point, and he's sort of, these pollsters are sort of like an inside club. But yes, New York Times Siena poll accurately now reflects what's happening at the moment, because you've got this affordability issue. That is a problem. I'm not sure exactly what happens. I mean, I don't want to say too much, but...
And I understand that, but I've never said this, Paul. Are out there somewhere, I sound like a Linda Ronstadt song, out there somewhere is the dreaded A word involved, austerity.
No, I don't think we're going to get austerity. Pullback? No, because as you know, neither party wants to actually do anything. And they didn't want to do it when we had Simpson Bowles over a dozen years ago. And right now, unless the bond market or the financial markets put the pressure point on, there isn't going to be a resolution, which comes back to, like you ask about Iran, which to me is a very important, obviously, development. I'm stating the obvious, but what's the pressure point for the president? Is it $6 gasoline prices, $7 gasoline prices? I mean, certainly with the stock market at all-time record highs and rates still relatively low, there isn't really a pressure point for the president necessarily to make a strong decision. So maybe just the option is just waiting and seeing. Maybe there's some sort of change in leadership somehow by luck or whatever it might be, but you just sit and wait and these things just drag on. But again, in that world, as inflation's moving up, your real funds rate is shrinking, and that by that metric, monetary policy is easing. Equity market's high, credit spreads are tight. I mean, there's a lot of financial stimulus that's offsetting this mildly higher interest rate story we're seeing.
And on the interest rate story, I guess when we think back to the tariffs last year, a lot of folks on Wall Street were saying, boy, 450 on the 10-year put some pressure on the White House, and they kind of started to back away a little bit from some of their initial tariff discussions. But boy, we've blown through that.
Yeah, but the S&P was down 15%.
Yeah.
Let's not forget, S&P was down 15%, and the president quickly pivoted, and the market had a massive rally, and we basically repeated the same thing this past year.
But that's the key observation. And, I don't need the inside dirt from the White House. It's rude. But the fact is, he is completely beholden to the stock market. Is it just simple? Is it just a simple mechanism where Secretary Besson or Undersecretary Livornia walks in on the yellow couch and says, "Hey, stupid, the Dow's down"? Is it just that simple?
No, I think the secretary does a great job giving the president advice, and the president certainly seeks his counsel, and he, I think, is a great voice of reason given his track record. But the secretary is just one person. And the president listens to a bunch of different people. He's got his own instincts and behaves in a way that he thinks is the right move. But certainly the stock market, Tom, is a dominant driver. And if the stock market were to correct any meaningful amount, that would impact policy, both probably more foreign policy-wise. I'm not sure what we can do domestically at this point, given the midterms are so close.
Yeah, so briefly, it looked like we were on track for a normalization in Hormuz flows by mid-May, when on that Saturday morning, we did see a big pickup in flows when on Friday, Iran did communicate that the strait was open. But then it turned out that very quickly flows dropped back again. And over the last 2 days, actually, flows have been lower, roughly 5% of normal levels versus a 10% of normal levels since the start of the war on average.
We've gone sometimes down from day to day, and headlines go back and forth and trying to make sense. And there are times markets react, and there are times markets are like, we're not going to touch this one. We're just kind of waiting. How do you know? How do you have the conviction that you think this is going to be going on for much longer?
Yeah, so in this environment where there's so much uncertainty about the geopolitical inputs, but then also the logistics and shipping inputs, I think the value add we provide to investors is tracking, nowcasting what's going on, and then mapping scenarios for supply, demand, and taking some geopolitical assumptions and translating that into price and trying to help investors, to think about those different scenarios. Our conviction is stronger on the pricing framework than on the exact set of geopolitical assumptions.
Go ahead, Carol.
But is there an assumption that, I mean, we've seen no talks this weekend. You're assuming, like, I think the latest we were talking about that maybe Iran offered opening up the strait and putting the nuclear and, the uranium kind of on the side for now.
The talks about the uranium.
Correct.
Not like, here's uranium, we're going to put it to the side right now.
I meant the talks, yeah. Like, just slide it around. But I mean, how do you gauge what to kind of trust? Because I think the thinking has been, it's going to happen. And one day it's going to be like, everything's fine, back to normal. It doesn't go back to normal quickly, does it?
No, especially on the production side. We actually think that even by December, the recovery in oil production in the Persian Gulf as a percent of lost supply will only be around 90%. So still 10% of the lost supply in our base case is not back by the end of the year.
Which is significant,
Absolutely.
right?
Yeah. We estimate that the world will lose cumulatively about 2 billion barrels of Persian oil production by year end. To put that in perspective, that is roughly 20% of global oil inventories in the whole world.
Wow. Okay, so demand destruction that we're seeing or will see as a result of this. I talked to a colleague last week who was set to fly to Cincinnati this summer to watch the Cincinnati Open. He loves tennis. You can get closer to the players than you can at the US Open. It all sounds great until he looks at ticket prices. To get to Cincinnati, he was saying it was like $600. He's now not going.
Yes.
And I thought to myself, that is demand destruction as a result of higher energy costs. What's the price tag you're putting on that right now?
Yeah, so the longer the Hormuz supply shock lasts, the more the rebalancing mechanism will shift from inventory drawdowns, which you cannot do forever, to demand destruction via higher prices. We are seeing pretty significant demand destruction exactly in the jet fuel aviation market, also in petrochemical feedstocks, especially in Asia. And we do think that if this lasts longer, that the market may have to rebalance via significantly higher product prices as opposed to crude prices. Ultimately, product prices are what consumers and businesses ultimately pay. Our Brent upgrade to $90 per barrel by the fourth quarter. That's $30 higher almost than our forecast before the war. That would be even higher, around $100 per barrel, if we did not incorporate some significant demand losses. We now look for global oil demand to stagnate. Even if at the start of the year, we were looking for pretty solid oil demand growth, just above 1 million barrels per day.
Okay, so let's pull out a little bit further, Don. Do you expect that there's going to be, and of course, Europe and Asia impacted differently from the United States, but eventually it all trickles down.
Exactly.
So is a global recession, a part of this?
That's not our base case.
Okay.
But if you go to the severely adverse scenario that we consider, where you get 1 month of additional delays in normalization of Persian Gulf export flows and some damage to oil production capacity, either damage to infrastructure or the possibility that the strait never opens more than 70%.
Whoa.
In that scenario, we see Brent at 120, even by the fourth quarter. Product prices arguably would be significantly higher as well. And in that scenario, the probability of recession for various economies goes up. I would say especially in countries that are more vulnerable, EM Asia, EM Africa, frontier economies, potentially some European countries as well.
We'll look at Pakistan and the way that Pakistan has this vested interest, not just from a national security and economic perspective in getting this war done, but from a diplomatic perspective as well. I mean, you look at what's happening in that country. You mentioned Europe. What countries in Europe do you think could be most affected?
In Europe, with the exception of Norway and the UK, everybody's a major net importer of oil and gas. From a natural gas perspective, Italy is the most vulnerable, whereas countries such as, for instance, Spain have made a lot of progress in increasing the share of solar and other renewable sources in their power stack. But overall, Europe is pretty vulnerable.
What about here in the United States? Because we're still, even though we don't rely on oil from that travels through the Strait of Hormuz to the same extent that other countries do, we're still seeing WTI up over $96 a barrel right now. Anyone who's filled up their tank knows that we're not,
especially diesel, close to $6.
Especially diesel, and the flow through on diesel to all the products that we buy. Produce, other cargoes. What's the effect on the U.S. and sort of how long does that go?
Yeah, so initially the surge in refined product and crude prices was very much an east of Suez, eastern part of the world phenomenon. But when you see shortages, when you see extremely high prices in the Middle East and Asia, markets do their work and they bring, for instance, diesel and gasoline and crude from the US to the east. And we have seen pretty sharp drawdowns in US refined product stocks in the last couple of weeks. In fact, the US is pretty much at full export capacity for crude and products. We're starting to face some pipeline constraints, port constraints. And so the more the US exports, that provides some relief to the rest of the world. But it sort of narrows this gap between prices in the rest of the world and the US. It's a pretty global market, the oil market, different from the gas market.
Yeah, I love that you went there. I am thinking about lessons on the other side of this. I'm going to make the assumption that at some point we do get to the other side of this. I think about COVID and what we learned about global supply chains. What do you think are the lessons that we will ultimately learn off of this?
The need to invest in several energy sources to diversify supply in a world where supply concentration is high, where commodities are often used as a source of economic and geopolitical leverage. You may argue that it could accelerate the transition to commodities that you can produce at home, such as solar.
Renewables, right?
We've been hearing perhaps
this a lot.
Coal.
Yeah.
I also suspect that many countries will follow China's path in building very high strategic reserves, not only of oil, but of plenty of critical commodities that you're importing from the rest of the world.
But there's also a lesson for Iran here. And that is how powerful it is to close the strait and the power that it has over the rest of the world as a result of this critical waterway.
Yes. It was interesting that one of the Indonesia policy officials did mention that they don't rule out starting to consider tolls for the Strait of Malacca. So I think how this conflict is settled may set an important precedent for future management of waterways.
On that, just quickly though, if you're charging on all the oil that comes out of the Gulf, that automatically then is going to increase the cost, right? Or no? So the burden will ultimately be either on the Gulf producers that produce oil at pretty low cost. So you could imagine that their margins get reduced. Okay.
The other potential impact is higher prices for the rest of the world.
For the rest of the world.
Yeah.
Hey, before you go back to sort of the beginning here and you thinking what the fourth quarter price of Brent's going to be, at what point will you say, I'm comfortable lowering my price prediction there or raising it? Like at what point, it's April 27th right now. So when will you say we either have to raise or lower this thing?
Yeah, I think if the supply or demand fundamentals significantly surprise our base case, I could imagine upgrading the forecast if supply takes more time to normalize. I could imagine lowering the forecast if supply comes back more quickly. But I think our base case is already, close to a realistic best case possible. One scenario where you could see a downgrade is if demand losses are bigger than expected. Now, that could be a mixed bag for the global economy. If that's because we work more from home, we switch to other energy sources, the damage to GDP could be limited. A little bit like during COVID, human ingenuity limited the damage and allowed to recover quickly. The flip side could be if it's as a result of weaker GDP, especially in frontier economies, it's bad news for the global economy.
We got to start with the, I keep calling it the backdrop to the trade, but that's what it is. And it's high energy prices. And it does seem like traders are looking beyond the war, yet it's hard for a lot of people to say, there is a clear end to this. How are you looking at that?
Thanks for having me on, Tim and Carol. Well, we do a ton of research on energy. I founded an energy company, and our first ETF, AMZA, is a pipeline company. So we have a global supply and demand model. And so the way we framed it is there's a good rule of thumb that works extraordinarily well, which is every million barrels of lost capacity is $5. So if you frame it that way, if the Strait was shut down forever, then the oil price would be about $140 a barrel.
Okay.
So, because, there's elasticities of demand or sensitivity and supply. And, we started out roughly at 60. And so our point since the beginning of the war is that 100 is probably going to be an inflection point, because there's almost 100% certainty at some point the Strait will reopen. You essentially have every country in the world who wants to have it open. Now Iran, so we think that's a good strategy to blockade. Yeah. Probably not Russia, but that's not that important. So what we always try to do is look longer term. So at some point the Strait's going to be open, and so we're bullish long term. And we were bullish in mid-March because there's a cycle of fear and greed. So greed occurs during earnings season, like now, and fear occurs when there's no earnings, and you have hedge funds and other momentum investors typically overshorting stocks like KKR, for instance, in our opinion.
Yeah.
And a lot of the tech companies. So that's why we all have jobs, is that you have these inefficiencies in the markets.
So you're saying, though, longer term, you assume this year that the Strait will reopen, and probably sooner rather than later in your view, because Iran is feeling the pressure, the price. And even though we had an earlier guest who said they're used to an economy that's just decimated and having problems, and so maybe their threshold for pain is greater, there's a reality that they need the Strait open.
Absolutely. And the other Middle Eastern countries do. Pakistan wants it open. They're mediating. So we just try to stick to the most likely case and not all these outlier cases like, the Strait never reopens and we'll sell all of our stocks, and then you miss out on big rallies.
I think the concern for some people is the Strait opens, but Iran continues enriching uranium, and the U.S. and Israel don't want to see that happen.
Right.
So then you're sort of back to this, what you had before the war, yet the leadership in Iran has been decapitated by whatever measure you want to use. And that economy has been severely destroyed. And you have a military operation that has cost the U.S. untold hundreds of billions of dollars, tens of billions of dollars at this point.
Well, the way we see it unfolding is we do think it's a good strategy to blockade the Strait. So we actually went long the futures when they were off 70 handles over the weekend. I think it was last weekend or the weekend before. But if that doesn't work, we think that the Strait will be reopened by force, possibly using ground troops.
Really?
So that there isn't going to be a case where the uranium still stays there, that will destroy their energy infrastructure, use ground troops, and just open it up.
So it escalates.
Right.
Before it ends.
Yeah, so that would be a negative inflection for the market. We kind of saw that yesterday,
How negative, though, and how long does it last?
Because of this target and the fundamentals, which we can get into, we think it'll be a pretty shallow dip, like it really was. Like actually March's activity in the stock market was super bullish, because that's the best you can do for a sell-off in the U.S. at least. Then that means that we're probably going to go higher when things settle down.
So that's why you're holding to that 8,000 target.
Well, actually, it's valuable to come on and do appearances, because I don't really always love doing appearances, so I try to have good data. So I use this thing, I don't know if you're aware of it, but it's called the Bloomberg Terminal, and you can get consensus.
Know it well and love it well.
Yeah, and it's sort of definitive because people like me use it. So, and there's a great function, SPX Index EEO Go, and I set it to annual. And I said, oh my God, of course we should do this more often. We based our 8,000 target on 350, and it's now 375, and you can even click on it. I'm doing that now, and you get this fabulous chart of what happened. And you see I guess it's the yellow line. No, it's the purple line. It just took off like a rocket. And so actually my 8,000 target is conservative based on our assumptions about interest rates. So at 375, if we get there, we're far away.
complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
The Ebola outbreak in the Democratic Republic of Congo is poised to become the second largest on record within days after more than 850 new confirmed infections were reported over the past week. For more on this story, let's bring in Jennifer Zapasaja, Bloomberg's chief Africa correspondent in Johannesburg for us. Jen, we're seeing a spike in cases over the weekend. What can you tell us about what is happening there when it comes to the Ebola outbreak?
Yeah, Abir, we are seeing this recent outbreak spreading faster than we've seen from previous outbreaks. By some accounts, it's spreading almost 3 times as fast as the Ebola outbreak in 2014 to 2016. Now, what we've seen over the past 2 weeks is that we've seen the death toll nearly double right now. The count looks like it's the case count is up to just about 3,200 people. That was on Saturday, with 856 new infections reported over the past few days. And the death toll has nearly doubled in the last 2 weeks now to just over 1,400 people. And so what we're hearing from officials on the ground is that surely this is, of course, highlighting the scale of the epidemic and, of course, the severity for many people. But, of course, it's also pointing out that we have been able to track infections more clearly. But still, there are quite a lot of challenges on the ground, which we've been hearing. Containment efforts are still difficult. We've reported on the fact that this area is still very porous with people going back and forth through the borders quite often. There's artisanal mining that has become a difficulty, and also cross-border trade. And so at least trying to contain this has become difficult for people on the ground. And so while perhaps we are seeing more infections being able to be counted, it is still quite severe, and especially as we're seeing these numbers continue to go up, especially considering there is no vaccine at this point in time.
All right, Bloomberg's chief Africa correspondent, Jennifer Zapasaja, keeping an eye out on the unfortunate situation there. Now, we also are expecting a busy week ahead for European banks that are set to deliver second quarter earnings results. Barclays will be a key focus as investors look to whether the UK lender will benefit from frenzied equities trading that boosted Wall Street banks. For more on everything that is happening there, now bringing in Bloomberg's Charlie Wells in London. Charlie, good to have you on this morning. What more can we expect from Barclays results later today and the wider sphere of the lenders there?
Well, the environment has been pretty good for a lot of these large lenders across the globe that we've been seeing as these earnings have been coming out. And really, over that past quarter, it's that global volatility that has really been boosting a lot of these trading desks across the world, basically giving a lot of momentum to some of these firms which have really been able to kind of benefit from the volatility. We're expecting that for Barclays as well. Their trading desk is expected to bring in north of $3.3 billion in that quarter. Now, that's a great number. number, and we're going to want to watch when these results drop, but compare that to some of these U.S. lenders, right? So JP Morgan, Goldman Sachs, their trading desks brought in some $12 billion each. So again, the comparisons there are really tough. Another factor that's really kind of bringing in a boost for a lot of these banks, and could for Barclays as well, is the rate environment, right? The sort of higher for longer environment that actually could help Barclays in some of its key profitability targets. So those two factors, volatility and rates, really could help Barclays today.
All right, Bloomberg's Charlie Wells keeping on top of those earnings that we're expecting later today. Now, for a look at where equity benchmarks are sitting before we head towards the end of our show, we're taking a look at S&P futures, 0.3 lower, NASDAQ 100 futures about 0.8 lower, Dow Jones futures not doing much, and Euro Stoxx 50 futures also not doing much this morning. Now we're keeping an eye on the AI story. We're keeping an eye on the 4 Mag 7 companies that are set to report, the FOMC meeting that is happening on Wednesday. We're also expecting other central bank decisions, including the BOE and the BOJ this week as well, though no changes are expected in terms of policy or rates there. And then we're also keeping an eye on oil prices that are dropping this morning because of that de-escalation in the Middle East, and President Trump saying that a deal with Iran is still very much possible. But that is it for Horizons Middle East and Africa today. Stick around with us for Daybreak Europe. This is Bloomberg.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in this space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see, the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent, but when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. The chip rout deepens, sending global stocks lower. Double-digit declines in SK Hynix and Samsung, pushing Asia towards correction territory. Oil and gas, meanwhile, fall further as President Trump says there's a good chance of a deal with Iran. Tehran, though, denies formal talks are taking place. And a fashion fail for luxury giant LVMH as sales disappoint in its key division. We'll bring you the numbers from European corporates, including Barclays, Mercedes and Unilever. Well, a very good morning. Here's the picture in markets this Tuesday. We have to start in South Korea because the Kospi's been halted twice so far this session on declines of more than 8%. Currently, the Kospi down nearly 10%. And that puts the broader MSCI Asia Pacific Index set for a correction. Now, the bad vibes for chip makers are going global. Europe less exposed, of course, to tech. So Euro Stoxx 50 futures only down or flat to the downside. But Nasdaq futures down 0.8%, also on concerns about circular AI funding. Now, flip the broad cross asset and you can see all of this is despite oil falling even further on President Trump pausing daily strikes against Iran, saying that there's a good chance of a deal with Tehran, even if Iran disputes that. So Brent extending yesterday's decline, the biggest decline in more than 3 months. We're down another 1.3% to $87 a barrel. WTI flirting with $80 a barrel, and Treasury yields have been dropping as a result. The 10-year down 2 basis points at 4.62, setting up Kevin Warsh's second meeting at the helm of the Fed. Plenty ahead. Let's get you started. We begin with breaking earnings out of Germany. Mercedes reporting its second quarter results and the car maker lowering its full year guidance, citing weaker demand in China. Of course, you've seen this prolonged property slump there and that undermining consumer sentiment and curbing demand for luxury vehicles. So some of the key numbers here, they see their full year revenue slightly below the prior year. They had seen flat year on year. Second quarter sales coming in at 32.06 billion euros, just shy of the estimate. Adjusted EBIT for the second quarter, 2.3 billion euros. That's actually a beat on the estimate of 1.72 billion euros. So really, this had followed BMW already lowering its profit guidance in June. So Mercedes not able to preserve its own. This theme of China weakness really plaguing the European car makers this morning, but in particular the downturn in China putting pressure on the CEO of Mercedes, Ola Källenius, his push to take Mercedes further up market, making the company more dependent on wealthy buyers, just as China's economy is losing momentum. Difficult times for the company, as you can see. But now let's turn to broader markets, and stocks in Asia slumping this morning as a global rout in chip makers continues to deepen. Let's go straight to Avril Hong in Singapore. Avril, just take us to the root of the sell-off that we're seeing this morning. What's going wrong in South Korea?
Yeah, I mean, this is the global backdrop that you're seeing, right? Those concerns about the circular nature of AI financing at the time where China seems to be making a lot of progress on lithography manufacturing, reportedly at least. And that is the double whammy you're seeing for Asia stocks. As you highlight, South Korea, you're seeing the region's benchmark, though, down about 10% from the June peak, so correction levels. And think about as well how it's not just South Korea, the Nikkei, the TAIEX, they're also getting hard hit. But to your point, the circuit breakers have been rolled out in South Korea today. Let's flip the board and take a look at this next chart. I just wanted to highlight the size and the scope of the selling. So today you're seeing the Kospi at these levels. They are almost the worst session we've seen it at since the month of March. And if you think back to the losses that is already accumulated since the June highs, that is about 30+%. Roughly in that time, the stock of SK Hynix has lost about $570 billion in market value. And I think one analyst really put it best today that the greed has turned into fear for AI investments, and the year's biggest AI winners are looking very much like losers today. Now flip the board again. As for the progress that China is making on lithography manufacturing, I know you guys got a teaser a taste of that with the ASML declines in the Europe session. This is the Chinese read-through. We're seeing the lithography stocks, they are rallying, some of them by limit up 20%. But think about how for these Chinese chip makers, with such progress, there could be more capacity, and that could also put compression on the valuation. So you're seeing a lot of them coming under pressure in trade today, with Hua Hong Semiconductor leading those declines. Lizzie.
Avril, thank you. That's Bloomberg's Avril Hong. And let's dive more deeply into tech, shall we? Nasdaq futures also pointing lower, pointing to further tech weakness on these concerns about circular AI funding, including $750 billion worth of deals announced by NVIDIA. Now, it adds to the increasingly interconnected web of dependencies between tech manufacturers and AI startups. So let's get more now with Bloomberg's Anthony Stevens. Anthony, we already saw NVIDIA knocked off its perch as the world's most valuable company yesterday. How can NVIDIA make sure that the AI build-out continues without stoking worries about circular financing? Good morning.
Morning. Yeah, to some extent, some of these dynamics are out of its hands. What it's trying to do at the moment is to use its amazingly cash-rich balance sheet to kind of backstop some of its fast-growing customers until their own organic cash flow starts to pay for this data center investment. Now, the most of the data center credit is starting to struggle here on the CDS market. That's because people are concerned whether these data centers can pay for themselves, given how resource efficient the Chinese LLMs are starting to become. So that's really out of NVIDIA's hands. The efficiency gains made by the Chinese, whether those prompt increase usage of AI or it reduces the size of the pie available for data centers, that's largely out of NVIDIA's hands. What it's trying to do is to kind of help balance sheet short-term constraints of US LLM makers that are its key customers. Also, it is helping kind of other data center providers down the road in easing their financing concerns. So they're being a good citizen in the non-Chinese part of the AI ecosystem, but they have precious little control over the open weight Chinese part of the ecosystem, and it's developments there that are starting to really take on this flavor of increasing momentum on both the hardware and the software side that is starting to worry people on the CDS front from a fundamental level and from a supply front from the supply level, as Avril was hitting on the semiconductor space.
Well, yeah, just talk to us a bit more about the Chinese threat to European tech, because we also saw, as Avril highlighted, ASML shares hitting their lowest since early June yesterday, dropping more than 8% in Amsterdam on this report from the information that a Chinese state-backed company had started making precision chip-making tools, ASML's specialty, of course. How big of a threat are these DUV machines to ASML, Anthony?
Yeah, so deep ultraviolet technology is one step below ASML's top-of-the-line technology of extreme ultraviolet technology, right? But it provides the vast majority of chip-making etching. So a lot of DUV is needed, and then a tiny sliver of EUV goes on top of it for the top-of-the-line GPUs or HBM. So what is happening here is more that people are pricing in that China knows how to make these DUV machines and can start to work down the line of producing components such as MLCCs, substrates, and DRAM, NAND, all the stuff that is just one step removed from the absolute top of the line. Now, at the moment, even at the extreme of this reporting that China can produce 20 machines into 2027, this is a tiny sliver of ASML's sales. It's more the momentum of the technology progress of China that is catching the eye. It's starting to build pace across the software and the hardware ecosystem, and that is starting to replicate the moat that NVIDIA and ASML had in the Western ecosystem, a combination of hardware and software together. And that is what's causing the panic reaction, not only in ASML shares, but in all of ASML's suppliers and customers in Asia.
Super helpful context. Anthony, thank you so much. That's Bloomberg's Anthony Stevens. Well, let's turn to the macro now, because the Fed is set to begin its two-day policy meeting today. Markets pricing a near 40% chance of a rate hike this week. And Citadel Securities says it expects a move higher, warning markets against underestimating the extent of the Fed's hawkish shift. You've also got analysts at Bank of America and JP Morgan seeing the central bank's commentary pushing yields higher. Well, let's bring in Ben Ram, cross-asset strategist at Bloomberg MLive now. Ben, I'm looking at Brent lower again today, down 1.3%, $87 a barrel. And yet, the chance of a Fed hike this week is edging closer to a knife edge. Do you buy the argument that a move this week is needed for Fed credibility to prevent inflation becoming more entrenched?
Morning, Lizzie. I absolutely buy the argument that the Fed should be raising rates. What we are seeing in crude prices have tumbled for a third straight day, yes, but it is the longer-term trajectory that matters. And as I was saying yesterday, the average price of Brent crude is something like $88 a barrel this year, as opposed to $68 a barrel last year. And that's what matters for importers, and that's what matters for manufacturers' input costs. And the Fed, by its own admission, thinks that inflation core PCE is going to be 3.3% this year, and it also sees above-trend growth. Those are conditions. Given those macroeconomic projections and given what has happened to crude this year, they should absolutely be raising rates. In fact, you could argue that the rates are no longer restrictive. So they need to raise the rates ASAP, and whether they will do it or not today is the million-dollar question. As you said, that Citadel Securities is calling for the Fed to be raising rates, but if they did that, Kevin Walsh would immediately increase his credibility in the markets. Of course, the markets were thinking earlier that, he's Trump's man. Is he going to be able to stamp out inflation? But what we've heard from Kevin Walsh is all undoubtedly hawkish, and he has said before that running inflation above 2% is a choice that we make, and now is the time for him to prove that he means what he says, and therefore it's a golden opportunity for the Fed to be raising rates. And if they raise rates, they will set a cat among the pigeons in the markets. Bonds will sell off, yields will move higher, shift vociferously higher, and that will rattle through the other markets as well.
Ben, thank you. Indeed, President Trump, even just yesterday, saying that rates should be lowered, reiterating that position. Ben, thank you very much. That's Ben Ram, cross-asset strategist at Bloomberg MLive. Well, let's go to the heart of the oil and gas price declines. President Trump saying that the US and Iran are engaged in diplomatic talks to end the conflict in the Middle East, even as Tehran has said that no formal negotiations are taking place. But Trump also warned that the two sides would return to fighting if negotiations don't result in a deal.
They want to meet, and we're meeting. We'll see what happens. There's a chance we can make a deal. Without what we did, they wouldn't even be talking to us. They requested a meeting through their surrogates and directly. And we're meeting, and, good things can happen, I guess.
Let's get more detail now with Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar. Abir, Trump says give talks a chance. He's set to meet Israel's Netanyahu today. How likely is a deal with Iran looking right now?
Good morning, Lizzie. That's a very good question, a difficult one to answer at this point now. As you heard, President Trump was just saying that a deal could happen, yet another breakthrough. He did say that if it doesn't happen, they'll go back to hitting Iran just like they were. So, look, this back and forth is kind of the name of the game. It's what we've been seeing happening over the past 5 months or so. President Trump had said multiple times over the course of this war that a breakthrough is possible. That came in the shape of the MOU that was signed in Switzerland about a month ago at this point. But then we saw the escalations happening in the region. 13 consecutive nights of strikes by the United States on Iran that ended on Friday, Lizzie, without any explanation. Now, we know that Axios reported earlier this week that Admiral Brad Cooper, that oversees the operations in the Middle East for the United States, said that the attacks needed to end because they were no longer effective. Now, this is Axios citing their own sources. The New York Times also reported that the United States had halted the attacks because it was running low on ammunition. President Trump said the U.S. has more than enough ammunition, but that he would like to have more. So you're seeing, again, this back and forth in all of this. We know that Bloomberg reported a scoop about Iran and Oman meeting to discuss restarting movement through the Strait of Hormuz. And so this is at the heart of all of this, the Strait of Hormuz, but also the Red Sea. Lizzie, we're seeing parallel movement between the Houthis that are Iran-backed in Yemen hitting facilities in Saudi Arabia. We also reported a story about smoke coming out of a major energy facility in Saudi Arabia, Upcake, and that exports about 7 million barrels a day. Now, we don't have confirmation from the Saudi side as to why that is happening, or if it's true that the Yemeni, the Houthis in Yemen had in fact attacked it. But then we're seeing all this movement. Actual tangible conversations between Iran and the United States are not yet reported. And so to answer your question in a nutshell, could a breakthrough, yet another one, be happen? Possibly. We're not seeing signs of that happening. We're keeping a close eye, first and foremost, on the Strait of Hormuz and the movement there, to be able to determine whether whether oil markets are interpreting the moves there the right way. For the time being, movement there is pretty much paralyzed. Ship owners are still having to go through Iran and the United States to seek permission on whether to go through the waterway or not. And so this is the reality of the situation on the ground, despite Brent crude prices below $90 on the barrel this morning.
Abir, thank you so much. That's Abir Abu Omar on the latest developments in the Middle East, our Horizons Middle East and Africa anchor, of course. Well, let's turn to some of the risk events on the agenda for today. At 7 a.m. London time, top of the hour, we'll get more earnings from Barclays and Unilever. Given we've already seen blowout results from Wall Street, we are looking to see whether Barclays can beat trading revenue expectations, even if they still trail US rivals. Unilever's volumes, meanwhile, could be under pressure from those elevated oil prices that Abir was discussing. Staying in retail, also at the top of the hour, we'll get German retail sales numbers. And then at 3 p.m. London time, we'll get US consumer confidence data, expected to have weakened in July on those Middle East tensions, pushing gasoline prices higher and, of course, adding to uncertainty. But still ahead on Daybreak Europe, wildfires in France and Spain stabilise, but a new heat wave looms. We'll get you more from the region later on in the show. But first, Ukraine's president heads to a meeting with President Trump in Washington after securing jamming technology from the UK. We'll get you the details next. This is Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome back to Bloomberg Daybreak Europe. Now, the UK has agreed to share technology that can jam Russian air defence systems with Ukraine. The agreement to share the so-called Stone Cloak system came as the Ukrainian President Volodymyr Zelensky became the first foreign leader to visit Britain for talks with new Prime Minister Andy Burnham. Zelensky now heads to Washington, where he's expected to meet US President Donald Trump. And we can get more from Tony Halpin now, who leads Bloomberg's Russia government and economy coverage. Tony, good morning. I mean, Zelensky's had a tough time at home recently, hasn't he? What does he need to bring back from these trips abroad?
Well, I think a couple of things. That jamming system from the UK will be very useful for Ukraine in helping to increase the effectiveness of its long-range drone strikes in Russia. It's been targeting things like oil refineries, defense plants, logistics centers to try and step up the pressure on Vladimir Putin's economy. And as you say, he's meeting with President Trump this morning in Washington around 9:30 DC time. He's looking there really to cement the warming in relations that has happened recently between him and President Trump. He's hoping to discuss more support for air defenses for Ukraine, because while Trump's given him opportunities to produce Patriot missile systems in Ukraine, there's clearly going to be a time lag, and they have a deficit now that they're hoping to fill with more supplies. And things like increasing sanctions on Russia, again, to intensify the pressure on Putin, try to bring him to the table to bring a negotiated end to this war.
Yeah, for now, no sign, it seems, of a resumption of that US-led peace negotiation between Russia and Ukraine. Anthony Halpin there, thank you so much for the latest on the situation in Ukraine. But coming up, a fourth summer heat wave brings renewed wildfire danger to Spain and France. I'll get you the latest from the region next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, wildfires in France and Spain that forced the evacuation of more than 300,000 people have stabilised, but the start of the summer's fourth heat wave means little respite for emergency services. During a visit to Bordeaux, the French president underlined just how unusual the circumstances are.
Firefighters from across France are on the ground with around 20 firefighting task forces, unprecedented aerial resources, and more than 1,500 military personnel deployed. We are facing events we have never experienced before.
Meanwhile, the Spanish government says that the situation remains very, very complex. Let's bring in Bloomberg's Madrid bureau chief Rodrigo Orihuela now. Rodrigo, good morning. Just talk us through the extent of the damage seen in Europe so far.
So, as you mentioned, it is quite unprecedented. One of the officials in France was saying in recent days that these are a type of fire that maybe are more common in places like Canada and Australia, but are rare in France. They're also rare in Spain. So it is something that people are not used to. The Interior Minister in France yesterday did make the point that he is not being reassuring, and he is making a point of not being reassuring because the fires continue to exist. They continue to blaze, and he doesn't want, and until they're not off, he cannot say he cannot be reassuring. The final point, just as a sign of a kind of size and scope, in Spain, this is already the biggest fire ever. The one of the specific fires, the one in the region of Avila, west of Spain, of Madrid, which is heavy in forests. That fire itself covered about 55,000 hectares. And that's the one that's the biggest ever. This specific one is contained, but others continue, and firefighters are still at it. And the main issue, to my final point, as a final point, is that today the heat wave in both countries is supposed to come back.
And yet, the Spanish Prime Minister Rodrigo is saying that summers like this are the new normal. I mean, the scenes that we were just showing on the TV are hellish there. Are they likely to provoke a bigger rethink, greater policy action when it comes to climate issues?
Well, it is certainly something that the Spanish government has been talking about for some time. Obviously, in this specific case, it's so big that it brings it more to the forefront. It is also close to Madrid, which makes it easier to or draws more attention, the same as the French one, which is near Bordeaux. So a lot of attention is focused on it. Some people have been speaking about the size of these fires a lot for a while. The Spanish Prime Minister has called for what they call in Spain a national deal to fight climate change. But the other party on the other side has already said now is not the time to talk about this. So the question there is, will there be a rethink, as you say, or not? I think the answer lies in how open are parties to discuss climate change and its impacts, which seem to be the main reason behind this, and also spending in a way that is not visible. A lot of the spending and the prevention work has to take place by cleaning forests and woodlands and scrublands during the winter and spring months, and that requires certain investments which it's not clear that everybody's open to making at this stage.
OK, Rodrigo, thank you very much. Bloomberg's Rodrigo Orihuela, thank you so much for the update there on the wildfires. Now to some of the stories we're following for you this morning. Bloomberg Economics says that French consumer confidence data out later today is expected to show a gradual rebound in the second half of the year. Consumer confidence is at its lowest in more than 3 years, but the figures will offer an early signal of the effect of those successive heat waves. GDP data out on Thursday is expected to show the French economy avoiding recession. Well, those are some of our top stories this morning. But coming up on Bloomberg Daybreak Europe, why the latest LVMH results suggest the summer season could be an uncomfortable look for European luxury. That's next. This is Bloomberg.
The world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric
and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Lizzie Burden with your top stories. The chip rout deepens, sending global stocks lower. Double-digit declines in SK Hynix and Samsung, pushing Asia towards correction territory. Meanwhile, oil and gas fall further as President Trump says there's a good chance of a deal with Iran. Tehran, though, denies formal talks are taking place. And posh products under pressure. Mercedes cuts its full-year revenue forecast while sales disappoint in a key division of LVMH. Both companies pointing to weakness in China. Well, a very good morning if you are just joining us. 6:30 a.m. here in London, and we have to start this market check in Korea. The Kospi down 10.6% as things stand. It's been halted twice so far this session on declines of more than 8%, and it puts the broader MSCI Pacific Index set for a correction. Now, the bad vibes, as you can see, are going global. Eurostoxx 50 futures down 0.2%. It's less exposed, of course, to tech, but Nasdaq futures down more than 1% now, also on these worries about circular AI funding. Now, flip the board cross-asset, and you can see all of this is despite oil falling even further today on President Trump pausing those daily strikes against Iran and saying that there's good chance of a deal with Tehran. Tehran denying that, as I say, but Brent down 1.2% to 87.30 the barrel this morning. WTI flirting with $80 a barrel, and Treasury yields dropping as a result. So we've got the 10-year yield down 2 basis points at 4.62, setting up that second meeting of Kevin Warsh as Fed chairman. Now, let's turn over to the front pages this morning, starting with the Financial Times. It leads with the AI stock sell-off, saying it reflects growing investor doubts about the durability of big tech spending on AI infrastructure. Meanwhile, if we come to Europe, we can look at Les Echos out of France, saying that French industry is on the front line against those wildfires we were just discussing with Rodrigo in Gironde, with defence, energy and chemical companies taking measures to protect their strategic facilities. Finally, if we look at the Wall Street Journal this morning, it says that Meta is fighting a mountain of social media lawsuits at just the wrong time. The paper saying that the litigation could cost Meta billions just as it's going through an expensive AI transformation. Well, you can get a roundup of all the stories you need to know to get your day going in today's edition of Daybreak, which Terminal subscribers can find by going to DAYB Go. Now, let's turn back to earnings, specifically in the luxury sector. LVMH's key fashion and leather goods unit, home to Louis Vuitton and Dior, barely eking out sales growth last quarter as the conflict in the Middle East has deterred wealthy shoppers. Organic sales at the division, the group's most profitable unit, rose 1%, missing the 1.52% estimate of analysts surveyed by Bloomberg. With me now to discuss is Yelena Sokolova, senior equity analyst over at Morningstar. She joins me in studio. Good morning to you. So let's start off with LVMH, because you've actually got LVMH as a top pick, I note, despite these results we saw yesterday. The share's down about 28% so far this year. What are you seeing that investors are missing?
Yeah, so I think we at Morningstar would like to take a long view of the companies, and we do think that the company still has exceptional quality of the business. So it has one of the most profitable, the most prominent brands in fashion and leather, of course. sorry, with Louis Vuitton. It also has absolutely massive communication budget, which which is above all peers, and which makes the company being able to reinvest behind the brands to support their standing. Of course, longer term, if you look at longer term pictures, fashion and leather goods division actually outperformed the industry for the last 10 years. It delivered double-digit growth versus kind of 5% performance for luxury goods. So current decline for the last 2 years for this division comes on the back of extremely difficult comparison base after the pandemic. That's also something to bear in mind.
So how patient do investors need to be to see, for example, the hiring of Jonathan Anderson at Dior bearing fruit?
Yeah, so typically we see that after new designer hires, the results start changing a little bit after a year or a year and a half. So we are about entering this territory now for Jonathan Anderson at Dior. And notably, the company also said that Dior actually outperformed the fashion and leather division sales overall. So that's an improvement. So there is a little bit of improvement so far, but of course it's not sort of yet very meaningful.
I'm glad you mentioned leather, because a big question I want to ask you is whether you think that the Haaland effect is going to be real. We've seen the footballer Erling Haaland with his Hermes man bag. Is that going to show up in results down the track?
Yeah, so that remains to be seen. Also, we have seen male athletes increasingly wearing jewelry that supported also jewelry sales before. So that could be, of course, another kind of leg up to the industry. Of course, Haaland is especially popular with female viewers rather than male viewers so far. But of course, another influencer, kind of genuine celebrity supporting brands could be supporting factor.
And you mentioned jewelry. Are there other bright spots outside of what's becoming known as hard luxury?
Yeah, so hard luxury has been actually a bright spot so far this year. We have seen strong results from LVMH's watches and jewelry, but specifically from Richemont for its jewelry divisions, but also for the likes of Swatch, even delivering quite a nice growth. So we kind of see a broad shift from soft luxury, where maybe pricing has been a little bit more aggressive immediately post-pandemic. Consumers basically are shifting to jewelry and watches where they perceive lasting value.
So you're broadly very optimistic on the luxury sector, despite the headwinds from the Middle East and what we've seen as weak Chinese demand. We were talking about that in the context of Mercedes. Why are you seeing these signs of stabilization?
Yeah, so historically, luxury downturns lasted about 2 years. We're now in a third year of kind of softness here. We do see initial signs of recovery. So the recovery so far is driven primarily by the U.S. market, where we see both supportive equity markets so far, which, of course, given recent trends, remains a risk in itself. But so far, the results there are supportive. They come also on the back of much easier comparison base, because there has been a spike after the pandemic, and then it went down, and now basically the growth is from a healthier base. I still see potential for Chinese consumer resumption of purchases, because they are still sitting on those savings once the real estate situation stabilizes and sentiment improves. So we see very, very early indicators of that happening. And of course, you have wealth created in different sectors, AI being at the forefront of it.
Well, on that point,
yes.
I mean, surely a lot of people might lose their jobs because of AI. So how can we be sure that that won't outweigh, the wealth effect, where people make money off AI and they buy luxury goods with that money?
Yeah, so that could be an offsetting factor. So that is a risk for the sector, the kind of the dampening factor of AI on high wage employment specifically, because of course higher wage employment would be most affected if that happens. We already are seeing it on the entry levels with entry level positions with some jobs. So of course that presents a risk going forward for the sectors. But on the other hand, there will be also wealth created from those companies flowing through. So far far, it's hard to say whether AI is kind of one way, kind of a positive or a negative.
Okay, Yelena, thank you so much. Really great to see you. Glad we got to talk about Erling Haaland there and get to see him as well. Yelena Sokolova, Senior Equity Analyst over at Morningstar. Well, coming up, we will continue on the earnings theme. Mercedes cutting its outlook in the latest sign of weakness in Europe's autos industry, and we'll get the details for you next. This is Bloomberg.
Anything we do in Africa is going to be more risky than the US. I think the approach we want to take is how are we being compensated for that risk? And one of those is obviously going to be a valuation question. In our minds, valuation is a lot more attractive in Africa, even if we adjust for some of those Africa risks that a lot of Western investors see. So yes, in a lot of ways, you take some of those models that, as I said, might be more asset medium or asset heavy. There might be some more inherent risks. However, if we're saying we're adding some risk because of that kind of model, but we're now solving a core problem as opposed to maybe a nice to have solution in Africa, that might actually offset it. Where if you're solving something that people really absolutely need and can't live without, in a way that then that's a lot less risky. So again, we'd encourage investors to have a less binary view. In other words, the US isn't risky, Africa is risky. That's going to lead to a lot of complications down the road.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg. Earnings season is here.
There are earnings galore.
Some areas have done well. Equity trading has been an area of resilience.
Bloomberg is first to break the numbers.
Diving through the details of these earnings.
That is the weakest growth in more than 3 years.
With the smartest insights.
Are we seeing dislocations that point to something a little bit more severe?
If you look at where global growth expectations are, compare them to the start of the year, they're actually pretty similar.
But there is this uncertainty, and we haven't seen it in the results.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Turning back to Mercedes earnings, which of course we broke at the top of the show. It's cut its full-year guidance, citing weaker demand in China. Now, this is just the latest sign of weakness in Europe's autos industry after VW cut its outlook last week. Let's get more now with Elizabeth Berman, who leads Bloomberg's coverage of EMEA autos. Elizabeth, good morning. We already had some bad results from BMW as well. How different is the picture for Mercedes? It seems to be quite the challenge for the CEO's strategy to pivot to luxury.
I would say that they're pretty similar, but then, of course, there are some sort of details that are quite different. So BMW, they warned about a month ago that they won't meet their annual profit guidance, whereas Mercedes actually cut back the revenue forecast, which is in line with what we heard from VW last week. And the leading factor here is, again, China. Both VW and Mercedes had severe market losses there, outpacing an overall downturn in the market, which is also what's really undermining, specifically at Mercedes, the top-end luxury strategy that the CEO, Ola Källenius, put in place roughly in 2021. If I'm not mistaken, if you've got fewer buyers in China going for your S-classes, for your Maybachs, which is where those models were very successful, the overall strategy to sell many more of these cars is going to be a lot weaker. So that's what Mercedes specifically is looking at. What they also told us this morning is that they'll hone in more on costs and productivity gains, which is again very much mirrored across the German peers, across VW and BMW.
We just had an equity analyst on from Morningstar who was very optimistic that China is at an inflection point. What's Mercedes' outlook for the second half of the year?
I was very interested in the comments that your guest made there. I'd be very hopeful for a turnaround in the Chinese market, and which would put us on course to write more positive stories on these car makers. But from what I gather is that the property slump in China is so severe that consumer sentiment really has taken a hit, and that, of course, extends to buying cars. And then again, as we've mentioned many times before, this increased competition in China is really a struggle. In terms of Mercedes, what is helping them somewhat at this point, which I thought was pretty interesting, is yes, we know them as the maker of cars that are instantly recognizable, but they also have a very successful unit that makes commercial vans. Whereas the return on sales in the cars unit was around 4% in the past quarter, it was more than 10% for the vans. So they have a little bit of leeway where they can also do better and try and push their products a bit more other than just the cars that we all know so well.
OK, Elizabeth, thank you very much. That's Bloomberg's Elizabeth Berman. Well, turning to more earnings that we're expecting this morning, Barclays is expected to report an 8% jump in global markets revenue this morning. This is according to analyst consensus compiled by Bloomberg. The global markets unit contributed over a third of the bank's revenue in the first quarter, underscoring how the business underpins Barclays' global ambitions. Bloomberg's Charlie Wells is following this story for us. He joins me now. Charlie, just start us off with the top-line numbers then. Talk us through expectations for the bank's overall performance.
Well, the expectations are high. And, Lizzie, what I would say is that the setup going into this reporting season for Barclays and a lot of these other banks has been really positive. But the comparables are tough, right? The comparables are tough on the other side of the Atlantic. So JP Morgan, Goldman Sachs really had blowout quarters. And if you think about equities trading, that's really been the theme of this season, right? Really that volatility helping these trading desks. But if you compare, we were talking about that 8% increase in that markets unit for Barclays. But if you think about what that translates to, if you think about what's expected to come from trading at Barclays, that equates to about $3.3 billion. Compare that to JP Morgan or Goldman Sachs. They brought in $12 billion. So again, there's a really difficult comparable there. Think about BNP, their equities trading desk, that they saw an increase of 43% reporting that last week. So again, Barclays, the setup is good, but the comparables are tough going into this morning.
OK, so that comparable to year-on-year and the comparable across the pond difficult. American investment banks, though, trampling earnings records. So might we see optimism for Barclays?
I think we should. There's really high expectations going into this. And I think this season here in the UK and other parts of Europe, I think it's going to be really interesting to look at some of the differentials, right? That theme of equities trading getting a boost from volatility. Yes, likely to see that. I think something interesting that came out of BNP that we should watch for is this slight increase in loan loss provisions, right? Does credit come under stress here because of slightly more exposure to geopolitical risks to Iran than we see in the United States? We should be looking for some commentary on some regulatory changes coming from some of the other banks we're likely to see. But again, really, I think it's that equities trading business. And again, some rates positivity as well in Barclays today, right? Higher for longer, at least up to a point, can really benefit some of these banks, particularly here in Europe.
OK, Charlie, thanks so much for setting us up for those earnings. They will be dropping later on this morning, and we'll be hearing from the Barclays CEO himself, CS Venkatakrishnan, on the opening trade at 7:15 a.m. London time. Now to some top corporate stories we're following for you this morning. Other earnings stories. Audi cutting its full-year sales and profitability outlook as worsening conditions in China, a theme, as you can tell, along with US tariffs and the Middle East conflict, hamper its turnaround efforts. The Volkswagen-owned car maker now sees operating margin as low as 5%, with revenue of at least €58 billion compared to an earlier forecast for €63 billion. Meanwhile, we've got Philips slumping on TradeGate after reporting a fall in second quarter sales in China. again a theme in its largest unit. But the Dutch health tech company has raised its 2026 profit margin forecast after a US tariff refund boosted second quarter earnings. It also reported strong order growth in Europe as it works to offset higher costs from tariffs and the conflict in the Middle East. And we'll be hearing from Philips CEO Roy Jacobs on the opening trade as well to discuss those results later on this morning. That conversation coming at 8:45 a.m. London time. Elsewhere, Johnson & Johnson has agreed to a proposed $5.5 billion settlement to resolve most lawsuits claiming that its talc products caused ovarian cancer. The deal requires support from law firms representing at least 95% of the plaintiffs. J&J denies its talc products are harmful, but the agreement could bring a close to litigation that's hung over this company for more than 15 years. And Bloomberg understands that an NVIDIA employee has been detained by prosecutors in Taiwan who are investigating the alleged smuggling of AI accelerators into China. Sources say the employee's home has been searched, as well as his desk at NVIDIA's office in Taipei. NVIDIA is yet to respond to a request for comment. Well, those are some of our top corporate stories for you from around the world this morning. We've got plenty more coming up for you. We'll dive into the concerns on circular AI funding. That's next. This is Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Wednesday, the Fed decides.
Share wars just around the corner, setting the stage for a real debate. Is this meeting live or not?
Our number one objective is getting policy right. And if we get policy right, we can deliver lower prices.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis.
The sum of this is real GDP and the inflation piled on top of it.
That's going to cause inflation that does come into consumer goods in other ways.
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern. Thursday. The Bank of England makes its next interest rate decision, and investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Inflation is higher than we expected. Of course, now what we've got to do is get it back to 2%.
Join the opening trade team for live market reaction and analysis and on-the-ground coverage at the Bank of England. It all starts Thursday at 12:30 p.m. only on Bloomberg.
When you cut through some of the chip financings and some of the data center financings, ultimately what they're supported by are cash flows and leases ultimately to investment grade counterparts, and many of those being the hyperscalers. And so there is a element that you may be secured by an asset, but ultimately what supports that asset is a obligation or a cash flow from a investment grade corporate.
Carlyle Investment Management's head of asset-backed finance speaking there. And let's just unpack some of that tech financing risk now, shall we? As you can see, credit spreads for Alphabet and Oracle at their widest on record. For Amazon, they're the widest since 2018, and for Microsoft, the widest since 2011. But flip the board, and yet, in terms of percentage share in the share price, change in the share price, Alphabet is leading the hyperscalers. Now, flip the board one more time, because fundamentally, the US investor base has a pretty high tolerance for financial engineering, shall we put it. And yet, it seems like the patience is being tested. US credit markets drawing the line at NVIDIA, backstopping OpenAI so that SoftBank gets better terms for a data center, which SoftBank lends OpenAI money to open, which really crystallizes the market's concern about circular AI funding. The words of Michael Burry of Big Short fame, around and around we go. Just how much of the AI capex cycle represents real monetizable demand? That remains the fundamental question here. Now, to get all of these charts and the others that we've used on Bloomberg TV throughout the day, do go to CHRT TV Go if you are a Bloomberg Terminal subscriber. And let's also just remind you of the risk events on the docket for today. In just a couple of minutes' time, top of the hour, we'll be getting earnings from Barclays and Unilever. On that theme of retail, we'll also get German retail sales numbers at the top of the hour too. And later on this afternoon, 3 p.m. London time, we'll get US consumer confidence numbers. Now, let's check in on these markets again, because we have seen absolutely wild moves when it comes to the South Korean index. The Kospi has been paused for trading twice in the session so far. It's on track for its worst day since March. The Kospi now down 10.4% as the chip worries continue. That is infecting the global picture as well. Of course, here in Europe, we're less exposed to tech, but Eurostoxx 50 futures still down 0.2%. Nasdaq futures down more than 1% as well, which also comes back to those fears about AI circular financing that we were just discussing. But it's a big day for earnings as well. Coming up, earnings conversations with the CFO of Man Group and the CEOs of Barclays and Philips. It's going to be a wild ride on these markets today, so factor in those earnings as well. But all of these conversations coming up later on Bloomberg TV. The opening trade is coming up next. Anna and Guy will take you all the way to the European Cash Open. Brace yourselves. Stay with us. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, "Succession starts now."
I'm Francine Lacqua, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacqua. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacqua. Listen and watch on Bloomberg Television or wherever you get your podcasts.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Tuesday the 28th, good morning. What do you need to know? Chip stocks are having another very bad day. That's certainly top of the agenda right now. Trump also sees a, quote, good chance of a deal with Iran. Oil is definitely down on the back of that. And Barclays, Q2 numbers are dropping right now. Venkat will be along shortly to give us the details. Anna.
Let's put into numbers that very bad day for chip stocks, and you can see it very nicely expressed by what's happening on the Kospi today. This is just one day's move on the Kospi. We're down by 10.7% on the Kospi today. We're worried about a host of things. We're worried about capex in AI. We're worried about circular financing, and we're worried about what the Chinese can do in the AI space. What does all that mean for Europe? Well, Europe actually saw some of this tech selling yesterday. ASML down substantially on some of that news out of China and Chinese competition. So that pairs the extent to which we'll be pushed to the downside by the tech theme, but maybe there's more in it. For the moment, European futures down 0.1%. Lots of earnings to factor in. They don't all look good, but we're down by 0.1% on Eurostoxx 50 futures. At least the oil price is not rising. 87 is the handle that we have on oil this morning. The countdown to the opening trade starts right now.
Morning, Tuesday morning. Good morning. I'm streaming through the Barclays numbers, which look quite interesting. We'll get to Venkat in just a moment. Let's talk about the tech story. Tech is being hammered. Whichever way you look at it, tech is under real pressure. You can start with the chips. They don't look particularly clever. You've got the ASML story on the idea that actually the Chinese are making some significant breakthroughs when it comes to lithography, and that's going to open up a whole new realm in terms of China's ability to compete. But take a look at what's happening with the CDSs of hyperscalers. Take a look at what is happening with the circularity story when it comes to financing out of NVIDIA into the rest of the group. All of this is on the table right now. Whichever way you look, you are under pressure in this space right now. But chips are front and centre.
Yeah, absolutely. Chips are front and centre, and we thought useful to linger on this as we head into a busy earnings day in Europe, where our attention will be understandably diverted in other directions for a moment. But we are seeing substantial losses in the Asia session, as we were saying earlier, 10.5% down on the Kospi. And some of the individual names that are considerably weaker, it's some of the chip makers, so Samsung, SK Hynix, of course, but also over in Japan, Kioxia, so it's not only about South Korea. Nikon and Tokyo Electron also down, and that's linked to the ASML story. The fact that the Chinese have now a competitive threat to ASML in the chip equipment making space. And so those companies are down in the Tokyo session. So interesting to see to what extent this comes through into Europe today. We are seeing slightly weaker futures for Europe. I'm also intrigued by the CDS story around the likes of NVIDIA and SoftBank, and Anthony Stevens pointing our attention in this direction. There were a lot of things that the market didn't like, it seems, about the NVIDIA OpenAI financing. Just once again focusing in on the nature, the circular nature of some of this financing. And the FT has another story about NVIDIA signing a lease at a data center in Texas that has similar hallmarks. And so it seems as if this is an area of concern for the markets.
Yeah, and this is all ahead of the hyperscalers. So that we haven't even seen the hyperscaler numbers this week. We thought that was going to be the major event, but it looks like this already is signalling a great deal of concern around what is happening here. If the hyperscalers come through and signal that they're going to continue to spend at the rate that they are right now, we've got 4 of the 7 reporting this week. How is the market going to take that, considering the backdrop of the concerns that we have right now? Where is the money? Show me the money. How are you going to make money on this huge investment that you're delivering right now is going to be and will remain the key question.
Yeah, absolutely. Still not sure what it is that we're looking for in CapEx. Do we want to be reassured by higher numbers, or do we want to be reassured about discipline and slightly lower numbers? But all of that's still to play for. Lots to talk about when it comes to the technology space over the next couple of days. And just as a reminder, tomorrow we've got Meta, Microsoft, Qualcomm and SK Hynix. And then on Thursday we have Apple, Amazon and Samsung.
So what I thought was interesting about yesterday's session in Europe, ASML, biggest points drag by a mile, no problem at all, 2 points off the stock 600. But if you look at the other end of the story, SAP had a great day.
Yeah.
Capgemini had a great day. So the market rotated out of some of the kind of the hardware trade back into some of the software trade, which was quite interesting. And if you look at the equal weight in the US on the S&P, it had a very good day, hit a kind of fresh record high. So the market is kind of rotating out. The money's not coming out of the market. Some of it's finding its way into other parts of the market.
Yeah.
How sustainable is that particular trade
We
as well?
will talk later about what that broadening trade means. Is it all good? We'll get into that conversation. Let's dive into some of these earnings stories that we're getting this morning, and there are plenty of them this morning. Let's start with the listed hedge fund space and Man Group. So we get numbers out of Man Group this morning. First half net inflows really comfortably beating the estimates. So we've got a number here of 7.1 billion in net inflows for the first half of the year. That is against an estimate that's sort of just above 2 billion. So that's certainly well above estimates. The assets under management then looking well above estimates. The pre-tax profit looking above estimates. So let's get into a conversation. We're joined now by Antoine Forterra, who's the Chief Financial Officer over at Man Group. Really nice to see you, Antoine. Nice to have you with us. So that net inflows number really stands out. Tell us what you think has been driving that money coming towards Man Group in the first half of the year.
Morning, Anna. Morning, Guy. Thank you very much for having me today. We're very pleased with the results this morning. We delivered very, very strong earnings, as you can see. Very solid investment performance across the range of products. Record net flows, as you've highlighted, leading to record AUM. And our management fee EPS has grown to the highest level in 15 years, 46% growth in the year. But if you go beyond the numbers, what is particularly pleasing is the broad-based nature of the growth you're seeing and the investment performance we're generating. Our main multi-strat is up around 7.9%, and that's the best representation of the alpha we've been able to generate for clients. And then we're seeing growth in most of the categories in our space. And so it tells us that our strategy is working, we're delivering, and that the clients, and where we started, the clients are listening, and they're interested in the content that we can deliver for them. So very strong set of numbers, which gives us great confidence for positioning and our future.
OK, and so I was going to ask you, yes, which of the strategies were doing well, AHL, numeric, GLG, but you said it's sort of broad-based. What does the volatility in the markets mean for you, Antoine? What does it mean for a business like Man Group? Because whether that is driven by the oil price and everything that's happening in the Middle East, or whether that is driven by hyperscalers or memory chips, there is a lot of volatility to either fear or to use as an opportunity.
So the demand has been broad-based across a range of products, liquid alternative, private alternative, as well as long only. And it tells us that clients are looking for solutions, product strategies that give them good quality returns in times of uncertainty, in times of volatility. We talked about the AI, the volatility you see in markets. The alpha environment has been relatively rich, either on the macro level. Some of our strategies on the macro side are up 7-8%. But also on the micro level, we're seeing our long-only equity and credit fund managers performing particularly strongly. And so in time of uncertainty, volatility, people should stick to the basics, stick to quality investment returns, quality strategies, customized, which is what we're here to deliver.
How hard is it to hang on to talent right now? What's the talent? Every day I see people moving. The talent war seems extraordinary.
Talent is one of our key strengths. You hear us talking about talent and technology. These are the two strengths of our business. We pay a lot of attention to our talent. Attrition this year is near record lows. and we invest in talent, and tools such as AI are a great way to attract and retain talent. Our 40-year history in quant and technology enables us to deliver those tools pretty smoothly to organization in ways that really demarks us from competition, and that turns us into an attractive position for talent.
Is it hard to figure out what the ROI on the AI investment is? Like, how do you got the talent? The metrics kind of work there. I can understand how you judge that. How do you judge the kind of what you're doing in AI?
We're so excited about AI. As I said, we've been at it for 40 years in tech and quant, and it's really a transformation of our business. Yeah. I'll give you an example. You're a typical portfolio manager. Your role is to process disparate information, build models, interact with companies. We now have portfolio managers who have created agents who can do that for them, tremendously accelerating their throughput. They can interact with double the number of companies that they usually interact, and they can have double the number of meetings that they have. And if you think that alpha is, ultimately the number of bets you can make times the probability of success of those bets, that should lead to better outcome. So we're tremendously excited. We don't succumb to, what people have started calling cognitive surrender. This is a way for us to turbocharge cognitive capabilities in our business.
How do you keep the spending on AI in check in a business where it must be tempting? There are opportunities everywhere to perhaps explore some of that alpha, but it all costs money and tokens.
It costs money and tokens, but it's a resource allocation decision, and we're fortunate to have the scale, the size. Talked about the growth you're seeing, the numbers that you're seeing. That enables us to invest and really deliver the best to our teams.
Are you worried about private credit? I know this is an area, there was much excitement years ago. You've got some exposure in that space, a part of your business that focuses on private credit. Are you concerned about private credit and what might happen there?
So private credit AUM has increased to $7.6 billion across the half. And we're seeing both very solid underwriting from our teams on the direct lending side and opportunistic credit. The realized default rate is sort of 1% level on the direct lending, which is way below the kind of 4% you're seeing on the BDC space. And the opportunistic credit team has returned north of 30% annualized in the first half. So the numbers are very strong, leading to growth. We still see this as a growth opportunity for us. Clients are interested, both institute and wealth clients. Yeah. And we're well positioned to capture, but we are cautious. Our positioning is one where we're here to return quality returns for investors, and it starts with the quality of underwriting.
Clients happy to put money into that space? They want their money back? Kind of what? Just give us a sense of.
Our clients are happy to put money in that space. We have no exposure to some of the structures that have sort of illiquidity mismatch that have been reported in the US. We have no exposure to those structures. In our case, clients are interested, and you see that in the rate of deployment that I described, and the fact that in the first half we had the first close of our new opportunistic credit fund at the beginning of June, and the first close alone was bigger than the full previous vintage. So it tells you that clients are interested in broad private credit still.
If you have an extra pound, euro, dollar to invest right now, is it best invested in new capabilities, AI technology? Is it best invested in your own stock, buybacks? Is it best invested in expanding the business, organic growth, non-organic growth, M&A? Where's the opportunity to grow the business right now?
The opportunity to grow the business is across most of what we do in our strategy. If you look at where we're investing, quant equity, credit and solutions, probably where I would put this extra $1 or £1. On the quant equity side, we're seeing record AUM. There's plenty of room for us to grow. On the credit side, we've now reached $60 billion of credit AUM, starting from less than 5, probably 7 years ago. And then on the solution side, huge demand for product. So the allocations we're making are across the 3 bets, and then the platform that supports it, which is predominantly about AI.
Antoine, thank you very much. Thanks for kicking off the show with us this morning. Good to see you. Antoine Forterre, the Man Group CFO. Coming up on the programme, demand in the key Chinese market remains challenging for Philips. We'll be speaking to the CEO of the Dutch medical equipment maker. That conversation later in the programme. Plus, a new fund is being launched to protect against what Altana Wealth sees as an inevitable downturn in private credit. We'll get that view later in the programme. The company's founder and CIO, Lee Robinson, will be with us on the show. Up next, don't miss our interview with the Barclays CEO. CS Venkatrakrishnan will be with us shortly. The British Bank reporting earnings. If you you have any questions, please get involved in these conversations. IB plus BBTV Go is the function on the Bloomberg terminal that will put you in touch with this team. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Welcome back, everybody. 16 minutes past 7 here in London. The futures picture for Europe, then, looks flat, really, to negative, but that does not do justice to the news flow that we're seeing through the Asia session, the extent of the selling we see through the Asia session on the tech theme. The Kospi down by 10.7%. Some of that is to do with nervousness around Chinese competition, and some of that was in our markets yesterday, Guy, because we had considerable pressure on the likes of ASML and the rest, or some, rightly, you mentioned earlier, of the tech space, certainly around hardware. But that's the overall picture in these markets this morning.
Let's talk about the Barclays numbers. Hit the screen a little bit earlier on. They make fascinating reading. Let's talk about what's been delivered so far. So the overall numbers in terms of the investment bank are a beat. This is for the investment bank. Certainly the revenue on that side of things. The bank has upgraded its 2026 group income target to 31.5 billion. Equities have done very, very well. Fixed income, we'll talk about that in just a moment. CS Venkatakrishnan is the CEO, of course, of Barclays. He joins us now. Venkat, good morning. Quite the set of numbers this morning. Equities really stand out as being a very strong performance. Do you think that business, that side of the business, could have done even better if it had even more access to capital? Is it being throttled? Is the performance of that business being held back, do you think, right now?
No, not at all. Well, first of all, thank you for having me. I'm absolutely pleased with the set of numbers we've published today. You know, our top line income of 8.1 billion pounds is up over £1 billion on the same number last year. Profits of 3.3 billion pounds are up 30% over the previous year. And the investment bank, as you say, has done extremely well, including my colleagues on the equity trading floor behind me. Equities are now 30% of Barclays. And remember, this was the house that fixed income built. And so the diversification we're seeing in the business, the strength we're seeing in our business is something that we're truly happy about. And to your question, we are doing this in a very disciplined way, with disciplined capital, disciplined cost control. And the revenues keep going up, the returns keep going up. And we're doing it on a fixed capital base and really sweating it. And our capital efficiency is much higher than we thought it would have been at this time. So I'm pleased with the numbers all around.
Venkat, you talk about all round. So let's just talk about whether you're happy with the numbers all round. As you say, the reason Barclays stands out in Europe is because it is diversified. It has the equity side of things. Others have got that as well. But it's also got the fixed income side. And you are probably the most diversified bank in Europe because you have those two pillars. Equities are smashing it. Fixed income a little less so. As you say, you're the bank that was built on that side of things. What do you need to do to get fixed income to be performing at the same level as equities?
Yeah. Well, this was a very great quarter for the equity market because there was a lot of volatility. Fixed income has actually done quite well if you look at the absolute numbers. The comparison with last year suffered because we had a really great quarter in the second quarter last year. But I'm very, very happy with the progress in fixed income, particularly in securitized products, which is a business we've built from nowhere to being high-ranking on Wall Street. Our credit businesses are very high-ranking. Our depth with our clients keeps increasing. One of the statistics we said 2.5 years ago was with our top 100 clients, we wanted to be top 5 with 70 of them. We are now at 65 in the middle of this year. So that's great. And the UK businesses are producing over 20% ROTE. The bank itself has produced 16.1% ROTE in the first quarter, in the second quarter, and 14.8% for the full year. So we are, reaffirming our guidance very confidently for both this year and for 2028. And as you said, we've upgraded our income.
Venkat, good morning. I want to ask you about AI from a couple of different angles. Firstly, around what it means for the investment banking part of the business and the opportunities that AI creates to do more business. We saw a lot of this on Wall Street, that the AI rollout, the build-out of data centres and all of the other infrastructure created a lot of opportunities within investment banking. Are European banks and is Barclays getting as much access to that theme as you think the US players are?
Yeah. Well, as you say, Anna, there are different parts of AI. There's first how we use it ourselves, and it's an important part of our own investments and our technology investments. Second is what's going on the street. We have clearly been part of the very large debt issuance programs that many of the hyperscalers have done in order to fund their AI build. So we are a part of that because, one of the things we do really well is to help companies finance themselves.
OK, so Europe is playing its role in that rollout. And you mentioned that AI has another dimension, and that's what you do with it yourselves to make your business work better and to get the most out of it. So how do you look at the return on investment in AI, Venkat? How do you measure that, and what is that measurement telling you?
Well, we're early, and it's going to take a long time. What I would say to you is that it's a great tool, and there's a great potential to be unlocked. To unlock the potential, you've got to invest in modernizing your systems, harmonizing your processes, and standardizing the ways in which you do things, which is one of our biggest investments across the bank, and we continue to spend hundreds of millions on it. On top of that, once you layer AI to drive intelligent processes, you will get the best out of it. And so it is a journey that doesn't take place over weeks or months, but over quarters and years. But we're very optimistic about what this can do for us.
Venkat, where's the opportunity for growth now?
Well, we continue to do well in our different markets. Our UK market has been growing quite well. We've been at 5% annualized growth in UK lending. And the UK economy is doing much better than most places in Europe. And so we're capturing market share in the UK, in corporates, in retail banking. Our wealth segment and our prime segment in the UK retail bank is really doing well. we've cut custody fees to zero for our self-directed investment. We've introduced new planning and advice features for wealth management. We see a lot of growth in the UK, and of course our US consumer bank is an entirely digital offering. We've announced a new partnership with Samsung, both for their card and their wallet. We've bought a company called Best Egg, offering direct-to-consumer loans. So there's a lot of opportunity across the franchise, which we are carrying out in a disciplined way, and both building our capabilities and increasing our scale.
Yeah, I see income at the US consumer bank rising 38%. That's a big number. Just out of curiosity, when it comes to the UK, have you met the new Chancellor? Are you going to meet the new Chancellor? When you do meet him, what are you going to say to him?
Well, I had the privilege of meeting him at your offices in London. And look, he's very encouraging for both the industry and the economy. The UK needs more growth and more productivity. And I think the government and both the Chancellor and the Prime Minister recognize that. And they're going to build on the foundations that their own party has created over the last couple of years, deepening the involvement of the leading UK firms and industries in the growth of the country. They say growth in every postcode, and I cannot be more supportive of that. It's the right idea.
So it's the right idea. So you like the idea of growth in every postcode. They might be looking for some pretty broad shoulders, though, to lean on in terms of tax revenue. Do you have any thoughts, Venkat, on whether the banking sector can handle being taxed more, whether business can handle being taxed more?
Yeah. Well, look, the banking sector has a very important role to play in the economy. We are indeed broad shoulders, not just in the size of our businesses, but in the capabilities which we offer. The question is, how do you use it the right way? The right way is to use our resources to increase lending into the UK economy. We've spoken about changes that they can do to certain acts to allow greater consumer lending. And I think every pound of capital that they keep in the banking system will be multiplied by 8 or 10 in terms of the lending which we can do. So the right thing to do is to continue to increase the capital in the banking system, not seek to remove it, and then to get us to lend, which is what we want to do anyway.
Venkat, just briefly, is there anything that worries you at the moment? We started this programme talking about a volatile environment around the AI theme. Some people are worried about private credit. What are you worried about at Barclays?
Well, look, I think there's been continued uncertainty in the markets. You spoke about AI. We've seen both a run-up in technology stocks and technology-related stocks, and now some volatility. The crisis in the Middle East continues. The crisis in Russia and Ukraine continue. The UK economy, the US economy have been robust. Employment has been strong. Credit conditions are strong. But they're facing a kind of uncertainty at a global level that's continuing and persistent and not been seen for a while. So I have to worry about that. And we protect ourselves by running good businesses, by being well capitalized.
Okay.
Our CET1 ratio is at 14.3%. So I'm worried, but we try to run a safe bank.
Venkat, thank you very much. Thanks for joining us. Really good to speak to you. The Barclays CEO, CS Venkatakrishnan. Coming up on the programme, we'll get back to some of the themes we were just hearing about there. The chip route deepening, sending global stocks lower. Certainly, we've seen that through the Asia session. The Kospi considerably weaker. The likes of SK Hynix and Samsung considerably weaker. The Kospi down by 10.7%. We'll dig into what's behind the sell-off, the latest iteration of this chip wreck. We'll get to that shortly. This.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Tuesday the 28th, good morning. 30 minutes to start of equity trading here in Europe. Europe looks like, to a certain extent, a sea of calm when it comes to what we're seeing globally on the equities front. Nasdaq futures are down circa 1% right now. European futures are barely budging in comparison. Look at that. Euro Stoxx 50 futures down 0.1%. FTSE's flat as a pancake. CAC up a little bit. LVMH to be factored in, caring to come later. All of that is a European story that, as I say, looks quite calm right now relative to the big moves we've seen overnight out of Asia and what we're seeing right now when it comes to Nasdaq futures.
Yeah, that futures picture in Europe, it does stand out for its strength, even though it's flat, doesn't it? And despite the fact that we've had corporate earnings that haven't all looked good, even away from the technology space, from the auto space and health tech. Let's talk about where we are on bond markets then. Quick check on where we're moving here. And perhaps this tells us something important, because yesterday we did see that the markets got a real boost in Europe from, tech concerns aside, a real boost from a weaker oil price. And that does continue to be the case today. We're at 87.32 on Brent, down by 1%. And as a result, we see another day of buying on European bond markets, and those yields just coming down just a touch. But let's return to the concerns around technology, and certainly stocks in Asia are slumping this morning as a global rout in chip makers deepens further. The losses are coming after a Chinese state-backed firm reportedly began producing machines that could rival ASML's dominance in the space. Meanwhile, at NVIDIA, more deals and rising leverage are pushing up the cost of insuring the chip giant's debt. Let's bring in Bloomberg senior strategist Neil Campling to talk us through some of these concerns around the tech space. So there's a lot to think about. Chinese competition, what they can do against ASML and the like. But let me start with the concerns around NVIDIA, circular financing and all of that kind of activity. Because yesterday we had a story about this involving OpenAI and SoftBank, and then the FT has another story about another data center that they seem to be backstopping this morning. And meanwhile, the NVIDIA CDS, the cost of insuring against default at NVIDIA, ticks higher. What's it telling you, Neil?
So I think that the big question is what proportion of NVIDIA's sales are going to come from an ecosystem that NVIDIA's own deals are, to what extent, artificially inflating the demand of the AI chips and ecosystem. So that's the big question. So the story that came out yesterday regarding NVIDIA, the backstopping of the high data center, it wasn't a new story. It was actually out earlier this year. But it was an incremental increase in terms of the backstopping, the funding of the SoftBank deal for the OpenAI. So there's that question around it. So, and it actually, Bloomberg on the terminal has got a really good explainer of the whole circular deal stuff. Originally written actually in January of this year, just updated overnight because there's just more information around this circularity kind of argument. So that's, I think, one of the key things around it. But I would say it all started last week when one of those ultimate cash machines, Google, Alphabet, reported negative free cash flow for the first time ever in a quarter since coming public. I think that was kind of, in a sense, like the lighting of the litmus paper, if you like, the smoking gun that led to, again, the CDS spreads blowing out, the worries over what happens with all of this circularity kind of arguments, and bring some investors who are as old as me remembering what happened back in 2000 when Lucent had similar kind of risks around the dot-com build-out, etc. And that worries people.
It does, of a certain age, of a certain vintage.
Certain vintage.
Yeah. Are chips still cyclical?
It's different this time, we keep being told. However, as soon as the concern around chips and memory pricing in particular becomes cyclical, then investors will start looking at the chip companies, especially the memory companies, on a price-to-book basis historically, rather than a sort of what appears to be a cheap price earnings kind of multiple. Chips have always been cyclical. Memory, particularly, always been cyclical. Now the memory companies are investing more in chip production.
Yeah, the Chinese are getting it, and the Chinese are going...
Chinese are going in. The Chinese, we had the big IPO yesterday, which increases their balance sheet to allow them to invest. There is only so much capacity in terms of demand to meet certain capacity. There's more capacity coming on down the line. So I suspect it's a question of when they become more cyclical again. As opposed to if.
I wonder how much what we make of Chinese competition in this space, because it's clear that we think about it as one big market. From the ASML movement yesterday, the share price dropped on the back of that talk about what China can do in the ultraviolet lithography space. But at the same time, in some parts of technology, we think of it as two separate ecosystems, don't we? As if NVIDIA doesn't count on any sales into China in some of their earnings reports because of the difficulty in doing business I mean, how should we be thinking about the China-West technology landscape, do you think, Neil?
There's definitely a battle over frontier AI models and who has the best technology. And clearly, China has been without lots of IP in the core building blocks for a number of years now. And yet they do seem to be coming up to speed very, very quickly. And we heard this from some of the models that were announced last week. So once we get, are they playing fast catch-up? They're no longer years behind, it would appear. The narrative around the ASML machines yesterday, we're talking about less than 5% of ASML sales. It's not necessarily the impact to the revenues longer term, but it's just a change in narrative that is concerning people.
The gap is closing and closing fast. So we now look forward to the hyperscalers, the what is it, 4 of 7 we get this week. What's the smart move here? For what they have to, if they come out and give big numbers, we're going to spend billions of billions more. How's the market going to react, given the setup that we have right now, Monday, Tuesday? Going into Wednesday, Thursday, the setup feels quite negative. The market is nervous about companies that are spending money. They're nervous about when the money comes back, when cash flow goes... All of these questions are on the table going into the numbers. Is the bar... where is the bar?
Well, I mean, the bar is set, I think, in the run-up to this in terms of will one of them break ranks and actually potentially slow spending? That's the kind of question I wonder, whether someone like Microsoft will step back with their first fiscal year guidance, forward guidance this week. Will one of them break ranks? Meanwhile, there is a little tech company that isn't committing hundreds of billions of dollars to AI capex.
Yeah, you might have heard of it.
You might have heard of it, called Apple. Are they sitting there to wait to see who pans out to be the winner in this space and then just rents the capacity off them without committing those hundreds of billions of dollars? So it feels like somebody has to blink first, don't know who that's going to be. Meanwhile, Apple is sitting there waiting to work out and find out who the winner is.
Or buy some of these companies potentially.
And we get numbers from Apple as well this week, don't we?
We do indeed.
Yeah, as well as the hyperscalers.
Yep. New boss over there. Maybe a new strategy. Neil, nice to see you. Thank you very much indeed. Busy week coming up. We're not done just yet. Neil Campling joining us on the tech trade. We'll go from tech to luxury next. The key fashion and leather goods unit at LVMH just about overnight, eking out some sales growth. We're going to dig into the numbers. French luxury front and centre. We get Kering as well a little bit later on. That is all coming up. This is Bloomberg.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but it is going to be a platform that runs in parallel to our more traditional exchanges.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything. Thursday. The Bank of England makes its next interest rate decision, and investors will look to BOE Governor Andrew Bailey for signals on the rate path ahead.
Inflation is higher than we expected. Of course, now what we've got to do is get it back to 2%.
Join the opening trade team for live market reaction and analysis and on-the-ground coverage at the Bank of England. It all starts Thursday at 12:30 p.m. only on Bloomberg.
Welcome back. This is the opening trade, 7:42 here in Europe. And the European futures picture, well, it's just turned into negative territory, but it's not driven by any of the major markets you see on that board. So FTSE 100, DAX and CAC futures all pointing slightly higher. We've got plenty of earnings stories to talk about this morning. Euro Stoxx 50 futures, though, broadly pretty flat. That's not a bad performance given what we're seeing in Asia, but we'll certainly be recapping on some of the earnings stories that we've had this hour and the hours ahead of this, and overnight, in fact, as we get closer to the European trading trading day. We'll park that thought for one moment and get back to the oil story in the Middle East. Oil is extending declines after President Trump says the US and Iran are engaged in diplomatic talks to end the Middle East conflict, even as Tehran says no formal negotiations are taking place. But Trump also warned the two sides would return to fighting if negotiations didn't result in a deal.
They want to meet, and we're meeting. We'll see what happens. There's a chance we can make a deal. Without what we did, they wouldn't even be talking to us. They requested a meeting through their surrogates and directly. And we're meeting, and, you know, good things can happen, I guess.
Let's get more details with Bloomberg Horizons Middle East and Africa anchor Abir Abu Omar with us once again. Give us an update then, Abir, on what's been happening overnight. We see the oil price continues to track lower, 86 now the handle on Brent, 86.36, down by more than 2%.
Good morning, Anna. Well, I mean, you alluded to it in your intro. A lot of back and forth between the U.S. and Iran. President Trump, as you have said, and as we've just listened to, said that a breakthrough, yet another one, could be possible, but that if Iran doesn't agree to some of the concessions that the U.S. had laid out multiple times, hitting Iran again could happen. Meanwhile, we don't have a formal response from the Iranian side. Iranian foreign ministry officials have said that they could put through delegates to the United States. But again, we don't have any substantial negotiations happening between the two sides. Meanwhile, the fighting between the two parties has stopped since late Friday when, after 13 consecutive nights of attacks by the United States, all of a sudden we saw a stopping of hitting the targets in Iran. Iran later on Sunday is saying that it will suspend attacks against shipping in the Strait of Hormuz, but also countries in the region. Those have included Kuwait, Jordan, Bahrain. Meanwhile, Anna, and what's more important here is the Strait of Hormuz. While the fighting has indeed stopped for the time being, the U.S. maintains its naval blockade on Iranian ports. Iran is also threatening ships that don't stick to the routes that it had laid out. And so movement there is pretty much still paralyzed when it comes to ships making their way through. So there is a distinction to be made between the reality of the situation, that is the paralyzed movement, and what oil markets are interpreting. And this is why you're seeing Brent crude now at, as you mentioned, $86, $87 on the barrel. Parallel to all of this, equally important, Anna, is the fighting that is happening between Saudi Arabia and the Houthis in Yemen. That is also affecting the movement in the Red Sea, Bab el-Mandab, another strait, which Saudi Arabia had resorted to throughout the course of this war. So we're watching parallel movements, or a lack of movements in those waterways. And that is something we're going to keep an eye on, as well as a return to those negotiations between the United States and Iran, if it is going to happen over the course of the week.
Abir, thank you for the updates. Abir Abu Omar, Bloomberg Horizons Middle East and Africa anchor, joining us out of Dubai with an update on what's happening there. Let's come back to the stock story. Around 15 minutes ago, the Cosby closed down 11%. 11%. That is an epic intraday move for an index. Let's go to Anthony Stevens in Hong Kong to get an update on what we've seen overnight out of Asia. Anthony, that's a big move in anybody's book. Yes, this is a market that has been pushed up very strongly. Yes, there's a lot of leverage here, but an 11% move to the downside. Is there any sign of a bounce?
Well, it's an interesting index, right? It's a two-stock index, and that speaks to why volatility is so high. It's actually single-stock volatility. And these two single stocks are in the memory space, Samsung and Hynix, and they have been materially disrupted by these headlines around the DUV space. The DUV space basically allows China to mass-produce cheaper memory to kind of fill in the gaps that the HBM kind of curbs have put on China. Now, this is the speculation that the market is running with. We don't have a lot of information on exactly what the technical specifications of the machines that are supposedly being produced in Shanghai, and the number being produced is around 20 into 2027. So this is not a very high number of machines, but the capability of China to ramp up production is really well known, and across Asia, not just in Korea, anything that can be made with DUV machines has gotten hammered today. We are talking about NAND in Japan, which is down, Carrick share is down 18-19%. We are talking about substrates in Taiwan, which is all pegged down limit down. Even China itself, China has disrupted itself with the Chinese Chinext index down 7%. So a lot of the simpler chips made in China are now trading limit down as well. So this is an ongoing theme. What can these chips be made to make, and how many of them are out there, and how much it will increase the Chinese production capacity is up for debate. But this comes at an extremely fragile time in AI sentiment, as worries around the circular trade meet worries around Chinese LLMs and their efficiency in using these resources in the first place. So a lot of headwinds on the AI hardware trade, but you are seeing some signs of life in the AI software trade, which is what kept the S&P flat and what is helping Europe today as well.
Yes, and it helped Europe yesterday. We saw, ASML was weaker, but SAP continued to impress, as Guy was pointing out earlier. So we're concerned about Chinese competition then. That seems to be one of the threads, and that's to some degree was a story in Europe yesterday. What concerns you about the CDS story over at NVIDIA and over at SoftBank, Anthony? Is this something that we should really be watching as we continue to document cases of what are called, the circular financing concerns?
Yeah, yesterday's CDS move in NVIDIA marks a kind of change in sentiment around these circular financing deals. NVIDIA is an absolute cash machine, so it's been very kind of resistant to any kind of credit worries. But yesterday you saw a small blip up in the CDS, which kind of freaked people out. And that's because it has a knock-on impact to other AI fundraising, not necessarily NVIDIA's balance sheet, but other people who are coming to the DCM market. The DCM market is massively full of AI deals to the back end of the year. And any movement in kind of a bellwether CDS, joining the likes of Oracle, SoftBank, Amazon, Meta, that have materially weakened already, puts pressure on this fundraising and the prices at which this debt can be raised. Now, debt financing has become very important as equities have started to come off a little bit for hyperscalers. So people are more likely to go to the debt market given how tight spreads are versus history anyway. So spreads are very tight, but let's look at the pricing people managed to get in the deals in the back half of the year. And based on that pricing, they get to determine how many of these chips and data centers they can build. So the two trades are tied together at the hip. We need to watch the CDS, and we need to watch what kind of hardware people end up buying in the end.
Anthony, great stuff. Thank you very much indeed. Anthony Stevens joining us with the latest around the tech story. The numbers are dramatic this morning. Makes luxury feel relatively safe. LVMH, key fashion leather goods unit, home to Louis Vuitton, of course, Dior, barely eking out sales growth last quarter. The conflict in the Middle East certainly deterring wealthy shoppers. Organic sales at the division, the group's most profitable unit, rose 1%. The estimate was 1.52. That was certainly coming out of the analysts that we'd surveyed here at Bloomberg. Angelina Rasque joins us now. She covers luxury out of Paris. Angelina, what stands out here? The stocks looks like it's called a little bit softer. Why is that? The numbers are okay. They're not great, but they're okay. So what is the kind of the takeaway from these figures?
Hey there, Guy. Indeed, I mean, the positive was that the key fashion and leather goods unit returned to growth in the second quarter. That was for the first time in 2 years. So that's obviously the unit that includes brands like Louis Vuitton and Christian Dior Couture. However, the growth rate was slightly disappointing, so I think investors were expecting a little bit more. The positive is that Dior in the second quarter grew slightly more than the unit average, and it was led by growth in the US, especially double-digit growth rates. However, we're not seeing really strong recovery signs in China, which is a crucial market for luxury goods. So that's perhaps what was missing. On the positive side was a watches and jewelry unit, and really it was jewelry because watches were negative, but jewelry, it was led by Tiffany and Bulgari, and that's similar to what we saw. I mean, it grew 11% in the second quarter, and that's similar to what we saw with Richemont, the owner of Cartier and Van Cleef. I think in these times of uncertainty, the aspirational consumer especially, they are quite keen to see, they probably see more value in jewelry, a gold bracelet, gold jewelry, because that will probably keep the value in the long term.
Angelina, thanks for the update. Bloomberg's Angelina Rascare will certainly keep an eye on what's happening with that stock at the open. There are other stocks that we need to focus on. Plenty of earnings out this morning. Bloomberg's Alex Morgan has a rundown of the other stocks to watch. Alex, good morning.
Morning, Anna. Well, good luck to all of us. We've had our coffee this morning. It is a busy one. Let's kick off with Barclays. It's equities here, really driving things. Traders there having their best second quarter in 4 years in terms of the haul. Let's put that in context with Wall Street peers, where, again, we've seen stock trading really reaching all-time highs and surpassing the records. You can see Barclays here around 45% increase, but have a look at some of these other Wall Street names. JP Morgan around 86%. You can see their equities really driving things there, particularly for Barclays as well. Let's turn it over to car makers, though. We know that German car makers, European car makers, are experiencing pressure on a number of fronts. We've got Mercedes, they're experiencing a bit of a drag in China. Those details out this morning. Keep an eye on them. They're not alone, though, of course. Other European names, including BMW and Porsche, we'll see this week, struggling. When it comes to Mercedes, though, you've also got competition on the home turf from Chinese rivals as well. And then kicking over to Unilever. Well, here, we might have had a bit of a World Cup deodorant boost. That was a thing analysts were looking for. Overall, they've had a bit of an interesting year. You can see year-to-date down around about 5%. However, they've beaten estimates in these sales, particularly due to soap and deodorant in the emerging markets. We could have done with some of that over here watching the World Cup in England, but that's another story. Back to you guys.
That's the weirdest thing I've heard all day, Alex. Thank you very much, Bloomberg's Alex Morgan. World Cup deodorant
I actually wrote
boost.
that down.
Yes.
World Cup deodorant boost.
It's worth writing down. Sometimes the strangest things are.
OK.
But we need to focus on Philips as well. Healthcare supplier. A beat and raise, but mostly driven by tariff refunds is the conclusion from some of the analysts. And so maybe that limits the impact.
Yes, it looks like it's going to be a negative open for Philips. And I think the reason for that, judging by the commentary that I'm reading this morning, seems to suggest that that's the China weakness story being factored in to what they are saying. So, yes, they've had some benefits on the tariff front, but it's not... I guess that's seen as a one-off and not something that's going to be sustainable. Anyway, Roy Jacobs is going to be joining us very shortly. We will find out exactly what he has to say. I think he's going to be joining us in the back half of the next hour. It's a really interesting market this morning. So what do? Do you continue with the trade of buying SAP? Is that the antidote to the chip weakness we see in ASML? Europe looks fairly flat, but there's a whole load of other stocks that are going to get priced in this morning. LVMH, Barclays, lots of really good names out there.
Lots of earnings stories. And then we had the Asia chip sell-off. We've got the Nasdaq futures picture looking weaker, down by another %, as if there's sort of a continuous thought there. But Europe provides something of a speed bump in the way, a positive one perhaps, or maybe just a flat one. We will come back with the opening trade. This is Bloomberg.
The world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Morning, how you doing? A couple of minutes to go until we start trading here in Europe. Just looked at European futures. You'd think, you know what, there's nothing going on in the world right now. Nothing to see here. Move along. It's really boring out there. Of course it isn't. Look at the Asian session. Look at what has happened with the Kospi overnight. The Japanese market, the chip stocks, all under pressure. Look at what happened yesterday in the United States. To a certain extent, there has been some of the action below the surface here in Europe. Look at what happened with the ASML yesterday, SAP. This is the chart yesterday. This is the one you got to price in first thing this morning. That's where we went out in Europe. We were a little bit higher into the close yesterday into the United States, but US futures are, particularly on the Nasdaq side of things, very negative this morning. We're down by circa 1%. So this is the picture we have in Europe. This is where it leads us. The Euro Stoxx 50 futures that is doing nothing. And FTSE futures that are up by 0.1%. DAX futures that are up by 0.2%. CAC futures aren't really doing very much either. If you're looking for a place to kind of relax and take a deep breath, Europe feels like that is the place to do it this morning. At an index level. Below the surface, there's some action, Anna.
Absolutely. That is the role of Europe today, to allow you to take a deep breath. But let's look at some of the individual names where we might get some more volatility. Philips is in focus, the medical equipment maker. We'll be speaking to the CEO later. They've been flagging rising cost pressures. Maybe that's going to be something that sticks to them this morning. Could this stock move lower, despite the fact that they beat and raised, but some of that was at least to do with tariff refunds. Barclays certainly in focus as well. We spoke earlier on to the CEO. Equities traders certainly delivering for that particular business. We'll watch that stock at the open. And Mercedes has cut its revenue outlook on Chinese luxury. The Chinese luxury dynamics attached to the property weakness in China, it would seem, Guy.
OK, how do we factor that all into our thinking this morning? Let's find out. Let's show you some numbers, give you an idea of what is going on. I'm not sure over the next minute's going to deliver that much excitement, because Europe at an index level, as we've already articulated, is not doing very much. The FTSE is up by a staggering 0.1%. The Kospi closed down today by 11%. So the FTSE 100 flat, doing nothing. And there's been plenty of guests on the show talking about the idea that if you want to hide out, the FTSE could be the place to do it. Stock 600 is up by 0.1%. We'll wait for the CAC to arrive. It's got to factor in LVMH this morning, plus also looking forward to what is happening with Kering. DAX is going to be interesting, what happens with Mercedes. The IBEX is up by 0.7%. I'm going to look into why that is this morning. The AEX, let's see what the ASML story is this morning after the big rout that we saw yesterday coming through for that individual stock. So there's some really interesting single stock stories which are clearly moving things around. The CAC going to be interesting as well to delve into the details there. But at a headline level, Stock 600 is up by 0.1%, Anna?
Well, if you want to know where to hide out, the answer seems to be you hide out in some of the consumer-facing stocks, because that's where we're seeing the strength coming through. So personal care is the place to hold out. That is the best-performing sector, and within that, we see Unilever up by 5.4%. It's not only Unilever. Reckitt Benckiser is higher on the back of Unilever. We had Alex Morgan telling us about the numbers out of Unilever earlier on, but sales jumping on demand for Dove soap in India, in the United States, so that's clearly doing well for them. And that seems like, in the face of all of this tech volatility through the Asia session, and still ahead of us into the US session, maybe that is the calming thought that Europe can provide this morning. So that's the best performing sector, is personal care. To the upside, we do have actually most sectors in positive territory. We've got consumer products also on the rise. There are only 5 sectors in negative territory. Technology is one of them, and we're down by 0.8%. The likes of Soitec down by 3.4%, ASM International down 3.3%. So a continuation of yesterday's dynamic, it would seem there. I see SAP is up by 1.1%. So it's a sort of dialed back version of yesterday when it comes to the tech narrative then, Guy.
Barclays is down really hard. It dropped initially out of the gate really strongly. It's still down by 5%. Let's call it circa 5%. Is that credit exposure? Is that the FIC underperformance that we've seen coming through this morning? Is that what is ultimately driving that?
It's being read across into other UK banks, which is interesting. Not to the same degree, obviously, but NatWest is down by 2%. Lloyds Banking Group down by 1.9%. So is it something that's been said on the UK? We'll delve further into the details there and see if we can unearth something. But yeah, at first look, the numbers didn't look bad. And certainly when we heard from CS Venkatakrishnan earlier on, he was pretty confident about certainly the performance that the equity traders had delivered and the rest of the business. Let's widen the conversation. Talk to Paul Markham, Investment Director and Head of Global Equities over at GAM Investments, with us on set this morning. Paul, very nice to have you with us. Thank you. It was a really interesting day in markets. As we've been saying, Europe sort of stands out as an area of calm. Set aside the banking results for just a moment. An area of overall calm for these markets. The Stock 600 up by 0.2%. Yesterday we saw weakness in tech, of course. And through the Asia session, we see real weakness in tech. But is that what you're looking to Europe to provide? Some sort of diversification, personal care seems like the place this morning. But is that the story for Europe right now?
Yes, I think it is, Anna, and good morning. Thanks for having me. I think that the sector mix in Europe is really quite advantageous in this kind of market environment. It is quite heavy in some of those areas which may do better in this kind of more defensive market. It also benefits from more of that kind of value rotation that we may see as a result of some of the dislocation around tech. So I think from that perspective, you should probably expect to see Europe be a relatively good performer. That doesn't necessarily mean that it will make a whole lot of progress on an absolute basis.
Yes, and I have to ask you about the tech, the chip wreck that we're seeing through the Asia session, ongoing selling of all of these chip stocks back to levels that we haven't seen since April, which doesn't sound like very long ago, but we've been on a big old journey higher on some of those names since then. So how does that set us up for the earnings story around tech that we're going to get into this week with numbers from some really big hyperscalers and other big tech names? How are you thinking about the tech narrative as we head into those corporate earnings?
I think there are two aspects to it. One is the basic long-term fundamental story, which I think remains largely intact. The recent news that we had from Moonshot and Kimi, clearly the frontier is now has less of an advantage over some of these other secondary kind of models that we're seeing in AI, and that is a concern. However, I think that what we're seeing on the other side is very significant adoption of AI at a faster clip than we had been imagining. On the other side of that, this kind of position-led rotation was always going to happen at some stage, and it was always a question of what set it off. If you recall, last January we had something similar with DeepSeek, and we're having a similar thing again, and it's always likely again to happen in the summer months when volatility is higher because volumes are lower. So I think my view on that would be to stay in touch with the tech names, stay involved with them, but maybe at lower weightings and wait for the opportunity to add back to those positions as we go through to the rest of the year. And very quickly on earnings, it's damned if you do, damned if you don't. So I think this quarter...
On the CapEx side,
yes,
certainly.
exactly. So that kind of is being taken badly. And even the CapEx beneficiaries, some of the semi-cap equipment manufacturers, for example, are starting to underperform as well. So you can't really find a place to hide within that hardware space.
So this is a buy the dip opportunity.
Not just yet.
No, sure, not just yet, but it is.
But
that's what's
absolutely. I mean, if you think, for example, a stock like Hynix, and there's been a lot of excitement around the fact that, you know, it's on very low multiples. You usually sell Hynix on low multiples. You don't buy it on high multiples. But what you should expect is a higher multiple to sell on the basis that margins and pricing are increasing very significantly. So the fundamentals there are very, very strong. I just think that there are so many people on the same side of the boat that there is always going to be a situation where there is over-ownership of some of it.
So this isn't the end of the story?
I don't think so. I do think there will be a hiatus and a pause until maybe a bit later.
We go higher from here? Not from here, but we will go higher.
We will eventually go higher. This is not a definitive end, Guy, no.
Right, OK.
So, as you said, still intact, that underlying argument around AI and what it delivers, or the underlying argument around stocks. Can I ask you about the turbulence that we're seeing sort of under the hood on the S&P? Because I was drawn to this slightly complicated line, but I'll give it to you anyway, Paul, and see what you make of it. During 2026, up to this point, we've seen 8 occasions where the weekly gap between the best and the worst performing groups on the S&P has been a double-digit percentage growth. So there's just a lot of disparity within the S&P. And somebody, one of our colleagues has written a story about this and has looked back at the other times where we've had that occur, and it was 2000, 2001, 2009. So you can see where this question's going. I mean, are you concerned about the disparity that we're seeing between these different groups and what that tells us?
Yeah, I mean, I think, to start with the positive side, I think as long as we don't start to see the whole market dragged down because we have this skew towards tech. We have high ownership of ETFs and indexed products, which can lead to sort of stop-loss style behaviour, and then you start seeing a ratcheting down, and it becomes a trend, and it becomes a rout. I think as long as we don't get into that, then we're okay. And clearly, some of the rotation, you have these incredible stats where, the top 10 stocks in the S&P are worth more than the other 490 and all these kind of things. So I think that all of that, we're not yet into that territory. Clearly, if investors want something less volatile and they want to hide out somewhere, they're going to have to accept much lower or higher valuations on a peg basis, so lower growth style stocks. But as long as investors are staying involved, I think that's very healthy for the market. It's a broadening out, and I wouldn't be too concerned about that.
OK, so that broadening out is a good thing. How does it stand up to the chance that we get Fed rate hikes? And how are you thinking about the Fed? Because we're now at a, 40% chance? Some people thinking we could get a hike this week then. That's what that 40% tells you. Some people think, 4 in 10 people perhaps, are thinking that we get a hike this week. How nervous are you going into a Fed meeting where we have that kind of number?
It's a bit of a knife edge, isn't it, actually? Because, the employment numbers have actually been fairly healthy. But, there are some concerns that inflation is starting to get a bit sticky. And there is evidence, that the Fed is now much less clearly dot plot led than it was. You hear comments made about, for example, the UK economy, where inflation has been very hard to drive out of the system, and I think the Fed is aware of that. So I think that there is a chance that rates go up, and it could lead to a bit of a further bout of volatility in markets. That may well become an opportunity for a broader set of assets, but not necessarily just solely in tech.
Does fixed income provide the diversification? How do I diversify my portfolio? If I want to de-risk at the moment, if I'm worried about this volatility continuing, what do I do?
I think, to be honest, Guy, if you think there is still this risk of there being a Fed hike, clearly, fixed income is going to be a tricky place to be depending on where you are. It may be a little bit more or less volatile to be in kind of high free cash flow stocks, ones which potentially have high dividend yields. They could be a good place to be. The S&P, of course, isn't a fertile place for that. Europe is a good place for that. The UK in particular is a good place for that. So dividend yield could be a factor here, actually, in this kind of situation.
And all of this is going to outperform cash, is it?
They could potentially on a total return basis, but it might well be if rates being now closer to 5 than they are to 4, that cash for a short period of time could well be a place to be if you have that flexibility, particularly as an individual investor.
Paul, what are you thinking about the drop in oil prices that we've seen this week? None of us can, has a crystal ball as to what happens in the Strait of Hormuz and the Red Sea. But what assumptions do you have to make about the oil price and the extent to which this still drives market thinking and the extent to which we can put it on the sidelines?
The really big moves like we've had in the last few sessions where they've been nearly double-digit here and there in either direction are still a concern. I think lower 1 to 3% moves in the price just have caused fatigue in the market. And I think reacting to it does create a kind of whipsawing effect that as a portfolio manager is not really what you want to get sucked into. So from my perspective, I've tried to sort of ignore those moves unless they become either something which is more of a trend or if they're very, very sharp and very, very significant.
What's the big opportunity you're looking at in Europe, Paul, right now? I'm looking at this Unilever share price move up by 6%, most in 2 years, sales beating expectations. I mean, maybe not that particular company, but are you thinking about things that are resilient to all the volatility?
So it's a really key question, Anna, because I know for my time in markets, there's always been a very clearly defined set, until recently, a fairly clearly defined set of defensives. And those consumer staple style stocks, HPC style stocks, really used to fit into that category. The problem we've seen over the last few years on a fundamental basis for those kind of businesses is that branded goods in that space aren't as worthy of a premium as they used to be. Own brand at supermarkets has become a big trend. Input costs have become an issue. Emerging market growth has fallen away. So if you think about the sort of Latin America-driven growth story that people like Colgate and Unilever had in the 1990s and 2000s, that's gone away. So it's actually been quite hard to buy those names with the confidence you used to. It does seem like with this set of results, hopefully there's some kind of stabilisation coming around for Unilever. I think also the valuations reflect the fact that they don't have that cast iron sort of mid-single digit high cash generative earnings that they used to have. So I think that could certainly be an interesting area.
Costs are a big factor for those kinds of companies as well. Paul, great to see you. Thank you very much indeed for dropping by to see us. Paul Markham, Investment Director and Head of Global Equities, joining us from GAM Investments. Let's take a quick look at the Core 6, figure out what is happening here and get an understanding of kind of how the market sees the world this morning. Nestle on the right-hand side of the screen, talking about that theme. reflecting that theme that we've just been discussing. But ASML is down again this morning. Schneider is flat, which I think is interesting. LVMH, though, is up 1.1% this morning. So there's a lot going on in this market. Let's try and dig into some of the details a little bit further. Unilever is maybe a good place to start. So let's point Alex in that direction.
Morning, Guy. Yes, well, we saw the red head there. Unilever was up 6.5% just a few moments ago. That's the most in 2 years. And, of course, that's coming off those beats in the earnings. And also, it's worth noting that there is, well, there you go, as you can see, ticking up in the green as we're speaking, there is this overall transformation plan that the company is undergoing. And it seems that investors are liking that as well. It's the move away from the foods brands. Of course, we've seen the completion of the spin-off of the ice cream brand and the focus more on these products like beauty and well-being. Let's turn to banks, though. And after talking up the results, the sales from the equities traders at Barclays, you can see sharply down in the red this morning. And that potentially is because there were some misses on the fixed income trading. But also, when we looked earlier at the cross picture, looking across the pond and seeing how well stocks traders have done on the other side of the Atlantic, maybe people were expecting even more over here. Let's turn to Man Group, the investment firm. They also had some earnings out this morning, doing well. You can see up around 8% this morning, also on the move out of the gate. And then you have Orange. Now, just yesterday, they had a statement out, of course, the primarily French telco, about a new project into data centres. Well, also, they're up in the green this morning, advancing around 4% this morning. So a bit of a mixed picture there, but the real leader of the pack is Unilever, and that's coming off the back of those beats, guys.
Alex, thanks very much. Alex Morgan with some of the stocks that are in focus this morning and on the move this morning. We will continue the conversation around Barclays shortly. Shares dropping despite beating estimates. A host of reasons out there. Is it the costs? Is it what they've said about the UK part of the business? Is it the investment banking part of the business? And seeing all of these being cited by various analysts this morning. We'll get to that conversation next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
I'm absolutely pleased with the set of numbers we've published today. You know, our top line income of £8.1 billion is up over £1 billion on the same number last year. Profits of £3.3 billion are up 30% over the previous year. And the investment bank, as you say, has done extremely well, including my colleagues on the equity trading floor behind me. Equities are now 30% of Barclays. And remember, this was the house that fixed income built. And so the diversification we're seeing in the business, the strength we're seeing in our business is something that we're truly happy about.
The CEO of Barclays speaking to us earlier, and the stock is under a little bit of pressure this morning, and we've been citing a number of reasons for that, and different views coming from different analysts. We're down by just shy of 5%. Let's get the thoughts of Bloomberg's Charlie Wells, who's been combing through the details of what all the analysts are saying this morning. And we heard, good morning to you, Charlie, we heard CS Venkatakrishnan there saying that this was the house that fixed income built, and maybe there's room for a little bit of disappointment there. I'm not sure if we're just splitting hairs, but at the moment, something's pushing the share price down.
Before market open, it was looking like this was going to be in the green. Now we're in the red. I think there's a lot of questions here. And it was really hard to find a red flag, at least in the numbers that we saw, right? We saw beats across the board. We saw beats on equities. Equities has been the theme of this earnings season in banks so far. We saw, softness in FIC. That could be, as you mentioned, some of this. We saw, loan loss provisions. I think this was something that I was going to come on and say we should maybe check out loan loss provisions. Those were better than expected. So I think this could be a case of high expectations, right? The comparables are tough. The comparables are tough to the United States. We saw, Goldman Sachs reach, I believe, its highest level in the market ever on the back of these stellar earnings. Yeah. Stellar earnings from JP Morgan. I think this red is a mystery.
Can you compare? Every time we compare Barclays with Wall Street.
Right.
Is that a fair comparison? Wall Street now has easier regulations. It has it's freer capital. It's got better access to capital. You can fund these divisions more. Is it a fair comparison? It just feels like Barclays is a little throttled in terms of what it can do, and I can understand why. It wants to build a diversified business. Yeah. It wants to have all of these various engines firing, and it wants to be capital light in some respects. But can we compare it with Wall Street? Therefore, are those expectations the right ones?
I think your intuition there is right. I think like apples to apples is better than, American apples to... Are there British oranges? I don't know about that.
The apples.
Yes, exactly. But no, I think you're right. And I think looking at some of the European lenders that we're likely to see report this week, I think that's smarter. That's where we get more of this nuance, as you say. And I think, in that interview, which I think anyone watching now should go and rewatch, because it was really good, you asked, your first question out the gate to Venkatakrishnan was, is equities throttled here, right? They did make that pivot in 2024. They are trying to get growth out of that trading, out of that markets division, but they have imposed some self-imposed capital limits there. And so is this a missed opportunity? Is this an opportunity cost? And I think across the continent, we're going to get some really interesting takes here, right? Because 2019, Deutsche Bank, they pivot out of equities. We see a lot of different kind of, strategic moves. And so I think when you look, Europe to Europe, when you look cross-channel instead of cross-Atlantic, you get more of those strategic choice questions. I think those are a lot more interesting.
And we made the point earlier on, Charlie, that this was weighing on some of the other banks in the UK. So it's sticking even closer to the British apples, that we are seeing some weakness coming through in others. And is that because the market is saying, look, there's some specifics about the UK business that are making them nervous? And I'm pulling out this line from Citi this morning. Our concern is that the mix is likely to disappoint, with the three UK businesses showing a combined -2% profit before tax miss on a slightly weaker NII. And so if you're looking for something that is UK specific, and then there's the context of a new government, I'm not sure that's relevant today, but that is the wider context from the UK business.
And I think for a lot of investors, I think that's the kind of question about Barclays, right? You've got the markets business, the trading business, so important to their global ambitions. But then basically you've got this sort of domestic lender. And, that's a little bit different of a kind of put together than a lot of the other banks that you see, even in Europe. I think something that was interesting that did stand out to me was that growth in the United States, right? And we know that a lot of banks, we know Santander, for instance, is trying to grow in the U.S. So I think you see potential weakness in the U.K., potential growth in the U.S. I think, again, that's a kind of interesting shift that we should be watching.
I give you the Blenheim Orange, which is actually an apple here in the UK.
Is this the answer to the question? Is there a British apple?
Well, there are loads of British apples. Maybe
Sorry.
not on the British Orange, but I found the Blenheim Orange. Anyway, Charlie, very nice to see you.
I would eat it.
Yeah, that sounds very tasty to me. Very healthy as well. OK, let's talk about what else is healthy this morning, and that is the Mercedes share price. Up very nicely. This on the back of what is being described here as robust profits and cost cuts. China, though, is a factor in your thinking when it comes to this stock. China and luxury cars are certainly a struggle right now. Elizabeth Behrman, Bloomberg EMEA Autos Industry Team Leader, joins us. Why is Mercedes up as strongly as it is? Are these numbers that good?
The market certainly likes it. I think it's a case of better than expected or less bad than feared. If you think historically, a car-making margin of 4% is pretty dire. But on the whole, as we've seen from the German car-making peers of Mercedes, namely VW, and the Audi brand would be the direct competitor, of course, and BMW, they've all been reporting far lower profitability. What this result tells us is that some of the cost-cutting efforts at Mercedes are paying off. They're also launching this really broad product launch, and that's reaping some results as well for them.
It's really interesting, Elizabeth, to see that the market is taking the glass half full view of Mercedes today. And I mean, sometimes you see that when a market thinks the bottom is in and they're ready to believe again in the story and they're looking for the first signs of a turnaround. But this is a sector that is still under so much pressure.
Absolutely, it's still under so much pressure. And Ola Källenius, the CEO, also pointed to more cost-cutting efforts needing to happen, particularly at German sites. We know from VW that in Germany in particular, it's really hard to shave costs significantly because of the labor setups. Like VW, where the situation is even more complex for significant job reductions, Mercedes has a guarantee in place that precludes it from firings of workers for the foreseeable future. And at the same time, in the Chinese market, Mercedes is continuing to struggle. And during the second quarter, we saw how the market slide at Mercedes outpaced the overall market downturn. And that's because of course, of local rivals gaining ground, particularly at the electric vehicle end.
Elizabeth, thanks very much. Thanks for joining us. Bloomberg's Elizabeth Behrman with the latest on Mercedes, and we brace for other earnings from that sector, of course. Let's turn our attention to personal care, and Unilever is in focus, and this was one of the standout performers to the upside that we spotted out of the gates at 8 o'clock this morning. It's pared some of those earlier gains a little bit, but it's still up by 4.6%. And I'll pull out a couple of lines coming through from some of the analysts this morning. Standout is one of the phrases being used by Barclays analysts. Scant picking for the bears is another phrase I see coming through. Very strong volume growth, another phrase coming through. Emerging markets, there was a high expectation they'd do well in EM, but it's beaten those expectations. And so a host of positives around Unilever.
I did not expect a World Cup deodorant boost.
No.
But that's what I think is the hot weather.
Yes.
Maybe probably is a more contributing factor.
Yes.
Maybe the World Cup just.
You wonder what we discussed in the breaks. We were discussing this earlier on. Whether it's the World Cup, whether it's the hot weather. But Philips also in focus this morning.
So it's getting crushed. Stock's down by 9%. Why? We will find out shortly, but we are now trading at 21.39. I'm looking at a one-year chart. We are now at a one-year low on the stock. June, July has actually been okay. It's definitely rolling over now and rolling over pretty hard. Roy Jacobs is the CEO of this business. We're going to talk to him very shortly, 8:45 London time.
We'll be back with more on the markets shortly. This is Bloomberg.
my old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, you know, my dream is to play football and play professional football. And you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back, everybody. This is the opening trade. 30 minutes into today's session, and Europe delivers you something a little greener than the rest of the world and some earnings stories to digest this morning. So we're up by 0.3% in the overall markets. This really is in contrast to what we've seen through the Asia session. It wasn't just 10% down on the Kospi, it was also considerable weakness in Japan as well. But that's very much the tech theme. Europe played some of that yesterday. We saw ASML very much weaker on the back of concerns around Chinese competition in yesterday's session. But we're stuck here in Europe between that theme in Asia and then into the US. We are looking at Nasdaq futures and E-minis that are still negative. So it's as if the tech theme has further to go. But in the meantime, Europe does what it wants with its earnings stories. And we've had plenty of those. Top level then, Guy, we're making progress across European stocks, up by 0.3%.
It's amazing. It just kind of stands out so obviously as a big difference compared as a differentiator compared with some of the other markets we're watching right now. Let's break it down. Higher, 412. Lower, 177. Let's call that 2-to-1. Volume's actually fairly decent today, which is interesting as well. Tech got battered yesterday. Deodorant is doing well today. Let's talk about the deodorant trade. Unilever up very nicely on the back of its numbers this morning. The sector's up as well, so it's got a tailwind from that kind of rotation narrative that we're watching. But look at Unilever. It is up by over 5%. Now, LVMH was up. It's now down on the back of the numbers that were delivered last night. Remember, we've got Caring out with numbers a little bit later on as well. Let's call LVMH flat. Man Group, we had the CFO on the show a little bit earlier on. Inflows look strong. The market likes what it hears, and the stock is rising on the back of that, despite actually a fairly decent performance that has been delivered by that stock so far this year. Let's turn the tables and look at the underside of the table and figure out what we're seeing on the downside. Phillips, is this a cost story? Yeah, probably is a cost story. It's not a tariff rebate story because the stock is being marked down really strongly on the back of the numbers. Look, Phillips is down by 9% right now. Barclays is also under significant pressure as well. Why? I don't know. To be honest, I'm really struggling with this one this morning. As somebody pointed out to me a little bit earlier on from Bloomberg Intelligence, maybe it's simply that there's an awful lot of buys on Barclays right now, and maybe some of that is simply being unwound right now. There are other reasons out there. It could be just as simple as that. And ASML, after a big drop yesterday, is down by, let's call it another circa 2% today on the back of this continuing concern around what China is doing in the lithography space, Anna.
Let's get an update then, Guy, on some of the other stories we need to know this morning. Wildfires in France and in Spain that forced the evacuation of more than 300,000 people have stabilised, but officials are warning that another heat wave expected this week will make the fire's evolution unpredictable. The Spanish and French governments are now studying ways to funnel money into the regions that are impacted by these fires. President Donald Trump says the US and Iran are engaged in diplomatic talks to end the Middle East conflict, but warned the two sides would return to fighting if negotiations didn't yield a deal. Trump's remarks came after the US held off attacking Iran for a third straight day, and Iran paused strikes on Gulf countries. Separately, Bloomberg has learned that Oman and Iran are trying to reach an agreement to restart shipping through the Strait of Hormuz. And a sell-off in semiconductor stocks is continuing today as fresh signs of China's progress in the advanced chip making and mounting concerns over the AI spending boom spark another wave of selling across the sector. The Kospian's index plunged in the Asia session, triggering a trading halt, while memory giants Samsung and SK Hynix each slid more than 13%. Guy.
OK. Let's move on. Let's talk about what we're seeing in terms of the private credit story and what is happening. Holdings in private credit assets continue to rise amongst insurers and pension funds. And it's making people worried. Certainly been causing concern at a bunch of central banks. You take a look at what they're saying. The ECB is one that stands out. The growth in private credit holdings certainly is an interesting story that is quite niche at the moment. Does it become a wider story going forward from here? It certainly prompted one fund manager to launch a new fund to take advantage of any downturn in this market, i.e. the insurer's exposure to private credit. And if the private credit side of things goes bad, what happens with the insurer's share prices is basically the idea here. Let's talk to the founder and CIO of the company behind this, Lee Robinson from Altana Wealth. Good morning.
Good morning.
In 2 seconds, more than 2 seconds, 10 seconds, just explain to me what your concern is.
Well, having been through, the dot-com, been through the great financial crisis, been involved in those trades, involved in the Big Short, when you look at private credit and you look at the sheer amount of money that flowed in a short period of time, and the lack of due diligence that was done, it echoes the financial crisis, right? Bad decisions being made. And we saw this earlier this year with First Brands, Tricolor, MFS. We saw that due diligence wasn't being done. And then we start digging deeper and you say, well, who holds these awful positions, right? As you said, pension funds and insurers. And when we were interviewed on Bloomberg, hats off to the journalists Abinar, Liza and Tassos last month, we had a huge number of incoming calls. Huge number of calls from concerned maverick citizens who have done the deep dive to big hedge funds, to other people. And when you look at this, there's so many red flags. So you've got regulatory arbitrage. So clever people are saying, I can get better treatment of my insurance capital if I move to Wyoming or I moved from New York to somewhere else. So you've got regulatory arbitrage. Then you've got ratings arbitrage. You go, well, if I go with this rating agency, I'll get a triple B, but if I go with this one, I'll get a B+, so I'm going to go with this one. And then you find out that the private credit companies are giving the EBITDA estimates and the multiples to the valuation agents for their funds. And then you start looking at all these red flags and you go, hold on, what's going on? And then you look a bit deeper and you go, well, clever people are saying, well, if you put 30% capital as an insurance company against this debt, okay, it's maybe reasonable. But you know what? If we split it up into mezz and senior and equity, you can put 19% capital against it. And this all rings like subprime mortgages, right? So there's a lot of red flags coming through at this stage. And so just to finish, and then another red flag is, of course, you've got the parent companies pushing all the bad credits into their subsidiaries. So these cross holdings are happening. Well, you saw with Blue Owl when it had to, had those redemptions earlier this year. So people are very concerned about, shall we say, malpractices.
OK, so that's the theory. You created a fund to look at this and potentially interest in the fund. How much are you seeing? Are people putting money into it, or is this just kind of theoretical exercise at this point?
Look, we're trying not to be big-headed. We're very good at looking at asymmetric returns. So when we got into Bitcoin in 2014. Why? Because we thought it could go down 50%, but it could go up 10,000%. We got in the dot-coms because of the same thing. We got in the Big Short because we thought we could lose 2 or 3% but make 50. The great thing about this situation at the moment is the spreads are really tight. they're close to their all-time highs. Some of these insurance companies are 80 basis points, 70 basis points. They've been as tight as 60 basis points on the CDS. So if I'm wrong, I'm not paying a lot to get it wrong, and I can put a lot of leverage on that at 60, 70 basis points that I probably wouldn't at 200 basis points. So that's one thing. Volatility, implied vols are not that high. And prices of assets, including AI stocks that are related to a lot of this credit financing, by the way. There's a lot of them. Meta didn't even have a CDS a year ago. Right? It's now, even though it was issuing billions and billions of dollars.
Go on now.
Yeah, go on now. And you know which way that's going, right? I mean, it's not going to go to zero overnight. So you can play these trades, and then you've had the fraud. You came into January thinking there'd be 3 rate cuts this year. Yeah. So people were buying duration. People want to be in duration. Now you're talking about rate hikes. Yeah. You're seeing a situation where private credit was sucking in money from retail. You now got redemptions. And people are saying, well, the redemptions have peaked. Well, to me, the numbers are higher than quarter one. So how does that work? So you've got tailwinds that have turned into headwinds. You've got tight levels, and you've got malpractices. It sounds like a trade you should be in.
So it's a lot for you to worry about, or a lot of opportunity, perhaps.
A lot of opportunity.
Yeah, to out there, Lee. So in terms of the CDS and the way that you play this, which is in the main, or has been up to this point, a lot to do with the CDS, is this because you think that the concerns around private credit are so great that insurance companies are going to be in trouble? Or is it that you just think the CDS is mispriced and people don't see that actually there's more risk here than is priced into the CDS?
I think it's both, isn't it? I think you can have a perfectly good credit trading at 60, 70 basis points, but people get concerned and it widens out to 200, 300.
So it doesn't need to collapse. It just
and then it comes back again a month later and you take your profits. I think there's that. And then there's also that credit one really is a bad credit and you make a lot of money. But let's say you didn't have it in your portfolio, but guess what? Every risk manager has to cut all their positions. And this is what we saw in the subprime, right? As soon as the triple Bs were going down to zero, everyone had to sell their single As. And it's a risk-off scenario. So we think the big problem here might be that, let's call it insurance company A, I'm not going to name them. They got over 40% in level 3 assets, which means they're almost impossible to sell. Right? So when the regulator wakes up and says you've got to put more capital and you need to sell assets, they're not going to be able to sell the level 3. So they're going to have to sell the level 1s and 2s.
So you sell what you can, not what you wanted to.
So the spreads widen, I think, and so you get this credit spread widening in general across the whole sector as well.
And we have seen some central banks being a bit worried about this, as you...
not worried enough.
Not worried enough, you think? OK. But in terms of your underlying worry, so you're worrying about private credit and where the risks are there and whether they are mispriced right now. Is that because you think that AI is just going to be so amazing it floors software stocks? And is it based on a belief in the power of AI, or do you not need to worry about what AI really is going to do to?
Well, AI is not helping, right? In that it's sucking out a lot of money, right? I mean, you saw SpaceX do $19 billion of debt after their IPO, right? You've seen Meta do $27 billion. That money's coming from someone else's potential credit, right? So if you're not such a lovely name in the AI space, you're somewhere down the list and you're trying to raise money in June 2026 and you're not going to be getting any calls from your bankers if they've got to focus on SpaceX. So that money is sucking out, right? And it doesn't help that most of our governments are issuing a lot more debt that's sucking out there. So rates could be going up. Credit spreads are very tight. Who's going to buy this duration? So we think credit spreads widen out. And if they widen out, there's knock-on effects. Yeah. Less money comes into private credit. People start losing money. Pension funds have to sell assets. It becomes a vicious circle.
Outside of credit, we're seeing, though, growing concerns around what is happening with the chip trade, the AI trade more broadly. We're about to see a series of hyperscalers reporting numbers. Some of them are gone, and we saw this with Alphabet going cash flow negative. The game seems to have changed quite significantly. What do you see happening next? Like, how does this trade unfold?
Look, we all love AI. I think everyone loves AI. But one of the things that struck me from the article last month in Bloomberg was the number of incoming calls, which tells me that people, they talk in public how they love AI, they look like an old fuddy-duddy, doesn't understand it, right? But in the background, they're going, these prices are insane, right? The multiples of sales that are on quantum stocks, that are on chip stocks, that's cyclical. Who's buying these chips in 2032, 2030, when there are established winners? Because not Gemini, OpenAI, Anthropic, Grok, not all of them are going to be winners. And there could be Chinese winners, by the way. It might not be any of them. So if not all of them are winners, then this massive race at the moment to become number one, number two is over. They're not going to spend all that capex and all that money. So the forward earnings of these chip companies, I just not seeing where it is. So I think people are starting to wake up to the fact that these are companies that you're looking at for 20, 30 years of earnings. They're going to have a big order flow in the next 2 or 3. But where's the next 27 years coming from?
Lee, thank you very much. A lot to think about. Thanks for joining us. Lee Robinson, Altana Wealth founder and CIO. Let's move to something different. We just want to keep you updated with some other news flow that's happening around the world, and this comes from Japan. A magnitude 7.1 quake hits Japan's Kumamoto. A tsunami caution has been issued. This is all according to the Japan Meteorological Agency. The maximum shaking intensity was 7 on a scale of 7. So we're keeping this very much in focus and under review.
Coming up, we're going to be talking about Philips. The stock is under significant pressure this morning. The company warning of rising cost pressures. Certainly, it's grappling as well with waning profitability at its key diagnostics and treatment division. Input costs into that business, a challenge right now. Roy Jacobs is the CEO. He is next. This is
world's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation. As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlet Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. Excellent reporting.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Welcome back. This is the opening trade. Now, Philips shares are slumping this morning. The Dutch company is warning of rising cost pressures as it grapples with waning profitability at its key diagnosis and treatment division. Joining us now with some details, Roy Jacobs, the CEO of Philips. Roy, thank you so much for being with us. So the stock is under a bit of pressure today, down by 9%, Roy. And I wonder if we can talk about some of the things that might be driving that. Some of the analysts are saying there might be a difficulty in achieving your margin guidance. How confident are you about the margin guidance that you've given to the markets?
So actually, we are very confident on the full year margin outlook that we have been giving. Actually, we opted for the tariff refund. If you look at the first half, we are up 10 basis points despite increasing inflation and tariffs that we are paying. We have said that in the full year, we are dialing up our mitigation actions. We already had 258 million of productivity savings in the first half, and we are generating more in the second half. And as they phase in, including when our new products, our new innovations at higher margins phase in, that will give us the strength also in the margin for the full year outlook. So we are having a healthy pipeline in terms of what we see coming in orders and sales in the second half. Very strong momentum in the personal health business. And as these cost mitigation actions also come through, we feel really confident that we will achieve the full year margin, as we said in February this year, despite everything that's going on around us. And what we did actually do is increase the absolute amounts of the adjusted EBITDA and also the free cash flow for the tariff refund that we collected by very proactively going out to immediately preserve our rights and already get most of that into the Q2 results.
OK, so is there any more to come from the tariff refunds, Roy? What's your expectation? What are you factoring in?
So actually, the vast majority of what would come, we have actually banked. And we are very happy with that because that's actually cash that we have in. There's only a few millions left. So we more or less concluded the tariff refund process in the US. We now see also new tariffs coming. So that's actually what we have been prepared for. When we made the plan for the year, we assumed that we would have to pay tariffs all year long. Now, the fact that we could have an opportunity to claim back, we fully grasped, and also we kind of achieved the goal of getting that money back. And I believe we are one of the first companies who got it back in the vast majority of the refund.
Roy, good morning. It's Guy. Can I just come back to the margin issue? Diagnostics and treatments. The margin there was circa 25% below where the market was anticipating that it would be. Can you tell me why? What happened there? Can you give me some colour as to what happened with that situation?
Yeah, so if you look to Q2 margin, actually the total margin delivered 12.2, which actually was in line with what we forecasted. We had two businesses, personal health and connected care, that did substantially better. And then one business, D&T, that actually was lower. Still was in line with our plan, but below expectations for sure. If you look to the reasons for that, that is this increase in inflation, also tariffs that we are paying, as well as China impact that is coming into D&T. We said for the full year, we see D&T margins strengthening, but we need time to actually offset some of this cost pressure. And that's actually coming in the second half of this year. So that's where you see in the D&T segment that some of the cost pressure that currently already kicked in Q2 depressed the margin. There was also a one-off effect from last year. We had a service booking into Q2 that made the Q2 2025 margin exceptionally strong in D&T. So we keep the trajectory underlying where we see more contribution coming in at the gross margin level. We also see the cost mitigation. And that's also why we are confident that we can reconfirm the full year guide for the group, but also where we see the strengthening of the D&T margin.
What costs in particular caused that you're going to mitigate against in the second half? What was it that caused the problem there? What's led to that number?
So for the D&T business in particular, two. One is cost and freight. The other is also chip cost. So there is materials cost inflation that we see coming through. There are two drivers. Right. Those are the main drivers, and those we need to mitigate. So we know what it is. We also know how much it is, and we will mitigate in the second half.
Are you confident you've got your arms around that, though? Because both of those two costs are highly volatile right now. Freight costs are all over the place. We're seeing what's happening in the Gulf, the Red Sea. Freight costs, if you look at the numbers, are very volatile. Chip costs Chip costs have been rising very, very sharply, as you well know. Is that a moving target? Are those costs going to be even harder potentially in the second half?
So we have accounted for a rising inflation, including these and also including prices for those. So that actually is what we are offsetting and what we planned for. We also, if you look to one we guided at the beginning of the year, we also built in a margin, a buffer for unforeseen external developments. And this is exactly what we're looking at. So next to our underlying profile, we also had some room to offset. That's why when we came out with the full year margin, we are very strong in reconfirming that we will be within a range that we initially guided for at the beginning of the year, despite the cost challenges that we see, because we have the offsetting productivity, but also we see the traction of our innovations coming in at the gross margin line.
Can I ask you about the Chinese business then, Roy? And you've already referenced that this was part of the numbers for D&T coming in a little weaker. But we've got some strict domestic product requirements for a number of categories in China. And I wonder how that is weighing on your ability to do business in China.
Yeah, I think the China impact, and that's where we saw some new regulation coming out in Q2, where they have a new centralized procurement policy that they're now expanding across all of China. Now, what we have learned when they came out with centralized procurement earlier, but in certain spots, cities and provinces, is that this actually depresses the market volume in total. So actually what we have seen is the market in total is down. That is because you see prolonged timing to work through these new procurement processes. And that hits us, and we are in D&T disproportionately exposed to China because it's a big part of the revenue. And while we are building up, and we saw really good momentum in that in orders, in PD, double digit outside of China, that takes a bit of time before they come into sales. And that's also what you see coming into the second half. So we're shifting some of the volume of China. We have planned for that to be taken up from a stronger Europe and also a stronger North America. And actually the good news is that North America over 12 months is double digit order intake growth. And Europe in the second quarter was double digit order growth. So we really see underlying also that momentum is coming in.
Yep. Roy, great to catch up. We genuinely always appreciate your time. Thanks for spending some time with us this morning. Roy Jacobs, the Philips CEO. Let's get back to the market. Skylar's here. Europe looks like a sort of place to hide this morning.
Yeah, I mean, it's doing much better than Korea is. I think we need we need to remember that Korea is a very different market now than it was 10 years ago, but certainly than other markets globally. So I wouldn't expect the same kind of spillovers. Yes, particularly in tech markets, I'm more concerned. But, you know, one metric is if you look at ETF leveraged AUM in Korea over total ETF AUM, that's at 6% in Korea. So that's quite a high number. Yeah. In the rest of the world, it's 1%. So, you know, there's more room for speculation to come down in that it was 4% in 2025 and we had a peak of 8%. So we've only done half of that. But it's just a more volatile market. So, yes, spillovers, but maybe not as concerned from a high level, big downside, especially when there's not a really specific catalyst that you can see being negative for earnings in the U.S.
Right. So, yes, that's an interesting one, isn't it? Because will we get a catalyst this week with all of the earnings reports that we get in the US? Did we see the catalyst last week with the cash flow negative on one of the big tech names? Are we still in search of a catalyst then to really crystallise negative sentiments around how far the tech story has run?
Yeah, I think we are. In terms of, yes, earnings have been stronger than expected, and that hasn't boosted the market. But I think until we see kind of broad-based downsides, so not just in those big names that are reporting, but over a longer term and in multiple stocks, not just your tech stocks, you're more worried about global growth, then you can kind of still continue. What worries me is when we get that catalyst, yes, you know, you don't have leveraged ETFs in the same way in the U.S. market, but you do have general leverage is very high in terms of margin debt in the U.S. in June reached a peak high. It's at levels, if you have a denominator in there in terms of total market cap, that are pretty concerning relative to the .com, relative to the 2021 bear market. So if you do get that catalyst, not necessarily we'll get that this earnings season, but when you do get it, I'd worry that there's quite significant downside.
It all gets very complicated, Guy, tracking the twists and turns of the tech story. So in the face of all of that, we have Unilever and Reckitt Benckiser up pretty strongly in this morning's session here in Europe.
Europe's the place to hide. Deodorant's the place to be.
It seems so. This is the theme of the morning. 8:56 here in London. That's it for this programme. We'll be back with the Pulse shortly. Thank you to Skylar. That was the opening trade. This is Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. Rates, risk, and the cost of capital on Bloomberg Real Yield. And personal finance, retirement, and wealth management on Bloomberg Money. A different topic every weekday, only on Bloomberg Television.
Newsmakers and market movers. This is The Pulse.
Good morning, everybody. Welcome to The Pulse. I'm Anna Edwards, live in London, and these are your top stories. The global chip rout deepens on AI spending fears. Slumps in Samsung and SK Hynix point to cracks in the memory chip boom. Barclays shares slide the most in more than a year, despite the UK lenders, equities traders and investment bankers beating estimates. Plus, oil and gas fall further as President Trump says there's a good chance of a deal with Iran, but Tehran denies formal talks are taking place. Let's check on some assets for you then. Real weakness coming through from the Asia session. It isn't just the Kospi, but the Kospi certainly stands out. Very driven by two individual stocks, of course, but down by 10.8% just in one day on that major market. The Japanese market also under pressure. Nasdaq futures then looking to pick up that negative baton by the time we get to the US session, and Nasdaq futures are down by 1%. In amongst all of that, we're pretty flat on the euro dollar. The Brent price, though, thankfully does continue to retreat. We're down by 2.8%. 85 now the handle on another calm night in the Middle East. Let's take a look at the European markets map, because this tells a very different story to the tech rout we've been talking about. There's a lot of earnings news in here. There's also a lot of resilience, it would seem, in European stocks, resilience away from that tech story. And so that seems to be where Europe is playing its card this morning. We see personal consumer goods companies doing pretty well on the back of maybe some haven flows and some earnings. Let's just get up to date with what we're doing on SK Hynix, on the ADRs there in pre-market. Just to give a sense of where this trend goes, it looks as if we've got further selling to go. We saw selling on the Philadelphia Semis Index yesterday. That went into Asia. We see a continuation of that through the Asia session, and it looks to be into the US session once again, with those ADRs under pressure. So the global rout in chip makers has deepened further, looks to have further to run. The losses coming after a Chinese state-backed firm reportedly began producing machines that could rival ASML's dominance in that space. Meanwhile, rising levels of corporate leverage have pushed pushed the cost of insuring Nvidia's debt higher after it announced fresh deals. Let's talk to Bloomberg senior strategist Neil Campling, who can bring together some of these disparate threads, a host of factors then weighing on the tech trade, weighing on our confidence around chip stocks, Neil, and not just chip stocks, but those companies that make the equipment that makes the chips. Let's go there first, because we do seem to be worried about Chinese competition in lithography. To some degree, this was Europe's story yesterday. ASML was considerably weaker on this story in yesterday's session. But how should we think about Chinese competition right now?
I think, Anna, the issue on Chinese competition is concerning to many players in the market because, of course, we've had lots of IP restrictions on technology going into China. And yet, somehow, China seems to have gone up the technology curve substantially in terms of the ability to produce chips, the ability to create AI frontier models, and potentially now even into chip equipment, which, of course, ASML is really the monopoly for both what they call deep ultraviolet, DUV, and EUV, extreme ultraviolet machines. So that's where I think the concern is coming in from that. And then with regards to the likes of the NVIDIA situation in terms of the circular deals, this isn't a new story in of itself, but the numbers mentioned in terms of dollars continue to move higher and higher. And the worries are how much of the AI ecosystem is being, if you like, artificially inflated by NVIDIA's kind of financing of their own ecosystem.
OK, and so all of this sets us up for an earnings season still to fully play out from the big hyperscalers in the United States, Neil, in a very nervous fashion, doesn't it? We're concerned about circular financing around NVIDIA and the AI space. We're concerned about Chinese competition, just how much of a build-out do we want to see from these chip companies? And then we're waiting for at least 4 really big corporate earnings from the tech space this week.
We are indeed, and I think the kind of the litmus test last week was the fact that Alphabet delivered their first ever quarter since going public of negative free cash flow. So what are we going to hear from the other tech giants this week? And as you mentioned at the top of the hour, regarding sort of the increasing cost of the debt within the hyperscaler sector. So we want to see where the free cash flow trends play out. And then whether any of those big tech firms will actually blink first and slow the pace of capex. That's not something that we necessarily know just yet, but it's certainly something to watch for this week. Meanwhile, of course, there is another big tech company, Apple, who are not investing hundreds of billions of dollars into the AI race. They're probably waiting to see who wins out, and then we'll sign a deal later on down the line, I think.
OK, and we get earnings from Apple as well, don't we, this week? Neil, thank you very much. Thanks for the update. Bloomberg senior strategist Neil Campling pulling together all of the themes that are weighing on sentiment around technology. Let's talk now to Laura Cooper, global investment strategist and head of macro credit at Nuveen. Very good to see you, Laura. Thanks for coming in. How concerned are you then about the tech dynamics? Do we set aside what we see on the Kospi and say that's a very different market, it's very volatile, it's very influenced by just 2 companies, and they have a fairly volatile track record recently? Do we set that aside as being different, or are you overall concerned about what we see in the tech landscape?
So there are idiosyncratic factors that are driving the Korean stock market in particular, most notably the ample leverage in the system. And yes, we are seeing a high degree of correlation with the U.S. NASDAQ. But I think at this juncture, we're not overly concerned about drawdowns in the tech space. And that's largely because of the earnings backdrop does remain exceptionally robust. There's questions around the return on investment from a lot of this CapEx spend, but we're not yet seeing signs of cracks there. And even if we look at margin expansion, really it's being driven by tech. So not any meaningful concerns. The key risk, I think, to watch for is when we see that first hyperscaler signal they're going to pull back on CapEx. I think that's when we could start to see some of this momentum really start to falter.
Yeah, it's interesting, isn't it? As we look ahead to so many earnings reports from these hyperscalers, Laura, you're pointing to the CapEx number, which I'm sure is where everybody is focused. But it's hard to know how the market is going to receive these CapEx numbers, because on the one hand, if you give a big number, does that express confidence? But also then, does that make people nervous about how much you're spending and how quickly? So is there kind of a Goldilocks hope when it comes to CapEx and hyperscalers? I don't know how they get it right this earnings season.
Well, and it's a key question for investors. You know, how much patience do they have before they start to see real meaningful returns on some of this investment? So far, investors seem to be continuing to want to bet on these big AI ambitions, and I think that's going to continue to dominate. If we take a step back, though, and look at valuations, we are seeing valuations come off their June peaks, but still well above the 5-year, 10-year averages, looking at that S&P 500. So I don't think we're going to see these AI ambitions really drive more multiples expansion. It's really going to come from that earnings backdrop. And because tech continues to show such robust earnings, we think that's going to continue to drive the market higher, albeit we're going to see these bouts of volatility, particularly in August when we're going to see lighter liquidity.
And we'll think more about the European earnings season in just a moment. But I wonder how the central bank narrative then rubs up against the tech story, because do we think that the tech narrative is robust enough to withstand higher interest rates? And will they come from the Fed? Even as soon as this week, Laura, what's your thinking?
Well, there's two great questions in there. I think on the one hand, the hyperscalers and the amount that they're tapping into the debt capital markets in particular at the longer date of the curve, that's actually adding to this higher for longer yield backdrop. So that does add a little bit of a conundrum, let's say, for the Fed. But I think the Fed is going to be really the key event risk of the week. And that's because very unusually, markets are pricing in, about a third chance that they could hike. That's double where they were a week ago. And that's very unusual. If we look over the past decade or so, the Fed has well telegraphed what the moves could be. And so I think this is investors having to grapple with this new Warsh regime of no Fed guidance. So I really am watching for that rate decision tomorrow.
Yes. And so 30-40% expectation that we get a hike as soon as this week. As you say, we don't normally go in with such sort of divided opinion, but this is by design, isn't it? The Fed chair wants us to think more carefully about the data we receive and make our own judgments about whether rates will go higher. Do you think then that we're going to end up with higher rates? How many hikes do we get this year, Laura?
Oh, that's a great question. It's less about when, but more about, it's less about if, but more about when. But I still think at this case, if the Fed is data dependent, like they're saying they are, the data since the last meeting, we've had softer than expected inflation. We've had a weaker payrolls print with that June around 57,000 for the headline. So the data itself doesn't suggest the Fed needs to hike in the near term. But that being said, we do have oil price volatility that's come back into play. That can lead to higher core inflation. And as well, if we look at the June meeting, just the amount of Fed members that were quite hawkish, anticipating anywhere from 1 to 3 hikes this year. So I think we're going to see, greater dissent. I think we're going to see, more speculation that the Fed could potentially hike rates. But if they do go tomorrow, markets are likely to extrapolate that even further. And I don't think the Fed is at that juncture where they want to do that because the data doesn't support it. So I think on pause for now. And we're still leaning against the need for a hike this year.
OK, Laura, thanks very much. Stay with us. In fact, we'll get your thoughts on the earnings season in just a moment. Laura Cooper from Nuveen. Now, Barclays equities traders posted their best second quarter haul in 4 years, driving an earnings beat and an upgrade to the British Bank's annual outlook. But that hasn't been enough to impress investors. Shares falling in early trade. CEO CS Venkatakrishnan told us he remains optimistic about the outlook.
I'm absolutely pleased with the set of numbers we've published today. Our top line income of £8.1 billion is up over £1 billion on the same number last year. Profits of £3.3 billion are up 30% over the previous year. And the investment bank, as you say, has done extremely well, including my colleagues on the equity trading floor behind me. Equities are now 30% of Barclays. And remember, this was the house that fixed income built. And so the diversification we're seeing in the business, the strength we're seeing in our business is something that we're truly happy about.
CS Venkatakrishnan there. Bloomberg's Charlie Wells has been looking at all of the details here that we've got from Barclays this morning. Charlie, good morning. So what does the share price reaction then tell us about perhaps the expectations going into this print? Is that what they've become a victim of this morning?
Well, Anna, that's a very good question, because this red behind me really is one of the key puzzles of the market this morning. Barclays reporting a really solid set of results. They beat on a number of fronts. They beat on equities. They beat on investment banking. And what we're really picking up on so far, if we flip and take a look at some of the misses here, that really seems to be what a lot of traders are focusing in on here. FIC in particular, right? You can see a miss there. Not a huge miss, but one that the market seems to be paying attention to. You see softness in that U.S. consumer revenue as well. And again, some difficulties here on operating expenses. So again, a solid set of results. They were in line with the trend that we've seen at a lot of global investment banks, but the market this morning not liking what it's seeing.
Yeah, so the market selling this stock. How do these numbers then from Barclays compare to those that we saw on Wall Street? Because inevitably, those are the kind of comparisons that get made, certainly around some parts of the business.
Well, Anna, that's one of these relativity issues, right? So even where we see beats, you can see that we're just not getting the same growth that we see in some of these American giants, right? So let's think about equities trading. This has been one of the key areas that traders have really been focusing on, analysts have been talking about, and you see in that second quarter, you see year-on-year growth at Barclays up 45%. That's a great figure, but not so much when you compare to the likes of, say, JP Morgan, where we see a growth year on year of nearly 86%. So again, this is where Barclays beat. Let's flip and take a look at where they missed expectations, because what we see is in that FIC number, you saw a little bit of growth, right? You saw a little bit of growth in FIC at Barclays, up 1.4%. That still missed expectations. Let's look at some of these other areas. Let's look at Goldman, up nearly a third there in that FIC space. So these comparables are difficult too. You're not just getting these misses, but when you compare some of the beats and some of the misses to the American counterparts, you get difficulties there. But let's just zoom out, right? Let's keep this in context. A lot of this movement is intraday, but if you take a look at the Barclays share price over the course of this year, we're up. We're up significantly, right? And we're up even compared to some, well, at least we were until today, some American competitors. So look, intraday, this is difficult, but if you look big picture, you still see Barclays in a prime position.
Charlie, thanks very much. Bloomberg's Charlie Wells with the latest on Barclays. Let's get back to Laura Cooper from Nuveen. Think about the earnings stories more broadly than just the tech space. We've talked about the tech sector already a little bit, Laura. Here in Europe, we have a standout story, really, by today's standards, because European stocks are flat. And all of that in the context of real tech selling, and the earnings stories are, in some cases, not in the case of Barclays, but in some cases are supporting stocks here. Are you looking to lean into some of the personal care companies, the more defensive companies, at a time where we're nervous about tech?
Well, I think Europe has been a really surprising story so far this year in terms of its resilience, despite everything that's being thrown at it, from the geopolitics to the energy crisis. And yes, I think there are pockets of opportunity in Europe. One area, as you alluded to, is around energy. We're seeing exceptionally strong earnings, and that is proving to be more of that geopolitical hedge. But other pockets, including banks, despite some idiosyncratic earnings stories, because valuations are relatively attractive. And there is some degree of AI exposure in Europe as well that can benefit in terms of looking at metals and miners, because the copper dynamic, we're quite bullish on copper. That's going to have feed through there. So I think there are opportunities, and we're seeing that actually translate in terms of broadening in the European earnings story.
Yes, it's interesting. You can see how companies in the basic metal space might benefit from AI. We keep asking CEOs to give us a sense of the return on investment in AI, and we're not getting a huge number of answers just yet, which is interesting in itself. You mentioned the banking sector. You do think it's cheap then, I guess. And what is it that you see that will change the cheapness on banks? What's going to drive a re-rating of this sector?
That's a great question. I mean, if we start to see signs of the European economy come under pressure, perhaps the resiliency of the consumer could start to be challenged. We'll start to see more loan loss provisions come through. But that's not our base case at this stage. We are seeing already leading economic gauges in terms of PMI have an upturn more recently. We expect the European economy to have a more pronounced recovery next year on the back of fiscal stimulus. So I think at this stage, the valuation story overlaid with the growth dynamics is still quite compelling.
Yeah, and in that context, in the European context, we have a central bank meeting this week. That's the Bank of England. You're expecting a cautiously hawkish message coming through there. Is that going to be the theme of the week then?
And I think that is going to be the key theme, in the sense that, policymakers don't want to be overly hawkish, because the data doesn't necessarily support that, with both inflation and the labor market deteriorating at the margin in the UK and the US. But as well, they're also not going to want to out-dove the market or be, too dovish, because we are still dealing with geopolitics, renewed oil volatility. So the energy price risk still remains. So it's kind of threading this needle, I would say, for them. And so, yes, I think cautiously hawkish is the way to describe it.
Okay, Laura, thanks very much. Laura Cooper, Global Investment Strategist and Head of Macro Credit at Nuveen. Coming up on the programme, Ukraine's president heads to a meeting with President Trump in Washington after securing jamming technology from the UK. Details next. This is Bloomberg.
Up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Welcome back. Now, President Trump says that the US and Iran are engaged in diplomatic talks to end the Middle East conflict, even as Tehran says that no formal negotiations are taking place. But President Trump also warned the two sides would return to fighting if negotiations did not result in a deal.
They want to meet, and we're meeting. We'll see what happens. There's a chance we can make a deal. Without what we did, they wouldn't even be talking to us. They requested a meeting through their surrogates and directly. And we're meeting, and, good things can happen, I guess.
Let's get more details with Bloomberg Horizon's Middle East and Africa anchor Abir Abu Omar. Abir, how realistic is a deal then between the US and Iran? At the very basic level, they have differing accounts of whether they're even talking to each other.
Good morning, Anna. Yeah, you're exactly right. I mean, you heard the back and forth in the president's own remarks just there, saying that a deal is possible. But then if it does not happen, then the United States will go back to hitting Iran. Now, this follows a halt in attacks by both the United States and Iran. This is after 13 consecutive nights of strikes by the United States on targets in Iran. All of a sudden, on Friday, the U.S. stopped attacking those targets without giving any explanation. Iran later on Sunday saying that it will suspend its own attacks as a result of the U.S. halt. But when it comes to actually reaching a conclusion or reaching a deal, as President Trump had suggested, we just do not have enough clarity yet, Anna. There's no sign to indicate that there are any substantive negotiations happening between the two. President Trump did say that Iran did reach out directly and through surrogates to the United States to have conversations. Iran says through the foreign ministry that while it could send messages through mediators and delegates, there's no concrete conversations happening at the moment. And so this is what we're waiting to see, whether actual negotiations similar to the ones that have taken place after the MOU was signed in Switzerland will take place over the course of the week or over the next few days, really.
And, of course, from an energy market perspective, oil continues to drop. $85 now the handle on Brent. We understand that Iran and Oman are looking to reach an agreement to restart shipping through the Strait of Hormuz. What progress is being made there?
Yeah, Brent seems to drop by the hour. Every time we speak, it's a little bit lower, Anna. And so what we know, and this is a Bloomberg scoop that was reported earlier, is that Iran and Oman held talks to restart movement through the Strait of Hormuz. Now, we don't have a lot of clarity still about what that mechanism will look like. We have, from historic sort of evidence, stuff to suggest to us that Iran and Oman were developing a mechanism to start shipping, to start charging fees for ships that are moving through the Strait of Hormuz. We don't know if those discussions were the ones that were taking place. But look, both the United States and Iran need shipping to start making its way through the Strait of Hormuz yet again. As of now, ships are pretty much paralyzed because while the United States had stopped attacking Iran, it maintains its naval blockade on Iranian ports. And then Iran is also threatening all ships that are not sticking to the routes that it had laid out. So you're seeing traffic at a standstill pretty much. Very little ships are making their way through. And then parallel to all of this, on the other side of the peninsula, you have a risk at the Red Sea now, which Saudi Arabia had resorted to throughout the course of the war, really, because of the shutdown in the Strait of Hormuz. So you're seeing the parallel war or the parallel aggression between the Yemen Houthis and Saudi Arabia taking place, putting further risk on the Red Sea, on the Bab el-Mandab Strait. And so that is a risk that has emerged over the past couple of weeks or so. And so there's a distinction to be made here, Anna, between what oil markets are interpreting and the drop that we saw over the past 3 days in Brent crude prices, and between what is actually happening on the ground, and that is a paralyzed movement or a semi-paralyzed movement in ships and tankers.
Abir. Thank you very much. Abir Abu Omar, Bloomberg Horizons Middle East and Africa anchor. Sticking with geopolitics, the UK has agreed to share technology with Ukraine that can jam Russian air defence systems. The agreement to share the so-called stone cloak system came as Ukrainian President Volodymyr Zelensky became the first foreign leader to meet with the new British Prime Minister Andy Burnham. Zelensky is now in the United States and will meet President Trump later today. Let's get more details with Greg Sullivan, who joins us now. Greg, good morning. So President Zelensky had a tough time at home. What does he need to bring back from these trips? Of course, there's been he's been having to deal with a lot of changes in his cabinet, making a lot of changes in his cabinet. What does he need to? What does success look like from this international visits?
These are both very important visits for Zelensky, and he can't come home empty-handed. And he won't, as you said, already securing the technology to jam air defenses from the UK, this so-called stone cloak, which will help his own drones make it through air defenses as they continue a campaign of long-range strikes within Russia aimed at bringing the cost of the war home to ordinary Russians and increasing the pressure on Vladimir Putin. But more immediately, and especially in Washington, he'll be seeking to bolster his own air defenses. Of course, Trump said that he agreed to allow Zelensky and Ukraine to domestically produce the Patriot anti-missile systems at home. However, that will take a while to ramp up. So while they will discuss next steps for that system and domestically producing them, they also need to discuss how to bolster, how to fill in the gap for Ukrainian air defenses amid Russia's own airstrikes, which are turning increasingly deadly amid a deficit of these interceptors. So that will be top of Zelensky's agenda. He'll also look to discuss sanctions pressure on Russia as Washington looks to consider a new package of sanctions very soon. So he'll want to discuss that with President Trump. And again, all of it aimed at trying to increase the pressure on Putin to come to the table.
Yes, Greg, so it's about sanctions. It's not about peace deals, but I suppose they're trying to get towards a peace deal. How elusive is that proving to be?
Well, it looks pretty elusive from where we sit right now. Now, President Volodymyr Zelensky did say that last week he talked to U.S. envoys Steve Witkoff and Jared Kushner, and that they had a productive discussion about restarting diplomacy. But at the current moment, there are no signs that talks look ready to start. President Vladimir Putin has stuck to maximalist demands, including to gain territory that he does not control militarily. He has not backed away from those demands. He's even rejected an open call from Zelensky to meet and negotiate an end to the war. There are also signs that the Kremlin has hardened its position, feeling that perhaps potentially some understandings that were reached with President Trump at the Alaska meeting last year have potentially collapsed. So potentially hardening that position, it does not look like there's any momentum towards restarting the talks. They've been stalled since February due to Washington's focus on the Iran war. So.
Greg, thanks so much. Thanks for the update. Bloomberg's Greg Sullivan joining us there with an update on Ukraine. Coming up, we will discuss the outlook for deal-making in Europe as the continent's companies attract renewed interest from investors. What does the M&A picture look like in Europe? That conversation coming up shortly. This is Bloomberg.
Look at the more successful economies in the region. The key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The term for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning. Welcome to The Pulse. I'm Anna Edwards in London, and these are your top stories. The global chip rout deepens on AI spending fears. Slumps in Samsung and SK Hynix point to cracks in the memory chip boom. Barclays shares slide the most in more than a year, despite the UK lenders, equities traders and investment bankers beating estimates. Plus, oil and gas fall further as President Trump says there's a good chance of a deal with Iran, but Tehran denies formal talks are even taking place. Let's talk about deals. Deals targeting European companies are on course to top $1 trillion this year, recovering from a dip following the Iran war. European listed companies are commanding average premiums of 24% from buyers, a figure well above the average for the last decade. Let's discuss that, the deals outlook, with Anna Scotland, who is co-head of EMEA Investment Banking and EMEA head of the Financial and Strategic Investors Group at Goldman Sachs. Anna, nice to have you with us. Thank you for being here on The Pulse. So what is driving this renewed interest in M&A, do you think, in Europe?
What I would say is, and I was here in November last year, and we had predicted that we would see a resurgence in corporate M&A, and that has really played out this in the first 6 months of the year. if you look at the 20 largest deals, which we basically had 20 deals above 10 billion, 15 of those are corporate deals. And these are deals that some of them we've been waiting for some time. If you think about the TK elevator sale to Kone, that was sort of expected maybe last time around when Advent and Siemens bought the business, but it happened now. So I think, it's sort of played out. And I think it's really this volatility which paradoxically is actually driving more decisive deal making. Not making a decision and not going ahead, in this uncertainty is probably a decision as well. So we are seeing more confidence and active forward-leaning stance than we've seen in a long time.
So would you say capital markets activity is continuing despite the sort of volatile geopolitical landscape? Is that what we're seeing? Are we just more accustomed to a background level of volatility that we just have to accept as a new normal and get on with deals regardless?
Yeah, I think that's right. Combined with the fact that you have these sort of once in a generation, several generations maybe, change in technology, underlying change in technology around AI. And then you have geopolitical, obviously, volatility. But also, I would say, corporates are sort of realizing that they need to act. Corporate simplification has been a theme for some time. We are continuing to see that. For example, the Volkswagen sale of Air to Bain.
Yes. I mean, we've talked a lot about private equity over recent years and how they've, in some cases, not been able to offload companies that they've wanted to either bring to market or to sell on. Is that going to get easier? Is it already getting easier? What does it mean for PE exits, the fact that we're seeing this activity?
Yeah, I would say this. If you take a step back and just look at the overall M&A market markets in volumes is up like 50% almost. Europe is actually up 90% because we've seen a lot of, the corporate deals, as I've mentioned. If you look at entries by private equity, that's also up. But it is true that, maybe sponsor M&A was a little bit slower than we hoped for in the first quarter. We've seen a sequential uptick in Europe in Q2. And we believe that that's going to continue. Now, it is this sort of different kind of deal making, selling into corporates, taking stock in exchange for instead of cash, for example. We're seeing continuation vehicles. We're seeing minority stake monetization. So the deal making is more varied. I would point out, though, that we've seen more entries and more deployment than, last year. So that's really encouraging.
And you mentioned technology and how we have such a, changing landscape when it comes to technology. Is that proving to be a catalyst for M&A within Europe?
For sure.
Yeah, trying to get hold of the right technology quickly.
Yeah, for sure. And by the way, if you don't do it quickly, I think we just put out this report talking about the sort of volatility paradox and also another one around AI and how it's driving deal making. If you look at the industries which have been active in Europe this year, it's industrials and business services. Last year, it was TMT. So it's interesting to see how that AI technology catalyst, I would call it, is driving M&A in other sectors than strictly tech. Yeah. And we expect that to continue.
And how's all of this being echoed in the IPO space, in the ability of companies to come to market to raise funds? We've talked about successes this year, but we've also had stumbles, some from the defence sector, spring to my mind.
Yeah.
So what does the landscape look like for IPOs?
Yeah, listen, going public is, it's a start of a journey, I often say. And, I worked on many IPOs over my career. And, it's rare that you see a sort of straight line, particularly in this uncertain geopolitical volatility, etc. What I would say, though, capital markets are open. Capital markets want to fund growth. And we, expect the best companies to be able to come to market. Now, if you have an event which happens exactly around your transaction, it's probably not the most prudent thing to go because you do want to deliver on returns for investors from day one. So I would say, yes, capital markets are open. We expect to see continued IPO activity. But it's not going to be a straight line. It never is.
Yeah, never a straight line. The AI theme has been so dominant in the US and Asia, certainly, less so in Europe, but there are opportunities within the AI space in Europe. They just look a bit different, it seems. That's what a lot of people are telling us. So how does the AI landscape impact on Europe? Is there less crowding out of other themes in Europe than maybe is happening in the US and Asia?
Yeah. Listen, first of all, I'm super excited about the opportunity for AI and technology broadly for European companies. We have a very, very strong base of highly performing industrial companies. I mentioned industrials being one of the most active sectors in M&A this year. I think that's going to continue. Industrial tech, European companies are optimally placed to take advantage of that. So that's an exciting theme. Business services. Financial services. Listen, I think in healthcare, I mean, I could go on, right? Like, I think what we saw being mainly a tech-based activity, maybe in 24 and 25, has already spread to other industries. And I think it's going to be a catalyst for M&A.
And if we want to get excited about that, we keep asking the CEOs about return on investment, from AI spending. And we don't always get a lot of detail on that front. And it's quite difficult. It's quite the sort of costs and benefits seem quite dispersed around the P&L. So difficult to say exactly what it's delivering. Do you see the evidence you need? Are the clients you talk to really confident that they're getting what they need from their investment in AI?
Maybe a couple of points. First of all, taking a step back, it's called a frontier technology, a generational technology, for a reason. This is going to play out over many, many years, even decades. And therefore, I understand our clients who do not want to necessarily sort of put hard numbers up front today. It will probably be a mistake to do so because it's going to play out. So what are they doing? They're identifying areas where they're going to see the benefits. We do so ourselves, be it in client engagement, be it in certain of these work streams that we have, work processes that we have identified. So I understand. I wouldn't say it's a reluctance to commit to numbers. It's being strategic with this technology. And that, I think, it's the right thing to be.
And this boom, if we can call it that we're seeing in M&A and this corporate activity, does it withstand higher rates? Do you think we're going to end up in a position with higher rates than, Anna, if we get, the Fed is in focus this week, the Bank of England, the BOJ, but we've seen a hold from the ECB, of course. But are you expecting higher rates, and will that disturb what we're seeing?
Yeah, listen, financing markets are super conducive. Like, they are there to finance both strategic M&A, this CapEx way we're seeing. Rates may move, but I just don't see that putting a lid on this activity because it's strategic, it's multi-decade, and it's exciting.
OK, Anna, thank you very much. Thanks for bringing us the excitement. Anna Skoglund, co-head of EMEA Investment Banking and EMEA head of the Financial and Strategic Investors Group at Goldman Sachs. Now, Barclays shares are slumping this morning despite an earnings beat, as results showed its US consumer banking and investment bank growth there lagging larger rivals on Wall Street. We spoke to the British lender's CEO about the results.
I'm absolutely pleased with the set of numbers we've published today. Our top line income of £8.1 billion is up over £1 billion on the same number last year. Profits of £3.3 billion are up 30% over the previous year. And the investment bank, as you say, has done extremely well, including my colleagues on the equity trading floor behind me. Equities are now 30% of Barclays. And remember, this was the house that fixed income built. And so the diversification we're seeing in the business, the strength we're seeing in our business is something that we're truly happy about. And to your question, we are doing this in a very disciplined way, with disciplined capital, disciplined cost control. And the revenues keep going up, the returns keep going up. And we're doing it on a fixed capital base and really sweating it. And our capital efficiency is much higher than we thought it would have been at this time. So I'm pleased with the numbers all around. I'm very, very happy with the progress in fixed income, particularly in securitized products, which is a business we've built from nowhere to being high ranking on Wall Street. Our credit businesses are very high ranking. Our depth with our clients keeps increasing. One of the statistics we said 2.5 years ago was with our top 100 clients, we wanted to be top 5 with 70 of them. We are now at 65 in the middle of this year. So that's great. And the UK businesses are producing over 20% ROTE. The bank itself has produced 16.1% ROTE in the first quarter, in the second quarter, and 14.8% for the full year. So we are, reaffirming our guidance very confidently for both this year and for 2028. And as you said, we've upgraded our income. The UK needs more growth and more productivity. And I think the government and both the Chancellor and the Prime Minister recognize that. And they're going to build on the foundations that their own party has created over the last couple of years, deepening the involvement of the leading UK firms and industries in the growth of the country. They say growth in every postcode, and I cannot be more supportive of that. I think there's been continued uncertainty in the markets. You spoke about AI. We've seen both a run-up in technology stocks and technology-related stocks, and now some volatility. The crisis in the Middle East continues. The crisis in Russia and Ukraine continue. The UK economy, the US economy have been robust. Employment has been strong. Credit conditions are strong. But they're facing a kind of uncertainty at a global level that's continuing and persistent and not been seen for a while. So I have to worry about that. You know, and we protect ourselves by running good businesses, by being well capitalized. You know, our CET1 ratio is at 14.3%. So I'm worried, but we try to run a safe bank.
The Barclays CEO, CS Venkatakrishnan there. Moving to UK politics now, Labour lawmakers have warned Prime Minister Andy Burnham that he will lose the support of his party if he approaches welfare reform with a focus on punitive cuts. The pressure comes as Burnham prepares to set out plans to boost education and employment opportunities for young people. In other news, wildfires in France and Spain that forced the evacuation of more than 300,000 people have stabilised. But the start of summer's fourth heat wave means little respite for emergency services. During a visit to Bordeaux, the French president underlined just how unusual the circumstances are.
Firefighters from across France are on the ground with around 20 firefighting task forces, unprecedented aerial resources, and more than 1,500 military personnel deployed. We are facing events we have never experienced before.
Meanwhile, the Spanish government says the situation remains very, very complex. Let's bring in Bloomberg's Caroline Conan, who's actually in Paris and can bring us an update on everything that's been developing over the past 24 hours or so. Caroline, what's the extent of the damage then that we're looking at, and how stable is the situation now?
It seems like in both Spain and France, the situation has somehow stabilized overnight, meaning the fires have not spread much further. But that doesn't mean the fires have been fixed. In fact, firefighters in France are saying that today they have to fix about 100 miles of this wall of fire near the Bassin d'Arcachon in order to really circle the fire. It seems, though, that in the short term, the metropolis of Bordeaux is not threatened anymore. However, we are looking carefully at the next few hours because as soon as tonight, another heat wave is coming in both France and Spain, with temperatures rising to as much as 40 degrees Celsius and strong winds, so the situation could turn bad again.
Yes, indeed, and certainly something that the politicians will be very aware of. The Spanish Prime Minister saying that summers like this are the new normal, Caroline. President Macron saying that this is a situation that France hasn't seen before. Are these fires then, are they likely to provoke more thought, more action, a new course, a new plan for dealing with climate?
It is possible, and in fact, if you look at the cost of these fires, we have the Spanish Prime Minister Sanchez doing a press conference later at midday, and this situation in Spain is slightly different because fires have been considered as emergencies. This means that there will be some kind of emergency funds opening the door to financial aid in those affected in those areas around Madrid. The situation is different in France because fires are not considered, they are not included in what we call natural disasters, natural catastrophes in France, such as storms or floods, for example. That means that the insurance companies, at least in France, are going to bear most of the cost. The finance minister, Roland Lescure, was saying yesterday that the insurers will cover about 3 weeks of those people who have been evacuated and had to relocate. But of course, you have to look at the businesses. We're still in the middle of the tourist season. It's really the middle of summer in those regions, especially around the Cap Ferret Peninsula, where people have not been able to come back. Restaurants, hotels are still closed. There's no one in the streets. It looks like a dead zone, really. And these areas have about 8,000 people in winter, but they have more than 100,000 people in the summer. So far, about 13,000 businesses have been affected, and about 130,000 people are out of work, according to the Finance Ministry. There's going to be a crisis meeting at the Finance Ministry in Bercy on Thursday in order to give some answers, but clearly there will be a lot of debate about a long-term impact of these wildfires that are raging every summer. In France, 115,000 hectares, that's the worst in 2 decades. In Spain, it is also the worst since World War II. So clearly, there will be some questions about how governments can include these fires into natural disasters, natural catastrophe schemes. And we'll be talking also to the AXA CEO on Friday, one of the biggest insurers in France. That's going to be very interesting.
Caroline, thank you very much. Bloomberg's Caroline Conan setting out the details there of those wildfires. Let's pivot to some other news. This out of Japan. Japan's meteorological agency says an earthquake with an estimated magnitude of 7.1 has hit the country's southwest. The runway at Kumamoto Airport in Kyushu is closed. It's not known when it will reopen. Train services and some phone networks have also been affected. Kyodo is reporting that TSMC evacuated staff from its plant in Kumamoto. TSMC, Sony Group and Tokyo Electron also have plants in the region. Japan's chief cabinet secretary says no abnormalities have been observed at nuclear power plants in Japan. 9:47 here in London. Coming up on the programme, Mercedes shares. They're gaining today despite a slump in China, and we'll get further details on that ahead. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the centre of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
One is cost and freight, the other is also chip cost. So there is materials cost inflation that we see coming through. There are two drivers, those are the main drivers, and those we need to mitigate. So we have accounted for a rising inflation, including these and also including prices for those. So that actually is what we are offsetting and what we planned for. We also, if you look to one we guided at the beginning of the year, we also built in a margin, a buffer for unforeseen external developments.
That was the Philips CEO, Roy Jacobs, speaking to us earlier this morning. Shares are under pressure this morning after that warning of rising cost pressures, with the adjusted earnings margin in its key diagnostics and treatment unit falling in the second quarter. So that's the Philips story. Let's move on to Mercedes, where shares are climbing this morning after the car maker reported resilient profits that beat expectations. That's even as deliveries fell due to a slump in China. Let's get more now with Elizabeth Behrman, who leads Bloomberg's coverage of EMEA Autos. Elizabeth, good to speak to you this morning. So investors appear to have welcomed these results despite the challenges in the Chinese market for this business. What's the story?
Yeah, I mean, to be clear, Mercedes' profit still slid quite a bit, more than 1 percentage point to about 4% on the all-important car-making unit. And what Mercedes was able to do, as we've learned this morning, is the cost-cutting efforts that they've been putting in are resulting in some measures to underpin the business. Development spending has also been lower, and that's due to a lot of the big spending requirements on the electric vehicle transformation sort of having seen its peak. At the same time, the China challenge absolutely remains for Mercedes. In China, they sell a lot of the S-Class sedans and the related Maybach sedans that are key to the profits for the company.
Yes, and I saw that sales of those were related to the property sector, which has been an area that's been struggling in China. So what's the outlook for the second half of the year for the business?
Yeah, the company put a lot of emphasis on the second half of the year, where they expect to get lots of benefits from sales of new products. The company is working on the rollout of some 40 refreshed or new models. So that's good news in terms of garnering sales momentum. What's going to be really interesting is how some of these products will do in China. One of them that we'll be paying a lot of attention to is the electric GLC SUV. It's generally one of Mercedes' best-selling models, and that's going to go on sale in China within a few weeks. And it's in that area of SUVs that are premium, but sort of mid-range premium, where a lot of competition is present in China from the likes of BYD, from XPeng, and what the issue there is that the competitors are able to offer these cars at prices that outsiders, Mercedes, BMW, Audi, are really struggling to match.
Elizabeth, thanks very much. Bloomberg's Elizabeth Behrman with the latest there on Mercedes. On to LVMH, where the key fashion and leather goods unit, home to Louis Vuitton and Dior, barely eked out sales growth last quarter as the conflict in the Middle East deterred wealthy shoppers. Organic sales at the division, the group's most profitable unit, rose 1%, missing the 1.52% estimate of analysts surveyed by Bloomberg. Let's bring in Bloomberg's Angelina Rascouet, who covers luxury for us from Paris. Angelina, what stood out then most to you from these results?
Hi there, Anna. I mean, indeed, it was on the positive side. The key fashion and leather goods units returned to growth the first time in 2 years. However, as you said, it was a slight miss on the growth number. It was led by, Christian Dior did slightly better than the unit average, so that's relatively positive because they have a new designer. He's put out new collections, and there were fears that perhaps it wasn't doing so well, especially because they're facing competition from Chanel, who also has a new designer. So Dior did slightly better than the unit. Louis Vuitton was in line. So that's on the positive side. But I think there's still question marks, and that's potentially why the stock reacted negatively this morning. When it comes to growth in China, I mean, we're still not seeing strong recovery sign. And the other unit that actually did positive was the watches and jewelry unit, led by the jewelry unit. So that means Tiffany and Bulgari, and that's something we had seen as well with Richemont. Richemont, its mega brands Cartier and Van Cleef did really well, and that probably means that in times of uncertainty, consumers are keener to spend on gold products rather than perhaps leather goods and accessories.
And Angelina, what are you looking for from Kering and Hermes, these results still to be reported?
Indeed, so Kering will be tonight. Kering, I mean, it's in The biggest brand is Gucci. Gucci, we know it's been in turnaround mode, so we are expecting quarterly sales to be negative, but slightly less negative than in the first quarter of this year. The company is in a turnaround mode, and I guess investors probably have to be patient. We know that the market is expecting the Kering jewelry unit to be positive, just like the rest of the sector. And tomorrow we have Hermès, and the big question mark regarding Hermès is whether they have to manage the difficult decisions of whether to keep growing their leather goods units. So that's the one that includes, the Birkin bags, the Kelly bags. But at the same time, how do you preserve brand equity if you keep growing that unit?
Angelina. Yeah, absolutely. Thank you very much. The perennial question in luxury goods, Angelina Rascouret, with the latest on the luxury sector. Up next, Bloomberg Brief will continue to count you down to the start of the US trading day ahead. European stocks making modest gains this morning on the back of earnings. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Today, Wayfair sees immense potential in brick-and-mortar stores.
When we got into physical retail, our view was that, even if the market continued to grow for e-commerce, probably a large chunk of the market in the space would stay offline.
Kate Gulliver showed me around Wayfair's new 150,000 square foot Atlanta flagship store.
When customers who have seen us online come into the store, they're generally a bit surprised by actually the breadth of what we offer. Often if you're going online, maybe you're looking for something particular. But when you come into the store, you walk in, you see, the market square, you see all these pillows, you see the decorative accents. So what we're seeing actually is that in store, we do really well in some categories that online are, less a percentage of the total.
How does technology help in kind of making it seamless online to store?
I think
and vice versa.
The biggest thing is for the customer on the front end, that she can be in the store, that she can actually shop here, go back home, complete that purchase. And if you look at these sort of price tags and everything, they're all these digital tags. That's because they're the exact same prices they are online. So you're not going to be surprised that you saw something in the store and then you decided to purchase it online, that it's somehow different and that the offering is different. It's actually very consistent, but when she's here, she can have her app open and everything that she's doing here can be very similar to what she's doing at home. And I think that consistency is quite important.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. The chip slump gathering steam, stock futures dipping on AI angst. Deal optimism, oil extends its decline as Iran and Oman negotiate restarting shipping traffic in the Strait of Hormuz. And more trade tensions. Beijing warns Washington against sanctioning Chinese AI firms. Germany, meanwhile, maps China's trade weaknesses. Ructions once again in South Korea as chip makers plummet for another day. Let's get the details of the Asia session now from Winnie Su in Hong Kong. Winnie.
Good morning, Bonnie. Well, a very brutal sell-off in the chip sector in Asia today, with a gauge of Asia chip makers seeing its worst decline, intraday decline in more than a year. Now, a couple of different factors in play. First of all, we have the rising Chinese competition after that report of a Chinese state-backed company mass producing such DUV machines, which are essential for these AI chip making. And we see that pressuring the global peers around the region. Now, following that, we also have those concerns around NVIDIA's circular financing potentially inflating the underlying AI demand and valuations. And of course, not to mention, we have SK Hynix's earnings coming up tomorrow, as well as Samsung Electronics the day after. So a bit of a caution ahead of that. Now, flip the board and take a look at the broader Asian market, because we are seeing South Korea's Kospi index leading declines here, down more than 10%, and with the exchange triggered 2 circuit breakers. MSCI Asia down about 3%, and that is also headed for a technical correction. Now, when it comes to Japan, we did just hear about an hour ago that there was a very powerful earthquake that hit the Kyushu area, and that area is essential for these chip makers as they have a lot of factories there. So we are in the middle of looking at some of the impact on these factories as well.
All right, Winnie, thank you so much. An awful lot going on once again in Asia. That's Winnie Su there. Now to London for a look at Europe with Justina Lee. Justina.
Good morning, Vonnie. Now, it's a good day to be a little bit boring and also not have that much exposure to the AI trade. Now, we're seeing here the Stocks Europe 600 still calmly up 0.3%. Because, of course, today oil is down, and that is a good day in general for European assets, especially a lot of those automakers, which is why we see the DAX actually up 0.5%. Now, also kind of a good day to be kind of a lot of fixed income assets. You can see here the UK 10-year bond yield actually down 10 basis points. Now, this is noteworthy, especially because gilts are outperforming German bond yields today. And so maybe this kind of reflects the fact that markets expecting the BOE to be able to be less hawkish compared to the ECB as long as oil is kept kind of not rising further. And now we flip the board here. An interesting story yesterday from my colleagues about how the Swiss National Bank plans to keep its key rate on hold at 0 until the end of 2027. And we can see here the Swiss franc weakening against the euro for kind of 2 days straight. And that's kind of reflecting the fact that, you know, the SNB is not kind of in a rush to raise rates at all.
Justina Lee, thank you so much. Well, as Justina said, oil prices are lower, and as you can see, Brent down another almost 3%. It's trading just about $85 a barrel now, with New York crude at $80 a barrel. So that's a far cry from where we were just literally 2 sessions ago, where we were almost $16 higher. European gas futures also coming down, still trading around 56.75 a megawatt hour. Again, that is potentially helping the mood, not helping to offset this lack of confidence or this waning of confidence in the chip trade, or specifically the US and South Korean chip trade. And to that extent, you see that we have Nasdaq 100 futures pointed lower once again. This after yesterday's sell-off, which obviously bled into Asia. And it'll be interesting to see at what point this gets stemmed and at what point buyers want to come back in again. Obviously, all of these things are still up very healthily year to date, but they have had a massive sell-off. Russell 2000 futures not moving too much. S&P futures pointed lower, but not to the same extent. If we look at yields, obviously the other major risk this week is the Fed, and a new voice out today, Citadel Securities, looking for a hike, saying that it would bolster Chair Warsh's inflation-fighting credentials, as well as really just getting rid of the idea of forward guidance forever, because it would be a move that wouldn't have been telegraphed by the Federal Reserve. As you can see, we're down a couple of basis points really across the curve, more so at the front end. Healthy auctions right out as far as the 2-year, but beyond that, it seems there's really just not much appetite. A 5-year auction which didn't really meet too much demand, and that's after all of the longer end auctions that we've seen that also suffered the same fate. Let's get to some individual market movers now. Back over to London and Chloe Melly. Chloe.
Good morning, Bonnie. As you were mentioning, we are seeing this big chip sell-off this morning in pre-market trading, with 2 things in particular weighing on that sector: those fears around China's progress in chip making, and then also those concerns around the sustainability of AI spending. And so we are seeing red across the board there. Moving on to Johnson & Johnson, which is also in a focus this morning after the company agreed to pay $5.5 billion to settle claims that some of its products cause ovarian cancer. We We're seeing the shares up this morning because this removes the overhang of that litigation, which had really put pressure on the stock over the last few months. And finally, moving over to Europe, where Unilever has raised its guidance thanks to strong demand in the US and India. And this seems to confirm that the strategy of moving away from food and refocusing on personal beauty is really working out quite well and paying off for that company. And we're up about 6% this morning in London.
All right, Chloe, thank you so much. Chloe is going to be back later in the hour, and also coming up this hour, the Federal Reserve set to begin its two-day meeting. We'll discuss with Henrietta Pacmo of Allspring. Semiconductor stocks leading a heavy tech sell-off. As you heard there from Winnie, the Kospi posting its second biggest drop since 2001. SK Hynix and Samsung, of course, a large part of that, the former having plunged 47% from its all-time high in June. And that weakness bleeding into futures this morning. Bloomberg's Neil Campling joins us now. Neil, we also saw Nvidia CDS's spike yesterday, right? So there's very definitely a waning of confidence. Is it justified, or do investors just feel like, you know, we've had enough of the positive AI narrative and it's time to take profits here?
I think that final word you mentioned there, profits. I mean, a lot of these stocks are, in terms of like Hynix, for example, up triple-digit year to date. So it's an easier call to potentially lock in some of those profits now and wait to see what we get later this week from the hyperscaler earnings. And also, traders will remember that Samsung posted an enormous pre-profit earlier this month in terms of preliminary numbers, and the stock fell on the back of that. So I think it's a question of locking in the profits now while waiting for further direction later in the week. And as you mentioned, of course, the CDS spreads in terms of the credit market is giving those signals in terms of the tech narrative is likely reflected in some of that risk aversion for the sector.
Yeah, and also I suppose just the amount of supply in that area as well. We can't discount that that's a huge factor in that as well. Neil, why is it so difficult to get price discovery here? I mean, we've had such a massive run-up and we've had so many sell-offs now. Are investors unable to value these companies?
So the valuation argument is a really interesting question that you posed there, Bonnie, because if we look at memory in terms of the absolute price earnings multiples, they're very, very cheap. However, if they return to the kind of ideas of chips being cyclical and memory in particular being cyclical, then investors won't look at them as being on a price earnings basis. They'll look at them on a historic price book basis, and they're very elevated relative to where they were over the course of the last 20, 30 years. So I think that's a key question in terms of which valuation do we look at. And that discovery mode will take some time to play out in terms of supply, demand, the AI ecosystems, which models playing out, which ones are likely to be winners, and the free cash flow from the hyperscalers themselves, which we had that warning sign really from Alphabet's result last week, where it's been highly cash generative in the past, and this quarter they produced the first free cash flow negative quarter since going public.
So we just don't have enough information yet. Neil, thank you so much. That is Bloomberg's Neil Campling. Staying on the tensions around the US-China AI competition, Beijing setting a ceiling on new tariffs by Washington and warning against sanctioning Chinese AI companies. For more, let's bring in Bloomberg's Brendan Murray. Brendan, is this all rhetoric because the US seems to have upped its bellicose rhetoric re-trade in China in the last few weeks?
Yeah, exactly. I think what's happening here is China came out of this latest round of U.S. tariffs last week with an effective tariff rate of about 22%, and China is now saying less than 2 months before Xi and Trump were supposed to meet in the U.S. that if it goes any more above around 30%, which is where it was before the Supreme Court ruled against President Trump, then there are going to be problems. This is essentially China drawing a red line in the sand and saying, if you cross this, we're going to have a trade war again. And on top of that, we have these accusations from U.S. officials that China has taken U.S. AI technology and used it for its own company's benefit. So the trade war between the U.S. and China is still at a stable place, but this is just another signal that China's only going to take U.S. tariffs so far, and U.S. accusations of the kind of the tech theft that have been lobbed at Beijing so much before they hit back at Washington.
And then it seems that Germany has been doing some Oppo research. It's actually mapping out China's weaknesses. This is a great story. Give us some of the details.
Yeah, this is some great reporting from our colleagues out of Berlin, where there's a real economic reckoning going on. Germany has to decide, really, is it going to be a partnership with China, or is there going to be a competitive threat? And given the hits to the German auto industry, the German chemical industry, the officials in Germany are now looking at ways that they can apply leverage on China should it come to that. Remember, China weaponized its critical minerals last year. The Western world in Europe and in the U.S. took away a lot of lessons from that, and one of those is we better be able to apply some leverage in return, and that's what we're reporting today. Officials in Germany are looking at. There's no attempt here to escalate things, but it's more of a sort of defensive mechanism that it seems to be employing in case things get rough with China on the trade front.
Yeah, I mean, one would almost have to ask the question, is it too late for all of this for Germany? But we shall see. Brendan, thank you so much. Bloomberg's Brendan Murray. Now to other top stories trending on the terminal this morning. Barclays shares are dropping the most in over a year after second quarter earnings showed it's lagging behind US peers in consumer banking and investment bank growth. Barclays CEO C.S. Venkatakrishnan spoke with Bloomberg.
I'm absolutely pleased with the set of numbers we've published today. You know, our top line income of £8.1 billion is up over £1 billion on the same number last year. Profits of £3.3 billion are up 30% over the previous year. And the investment bank, as you say, has done extremely well, including my colleagues on the equity trading floor behind me. You know, equities are now 30% of Barclays. And remember, this was the house that fixed income built. And so the diversification we're seeing in the business, the strength we're seeing in our business is something that we're truly happy about.
Meanwhile, Mercedes reports robust profits in the second quarter, even as sales slumped in China. Cost cuts helped offset weaker demand. Citadel sees the Fed raising interest rates this week. The firm's head of macro strategy says that a quarter-point increase would, quote, reinforce Chair Warsh's repeated pledge to restore price stability. Coming up, Iran optimism. Iranian and Omani officials discussing to restart traffic in the Strait of Hormuz. More next. This is Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Bloomberg Brief, I'm Bonnie Quinn in New York. Optimism around deal talks with Iran dampening oil prices further today. Bloomberg learning that Iran and Oman are continuing discussions aimed at restarting shipping through the Strait of Hormuz. This as President Trump talks up negotiations with Iran. Joining us now from Dubai is Bloomberg's Abir Abu Omar. So Abir, what are the options that Iran and Oman are speaking to?
Good morning, Vonnie. So our understanding is that both sides have spoken about the possibility of restarting movement in the Strait of Hormuz. Now, this is a Bloomberg scoop that was reported late last night. And essentially, all we understand is that, again, both Oman and Iran are discussing ways to restart this movement that was pretty much paralyzed over the past couple of weeks or so, especially since the U.S. started attacking Iran for 13 consecutive nights. Now, those attacks have stopped on Friday. We don't have an explanation neither from the Trump administration or anyone from the U.S. side as to why those attacks have stopped. But in return, we know that Iran said on Sunday, by the end of the week, that it will suspend its own attacks on the region and shipments in the Strait of Hormuz as a result of the U.S. stopping its attacks on cities in Iran. Now, just something to bear in mind here, Vonnie, while Oman and Iran are discussing ways to resume or to help ships resume their traffic through the strait, we understand that the movement there is pretty much paralyzed. You're seeing Brent crude on the screen at $86 on the barrel. You're seeing NY crude also a little bit lower, but there's a distinction to be made between what markets are reflecting and the optimism there, but what is also happening on the ground. On the ground, the movement in the Strait of Hormuz is still at a standstill or semi-standstill. And then you also have the parallel movement in the Red Sea. We've seen the aggression between the Yemen Houthis and Saudi Arabia pick up in recent weeks. And so you're seeing the movement there at risk. Saudi Arabia has resorted to Bab el-Mandab Strait in the Red Sea, Vonnie, throughout the course of this war, and this is now at risk. So the distinction that needs to be made between what is happening in energy prices and then what is happening on the ground is important. But what we know is that the two countries are essentially in talks for us to see a little bit more movement in the waterway that was halted or came close to a halt over the past 14 days or so.
And how much say does the U.S. have in this? As I understand it, Iran and Oman are talking about a middle passage. There may, though, be mines there, at which point they would have to be cleared or neutralized. Where does the U.S. come into all of this?
That's a very good question. And look, while the U.S. had halted its attacks against Iran, we know that it's maintained its naval blockade on the Strait of Hormuz. And so you have that situation of the double blockade yet again. This was the case at the beginning of the war. We're now seeing a resumption of that double blockade. The U.S. Threatening to attack ships that are making their way through without permission. Iran, on the other hand, also asking ships to stick to routes that it has laid out for them and asking them to essentially also seek permission in order to make their movement through. And so ships that are not sticking to those routes or are not asking for permission are at risk of being attacked by either the United States or Iran. And so you're having that situation in the Strait of Hormuz. The risk of Iran and Oman tolling the Strait of Hormuz still very much there. So those are things that we're keeping an eye for and the discussions that are possibly set to resume. We just don't have a lot of clarity on that, Vonnie, yet.
All right, Abir, thank you so much. Keeping us up to date there is Bloomberg's Abir Abu Omar. Coming up, a look at what else is making headlines in your front page news. This is Bloomberg.
look at the more successful economies in the region, the key to their success is continuity. But the way our constitution is written, it actually encourages a lack of continuity. And that's a problem. The terms for local government is 3 years. When I first became a congressman, it takes you a few months to learn the business and to make your connections, to network, etc. If, for example, you are not particularly favored in the majority, passing a law in a year and a half is not that easy to do. After about a year and a half, you already hear that there's somebody in your district beginning to campaign and is going to oppose you in the next election. So you have to go back to your district to take care of that. And how much work do you get done?
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
It's Bloomberg Money.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
This is Bloomberg Brief. I'm Vonnie Quinn in New York. Heat waves are ravaging the United States, causing power outages and threatening data centers. PJM, America's largest power grid, warning that data centers that fail to secure enough power generation could be temporarily dropped from the grid during high demand periods. Bloomberg's Noreen Malik joins us now. Noreen, how does it work in an emergency? So JPM has announced an emergency auction to help plug a shortfall, but who gets the power from that auction? Is it the highest bidder?
Yeah, so there's two things. On a daily basis, PJM is securing power for the same day. So there's a daily auction, and then there's the emergency auction you're talking about is a longer term planning auction. And that one specifically is meant to make sure there's enough power for data centers like down the road, like 5 to 10 years down the road, depending on the timelines for when it comes online. But right now, everyone that's connected to the grid expects to get power from the grid, but data center demand growth has been so fast that PJM is like, well, when it's extreme heat and everyone's got the AC on and data centers need their own AC too, they will have to get off the grid. And data centers have on-site generation, backup generation, diesel units mainly, but increasingly natural gas, so they'll likely have to shift to that. Or in winter, we saw Google shift some of their workload from Virginia to Chicago as a way to reduce demand there.
Yeah, I mean, can they be forced to? One of the board members of PJM said that existing customers shouldn't have to bear higher capacity costs caused by the new large loads that do not bring basically their own power supply, right? Why should other customers have to pay more? And indeed, prices are spiking because of data center needs.
Yeah, this is the big debate in PJM right now. And I think it's important to understand that just like a couple years or so ago, PJM had so much excess supply. They had spare power plants were shutting down because there wasn't enough demand growth, and the demand growth from data centers has been sudden. It's caught everyone by surprise. So that has been creating a lot of growing pains. They've soaked up all the excess supply, and you're exactly right. The infrastructure that's in place, the power lines, the power plants have been built and paid for by generations of people living in that area, Americans. And so now you have these big data centers coming in. They can use up enough power as entire towns or cities. That's how big these are. And so now it's like, how do you make them pay for it? And how do you make sure the lights stay on for everyone?
Tough questions. Noreen, thank you so much for joining us today. That is Noreen Malik. Time now for your front page news. First up, the Financial Times reporting NVIDIA has signed leases worth up to $50 billion for a massive Texas data center. It's a previously undisclosed commitment that shines a new spotlight on NVIDIA's growing role in financing AI. Next up, the Wall Street Journal is reporting President Trump is turning up the heat on RFK Jr. to cut back childhood vaccines. The Journal says the president asked RFK Jr. in May to investigate the alleged connection between vaccines and autism and is frustrated Kennedy hasn't accomplished more on that issue. And finally, the Washington Post reporting the Trump administration has asked the Supreme Court to clear the way for an executive order that would place new limits on mail-in ballots for November's midterms. A divided appeals court panel upheld a federal judge's block on the order. Coming up, we're going to look ahead to the Fed decision. We'll be speaking with Henrietta Pacamont of Allspring Global Investments. This is Bloomberg.
Do you mind being called an ideological lunatic or a bunch of left-wing nut jobs?
You know, I've been called worse things than that.
Oh! You'd think she owned the place.
23andMe, I think, is so incredibly valuable. We're coming back.
It had that kind of detective story feel to it. You know, when you're hot on the trail of something, you know that it's very exciting. What magazines were you reading as a kid? I don't think I was reading magazines until I was in them. You are on the cover of all of these.
Oh, and there's many, many more, but we just don't have time.
Why should people trust you?
I don't think anybody should trust any company or entity completely with any of this.
It's very uncomfortable. Artificial intelligence is this force that is far bigger than we are.
I want to build better businesses around these brands.
The shock will never wear off.
So you're a brother and sister running one of the most powerful companies in the world. When you argue, who wins?
No one. The way I could see AI being banned or blocked is if something really went wrong. And if something really went wrong, then maybe it deserves to be.
So is it paradise ahead or Gattaca?
Maybe somewhere in the middle.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning. I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. The chip slump continues. Stock futures dipping on AI angst. Deal optimism. Oil extends its decline as Iran and Oman negotiate restarting shipping traffic through the Strait of Hormuz. And earnings season continues. Boeing, Coca-Cola, and Ford all on deck. Oil dipping then with Brent crude now firmly below $87 a barrel. Actually, we're at $85.63, $5 lower than that for WTI, and European gas futures also down by more than 3%. Seems to be more optimism today, given that there were, again, no strikes overnight. And the president was talking up the idea that there were deep negotiations going on. He mentioned that to Axios yesterday, though he didn't give details on what exactly. Futures-wise, it seems to be a chip story, once again inheriting the pessimism from the Asia session, where we saw the Kospi down nearly 11% on sell-offs and Samsung and SK Hynix. Several stories percolating, from China building its own lithography-type machines to NVIDIA CDSs spiking, NVIDIA financing more than $750 billion worth of AI spend itself, and the circular financing just really causing investors to back off a little bit, and perhaps it isn't quite the time yet to get back in and start to rebuild positions. Yield-wise, it's all about the Fed, of course, and those auctions. Healthy as far as the 2-year tenor, and beyond that, well, not so healthy. We have the 2-year yield down almost 3 basis points, and the 10-year yield still above 460. That 30-year yield is coming down, though, ever so slightly, though we're still well above 510. Let's get to some individual market movers now. Here's Chloe Melly.
Good morning, Vonnie. We are seeing this chip sell-off extending in pre-market trading this morning. As you mentioned, there are worries over just how much progress China is making in advanced chip making, and also those concerns around the sustainability of AI spending and this circular financing. And so we are seeing all of those names quite firmly in the red this morning. SanDisk, Marvell, Intel and Qualcomm very much taking a hit this morning. Moving on to Johnson & Johnson, which is up in pre-market trading after agreeing to pay $5.5 billion to settle claims that were related to ovarian cancer cases because of some of its products. And so this removes overhang on the stock litigation that had really put pressure on the shares for a while. So the removal of that is lifting Johnson & Johnson this morning. And finally, Barclays here in London is taking a bit of a hit despite some very strong equities trading. The problem there was that Wall Street banks had set the bar just so high that it was quite difficult for European investment banks to actually hit that same bar. And so we are seeing some of that disappointment there for Barclays this morning, down almost 5% in London.
All right, Chloe, thank you so much. Chloe Melly there. Markets pricing in rate hikes sooner now as we await the Fed's decision tomorrow. Joining us is Henrietta Pacmont, fixed income COO at Allspring Global Investments. So there's quite the non-zero chance that we'll get no hold tomorrow. In fact, we might get a hike. Henrietta, at what point will the Fed feel compelled to hike? Do we have enough data that would allow them to hike?
It's going to be really interesting to see what happens tomorrow for a variety of reasons. At this point in time, data is actually quite hard to read, right? Given the moves that we've seen, oil is easing off a little bit over the last couple of days, but you had a spike there. You've got the potential effects of El Nino that might feed in later in the year, and we're seeing strong signs on the economic side. So a number of data points that could lead to a hike. At the moment, if you look at what's priced in, we don't have a hike priced in for tomorrow, but we do have hikes priced between now and a year end. In that context as well, obviously we've had feedback from the Fed chair, Walsh, and the style that he wants to give, and less forward guidance going forwards. So it'll be really interesting to see what comes out of tomorrow.
Yeah, I just want to read a quote from Frank Flight of Citadel Securities. He's expressing what some in the market do believe. Quote, the market may once again be underestimating the extent of the hawkish shift at the Fed. A hike this week would emphatically end the forward guidance era. I suppose what that's getting to, Henrietta, is that there are other reasons potentially for hiking than just showing off your inflation fighting credentials. Would it be enough for the Fed to hike in order to prove that, for example, the forward guidance era is over, or would it have to be just in response to the data?
So I think if there is a hike tomorrow, that would cement going forward that there will be less forward guidance, because I think that would be a surprise for the market, and I'm not entirely sure that the market will like to see a hike tomorrow. So I think that would definitely cement his credentials and what he's been saying so far.
Henrietta, these auctions that we've been seeing, fairly healthy, 3-month notes, 2-year notes, but then beyond that, investors seem to still be balking. What exactly are investors expressing here?
So I think that's fair, right? If you look at our portfolios, we're certainly focused on the sort of shorter to intermediate areas of the curve, and we're a lot more cautious on the long end. A variety of reasons for that. Obviously, it's a bit of a safety valve for the markets when they get anxious about inflation, when they get anxious about deficits, and we've also seen a fair amount of issuance there. And what's interesting is not just your sovereigns that are issuing in that space. Obviously, it's one of the areas of predilection of the hyperscalers as well. So you're getting corporate issuance in the long end. So a lot of reasons to make the technicals on the long end of the curve a little more difficult at this point in time.
We got a headline just a moment ago that Meta and BlackRock are developing a data center campus in El Paso, Texas. Curious as to what you think about the amount of volume that we're seeing basically in terms of issuance in order to fund all of these data centers, these campuses, and all of the expansion that we're seeing, Henrietta. I mean, are you at Allspring interested in any of it?
So it's big, right? The volume is huge, and they're also tapping all areas of the market, which I think is really interesting. They're going to the IG market, they're going to the high yield market. You're also seeing issuance that's linked to this development in the structured product area, private markets, you name it. It really is pretty broad. Not only that, they're not just tapping the markets in dollars, but across other currencies as well. So you can see why there's a little bit of indigestion at this point in time. So this is something that we have expected. The companies have guided that they're looking to issue to fund this development. So it's not unexpected, but the volume needs to be digested. What we've seen over the last few days is quite interesting. We've had sort of spikes in yields. Look at March, look at the sort of end of May as well in that space. But it's taken a bit of an acceleration in the last few days, which makes it a lot more interesting from our perspective. So this is really what we've been expecting and hoping for, that you have a bit of volatility in spreads so that we can tap into these interesting yields. And I think our focus at this point is going to be in the primary market.
Primary market. Also, we're not just concentrated on the Fed this week. We have the BOE, but also the BOJ as well. Not that we're expecting a move just yet, but are you seeing anything interesting globally that you're trying to take advantage of right now?
So from a global perspective, what we like at this point in time is the diversification aspect. We are, if you look at our multi-sector portfolios, really tapping into that so that we have a bit of a buffer there. Yes, I agree. If you look at the Bank of England, not expecting much this week. BOJ, same thing. You do have some hikes that are priced in between now and year end in both spaces there. We'll have to see what the inflation picture looks like and obviously what the growth picture looks like in Europe there as well.
Henrietta, what is your, maybe an unfair question, but your forecast for the 10-year yield towards year end?
It's been interesting to see the sort of behaviour over the last few days. We touched 470 in the 10-year in the last couple of days. That's when we were still sort of seeing strikes in the Straits of Hormuz. We've sort of come off the boil a little bit. We're going to have to watch what happens. I think, as I mentioned at the start, some of the data is going to be hard to read, given some of the uncertainty in the market. So I think that's going to keep the central banks on their toes, and that's going to feed into the rest of the curve as well. So I think it's going to be really quite path dependent in terms of geopolitics, in terms of also what happens given the sort of heat waves that we've seen and what impact that might have on food prices and inflation going forward. There's a lot to contend with between now and the end of the year.
So you're saying it could in fact go either way with the 10-year. It could be higher, it could be lower.
I think it's going to be a ride. We may have seen the peaks at this point in time. If we have a bit of a slowdown in terms of growth, that could be positive. If we have seen more of a peak in inflation, which is a distinct possibility, we could see less pressure on the 10-year. That being said, I think from an investor perspective, at this stage, you've got some pretty interesting yields that are on offer, particularly as we see volatility in the equity markets. So I think for investors that are interested in income, there is income in the fixed income markets at this point in time.
All right, Henrietta, thank you so much. Henrietta Backman of Allspring Global Investments. Now to other top stories trending on the terminal this morning. Germany is working to identify Chinese economic vulnerabilities if the European Union finds itself in a trade war with China. Germany says the goal is to strengthen its negotiating position, not shift its policy towards China. China has set a ceiling on new U.S. tariffs and warned Washington against sanctioning Chinese AI companies. The move comes weeks before the next meeting between President Donald Trump and Chinese leader Xi Jinping. Johnson & Johnson has agreed to pay $5.5 billion to resolve years of litigation surrounding claims that its talc products caused ovarian cancer. J&J says this would be a, quote, efficient conclusion to the lawsuit spanning 15 years. Coming up, President Trump set to meet Israeli Prime Minister Benjamin Netanyahu in Washington as Iran tops the agenda. That's next. This is Bloomberg.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
Today's CFOs are reshaping the C-suite. Bloomberg's Chief Future Officer shines a spotlight on these dynamic leaders.
What's the skill set that you would advise every aspiring CFO to develop?
Psychology.
I think analytical skills are important. Obviously, you need to like the numbers. If you don't like numbers, then don't go into finance. It's sort of like a recipe for disaster if you don't like numbers.
Not only for the CFO, but also the company's management. That's a communication and the collaboration.
I spend a lot of time figuring out how to take the complex and make it simple, and then finding a way to be able to communicate that both internally and externally.
I think it's relationships, whether it's working with investors, bankers, with the senior management team, with the board. Having your head down is one thing as a finance person, but keeping your ears open is super important as well. And I think that all of that is what kind of builds out being a successful CFO.
Watch Chief Future Officer only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
They want to meet, and we're meeting. We'll see what happens. There's a chance we can make a deal. Without what we did, they wouldn't even be talking to us. They requested a meeting through their surrogates and directly. And we're meeting, and, good things can happen, I guess.
President Trump talking up talks with Tehran as Iran and Oman discuss Restoring shipping lanes through the Strait of Hormuz. Joining us now from Dubai is Bloomberg's Abir Abu Omar. Are these separate talks? Is President Trump talking about the Iran-Omani talks, or is he also talking about U.S. mediators? Do we even know, Abir?
Good morning, Vonnie. That's a good question. No, we don't, is the answer. What we know, what we've reported on, is that Oman and Iran have had separate meetings, and that is to discuss restoring, as you have mentioned, the shipments through the Strait of Hormuz. Now, what we understand happened during those meetings is that the both countries are trying to open up what is called a middle passage. So, Vonnie, throughout the whole war, Iran has been asking ships to stick through the lanes that it has laid out, and that is close to the northern parts of the Strait of Hormuz or close to its borders, and ships that have gone through the southern part of the Strait of Hormuz or closer to Oman, Musandam, really have had to turn off their lights to be able to go through, or else they're at risk of getting attacked by Iran. And so we understand that the countries are trying to restore the movement through opening this waterway that has been pretty much shut throughout the course of the past 5 months or so. Now, there's no clarity on whether this is actually going to happen or not. We understand that those are talks at this stage. President Trump saying that Iran, as you just heard, has reached out directly and through surrogates. Iran, through the foreign ministry, saying actually any kind of discussion that is happening is probably messages that are going through negotiators, that are going through mediators, but no active substantive negotiations are happening at the time being. So we're keeping an eye out on the course of those meetings and whether we're going to have actual conversations happen between Iran and the United States directly similar to the ones that have taken place after that MOU, Vonnie, was signed in Switzerland about a month or so ago. That all seems like history for the time being, because the escalation in the Middle East that has happened over the course of the past 13, 14 days, despite being halted on Friday by the United States, seem to suggest that we're seeing a period of re-escalatory movement in the war here in the region.
And Abir, President Trump meeting Benjamin Netanyahu in Washington. What's been the reaction in the region to this meeting?
Yeah, you're right, Vonnie. So far muted. What we understand is that Benjamin Netanyahu is going to attend the funeral of Lindsey Graham that is taking place. He also said that he wants to meet with President Trump to discuss many things, including Iran. He did say earlier in the week that he will ask President Trump to keep a, quote, constant watch over the nuclear program in Iran, that Iran can never attain a nuclear program. And the nuclear component, Vonnie, is not just Israel's main goal, it's also President Trump's main goal. It was laid out in the 14 concession MOU, still not being discussed because at the front and center for the time being is the Strait of Hormuz and the movement through tankers and ships there.
All right, Abir, thank you so much. Bloomberg's Abir Abu Omar. A global chip rout deepening after a heavy sell-off in Asia. Bloomberg Semiconductor Index for the region slumping and bleeding into U.S. futures too. Bloomberg's Neil Camping joins us now. The repricing continues. Neil, is this all off the back of fears that China will eat everybody else's lunch when it comes to not just, you know, AI, but the stuff that goes into it, the semiconductor, the chips, the lithography machines now, and everything else along with it?
I think the fear with regards to the investment universe around AI is that China, despite not having access to a lot of the IP, seems to be playing very fast catch-up now. The frontier AI models seem to be months behind rather than years behind. So, as you mentioned, whether it's through the chip equipment companies, whether it's developing the internal solutions, whether it's the chips or the memory or the financing of similar, it's all leading to those concerns, I think, for the momentum trade in AI, just ahead of the significant earnings we get in the next couple of days from the big memory companies through to the hyperscalers, Vonnie. So there's so many moving parts, but one thing is definitely for clear, that while indexes are reaching new highs, the S&P equal weight last night, for example, one thing we are seeing is volatility at the stock level is significant.
Yeah, absolutely. Neil, also just learning that Meta and BlackRock are developing a data center campus in El Paso, Texas. It's hard to keep track. Is this something that we didn't know about before? And put it into context for us for both Meta and BlackRock, if you can.
Yeah, sure. So I think the numbers that I've read, obviously, it's a breaking story, but it's about $10 billion of commitment for Meta. They'll own 20% of this particular data center. BlackRock will own 80%. Now, to put those kind of numbers into context, the numbers we were talking about yesterday for NVIDIA's capital commitment to this new OpenAI data center was up to $600 billion. So relative to that data center, it's quite a small number. But it's just adding even more capital clearly to the whole AI trade. But it's small relative to what we heard yesterday for the OpenAI platform.
Yeah, it's just these headlines now that they're getting taken negatively and they keep coming. It doesn't really help the narrative. Neil, thank you so much. Bloomberg's Neil Camping. Staying with earnings now, and Boeing set to report before the market opened. Bloomberg Space and Aviation Managing Editor Benedict Kamel joins us now. So Boeing is recovering. It's somewhat of a pace, Benny, but we're very, very much off the highs of, say, back in 2018 when orders were at 1,100. We're at something like, 300 now after Farnborough. What's the next 12 months going to look like for Boeing?
So, as you said, Vinny, this is a company that is recovering, and we'll probably see that in the earnings. A couple of things that people will be looking out for. Will Boeing have generated cash in this quarter, or will that be something we'll see in the second half of the year? Will they maintain some of their longer-term targets? What are things looking like on the certification front? For some of their aircraft, it's the 737 and the 777X. In particular, those two types of aircraft are still awaiting certification, at least some of those models. So we're waiting for updates on all of that. But broadly speaking, and we're coming out of the Farnborough Air Show last week, the tone is certainly positive, if not upbeat. We spoke with Kelly Ortberg, the CEO, at the show last week, and he generally said we haven't quite turned the corner yet, but we are certainly on a good path. So people will be looking out for more evidence on that today as they unveil earnings. There'll be an earnings call with a CEO, with a CFO. There's usually a message to employees where he'll sort of feel the temperature of the company a little bit, so people will be dissecting that. So all of that happens in just over an hour, so lots to digest.
Absolutely. Can't wait. Benny, how much of the next sort of few months and the recovery in general is out of Boeing's control, in the sense that engine producers sort of have to get their acts together as well, right? Pratt & Whitney and some of these other engine producers.
Yeah, I mean, the entire industry is fairly finely tuned, and there are a lot of things that are in some ways out of Boeing's control. There's geopolitics, which we've discussed often here on this forum. What will China do going forward? Will China resume ordering aircraft? What about some other countries that might be more or less amenable to the political whims out of Washington? But as you said, engines are also a big component. We've heard in particular from Airbus that they have issues with engines. They've produced what they've called gliders, so essentially ready-made aircraft, but just lacking a key component, which is the engines. It's been less of an issue for Boeing, but they have said that they have some issues with supply chains, be it engines, be it interiors. So again, people will be looking out for any clues that that's improving. So in about an hour, we will know more.
Yeah, can't wait for those headlines to cross. Benny, thank you so much. Bloomberg's Benedict Kamel there. This is Bloomberg.
The global economic playbook is being rewritten and the levers of power are moving in real time.
To see where the world is headed, you have to look where the action is.
I'm Haslinda Amin in Singapore.
I'm Menika Doshi in Mumbai.
Welcome to Emerging the New Economy podcast.
Each month, we dive deep into how the world's most exciting rising economies are shaping the global future.
Join the conversation. Subscribe to Emerging on your favorite podcast platform today.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Bringing you the latest geopolitical news whenever and wherever it happens. I'm David Gura on the Salar de Uyuni in Bolivia, and this is Bloomberg.
Now we'll look at what's ahead today. Earnings season in full swing. Boeing and Coca-Cola reporting before the bell, and we get Ford after the market close. Plus, we get some data with U.S. wholesale inventories at 8:30 New York time and consumer confidence at 10 a.m. Some movers before the bell include some of the memory disk makers, SanDisk, for example, taking a hit as the tech glut deepens, particularly the memory chip stocks. Barclays now extending losses. Most of everything came in great in its earnings report. It's also giving lots more back to shareholders, but perhaps lagging some of its U.S. peers. And Johnson & Johnson may be putting the talc claims to bed, and that has that stock higher. This is your macro picture as we go into the Tuesday session. We have futures on the NASDAQ in particular pointed lower with that tech route that continued across Asia. Brent lower and yields lower.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form. but it is going to be a platform that runs in parallel to our more traditional exchanges.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
The good news for tech seems to be priced in.
They've got the strong earnings, but the market wants more than that.
When the market stops rewarding good news, you have to pay attention.
We're still positive on tech longer term.
Going long U.S. equities just outside of the mega cap tech, I think, is a great place to be.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, stocks stumble, the Nasdaq 100 slides and the chip rout deepens as the Kospi plunges weighed down by SK Hynix and Samsung. Europe's tech giant, ASML, is struggling on reports of the emergence of a Chinese competitor.
Yeah, there's a story in the information that China has created a deep ultraviolet lithography machine that can potentially compete with ASML to produce chips more cheaply. This all goes to a similar theme, which is the AI story is changing. BlackRock put it really well yesterday in a white paper saying the bigger question is whether today's extraordinary profit levels can be sustained as cheaper models reshape the economics of AI. A lot of these cheaper models are coming from China, and the question is how much can they penetrate the market and seriously eat into some of the profitability of big U.S. technology.
And obviously this comes at a time when China is desperate to get their hands on these machines. They're barred from getting access to the most advanced versions ASML is able to sell. I believe they have 8 generations back. So for China, this would be a massive step forward. But this is early stages. We don't even know the name of this company. That's how early we're in.
There's some weakness in the chip sector. We've seen it over the last 3 days. Spills into South Korea. Check out the Kospi getting absolutely hammered. SK Hynix, Samsung, absolutely battered. Those 2 names plunging in trading over in Asia. You've now got 3 fronts for the weakness. Price and positioning had a massive run-up in some of these names. The financing of the ecosystem, NVIDIA a piece of that in the last 24 hours, and now competition and capacity. Those 3 things together, that's a headwind for this sector.
Yeah, and given the first aspect of that, which is the positioning, people need any excuse to sell, to lock in profits. So that only exacerbates the price action with the anxiety coming from the other 2. There is a question, as you mentioned, about China, which we just hit. But the financing aspect is increasingly present, as about 80% of future financing needs comes from the external capital markets, not free cash flow. At a time where you're seeing credit spreads start to widen, you're starting to see credit default swaps widen, and frankly, you see a lot of these equities come under pressure. At what point will that stymie the hopes and dreams coming forward?
We've got a tech scare on our hands. We haven't got a growth scare, but can one turn into the other? We'll spend some time on that. Check out these numbers from UPS this morning, dropping just moments ago. This is their outlook. They now see full-year revenue of about $91.2 billion. The previous range was about 89.7. The estimate was 90.39. So it's better than expected and higher than previous. Bramo, some good news from UPS.
Yeah, talking about CapEx coming in pretty much in line and saying that they've successfully completed the Amazon glide down. This has been a company that's been beset by competition from Amazon, as well as ongoing union negotiations. But the fact that they raised their full year adjusted EPS view to $7.22 versus the consensus of $7.13, this is actually a positive. So if this is the read of the overall consumer, which is a big if, it is showing the same kinds of green shoots that you're hearing from everyone else.
Lisa's reminded you it's not just about big tech this week, though kind of just about big tech this week.
No.
The week starts on Wednesday, the scheduled week anyway. Let's go through the results you can look for. These are the tech names we keep talking about. So Microsoft and Meta on Wednesday, Thursday, Apple, Amazon. In a year from now, we'll hear from NVIDIA. There's another name in the mix in the next couple of days we should pay attention to. In the next 24 hours, you'll also hear from SK Hynix. We've been exporting market volatility. When you get jitters like this, we've also been importing market volatility from places like South Korea. And I think those earnings will be pretty important to the broader market.
Yeah, although it's unclear exactly how the market's going to react to them, because SK Hynix is probably going to report another record quarter of earnings, and yet its shares are down 47% from the all-time high in June. Why? This isn't necessarily because people are worried about what they're going to deliver. They're worried actually about the existential risk from DRAM production over in China. This has nothing to do with their particular performance. It's that maybe their profitability is just too high to continue for much longer.
Stock is down 15% is South Korean trading this morning. Unreal. Coming up this hour, we'll catch up with Cam Dawson of New Edge Wealth as the chip sell-off drags equities lower. Mame Q of PSP Growth on the emergence of Chinese competition. And Jonathan Pingle of UBS predicting a family fight over at the Federal Reserve. It sounds like we've had one already, based on the reporting from the Wall Street Journal in the last 24 hours.
Yeah, I'm shocked.
Right?
I mean, we all were expecting. And the key question for a lot of people is just how many dissents are you expecting? And frankly, how volatile are some of these conversations going to be?
I did feel seen by Governor Waller when he apparently said at this dinner, tell me the name of who's leading one of these task forces and I'll tell you what the policy is going to be. Personnel is policy. We know all these names. We know how they think. So I feel like that's how a lot of people felt going into this when Kevin Warsh kept foreshadowing the fact that he was going to announce these massive task force. Well, I guess we'll have to see what they come out and say.
To be fair, that's also how most Fed meetings feel often, right? We know what they're going to say ahead of time. You tell me who's on the committee and I'll tell you what they're going to say at the meeting in the next 2 days.
Yeah, it's just that normally they're not given the same kind of mandate to set policy for the next however many years, which is part of the issue that a lot of them are grappling with. What is the Fed that really is helmed by Kevin Warsh?
That 2-day meeting begins later this morning. We begin this hour with the chip sell-off building. Cameron Dawson of New Edge Wealth writing the following. The semiconductor profit cycle depends on two big factors. Hyperscalers continuing to spend aggressively and limited new competition entering the space that could challenge margins. Markets seem to be questioning both. Cam joins us now for more. Cam, good morning. Good to see you.
Good morning.
That quote just perfectly illustrates this moment we're in right now. We are questioning both. Do you think it's valid to question both?
I think it is, but I think before we get to the fundamentals, we have to appreciate the technicals, because so much of the upside was driven by positioning chases and squeezes and flows. And so what we're experiencing now is effectively the mirror image of that. Because flows were so aggressive into leverage products within the semiconductor space, not just in the US, but of course in South Korea, what we're seeing is the dynamic is that as that leverage unwinds, you're seeing a lot more downside. Effectively, these stocks got so overbought by the time you got to the middle of June that even though we've seen things like a 40% drawdown in something like SK Hynix, you're technically not oversold yet. So if you look at a name like Micron, yes, it's down over 20%, but it's still 40% above its 200-day moving average. You can think the same thing for the stocks overall. So it's important to remember narrative follows price. So all of these negative narratives on the fundamentals we're talking about, it's effectively just following the negative price action.
So is this a price move looking for a narrative, or is there a story here?
I think it's a matter of both. I think some of the dynamic that we saw in the upside move was ignoring the fact that a lot of these capacity additions, whether you're thinking about Micron itself adding capacity, SK Hynix, Samsung adding capacity, and now China adding capacity, we've all known this for the last 6 months, over a year, because we've known that there has been a capacity shortage. But now the market is starting to wake up to it. And at the end of the day, you had this clarion call from big bulls on things like Micron saying, of course, the 85% gross margin is sustainable. This time is in fact different. But this is still a very, very cyclical business. And so given the fact that you are going to have capacity additions over the course of the next few years, you will see downward pressure on those gross margins. The big difference, or the big thing to watch, is that is there any downward pressure on the revenue line? Because that's really when you start to see the deleveraging and the operating leverage of these businesses. And if you continue to see weakness within the hyperscaler names, the question that we have been asking is, if the stocks continue to get pressured, will they continue to raise capex?
At the same time, there's this issue of exactly whether the economics are changing and moving away from certain companies. And I'm thinking of, say, the closed models like the OpenAIs and the Anthropics that are suddenly coming under pressure from open source models that are coming out of China but are being adopted rapidly by a lot of U.S. companies. I mean, the search for cheaper models is definitely taking steam. Do you think that does fundamentally alter the tech story?
Yeah, because I think the big question that you have is a scaling factor. We know that we are getting growth because of some of this CapEx investment, but effectively the growth is coming in slower than what the CapEx investment is. So you can see that by looking at free cash flow. Free cash flow for a name like Google was negative in the quarter because their CapEx is growing faster than their operating cash flow. You go to 2027, that's going to be the case for all of the hyperscalers. And so you're going to have a world where CapEx grows faster than operating cash flow. You're not seeing it show up in the operating fundamentals yet. And this is in a world where we're still thinking that we're going to be at the leading edge, and those are going to be the areas, those leading edge models are going to be the areas that drive growth. If you have competition, then you could still be in a world where CapEx continues to grow faster than operating cash flow, not just in 27, but potentially in 28. That, of course, would come into ahead with where consensus is, simply because consensus is expecting a big acceleration in operating cash flow in 28.
Have chip stocks and hyperscalers sold off enough to make them attractive to you?
On a technical basis, no. I think that if you're looking at oversold indicators for something like the semiconductor area, certainly you're not at that level of a total wash and flush out yet. For the hyperscalers, you're now trading at a valuation that is as low as it was back at Liberation Day, valuations that are as low as it was back in the lows in 2022 for certain names. Meta, for example, has undercut those lows. You can also look at ETF flows. Mag 7 ETF flows have been very aggressive outwards over the course of the last month or so. So there's probably some opportunity there to step in. The challenge that we have is that we know these businesses are fundamentally changing. They were monopolies that had very high return on invested capital because they didn't have to spend a lot of money to make money. These are now competitive businesses that are having to spend a lot of money to make money, which means that ROICs are going lower. So we think structurally valuations will go lower as well.
It's why Meta and Microsoft to some extent are in a bear market. You alluded to it earlier in the conversation. I don't want to bury it. It's important. Do you think they respond to what their stocks are doing? Do you think the stock moves shape their approach to CapEx?
Well, in a way, they kind of have to. Because if free cash flow is negative, that means that you have to rely on outside funding to meet your CapEx goals. But now that outside funding is getting more expensive. If your equity price is down, your incremental equity raises will be more dilutive. If your credit spreads are up, your incremental debt raises will be more expensive. So they cannot ignore the markets. And if you're a name like Microsoft, who's seen its valuation fall by 45% since October, at what point do you say, hey, maybe this is being perceived as being profligate and we need to pull back on that spending?
That has been a massive tailwind for this economy. So let's work through it. The year so far, rolling shocks through energy, through rates, now through tech. Does that become a growth scare at some point? Does the shake-up in tech translate into some kind of fundamental story down the road?
Potentially, yes, if we see more weakness within the S&P 500. The strength of the equity market has been such an important driver of economic growth or support for economic growth in the U.S. It's allowed the consumer in many ways to deal with the fact that real income growth has been negative because of higher inflation and low wage growth. But if you continue to see pressure within equity markets, and put this into context, we're still 3.5% off highs, so this is nothing to necessarily cause a big pullback in spending. But if you were to see a deeper, more protracted route, you could effectively have a negative feedback loop where the equity market weakness translates into economic weakness.
Cam, it's good to see you. Thoughtful stuff. Cam Dawson there of New Edge Wealth on the risks ahead. That was the conversation we were having yesterday. Do the jitters in the equity market translate into something more fundamental beyond just a story of price and positioning?
Troy Ludka at SMBC Nikko Securities America put out a chart that I thought was fascinating, that the household's equity ownership as a percent of net worth in the United States has risen to the highest levels going back to 1948. In other words, people are more exposed to the tech boom that we've been seeing in the equity market as a percent of their household wealth. So the wealth effect has that much more of a direct channel over how much they buy.
This is why you said the airline earnings were actually an AI tech trade, because people were being able to maybe buy premium seats instead of sitting in the back of the plane because of what is going on in terms of the money people are making when it comes to the AI trade.
Although to Cam's point, before we stretch this too far, we're down a tenth on the index this morning and some 3% off all-time highs on the S&P 500. The rout very much in chips within tech. Let's give you an update on news worldwide this morning with your Bloomberg brief. Let's cross over to Vonnie Quinn. Hey, Vonnie.
Hey, John, good morning. President Donald Trump reiterating his claim that the U.S. should have the lowest interest rates in the world. Trump saying he knows Fed Chair Kevin Warsh wants to do the right thing, but he has to work with, quote, very political board members. The sell-off in AI stocks intensifying, driving the Kospi to its lowest level in 3 months. Asia responding to the sell-off that started yesterday after the information reported China has begun mass production of homegrown deep ultraviolet chip-making tools. Meta and BlackRock teaming up to develop a data center campus in El Paso, Texas. The joint venture will feature 1 gigawatt of compute capacity to accelerate Meta's AI models. BlackRock will hold an 80% stake and Meta the remaining 20%. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. More from Vonnie in 30 minutes' time. Up next on the programme, another push for peace with Iran.
There's a chance we could make a deal. Without what we did, they wouldn't even be talking to us. And we're meeting, and, good things can happen, I guess.
Up next, Stephen Kirk of the Council on Foreign Relations, live from New York City this morning. Good morning.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anim, only on Bloomberg.
Your week ahead looks like there's some major events for you over the next 48 hours. A two-day meeting at the Federal Reserve begins later this morning, concludes tomorrow. Then tech earnings season really gets into high gear. Microsoft on Wednesday alongside Meta, Thursday Apple and Amazon at some point in between in the next 24 hours. You'll also hear from SK Hynix, and SK Hynix today is getting absolutely battered. Stock is down 15% in South Korea. Equity futures struggling stateside. Not so much on the S&P. It's where big tech lives. It's on the Nasdaq 100. We're down by 0.8%. Chips really struggling. In the bond market, 2s, 10s and 30s. An 8 or 9% decline on crude is worth a 1 basis point drop on a 2-year yield. We're down another 2 this morning. The 2-year around 429.94. Let's call it 430. That tells you a lot about what people believe this oil move really means for this Federal Reserve.
Not a whole lot, essentially, and that makes sense given how volatile things are. Citadel Securities came out and actually said they expect the Fed to hike rates despite the widely spread belief that they'll remain on hold, just simply to show that we're in a different place and we're sick of inflation. So let's see. There still is that more than 30% chance baked into the market.
Supply starting to matter further out along the curve as well. Had a 5-year issue yesterday. I'm sure you saw the results of that, Bremo. 5-year supply a little bit sloppy. Yeah. 7-year later.
$44 billion for it. And suddenly you start to have to think, at what point are they trying to anchor the long end of the yield curve as much as they are inflation expectations?
Well, let's get into the inflation story. Let's turn to crude. We do decline once again this morning. We're down by more than 2%. Brent back to 86. WTI just holding the line, just about above 80. Let's call it 81 this morning. Under surveillance this morning, another push for peace with Iran.
They want to meet, and we're meeting. We'll see what happens. There's a chance we can make a deal. Without what we did, they wouldn't even be talking to us. They requested a meeting through their surrogates and directly. And we're meeting, and, good things can happen, I guess.
So here's the latest this morning. The US and Iran pausing strikes for a fourth consecutive night. The president saying both sides are engaging in talks. Tyler Kendall was alongside the president on Air Force One yesterday and joins us now for more. Good morning, Tyler.
Hey, John. Good morning. Well, our reporting indicates it's Iran and Oman working toward a deal to reopen the Strait of Hormuz, which would then allow formal negotiations with the U.S. to resume over potential curbs to Iran's nuclear program. One of the proposals on the table is to reopen that so-called middle passage in the strait to traffic, though there are concerns about mines that have been placed there by Iran. Though people familiar with the matter tell us that Omani officials would like to make an announcement signaling progress in the coming days, though at this point there's no guarantee, because even with the pause in the fighting, traffic in the Strait of Hormuz remains stalled and is now dwindling in the Red Sea. President Trump told me yesterday that he's in constant contact with Saudi Arabia over the threat posed to shipping by the Houthis. And while the U.S. hasn't gotten involved yet, it stands ready to. Ship tracking data shows us now at least 8 super tankers are redirecting towards an Egyptian port to load up with crude from Saudi Arabia in a bid to avoid that more conventional route. Now, John, it is our understanding that Iran's foreign minister held a phone call overnight with his counterpart from Saudi Arabia. And amid this flurry of diplomacy, we heard President Trump yesterday say that there's a, quote, good chance that something could happen. He said that he has plenty of time to reach a deal. But he also added that if progress isn't made, then the U.S. will resume strikes, leaving the threat of escalation firmly on the table.
Tyler Kendall with the latest in Washington. More from Tyler in about an hour from now. Let's build on this with Stephen Cook of the Council on Foreign Relations. He writes the following. The Trump administration made it clear that it was standing down because the United States does not have the weaponry to carry on. The Iranians now know that they have impunity. Stephen joins us now for more. Steve, you say in your words the Trump administration made it clear. Did they make that clear?
Well, all of the reporting from the advice that the president has gotten from the Secretary, I'm sorry, not the Secretary of State, the Chairman of the Joint Chiefs of Staff, as well as Admiral Bradley Cooper, the head of CENTCOM, was that we were running out of munitions and that the bombing in the Strait had diminishing returns, so that the president called it off and is now relying on the Oman channel, where the real negotiations are underway. Meanwhile, Iran's proxies, the Houthis, as well as Iraqi militias, are doing a lot of damage to Saudi oil processing facilities and other energy infrastructure around the region. The Iranians are doing what they normally do, is that they are signaling directly to the United States and its allies and its neighbors in the region that it's willing to talk, while directing its proxies to sow chaos.
When it comes to rebuilding stockpiles, it's not like turning on and off a light switch. So do you expect this pause to be a long one?
Well, it does seem that despite the president's threat of escalation, that he has made the decision that that's not really in the cards. So I think that the pause will go on longer than he was indicating on Air Force One yesterday, which has really become just an idle threat. The last 2 weeks of bombing did not change the Iranian position at all, and in fact left them in a somewhat stronger position because it was the United States that essentially called off the campaign.
We know that Oman tries to keep friendly relations with everyone. They somewhat play both sides. Do you expect them to come out and support Saudi Arabia for a toll?
The Omanis have at times sounded a lot more like Iran's lawyer than a mediator. They maintain that they are being bullied by the Iranians because there is some daylight between Washington and Muscat. That, of course, is a self-serving statement, but it does seem that the Omanis are really the best chance for trying to figure out how to reopen the strait, whether it will be a toll or not. They say publicly at the moment that they don't support a toll. We'll see what happens as the negotiations take place. It's important to note that there's a negotiation going on between Oman and Iran right now, not between the United States and Iran and Oman.
At the same time, Stephen, attacks are continuing. There were reports on satellite images of smoke coming from an oil facility in Saudi Arabia. In Bahrain, there were 2 Amazon data centers that were reportedly under attack. How much do you expect to see a region-wide war amplified and participation of the likes of the UAE as well as Saudi Arabia?
It's a good question. And it seems to me, as I was noting before, that while the Iranians are signaling a willingness to talk through the Omanis, its proxies are being directed to attack American partners in the region, with the exception, I should say, of the United Arab Emirates, which has not taken any hits thus far. But the Houthis, who have a separate conflict with the Saudis, have hit Abqaiq, Abqaiq, a major oil processing facility in Saudi Arabia, as well as a number of other facilities. Iraqi militias have also joined in these attacks. So once again, it is the Iranians talking from one aspect of this, while at the same time their proxies undermining hopes for regional security.
I'm just wondering what it's going to take for some of these Middle East economies to really become, once again, a safe haven for businesses. Hilton just reported earnings and said that revenues from the Middle East and Africa declined by nearly 30% as a result of the war in the region. This was the hot spot for so many different companies to really go and do business. I mean, is that kind of over for the foreseeable future?
Well, this war has raised a question about the Gulf development model, which was based on security and stability and attracting the talent of the world to these city-states, and thus attracting lots of investment. If you cannot provide security, people are not going to come and people aren't going to invest. The Emiratis have taken somewhat different course. They have invested in the relationship with the United States and Israel, while at the same time signaling to the Iranians that they want to have better relations. That seems to have shielded them during this round. It's possible that the Bahrainis and others will follow suit. But once again, the Iranians are intent on disrupting American military operations in the region. And as long as the Kuwaitis and the Bahrainis and Qataris and others have major American bases there, they're going to come under Iranian fire.
Steve, it's good to see you. It always is. Thank you, sir. Stephen Cook there, the Council on Foreign Relations. In many ways, we're still in the new normal. Things haven't changed. Just rotating between strikes and talks with no durable, sustainable off-ramp for diplomacy.
Which is not a new normal that anyone really wants to tolerate. And frankly, the longer it goes on, it takes on a life of its own with respect to inflation expectations and disruptions.
Potentially, the opening of the Strait of Hormuz would give more leeway to the negotiations. But that middle passage they're discussing, well, they have to demine that first before vessels go through.
We've got a trouble in the tech sector this morning. Equity futures decline in chip stocks. That rout deepens. We'll catch up with Mo McHugh of PSP Growth in just a moment on reports that China is making new advancements in the chip space.
Western countries, all of them are cutting funding to Africa. And some of these programs were supported by funding coming from Western countries, like for human resources, for testing, for transportation of samples. And suddenly, African countries have to think how to fund money and to cover this gap. But it takes some time. And I think the combination of all of these factors are fueling this mistrust that we see at community level. We value the support we got and we are still getting from the US. And we think that if we continue to work together, and there is no reason for the US not to work with Africa CDC, Africa CDC is the leader in terms of public health in Africa.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. markets close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Your morning starts in South Korea. Good morning. Starts with the Kospi. We're down by close to 11%, the biggest one-day drop since March, potentially, for that index. If you look at Samsung, SK Hynix, they're getting hammered this morning. SK Hynix has lost about half its value in a month. And they're not alone. The chip sector very much under pressure. You see the follow-through stateside. The Nasdaq underperforms. Nasdaq futures negative so far this morning. We've learned a lot about price and positioning. We're also hearing a lot about increased competition and maybe increased capacity as well out of China. And the financing of the AI ecosystem facing some questions increasingly too.
You've seen an underperformance pretty significantly from the bonds that have been issued by all of the tech sector in particular, but even just the decline that we've seen in prices really threatens their ability to raise equity financing. Ultimately, it was a good story when they were financing all of the capex out of their free cash flow. It is a more worrisome story for people when their own money is on the line as investors, and that's what you're seeing right now in markets.
Even if you're putting up the growth, and that was what was interesting about the Alphabet numbers last week. How do the likes of Microsoft and others avoid an Alphabet-like moment in the next 48 hours?
Well, can they? And to go to Cam Dawson's point, does it require them ratcheting back some of their capex plans? Or are they damned if they do, damned if they don't? Between a rock and a hard place, as we were talking about yesterday. If they reduce their capex plans, well, you're going to be behind the curve and you clearly don't have ambitions. If you increase them, well, where do you think you're going to get the money? And why do you think that you can keep burning hours? Either way, it seems like they're in a somewhat tenuous position.
That's the equity story. Here's the bond market picture this morning. 2s, 10s and 30s. Yields declining across the curve, but not by much. 2 still around 430, down 2 this morning, down a single basis point yesterday. Off the back of this move in crude, and it's a big move. Down about 9% yesterday, down this morning again by, let's call it 2%. It's a big 3-day decline. Friday, Monday, Tuesday, 86 on Brent, WTI at 81.
The president with some soothing words that basically the market is looking at this as no immediate prospect of intense military strike. So they started to feel a little bit more comfortable, even though the Strait of Hormuz has a complete grind to halt. A lot of cargoes are starting to avoid the Bab el-Mandeb Strait. But the oil market is looking at the fact that the president is leaning towards diplomacy. But for how long? How many times have we been here with this cycle? And that's what you really need to ask yourself.
It's a limited rally in the bond market off the back of this, and I think that's for a number of factors. One being, how sustainable is this? Can crude really sustain this downward trend? We've had a vicious repricing of crude in 3 different directions over the last several months or so. The other issue as well is economic resilience, and I think that's keeping yields up. The Fed's still going to engage in talks about interest rate hikes. That will certainly keep yields elevated. And then the supply. Bramo, it's your story. The 5-year was a bit soft, the 7-year later, and this Treasury, unlike years gone by, has got some real competition coming from elsewhere.
Yeah, the central bank of Alphabet and the central bank of Microsoft, the central bank of NVIDIA, my goodness, they're being a central bank to every single tech company out there, really in serious competition with them. And that's the reason why this isn't from inflation expectations. When you take a look at the actual trade in bond yields, it's been real yields, which reached some of the highest levels that we've seen in more than a decade until just a couple of days ago. So the reason why oil doesn't matter as much is because this is a multifaceted story that has a lot more prongs. than just where goes the story in Iran.
Tens around 460 this morning. Yields lower by 2 or 3 basis points as we count you down to the opening bell. 3 hours away. Let's get you some single names to morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with the chip equipment stocks. They are falling this morning on that report that we've been discussing all morning that China is beginning to mass produce certain chip making machines, raising concerns that Beijing is making progress toward building its own semiconductor supply chain despite years of U.S. export controls. It also is raising concerns that Beijing could emerge as a lower cost competitor to Western companies like ASML and Applied Materials. But the selling isn't isolated to those names. It is spreading across the chip sector with AMD, NVIDIA also falling as investors use this story as a reason to trim exposure in one of the most crowded parts of the market at a time when investors have become just increasingly jittery around this trade. You could also say that with this report, investors are starting to weigh the risk that a more competitive Chinese chip making industry could eventually lower the cost of chip making, weakening the pricing power that these names enjoy right now. And we end on the biggest winners of this market, the memory names, of course, selling off on this report. Micron and SanDisk down about 5%. As I said, it just adds to the jitters since investors have already been questioning whether the hundreds of billions of dollars being poured into AI infrastructure will yield enough of a payoff. And now with this report, it also adds to questions whether all this investment is needed if we will eventually get cheaper models and cheaper chip making. John.
Yahara, thank you. Appreciate the update. More from Yahara in about 60 minutes from now in the next hour. On our radar this morning, President Donald Trump saying there's a good chance for a deal with Iran.
They requested a meeting. They would not have requested the meeting if we were doing poorly. The only reason they want to meet is because we've been hitting them very hard. Their whole shoreline's wiped out. The strait is in very good shape. And we're talking right now.
The extent of the talks between the two countries remains unclear. Elsewhere, the president voicing support for Fed Chair Kevin Warsh while taking game at the Board of Governors.
Kevin's fantastic, but he's got a board, and the board members are very political. He wants to do the right thing. I know what he wants to do. But you need the consent of some people that have perhaps bad intentions. Rates should be lowered.
Investors widely expecting the Fed to hold rates steady tomorrow with a very slim chance of a surprise hike. And finally, chip stocks selling off on a report that China is mass-producing advanced semiconductor machines. The information reporting a state-backed company is aiming to produce 20 machines in the next year.
You can argue, and many people will, and debate, frankly, whether these machines can truly compete with the likes of SK Hynix and Samsung to create the memory chips that are necessary. There's a bigger question here, whether north of 80% profit margins are sustainable before there is some sort of competitive pressure. The idea that some of these companies, the chip maker companies, the memory chips in particular, have been able to capitalize so significantly in these profits has historically been a recipe for self-demise because that will invite competition and demand and some sort of supply to meet that demand.
At the moment, it's just a prototype, and it's not becoming at the same level that we have ASML. And the reason why it's so important for China is because they don't have access to the level of ASML machines that we do or other parts of Europe or Asia have. They are barred by U.S. export controls. That is why it has a lot of people's attention. At the same time, they're producing 5 this year, maybe 20 next year, and we don't even have the company name. So I'm just a little bit skeptical into how advanced this company actually is.
How much weight can we put on this story? Mum Q of PSP Growth writing the following. The chip stock rally has largely been driven by scarcity, the rise of a low-cost competitor, and risk of China's self-sufficiency directly puts pressure on that. Mum joins us now for more. Mum, do you believe we have an upcoming emerging competitor to ASML?
Good morning, John. Nice to see you. Yeah, the chip stocks definitely had a rough week over the past week, or a few weeks if you count from their peak in June. But let's put this into perspective. If you look at the stocks index, they're still up 100% year over year, the index that measures semiconductor stocks. And several of the individual names are up 400, 500% year over year. I think it was on this show a few months ago that you asked me, is there any limit to their growth? Because the chip stock seems to be the bottleneck for AI, and there were no alternatives. So finally, for the first time, you're seeing the alternatives. You're seeing the pressure. First, you're seeing that from the domestic producers or competitors where you have hyperscalers making their own custom chips, and now you're seeing it from China. So I think anything that puts a dent on the perfection of the chip stocks will cause a market reaction. But let's not forget that they're still fundamental to core fundamental AI supply chain, and I wouldn't worry too much that crisis is emerging.
So how would you paint the narrative right now, Mome? Do you think that this is just some blow off top that gives it a more attractive entry point? Or do you think that this is a bigger readjustment to valuations that make more sense going forward, given the fact that there is likely to be some competitive pressures for these companies?
Yeah, absolutely. I think a while ago, we were thinking the upside could almost be infinite. And obviously that is not sustainable because, to your point, when you have that kind of profit margins in such a big market, you're going to invite competition. So I do think this is a reaction from the market that, yes, competition is here. It probably won't be the last competition. And what you see is not necessarily that these are bad companies to be in, but you finally, for the first time, are seeing a cap on what the valuation of these companies could be.
Do you think that we're going to see a cap on some of the CapEx ambitions from the likes of Amazon and Meta and Microsoft later this week?
Doesn't look like it, right? I mean, the numbers keep going up. I think the latest numbers is the Max 7 are going to spend $800 billion on CapEx this year. This was revised up even from just a few weeks ago when the number was 600 or 700 billion. And I think that's why the market is starting to put pressure on the CapEx too. It's losing patience with the story of invest today to hopefully win tomorrow. And we're not really seeing the end in sight in terms of just how much money it takes to build the overall AI infrastructure, and the market is not reacting well to that. So I think you're going to see that storyline throughout this week as the Max 7, more of the Max 7 report earnings.
We also are getting another fresh dose of this concern about circular financing, with this week NVIDIA being the backstop when it comes to OpenAI and SoftBank's data center commitments. How concerned are you again about this story that seems to pop up every few months?
To me, this is not a new story. It might exacerbate some of the concerns that we had before. One, that CapEx spend doesn't seem to be slowing down. It seems to be reaching new levels. And the other thing it does show me is adoption is still not there, right? And because the circular financing means you are paying your own customers, you're financing your own customers to drive the demand while the AI infrastructure matures. So I think there are two things maybe in two levers that can lead to a winning equation, if you will, that could ease some of these fears. One is there's a strong focus on cost. We're hearing all the time that cost is not sustainable. So you are seeing innovations from the hyperscalers to develop their own chips. OpenAI is developing their own AI chips. Even on the earlier innovation side, you're seeing companies like Ingram, like Cell Research, doing new innovations on memory, on long horizon agents to drive the overall cost of AI infrastructure down. And then the other side is obviously if AI adoption, we're seeing AI become mainstream, is embedded in our lives, that will ease concerns. And I think on that trend, everyone's watching enterprise adoption. There's a renewed interest in physical AI and robotics because that's a tangible way that these AI innovations are being embedded in our everyday lives. So names like physical intelligence, like general intuition, skilled field, those are getting renewed interest because the market is so desperate for some form of real AI innovation in our everyday lives.
A lot of vulnerabilities in the AI ecosystem at the moment. Mome, appreciate your time as always. Thanks for the update. Mome Q there of PSP Growth. Massive focus on tech, as there should be. Bramo's looking elsewhere, as she should be, because we've been talking about this, and we'll get to the jokes in a moment. But we've said repeatedly that if you look at the tech story right now, yes, there is a tech scare across several parts of the tech sector. But you look at the broader economy, it's hard to point to many companies right now who are too concerned about this economy.
So Royal Caribbean Cruise Lines, which is what you're most passionate about in your life, John, came out. They beat expectations. They raised their full year EPS forecast. Beat estimates across the board. Shares a little bit lower. They talked also about the geopolitical tensions that have been reducing certain lines, in particular in the Middle East. We heard the same thing from Hilton. So clearly not getting a good read through in the shares. But the commentary is that booking trends for 2027 are pacing ahead of historical levels, that the environment remains strong, that their differentiated experiences for Jonathan Farrow remain very robust in their offerings, and that, you know, they're going to go potentially Puglia. So I think that maybe that has something in your offing.
Look, we won't make this about me. I'll avoid that.
But
the backdrop for these stories,
totally.
These stocks seems to be okay right now. There's no scare. Now, maybe there is one in the pipeline, but you don't see it this morning, which is why we keep going back to these rolling shocks through energy, through interest rates, through tech as a sector in the equity market, but not through the economy.
And it explains why equal weight continues to outperform and hit an all-time high yesterday. So even though we're all focused so intensely, and correctly so, on big tech, because that's been a huge driver of everything, the consumer's hanging in there, and that's what these stories show.
That stock is down by something like 5% of the pre-market. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Vonnie Quinn has more. Hey, Vonnie.
Hey, John, thank you. President Donald Trump preparing to meet with Israeli Prime Minister Benjamin Netanyahu at the White House today. Administration officials saying the two leaders will discuss the framework agreement they signed with Lebanon over the Israel-Hezbollah war and the expansion of the Abraham Accords. President Trump also meeting with Ukraine President Volodymyr Zelensky, who is in Washington for Senator Lindsey Graham's funeral. Zelensky saying his top priority for the meeting is securing stronger air defense and strategic cooperation as Russia intensifies its attacks. In markets, Citadel Securities expects the Fed to announce a rate hike tomorrow. The firm's head of macro strategy writing in a note, quote, a quarter-point increase would reinforce Warsh's pledge to restore price stability and show policymakers no longer rely on signaling every policy move well in advance. And that's your Bloomberg Brief. John.
Hey, Vonnie, thank you. Thanks for the update. Up next on the programme, potential descent in the ranks.
Warsh wants to indicate that he is in control. He doesn't want to look like he's being pushed around either way. I think you would get at least one descent. We would guess two, probably, if Warsh keeps rates on hold this week.
Has Waller been throwing the bread rolls across the table at dinner?
Tell me who it is.
Is that what's been happening?
I think that, he's got the arms for it.
He certainly got the arms for it. I would not get in a fight with Chris Waller.
No way.
No. Kevin Warsh's got my build. Stay clear from that. Just steer well clear.
I will.
Jonathan Pingle of UBS joins us next, live from New York City this morning. Good morning.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream. And a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start on the third floor or the lobby. You actually have to start in the basement.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Tyler Kendall in Geneva, Switzerland, and this is Bloomberg.
Tech underperforming once again this morning. We've had 3 days of weakness for semis. It continues this morning. On the Nasdaq, we're down by 0.9%. On the S&P 500, only down 0.1%. Those tech jitters preventing us from getting a nice rally off the back of this move in crude. Down yesterday, down again this morning. WTI and Brent declining by, let's call it 2%. Brent crude at 86, but a limited rally in the bond market. Yields down a single basis point at the front end of the curve yesterday, down by 2 this morning. Let's call it 430 on 2s. Let's call it 462 on 10s. This from HSBC. And Dhiral Narula saying it's more than oil prices driving long-end rates. We think this reflects a combination of fiscal concerns amid renewed headlines around budget deficits, in addition to mounting capex guidance coming from the private sector.
This is clearly on their minds. How do you cap long-end yields in the Treasury market when you have real competitive pressure from the issuance from big tech? There also is a question of how do you solidify no forward guidance, this concept of a very different Fed with a renewed focus on inflation. And that's Citadel's point, and the reason why they're expecting a rate hike this week, even though a lot of people do not have that as a base case.
That Fed meeting begins later this morning. Under surveillance this morning, potential descent in the ranks.
Walsh wants to indicate that he is in control. He doesn't want to look like he's being pushed around either way. I think you would get at least 1 dissent. We would guess 2 probably if Walsh keeps rates on hold this week. There's an irreducible level of uncertainty here because we have no strategy, no playbook from Walsh.
So here's the latest this morning. The Fed Chair Kevin Walsh heading into his second policy meeting later on today as Fed Chair. Strong labour market data and renewed pressure on inflation, injecting fresh uncertainty into tomorrow's decision. Jonathan Pinkel of UBS predicting a family fight, writing, we see the FOMC on hold this week with 3 dissents as a base case, although we wouldn't be surprised to see 4. Jonathan joins us now for more.
No, I mean
that would be controversial.
Yeah, it would be. He left in his last press conference pretty strongly the sense that he would be supportive of the chair. So I'm assuming, and actually one of the reasons I think this rate decision really is Kevin Walsh's decision to make is in part because you've got a certain amount of division on the committee, but I do think Powell would go wherever Walsh goes, and probably Philip Jefferson, which sort of makes Walsh himself deciding the swing votes on the committee.
So where are the dissents coming from?
Well, the hawks on the committee, and I wouldn't be surprised if there was a
Logan Hammock. There's 2. Give me 2 more.
Logan, and I would say Kashkari is assuming a hike this year, and I also wouldn't be surprised if there was some demonstration of independence by, say, Elisa Cook or a Michael Barr.
What do you think is the main driver of it right now, especially given that inflation pressures may have peaked at least for the next couple of months as a result of where oil prices have been?
Well, I mean, they'll have to take the temperature in the room, of course, right? Because they may need to turn up the air conditioning in the family fight here, right?
Understood.
But when we look at the committee and what they're gaining and what they're losing is Kevin Walsh has really talked tough about, fighting inflation, right? So at some point he might need to put his money where his mouth is. And then there's a number of committee members that, essentially they're kind of losing patience at just the year-over-year rates remaining elevated, right? So I do think this is a closer call than, if you looked at the Bloomberg consensus, there's almost every economist expects them on hold. And I suspect the odds are probably higher than that for a rate hike. Because I do think there is this lingering tension of, how are they going to get inflation back to 2? Year-over-year rates look sticky. I mean, we think inflation has passed the peak and the data is going to bail them out. So I've got the Fed on hold for the rest of the year, but I have to say it's not high conviction.
Do you think that some of the volatility and the incredible gains that we saw in certain tech sectors was due to the Fed's policy leading up to this year as a result of some of the rate cuts last year and the fact that they have not been restrictive enough?
My guess is that this tech investment, I mean, it's been relentless. It looks pretty interest rate insensitive to me. I mean, we can see how it's been financed. A lot of it's been financed out of free cash flow. I mean, they are taking on more debt now. But given the optimism in this sector, my guess is, in a way, you probably needed 2 interest rates for the economy. One for the AI tech capex, which probably should be a really high interest rate if you wanted to slow it, versus everybody else who probably doesn't really need higher rates at this juncture.
Jonathan, there's one name you didn't mention, which is Waller, which seems to have some pushback on the Fed chair, according to this Wall Street Journal article about this dinner they had. But also the article talked about a quote Waller said this month: "Sternly staring at inflation till it melts before a withering gaze is not an option." Do you think potentially he dissents?
My guess is, given his speech 2.5 weeks ago, that he's kind of backed himself into a corner. I mean, he said he laid down a very specific marker for the decision to hold or not, and the data clearly met the marker. So I think rhetorically he's kind of backed himself into a corner. But his disagreements with the chair's views, they came out in that Q&A. I mean, there's open questions about, what's going to come out of the communications process, the task forces, how you think about forward guidance. And Waller does not seem fully on board with some of these changes.
Do you think that's healthy, or do you think it disrupts the transmission of monetary policy?
Which, the disagreements?
The disagreements in the public, the way it's playing out this morning.
In the grand scheme of things, I think it's probably healthy. I think one of the problems we're having, though, is the lack of forward guidance from the chair has kind of spilled over into a lack of understanding the reaction function, what they're looking at, what the risks he might think are. And given the fact that he can push around sort of the median of the committee at the moment, I mean, he's going to decide policy for the next few meetings. And we really have no idea how Kevin Warsh thinks about monetary policy. I mean, everyone's walking around saying they think they do, but I'm pretty agnostic.
Is that where your low conviction comes from? That you say on the one hand, I say hold, but it's low conviction because of that? Is it just that? You don't really know what the Fed chair stands for?
That is the big source. I mean, if we knew what the reaction function was, if he said, hey, I'm going to follow a Taylor rule, he doesn't have to give us any forward guidance, but we would know sort of how to weigh the incoming information. If we knew what he was worried about and the risks, we could take that into account. But he's really offered very little insight, and he's also written very different things at different states of his career. So it's just very hard to know, like, how is he thinking about policy now?
John, good to see you. Appreciate
Thanks for having
Thank
me.
you. Super smooth, this one about the temperature in the family fight. Bit of a family fight in here in the commercial break. Jonathan Pingle there of UBS.
Well, over the temperature of the...
Anne-Marie actually wants the room cooler, just to be clear.
Yeah, well, it's a little warm, and typically it's a little cold in here, and usually guests come in and they say, woo, nippy, and some people say, yes, see, and other people are like, but it's actually nice.
Some people.
I, of course, don't have a view. Up next, we'll catch up with Stuart Kaiser at Citi. I don't have a view on it at all. Not this morning. I haven't said a word.
That's right, ever.
I never have a view.
Never.
Oh, sure.
Jason Thomas of Carlisle joins us in a moment alongside Matt Hornback at Morgan Stanley. The second hour of Bloomberg Surveillance is just around the corner.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders.
Great scoop on this. You've been reporting about an activist investor coming up and trying to shake things up. What's the latest?
We've been hearing that there was going to be an activist at some point. The question was who?
There is a convergence of technology and national security.
The United States is a big country. We're playing in the Northeast. That's an economy as big as the United Kingdom.
This is a really interesting space to watch. We're expecting more consolidation.
As this is Bloomberg Deals at Bloomberg Invest, I want to talk about the broader deal and M&A environment.
This is a moment in time. We'll see how long we're here. It's far too early to call.
There is an underinvestment in what's going on in private markets.
because everyone's looking for additional AI cloud capacity, and it's very tough to build.
Everybody wants to get things going, and the IPO market is just one symptom of that. It is an early indicator of what we're going to see in the M&A market.
Let's go to Scarlett Fu, who's taking a closer look at drone companies. With ongoing conflicts in the Middle East and Ukraine, there's renewed investor appetite for new names in the space. Excellent reporting.
I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Technology is embedded in every aspect of our lives, and that revolution is playing out in real time. From finance to defense tech, AI to entertainment, from the road to the stars. Bloomberg is bringing you the stories of companies and people that are pushing tech to new frontiers, and the politics reshaping global tech markets. I'm Ed Ludlow, live in San Francisco, and this is Bloomberg Tech.
Every weekday, only on Bloomberg Television.
When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And
I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Are we breaking right now in our endless corporate debt?
Does anybody have any momentum going into these midterms?
With Alexis Christoforous on markets.
Geopolitical risk in focus.
And Michael Barr with news.
President Trump continued social media attacks.
The best in economics, finance, investment, and international relations. Bloomberg Surveillance on Bloomberg Radio, Bloomberg Originals, and the Bloomberg Business app.
Good morning, everyone. Tom Keene, Paul Sweeney, Michael Barr, Alexis Christoforous. Welcome to a pre-fed Bloomberg Surveillance. I mean, it's going to be a different meeting. I haven't seen enough mystery like this, and it's like back to Chairman Greenspan. Is he having a ham sandwich or a peanut butter sandwich?
And what's he going to give you, Tom? I mean, what's he going to give the marketplace in terms of a statement, in terms of comments and
huge
guidance and all that kind of stuff?
We've got some good voices today. Terry Weissman's going to join us, but you know, there's people looking for 3 rate cuts this year. There's people looking for no rate cuts. Rate rises, 3 rate increases this year. Some people looking for nothing to happen. It's a mess. It's all over the place.
It's okay. It's all right. I think the market's trying to figure out what's going on out there, and we've got. You know, I always start these days with oil, and I've got another pullback with oil. So we got WTI crude oil at 81. I got my equity futures are kind of mixed here today. NASDAQ, certainly some weight on the NASDAQ tape as people figure out the
little pre-Fed feel to it.
Yeah,
I think even with earnings.
We got a lot of earnings, Tom. Wednesday and Thursday, the big tech names. So we're on top of it.
We'll see. We say good morning to all of you across America and around the world. Going to dive into a Fed chat here in a moment, but it's a different Fed chat this time around. Right now from the Interactive Broker Studios, the Bloomberg Business Flash, Alexis Christoforous.
All right, thanks very much, Tom. A slump in chip stocks is broadening as concerns mount over the cost of the AI boom and signs that China is catching up in the technological arms race. Right now, S&P futures are down just about 7 points, but we do have Dow futures in the green, best level of the morning now at up 235 points, or about 0.4%. Meantime, NASDAQ 100 futures under pressure, down 284 points, or 1%. We mentioned oil a moment ago. It is lower. Brent crude down 2 1/3% at $86.28 a barrel, while West Texas Intermediate crude sits at $81 a barrel. That is down about 2%. The Bloomberg Dollar Spot Index up 0.1% at 1223.40. The Japanese yen down 0.1% at 163.93 against the U.S. dollar. Lots of pre-bell earnings to tell you about today. Coca-Cola moments ago reported comparable earnings per share for the second second quarter that beat the average analyst estimate. That stock higher by about 1%. Also higher UPS this morning, United Parcel Service, boosting its sales guidance for the year. We have got yields lower with the 2-year at 4.30%, the 10-year at 4.62%. After the closing bell, we're going to get profit report cards from Visa and Ford. That is your Bloomberg Business Flash. Tom and Paul.
Alexis, thanks so much. Terry Wiseman joins us now to say head of global strategy. Macquarie barely does justice to his esteemed Fed-watching career. Boy, this meeting, it is different. It is a mystery, isn't it?
Yeah, and I kind of blame Kevin Warsh for that. The idea that you should be terse in your statements and that you should limit the amount of communication and guidance. Well, what did you expect? If that is how you want to operate, you're going to see a lot of opinions out there because people are not going to be basing what they think on your words. They'll be basing everything on their interpretation of the future, including the short-term future. Look, the people who think that there are no rate hikes coming and that he will stay flat are probably the people who think the stock market's going to sell off and oil is going to sell off over the next 6 months. And that's a perfectly valid view to take.
But Dr. Wiseman, what's so important here, and I'm sure you studied this across your effort at Harvard, the basic thing to me is this a hearkening to the past, or can he not get away with that because of modern technology? The speed of information. Alan Greenspan didn't have to worry about social media.
I think he's not going to be able to get away with it, not because of technology, but because he's going to be pressed to give information when he appears before Congress, when he's in the presser, and of course you're going to have a bunch of other senior Fed staff say what they want to say at their appearances, and when they're asked to give commentary. So it's going to be difficult to keep a lid on what the FOMC says, regardless of what Kevin Warsh wants to do.
I don't think Paul will remember this, but Terry, you and I are old enough. I mean, Waller was on the edge of Wayne Angel yesterday.
Exactly. So I'm looking at the WIRP function here, Terry, on the Bloomberg terminal. Almost 2 rate hikes kind of priced in here.
I did not know that.
Yeah, we're up there. It's 43 basis points by the end of the year. I don't know. Does that seem reasonable to you?
It seems a little bit too hawkish, but I do believe they're going to be raising rates. I believe it's going to happen at the latest in October. There's a tail there to maybe moving it into September. The only reason I would even I am entertaining October is because the personal consumption price index revisions are coming out in late September, and maybe Kevin Warsh might be able to convince the committee to wait until that data is out before making a decision on raising rates. But if oil stays high, if the stock market stays robust, if there is no decline in inflation, yes, I could easily see September. That is the meeting after tomorrow when they raise rates.
We also have the Bank of Japan. What do you expect to happen there? Because I'm looking at the yen. I mean, Tom and I, we're kind of on a 165 watch here. I don't know.
Yeah. So the Bank of Japan has been very deliberate in their rate hiking or rate normalization process. They tend to raise the policy rate by about 25 basis points every 6 months, and that's been going on since 2024. If they continue to follow that pattern, you should not expect another rate hike until December. However, there were leaks last week about the prospect that the BOJ would accelerate the hike. So maybe they're going to do it in October as well. Having said that, up until now, their rate hikes have not done anything to curtail speculation against the yen. I don't think that's a reason to not hike. There are other reasons to hike, including the fact that real rates are negative in Japan. But if they sound too dovish at the meeting this week and dollar yen rises overnight as a result, I would fade that move, because if that happens, I think they would conclude that they did not convey the right message, and then there is a risk of intervention in the market, either rhetorically or with actual FX intervention on Friday.
Terry Wiseman with us with Global Strategy. Macquarie, of course, all of Australia, and here in New York is well. Terry, to bring it back to the Fed here, the elephant in the room to me is an elevated real rate. Ed Yardeni told me a couple days ago, he said, hey, rates are back to normal. Do you agree that we just got to get used to rates at this level because this was what it was like decades ago?
Yes, prospectively, but I would not say that the elephant in the room is real rates. I would say the elephant in the room is the fact that personal consumption expenditure price index on a core basis has been above 3%, or roughly around 3%. Forever. That is the elephant in the room. And I would highlight that, for those of us who think that Kevin Warsh is unwilling or has a penchant to offer no information, I would push back against that too. In his testimony before Congress a few days ago, he said something to the effect that divulged or betrayed his own tightening bias. He said that over the next few meetings, the committee would be examining the tools that it needs to roll out to control inflation. Given that, as I mentioned, inflation's been running, core inflation has been running at 3%, you would think that that implies a tightening bias. I think the question is when. Today, no, not today. September, possibly, more likely October when we get those full revisions.
I'm looking at the DXY index, 101.61 here. I mean, is there any reason to fade the U.S. dollar here? That was the call coming into the year until we...
Yeah, I mean, the reason to fade the U.S. dollar is that oil prices might come down if you get another memorandum of understanding between the U.S. and Iran. That I think would be the important driver, because one of the things that's been holding up the dollar all year has been high oil prices, and there's a very strong and valid fundamental reason for that. The U.S. economy actually benefits from high oil prices. We are a net exporter. And when the price of what you export goes up, it raises your real incomes in aggregate. Not everyone gets hurt, not everyone gets helped, but in aggregate, it benefits. That is economics 201.
Okay, we got to go to surveillance landman correspondent Paul Sweeney on this. I mean, do you feel like we're energy independent when you watch Landman?
I do. I mean, the folks down there in the oil patch are just, you know, they're loving life here. That shale stuff is real. I'm telling you.
Terry Weisford, thank you
Cracking all
so
over the place.
much. People are listening to this going, are they serious? Terry Weisford, thank you so much with Macquarie. Just a brilliant research note. Look for that through Macquarie. We protect the copyright of all of our guests. She is brilliant. Abir Abu Omar, we haven't had her on in ages. She's in Dubai. And to say she's a Middle East reporter barely describes her reach across all of the United Arab Emirates in the Persian Gulf. And she joins us now. But what is the tension sleeping and waking up in the morning from Kuwait all the way down to Dubai? What's the living tension right now?
Oh, good morning, Tom. An existential question there. Well, look, I mean, for the time being, it's a little calm here in the Middle East. It's especially been the case since late Friday when the United States had halted attacks all of a sudden against Iran after 13 consecutive nights of attacking cities within Iran. And so what we saw then was a sense of calmness. No explanation was given by President Trump or the United States. Some reports were floating around about the United States running out of ammunition. President Trump came out, refuted that, said that actually the U.S. has more than enough ammunition, but that he would like to have more. So for now, we're seeing a little bit of a pause in hostilities, especially with Iran saying that it will suspend those attacks against shipping in the Strait of Hormuz and countries in the region, including, as you have mentioned, Kuwait, the UAE, Saudi Arabia, and the others across the GCC.
What does the United Arab Emirates want here when you look at the royal family? Al Nahyan of Abu Dhabi and, of course, the separate family of Dubai. What do the royal families want from President Trump?
Look, that's a really good question, right? It's not just the UAE that I want to focus on. It's royal families across the GCC. And really what's at heart here, the key part in all of this is that these are very oil-rich countries, right? So for the majority of my career at Bloomberg, I've covered economics. And these countries, despite diversifying away from oil over the past decade or so, are still very reliant on oil. So when you have the Strait of Hormuz, of which a fifth of the world's energy goes through, when you see that come to a standstill, similarly to what we're seeing right now, because over the past 2 weeks or so, Tom, we've seen movement pretty much paralyzed there. And so these countries are really trying to double down with both Iran and the United States, keeping those diplomatic channels open to try to get those flows going again. And let's just not forget that over the past week or so, the Red Sea, Bab el-Mandeb Strait, of which Saudi Arabia has been resorting to throughout the course of this war to try to get its energy exports out, is also now being struck by the Houthis in Yemen. So this is a parallel war that is happening. So you've got two major waterways at risk. And so those countries are really trying to keep those channels open to mediate, to get this to be resolved and get the movement in the region to happen yet again.
Abir, is there a sense in your part of the world that the Strait of Hormuz, let's just focus on that for the moment, the Strait of Hormuz will never be a free passageway again?
That's the money question. Thank you.
And that's a really good question, right? Because there is this notion of the new paradigm, the new norm, and this was especially the case a couple of weeks ago or so, especially after that MOU was signed in Switzerland, when Iran said that it will start charging fees to ships and tankers that are making their way through the Strait of Hormuz, regardless of what the U.S. thinks, regardless of what Oman thinks. And so we reported a couple of weeks ago again that while countries in the region do not want to see that, they've kind of succumbed to the reality that this could very much be the case going forward. And not just the GCC, also the EU, right? They have had private conversations suggesting that this is not an ideal scenario, but this could very much be the new paradigm of how things are done. Iran is quite adamant on that.
But this is the heart of the matter. Paul's wonderful question here. If there's a forever change in the Gulf of Hormuz, who's going to police that?
That's a good question. Iran is the name of the game here. Iran says that it wants to maintain control over the Strait of Hormuz. And really, since the start of this war, Tom, you've seen Iran kind of wake up to this reality of how much control it can assert over the Strait of Hormuz, really. And this is what we've reported yesterday as well, is that Iran and Oman have had discussions over the weekend trying to restart movement through the Strait of Hormuz, especially the middle passageway.
I understand that, but what does Dubai want? What does Abu Dhabi want? What does Qatar want, etc., if they're going to give up the strait, which I don't believe, to Iran? I mean, that's the heart of the debate, isn't it?
It is. And look, for the time being, we don't have a lot of clarity on what conversations those countries are having. For the time being, what we understand is that countries in the region, namely Oman and Qatar, have been the main mediators between Iran and the United States, just getting those diplomatic channels to remain open, really, and to get the movement, not just when it comes to energy. Look, I mean, these countries are also very heavily reliant on FDI, on finance coming to the region. Dubai and Abu Dhabi are quite famous for attracting all these big funds around the world and big banks, and this is a message that we've been getting from people on Wall Street, from people in Europe, coming to the region, trying to say that we're still here. They're sending a message, and so those countries are really trying to keep business open. That is the main goal for a lot of the countries in the GCC.
Abir, thank you so much. Abir Abu Omar with us from Dubai this morning. Paul, I think your question is absolutely the heart of the matter. And it's being addressed nowhere at all is this changed Gulf of Hormuz, which until X number of months ago we thought was forever international waters.
It's a problem that we created and we own it. So I don't know how we fix it, but that was a waterway that was completely open for all the trade, including the energy. Now it's not. Now what do you do?
I'm advanced discussion on this, folks. I know that Oman is to the right of Yemen. That's the ignorance that so many Americans have. I got to look at the map, as I said yesterday, on the tip of the Red Sea, which I believe is a 16-mile wide gap on the Red Sea. I had to get out the map and start learning, from 8th grade geography, where I went down in flames.
Yeah, I was just seeing some video yesterday of the Strait of Hormuz, and there's lots of little Boston whalers buzzing around out there. You don't know who's in those boats, but before we started this war, you didn't really worry about it too much. Now you have to.
Now you have to. Thank you, Abu, for that from Dubai. Red and green on the screen this day before the Fed meeting. With our news in New York City, here's Michael Barr.
Thank you very much. Israeli Prime Minister Benjamin Netanyahu meets with President Trump today. The president also meets today with Ukrainian President Volodymyr Zelensky, just hours ahead of Senator Lindsey Graham's funeral. The U.S. and Iran extended their pause in hostilities, with the focus turning to talks between Tehran and Oman over restarting traffic in the Strait of Hormuz. Zach Cohen, Bloomberg government congressional reporter.
Specifically on over how to restart traffic in the Strait of Hormuz, which is essentially ground to a halt and has increasingly been an issue in terms of global energy markets. And sources are telling our colleagues that reopening the Strait of Hormuz, getting those carriers, those ships back through that key waterway could open up other parts of negotiations as Washington and Tehran look for some sort of peace deal, some long-term slowdown to the hostilities.
Bloomberg's Zach Cohen. The Pima County Sheriff's Department in Arizona says the investigation into Nancy Guthrie's disappearance nearly 6 months ago remains active and ongoing, though without a significant development. It comes as today's show host Savannah Guthrie released a new video pleading about her 84-year-old mother.
It has been months since our mom was taken from us. Our family is in agony. We are in a nightmare that will not end. Nothing about our situation has changed.
Investigators are still trying to trace the items worn by the masked man on Nancy Guthrie's doorstep and run a DNA test on hair found at the home. Historic wildfires in France and Spain have forced hundreds of thousands to flee their homes. Heat waves and scant rainfall have fueled these blazes. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Tom, Paul, Alexis.
Michael Barr, thanks so much. The news update, the Michael Barr Moment, it's brought to you by IBKR. For the past 3 years, Interactive Brokers, individual clients averaged 24.3% annually, beating the Standard & Poor's 500. Lower costs and access to 170-plus global markets matter. Visit ibkr.com/performance. Paul, I'm seeing all sorts of beats. Dan Curtis told me this. There's all sorts of beats out there. And to me, this singular headline today, can we do something that's not technology, not AI? Coca-Cola, second quarter, organic revenue rose 6%.
That's amazing.
That's a number you get with a nominal, maybe that's World Cup affected. I don't know. But that's a big number. And again, it goes back to this nominal GDP oomph of the economy.
Yeah, big sponsor for the FIFA World Cup, which was a huge success story. But, they're now seeing organic sales growth of 5% versus a previous forecast of 4 to 5%. So doing a little bit better there. And I have to admit, full disclosure, I'm a Coca-Cola person. But you put a Pepsi in front of me, I'll be done drinking. I'll be just as happy. I think Coca-Cola is one of the greatest beverages of all time. That's how much I like it. But don't drink it that often.
I could see a merger of Budweiser and Coca-Cola to keep the Sweeney House
every once in a while
happy. Michael Barr, are you going to weigh in here? I mean, a Coca-Cola or Pepsi?
You know what? I'm going to say neither because I'm a Detroiter. I'm going to say Verner's.
What are
Verner's?
What?
You never heard the ginger ale Verner's?
No, now I got to Google this.
Oh, my goodness. It's one of the best ever
Verner's
soft drinks.
Wow.
And my mother would say the A&W in the bottle and the can wasn't the same as the old A&W.
And the folks from Texas will say Dr. Pepper.
They would.
They will die on that hill. Big time.
We would die.
All right, I'm looking at Verner's here. Wow. Okay. Ginger ale, yeah.
Yeah, it's old school.
You can't get that. I've never seen that around here.
Every time my son comes in from Detroit, I say, bring me 2 6-packs of Verner's.
Nice. Okay.
Oh, please. With the Pabst Blue Ribbon, right?
Exactly.
But they're good. It's good.
I remember Orange Crush.
Yeah.
The rich kids had Orange Crush.
Yeah,
we didn't have
absolutely.
It.
Yeah. It's like fancy. They had like a gallon of corn syrup in it or whatever.
What about Tab?
Oh, man, 70s.
What a hipster. Remember that? Tab came along. He's like, it's a girl drink. Red and green on the screen right now. The VIX 18.91. The VIX elevated. Good morning. And now for the
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
7:24 on Wall Street. I'm Alexis Christoforous from the Bloomberg Interactive Broker Studio. We have got ourselves a very busy pre-market here with our earnings we want to tick through quickly for you. Coca-Cola up 3.5%. It raised its full-year outlook, boosted by demand last quarter while it was a major sponsor of the FIFA World Cup. We've got JetBlue's second quarter results beating the street as strong demand helped to offset high fuel prices related to the Iran war. Shares of JetBlue taking off this morning. Hilton Hotels quarterly profits and revenue beating expectations. The company also raised its full-year outlook on higher demand across its businesses. Still, shares of Hilton down 2%. And PayPal bumped up its profitability guidance and reported revenue growth in the company's first earnings release since receiving a takeover offer from rival fintech Stripe and the buyout firm Advent International. Shares of PayPal down about 1.5%. Speaking of being down, NASDAQ 100 futures off 280 points now, or about 1% as the chip rout continues. Dow futures, though, up 330 points, and S&P futures are down about 6. Oil is pulling back again. Brent crude at $86.60 a barrel, down about 2%, and West Texas Intermediate crude down about 1.75% now at $81 the barrel. Bloomberg Dollar Spot Index up slightly at 1223.16, and that's your Bloomberg Business Flash. Back to Tom and Paul.
Oh, Alexis, the things you learn about our guests. I'm looking at an ad from the 1990s. Right now, Bloomberg Surveillance, as we continue to look at the earnings, and the Coca-Cola juggernaut was launched in the 1990s around their Grinchmas campaign, which Universal is still doing. Joining us now, one of the key actresses of the classic Grinchmas commercial. There she is. I just saw her. Sarah, we'll get this out next time she's on. Cameron Dawson, that was your mom there with the red hair?
I mean, so classically trained Grinchmas actress, 100%.
How did we land this property?
It was an incredibly intense audition process, but I beat out the other young ladies, and I got to star in my Grinchmas commercial.
Do you get roll-on royalties here?
I did for a while. It actually helped pay for my initial college year. So
Right.
Look, it's great.
So I look at this to bring it back to the real Cam Dawson of 2026. Everything's a beat. And when I see organic revenue growth of 6%, it's just a nominal GDP popping economy. That's all it is.
Exactly. And there is no sign that we are in a growth scare. So we have to talk about the economy somewhat in a different light than we talk about markets. And I think that it's almost the inverse of what we were seeing back a couple of years ago, where we were talking about the market being so much stronger than the economy was. We're not seeing any evidence that the economy is falling off a cliff or growth is slowing down materially. You wouldn't have banks trading at 52-week highs and actually all-time highs if you were worried about growth in this economy. So I think that the growth is underlying, but what we're dealing with market volatility is effectively a positioning and valuation reset, mostly in the largest weights in the index, of course, being those tech names.
We've had some great earnings really over the last several quarters. 27, that's going to set the bar very high for the marketplace. I hate to look ahead too much, but here we are, looking at almost August here. 27 comps, is that going to be a headwind for this market, do you think?
I think that that's probably the biggest story that nobody's talking about yet, but we're going to talk about it a lot over the course of the next couple of months. Let's just take 2Q as an example. 2Q earnings are running at 37.9%. Now, a full 12 percentage points of that is just Google's one-time gain on Anthropic and SpaceX. Right. However, if you're thinking about consensus, which is expecting 15% growth overall in 2027, just removing that one-time gain from estimates, you could effectively have an environment where 27 estimates look a little bit too rich.
If we jawbone or do raise rates, is that enough to dampen the nominal GDP enthusiasm?
Yeah, that's a really fantastic question, because if you go back to the rate hikes starting in 2022, effectively what you saw was the anticipation of weaker growth, but it actually didn't show up in real real GDP, meaning that everybody expected, and by everybody, you looked at the probability of a recession in the Bloomberg function, it hit 65% the beginning of 23, but it was the recession that never came. You effectively had growth that remained far more resilient because the U.S. economy was far less sensitive to short-term interest rates coming out of COVID and the super low rates that we had in response, where people were able to term out debt, et cetera. So this time around, if we see the Fed hike not once, but twice, maybe three times, not saying that that's our base case, but if they start pulling the punch bowl away on liquidity, raising rates in a more aggressive way, could we see it slow down growth in a way that we did not see it slow down growth in 2023?
Tomorrow and Thursday, we're going to hear from some of the big tech companies, some of the big hyperscalers, and I think the market's a little unsure whether we want more CapEx, we don't want more CapEx. What are you going to be looking for?
We've been thinking about it as 16% versus 19%. 16% of the S&P 500 is the hyperscalers.
Okay.
They're the ones who are spending all of this money in order to fund the huge bull market in the 19% of the S&P 500 that is the SOX, or the semiconductor industry group.
Okay.
So the semiconductors rely on the hyperscalers' ability and willingness to spend. If either of those things get challenged by weaker stock prices or higher credit spreads, then that could not just challenge their own stocks, but of course challenge the semiconductor trade as well.
Can we go nerd difference equations?
Oh boy.
Please.
We're going first order difference equations with Cameron Dawson, and we're on the x-axis. And we have CapEx out X number of units into the future. Stupid, silly, we're spending gazillions CapEx. And along with that is an earnings capability on the same x-axis, and maybe even actually some new revenue profits from the stuff that they're spending the CapEx on. Where do those two lines converge out there? Is it, I don't buy the 2-year, 3-year out there. Is this like a 7-year project?
Yeah, well, the street actually has this converging more in 2028.
Yeah,
if you look at, really, which is very surprising, if you look at the free cash flow forecasts for this year, they're effectively a little bit of free cash flow generation from the hyperscalers. 27, negative free cash flow, and then a big recovery in 28.
Says who?
Says consensus.
Do you see that from the technoid people that you talk to?
No. So if you peel apart that consensus, effectively free cash flow is cash flow from operations minus CapEx. What the street has priced in is CapEx continuing to increase, but cash flow from operations accelerating materially in 2028.
Can you put it at 28?
I think it remains to be seen. I think the fact that companies are not talking about when they expect to see a bigger payback in the scaling of this CapEx is very interesting. Right now, for every dollar that they're spending, yes, it's driving growth, but it's not as if growth is faster than the spending that they're doing.
My point, if we're talking to fancy technoid people, Paul Kudrowski, Eric Bringels, and people like that, I don't think they're at 28. They're at 29, 30. 31, and that's not in the zeitgeist.
Well, and the challenge is, how do you pay for that? Equity markets are already starting to balk. Look at somebody like Microsoft.
You pay it for continued profits that they have.
Well,
they continue minting money.
And there's a big difference between stated earnings and the actual cash that the business is generating. You can drive a Mack truck through the EPS that's being reported because of all the different assumptions you can make on things like depreciation, the cash, or the tax benefit that they get from OBBB, for example, accelerated depreciation. You compare that then to cash flow from operations, and then compare it, of course, to free cash flow generation, which has been absolutely obliterated. What's important is that the names that are seeing the biggest deterioration in free cash flow have seen the biggest compression in their multiples. Look at a name like Apple. Apple's free cash flow is at a high. Its multiple is at a high. So at what point does Microsoft say, hey, my multiple's down 45%, maybe I should do something about it?
And just so you know, 10 minutes ago, literally in my inbox from Torsten Slok at Apollo, the chart that looks exactly like your chart about free cash flow for these hyperscalers that, 27, 28 is kind of the inflection point. And, Apple, I think, Tom, is getting the benefit of, they're kind of they're CapEx light.
Oh, yeah.
And they got some free cash flow, and the market's likes that these days.
Thank you. I got Boeing earnings coming out here, folks, so I'm looking at that right now. It's down a little bit, but it's, a big beat.
And Cam, you
4.94 billion, a trillion.
No. For what?
Apple.
Oh, yeah, absolutely.
we're like $5 away from $5
crazy,
trillion.
Crazy good. Cam, you gave us 6 pages of notes every time you come in here.
I never read them.
And she
Thanks.
could give us 3
I'm honored.
bullet points and we'd be happy. You give us 6 pages, so thank you for that. But again, you could give us 3 bullet points and we'd be happy.
This is great. I mean, it's how Paul actually reads. Sassower is nuts.
Yeah.
Sassower comes in with like a portfolio of notes.
Yeah, and he's
You
got
gotta do the
highlights.
work.
You got to do the work. I mean, that's what people tell me.
Really?
Yeah.
It's new to me.
That's something new. Cam, thanks so much for joining us there. As always, Cameron Dawson, CIO of New
10
Edge
seconds.
Wealth.
Boeing matters, doesn't it? Always.
Boeing does matter, and maybe the hyperscalers can take a book out of Boeing's or page out of Boeing's book. They were always having big capex that they had to do to develop new planes, and then talking about when they would get a payback on that many years in the future.
We read those headlines, 40 headlines. It's the Bloomberg difference, folks. On the terminal, it is our headlines that are the core of what we do. Boeing just out with earnings. They look to be constructive. It's got to be 60 headlines out. The headline, Boeing free cash flow nicely positive off of a negative estimate. From New York City, it's Bloomberg Surveillance.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From the Bloomberg Interactive Brokers Studio, I'm Alexis Christoforous. This Bloomberg Business Flash is brought to you by IBKR. Trade election, climate, and economic outcomes with IBKR prediction markets right alongside your stocks and options. Earn interest on your position and receive $1 per contract if you're right. Learn more at ibkr.com/predictions. A whole bunch of new earnings out here pre-market. Want to talk to you about Boeing beating on cash flow as it booked a fresh charge on that Air Force One plane for President Trump. Also, Coca-Cola raising its guidance boosted by World Cup sales. We've also got PayPal beating earnings estimates as turnaround efforts there continue to take hold. Taking a look at the overall market, we've got NASDAQ 100 futures under pressure, down 327 points as that chip rout deepens. We do have S&P futures down 13, but Dow futures up 300 as investors now pour their money into consumer goods and utility stocks. We've got Brent crude at $87.19 a barrel, down 1 1/3%. West Texas Intermediate crude down about 1% at $81.84 a barrel. A bit of strength here for the Bloomberg Dollar Spot Index, 1223.10. Yields are lower across the board. The 2-year at 4.30%, the 10-year at 4.62%. Bitcoin sitting at 63,390, and spot gold at 40.29 the ounce. That is your Bloomberg Business Flash. Back to Tom and Paul.
Thanks so much, Alexis. Greatly appreciate it. Good morning, everyone. This harkens back. I mean, Paul, you got to go back to the day Wesleyan had 7 touchdown passes. 1998 against Middlebury.
Really?
It just was amazing. Wesleyan took on Middlebury. Titans. They had a great season here. Joining us, a gentleman who took the orb in, Stephen Colano joins us. Did you catch any of those 7 touchdown passes?
I was on the other. I do remember that game. I was on the other side of the ball as a free safety for Wesleyan, but I do remember that game very well.
It was like a huge. I mean, it was like huge. Division III. It was like magic.
Enormous, yeah. That year we also that was our big win against Williams that year as well. So it was a fun season.
It was a fun, and it's still going strong. I would say it's way under the media's radar.
It has gone hyperbolic.
Division III kind of ball is a big deal.
Hyperbolic, yeah, crazy. And Wesleyan has really come on strong the last couple of years. The new coach the last couple of years ago. It's been fun to see.
It's great because the defensive tackles have 800 SATs. That's what it is. Stephen Colado with his integrated partners out of Wesleyan long ago and far away. I love what you say about the midterm elections. Is this time different just because of the stimulus and all? Is the political math not work?
I try to, this time isn't different is one of those phrases where it's like, I kind of look at the history, last 14 midterm election years, average return of the S&P from August 1st until November 3rd this year, but to the midterm elections is in fact 0. And you look at the median, there's not much dispersion around that. It's also 0. And with that comes increased volatility just given the uncertainty. And so we're trying to play into that, not expecting much from the markets, but trying to bring into some of our portfolios strategies that benefit from kind of options carry, options premium, where there's a range-bound market, but volatility picks up as a way to play into that until you get more clarity on the other side of the elections.
Earnings have been better than good. I mean, outstanding, and that's what argues has been driving this market. What are you making so far of the second quarter earnings and maybe the outlook for the back half of the year?
Yeah. No disagreement whatsoever. I was looking at the sector composition. I think it was a Bloomberg chart. Look, sector composition so far, earnings beats this year, with the exception of maybe consumer discretionary, which has been like 63% beats. Every other sector across the board is like 80 to 100% in terms of putting up positive numbers in beats and relative to expectations. I think I start to break down the market in the second half of the year between large caps and small caps. Small caps, I think they've had a great run year to date so far. They're starting to take it on the chin a little bit with the chip sell-off and some of the sentiment shift. But if you look at small caps, looking for I think almost 35% year-over-year earnings growth for 2026, and that breaks into kind of mid-30s to high 40s for the second half of the year. And I think what maybe people are not thinking about so much in the momentum around small caps is if you look at the percentage of interest expense or as a percentage of EBITDA for small caps, it's around 31%. Compare that to the S&P 500 where it's around 6%.
Yep.
And you have interest rates I don't see them going lower anytime soon, kind of the fundamental fair value of 2% GDP. So I think that's a headwind for small caps. Large caps, different story. I know I don't see the momentum continues. It's been interesting. It's like beat and raise, and now all of a sudden the sentiment has shifted and you're starting to see at least the chips start to sell off. But the market has broadened. You're starting to see... I think,
can the Fed get in the way?
I don't. They always can, for sure. I don't see them right now. We don't expect, or I don't expect rate action for the rest of this year. I think the task force, the 5 task forces, was actually a brilliant move. It kind of gives Kevin Wersch air cover to say, hey, well, we're going to have preliminary findings of September, final findings in December. Gives them air cover to kind of just say on pause.
4-week moving average claims 208,000.
Yeah.
208.
187 last week, lowest in a long time.
Yeah. So it's pretty solid. How do you position the AI trade for your clients these days? How do you guys kind of approach that?
Yeah, we've actually been with the premium, the Mag 7, the maybe take out Tesla from that for a second, the hyperscalers anyway. The premium that they've been trading at over the rest of the market has come way down, which has been great to see. So we've actually, and you have good businesses there, which is where the free cash flow generation, well, maybe say cash to use Cameron's previous comments, cash flow from operations has been great, free cash flow less so. But they have great businesses. So we've actually been rotating a little bit more into the hyperscalers on the other side of sentiment. Chip sector, when I took over semiconductors as an equity analyst at the Boston company in 2004, the guy to meet with at that point in time was Adam Parker, who was the senior research analyst at Bernstein. Met with him to get up to speed in the sector. I never forget. The first thing he said to me was, Steve, these are cyclical business. This is a commodity business with cyclical characteristics. Don't ever forget that. And when I look at the amount of CapEx going into memory, right, Micron, DRAM, that is a cyclical business. You've seen gross margins go from single digits to, in the case of Samsung, 40, 50%. And capacities coming on, margins, we expect margins to start to degrade, and I don't know that that's in numbers yet. So we've been moving more into hyperscalers and then continue to love the power theme, right? Around AI, you need the power. So utilities as well as kind of...
Is there a favored utility?
AEP, you can't go wrong. That's the one, right? Plays into PJM, which is you're seeing supply demand with PJM's news, what yesterday or the day before around power. AEP theirs, but even before that, like even some of the global companies, Eon, Schneider Electric, Eaton,
Columbus, Ohio. 16,000
16,000
employees. They're popping, Paul, a 2.8% yield.
Yeah.
I don't know. Do you know what the best thing about AEP is? They didn't change their name.
Yes, they stuck with it.
You see the name, and you're like, "Who are these guys?"
Who are these guys?
The slow, quiet winners.
Stephen Kalana, thank you so much. Wesleyan Football, also with Integrated Partners today. Right to it with our news in New York City is Michael Barr.
Negotiators from Iran and Oman are said to be trying to reach an agreement to restart shipping through the Strait of Hormuz. A successful deal would enable Iran and the U.S. to resume talks over ending their war. A special election today in Georgia to decide who will replace the late Democratic Representative David Scott in Georgia's 13th district. Bloomberg's Amy Morris reports from Washington.
6 candidates are competing for the seat, and the winner will serve out the remaining few months of the late Senator David Scott's current term. That could have an immediate impact on the balance of power in the U.S. House, where Republicans have a thin majority. Under Georgia law, the 4 Democrats and 2 Republicans will appear on the same ballot, and any of them could secure the seat. But if no candidate wins a majority, there will be a special runoff election on August 25th with the top 2 vote-getters. In Washington, Amy Morris, Bloomberg Radio.
In Michigan, a debate was held last night between the 2 Democratic candidates for a U.S. Senate seat. Former public health official Abdul El Sayed vowed to be independent from corporate interests, including utility DTE.
I am the most competitive candidate to take on Mike Rogers. But it's also this, that you've got to have something you're fighting for. Ask yourself, if DTE funds both Mike Rogers and Haley Stevens, who wins? DTE wins. And Blue Cross and Big Pharma and Big Tech and APAC, all funded by the same people.
Representative Haley Stevens name dropped a powerful ally, 2-term Governor Gretchen Whitmer.
Look, Governor Whitmer, Attorney General Nessel, the chair of the Michigan Legislative Black Caucus, Amos O'Neill, they all agree that I will be Michigan's workhorse, that I will stand up for us on day one, that I will beat Mike Rogers just like I have beat Republicans 4 times over.
Audio courtesy of Fox 2. The Michigan primary is August 4th to replace Democratic incumbent Gary Peters, who is not running. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Tom, Paul, Alexis.
Thank you, Micah. We've got Mr. Zelensky potentially in the 9 o'clock hour, I think.
Potentially, yep, in D.C.
And then we stagger forward into the 11 o'clock hour. Perhaps we'll have Mr. Netanyahu with us.
Yep, absolutely. So we're going to get Washington's a busy place here today.
Busy. You wonder what a photo op that would be.
Yes.
Zelensky,
right.
Netanyahu, and Trump together. That would be something to arrange. Maybe they're working on that right now. Red and green on the screen. Right now, the VIX 18.92. From New York City on YouTube, subscribe to Bloomberg Podcasts, our new digital entertainment. Good morning. And now for the
Now a look at the front pages.
What's making news around the world?
Your daily roundup of today's headlines on Bloomberg Surveillance with Tom Keene, Paul Sweeney, and Alexis Christoforous.
Right to it, our newspaper. She's wonderful at it. And Tuesday's a strong day. What do you have, Alexis?
You know, I'm going to start with a little romance. Oh. How do we like that?
Oh, please, why not?
From the Wall Street Journal. You think you found the one, and then you crunch the numbers.
Uh-oh.
So I don't know if it's a disturbing trend, a good trend, I don't know what to make of it, but young adults are using spreadsheets to grade dates and track their dating data. Some believe the data can actually help them avoid obvious red flags. Okay. These spreadsheet singles, as they call themselves, or love hackers, say that having that visual representation of what they want versus what they are allowing is helping them make these decisions.
How's that working out for them?
The article goes on to talk about some folks who think it's working for them, but the experts warn, where's the human touch in all this in the spreadsheet? They warn if you rely too heavily on the data, it can cause people to sort of go numb, sort of minimize your feelings. And
all right, here we go. Well, one person, Vera, she says she widened her search filters and went on 10 more dates across 7 days, meticulously evaluating each before connecting with a software engineer. How romantic is that? There you go.
I'll tell you, it's hard to beat the spreadsheets and love. The two just go together.
I'm using AI here right now, folks. Thank you, Google Gemini, for this morning. And we're going to do it like Jeopardy, Alexis. We're going to do it reversed here.
Okay.
The number jumps to between 20 and 27% is the answer. 20 to 27%. What percentage of married couples meet at a bar?
Yes.
Really? Yeah, less and less.
I guess.
I guess there's, all the dating apps, and now I guess there are spreadsheets.
Across a crowded room.
All right, let's move on. I liked this one from the AP. KFC founder Colonel Sanders' personal items are going to be auctioned off this week, including his black bow tie. This is a sealed bid. It's by the Menish Group. And I've got to tell you something, folks. I've seen it with my own eyes. Tom Keene, in case you're wondering, actually ties his bow tie. Yep. Like the good old-fashioned way.
Yeah, no clip on here.
But you know what? Colonel Sanders was a clip-on.
Was it?
That's so disappointing.
Man.
I don't know.
Yeah.
All right. Also up for auction, his pressure cooker. There is also his home in Shelbyville, Kentucky, named Blackwood Hall. It was actually the headquarters for his first restaurant. And also a handwritten planner from 1964 with herbs and spices recipe on it. But here's the rub. It is not Sanders' secret blend of 11 herbs and spices that went to the chicken. They think it was for like stuffing.
Think of the global industry he put together between KFC and Jollibee and all the rest. What's the other one? Chick-fil-A.
Chick-fil-A, yeah.
Oh, the whole aggregate of chicken.
It started with Kentucky Fried Chicken.
He sold KFC in 1964 to a group of investors, but continued as a brand ambassador for the company. Okay, yep. There you go.
And Menish, who was doing this auction, they called him really the first celebrity chef. When you think about it, it's kind of right. Yeah. Yep. They said he was a marketing genius for coming up with that Colonel thing, because that's not what he looked like. Goatee, glasses, bow tie, it wasn't him.
One more?
Yep, Wall Street Journal. I mean, we already know this, but the numbers are pretty startling. America's big cities are rapidly losing kids. So the Wall Street Journal did an analysis. They found the number of children under 18 living in big cities fell 6% over the past decade, and the drop is especially stark among families with little kids. The number of children under age 5 in big cities fell 15%, compared with a drop of 7% nationwide. And again, it's the same suspects, usual suspects: high cost, safety concerns, quality of life. And a lot of residents now are actually just remaining childless. They're just not having kids. San Jose, California, the highest number of kids where they saw the drop in little kids, down 34% for kids under age 5 in San Jose, California. And here in New York City, things are also bad. New York, the cost of living high, the number of children down 8% over the past decade.
It's real. Alexis, thank you so much. The newspaper's here. Alexis Christoforous. Yes, folks, I just got an email in by Acclaim, somewhat popular. She'll do stock moves.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Are all eyes still on American revenue growth?
Other than electricity, there's been nothing more important than AI.
With Alexis Christoforous on markets.
The stock up 47%.
And Michael Barr with news.
President Trump's clout within his party was tested.
The best in economics, finance, investment, and international relations. Bloomberg Surveillance on Bloomberg Radio, Bloomberg Originals, and the Bloomberg Business app.
Good morning, everyone. Paul Sweeney, Tom Keene, Michael Barr, Alexis Christoforous, right to it here. Special guests, a special moment coming up. Bloomberg Surveillance this morning, brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM insured municipal bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. We thank BAM for their BAM Mutual, for all of their support as well. Little lift to the market here. Calvacino walked into the building.
I know. Boom, right up.
Market comes right up, as you see. From the Interactive Broker Studios, the Bloomberg Business Flash, Alexis Christoforous.
Thanks, Tom. And it continues to be a mixed bag for stock futures, where NASDAQ 100 futures are down 221 points. That slump in chip stocks now broadening as concerns mount over the cost of the AI boom and signs that China is catching up in the technological arms race. We do have Dow futures up now by 380 points and S&P futures in the green by about 3. Coca-Cola reporting comparable earnings per share for the second quarter that beat analyst estimates. UPS boosting its sales guidance for the year, and JetBlue reaffirmed its full-year outlook. It also set a new long-term goal for 2028 as strong demand helped to offset higher fuel prices. Speaking of fuel prices, we have got oil pulling back today. Brent crude down 1.5% at $87 a barrel, and WTI crude $81.62 a barrel, down 1.25%. That's a Bloomberg Business Flash. Tom and Paul.
Alexis, thanks so much. Greatly appreciate it. Paul Sweeney and Tom Keene. And what we'd love to do is, particularly at a shop like the Royal Bank of Canada, when we get too aligned and too highly competent, to say the least, it's fun to get them both into the studio just to get a window into the day-to-day grind. I mean, Paul, you look at Lori Calvacini, you look at Amy Wu Silverman, they're talking to two different audiences.
They are. And if I'm a salesman at RBC Capital, I'm making bank off.
It's a gift.
I could sell
it's a
these
gift.
Anytime.
Joining us now for the first time ever, Amy Wu Silverman, Lori Calvacini of the Royal Bank of Canada. Let me just get this out of the way. Are the two of you on speaking terms?
Always. We talk all the time. It's my work wife.
When you talk about work, from the quant area of Amy Wu over to your incredible PowerPoints showing the texture of the market, what's the number one talking point?
I think we've been talking a lot about tech lately. I mean, it's just the conversation you can't get away from. And by that, I mean, sort of the, the hyperscalers are mostly in a different sector, to be honest. But the, sort of semis and the momentum trade, I think, is what we've been largely talking about. And what our work is showing on the semis is that you've hit average valuation levels. If you look at sort of a 5 or 35-year average, we had been hearing a lot of clients saying they thought the momentum wine was late innings, close to done. It's gone on a little bit longer, frankly, than I would have thought. But I would say that's really the genesis of a lot of the conversations of late.
Amy, for your clients, it's a big week for earnings, a big tech week for earnings. How are your clients in the futures and options? Are they leaning into these earnings? Or are they saying, like as Lori said, maybe the momentum thing is kind of coming to an end?
It's so interesting because ahead of this week, big four reporting, huge concentration. Tom's favorite word, skew, it's pretty flat, meaning people are not really deciding to hedge in front of any of these stocks. It's actually fairly sanguine. Look, part of that is we already had a big move in sympathy with Alphabet last week, so some of that's taken it off the table. But to give you an example, Meta, its implied move on earnings day is about 7%. This thing moves plus or minus 10% the last 4 quarters. So the fact that it's an inexpensive move is pretty shocking.
The magic of you two is your worker bees. I mean, you're out there hugely seeing clients. Do clients have a bet, Lori, on the market right now? Are they placing a bet out into 2027?
So, what's really interesting, Tom, and this has gone back a couple of months now, is, I go into the meeting and I have my price target and the methodology and the 5 models and yada, yada, yada. And people do want to talk about the valuation and earnings model because that's fairly unique in our process. But by and large, Tom, people don't want to talk about market direction. They want to talk about, let's look at all the sectors. Where's their opportunity? There's been this view, I would say, the last couple months I've had plenty of AI, I've had plenty of tech, I've had plenty of semis. What else should I be looking at? And frankly, a lot of the choices haven't been that interesting to people, so you get kind of stuck in those conversations.
So, Amy, over in your world, and let's say it's more alternative, more hedge funds, more leverage bets using mathematics, do they have the same feeling of let's go?
Yes and no. There's a little bit of nervousness. For instance, last week what we talked about is this whole levered ETF sphere. There's a lot of, what tail will wag the dog, because we've had, my favorite term, the paddling duck on the surface, but you've had these huge multi-standard deviation drawdowns in momentum factor. You have a lot of leverage piled onto these ETFs that are accumulating. And then if you get a burst of correlation, what does that mean to the markets? A little bit of nervousness. But when you look at the hyperscalers specifically, option sentiment's pretty sanguine.
Lori, these earnings we've been having over the last several quarters, including this quarter, have been just extraordinary.
Yeah.
I mean, it's almost August here. I think I need to start thinking about 2027. Are comps going to be like really brutally tough?
Well, I think in terms of, kind of 2Q versus 2Q, there's going to be some wonkiness. But I think the reality is that companies, have done a beautiful job of managing through all the challenges we've, as a society have thrown at them so far. That doesn't always last. And so one thing we've been highlighting to people is that sort of a risk we see in the coming months is at some point you may need to pull down 2027 earnings forecasts. And that's not so much about the comps, but it is the idea that if you look at the Iran war, for example, the buffers, the inventories, the hedges, those things that are kind of getting you through the next couple quarters, well, you're going to have to reset those. You're going to have to replenish those. We even heard last week one rail talking about how plastics inventories were starting to be rebuilt. Those are going to be done at higher prices. So I think that, kind of the idea of what you were able to manage through this year, if you have lingering impact next year, might just not be so easy.
Across America this morning and in Canada as well, Amy Wu Silverman, Lori Calvasina together from RBC Capital Markets. Paul Sweeney with the ladies who they lunch, they dinner, they're in airplane terminals a lot.
Yep, exactly right. I remember those days. Amy, are you surprised that we're not seeing more hedging in your world? I would think on margin, we hear about the wall of worry. I would think, well, I've had a pretty good year here. Earnings can't get any better than this, can they really? Are you surprised maybe you're not seeing more hedging at all in your world?
I try to talk my book and talk about how hedging is still relatively inexpensive. I think there's this element here of people still remember back to April 2nd. They still remember back to Liberation Day. They know there's this kind of cohort of retail who likes to step in. They like to buy the dip. It's changed a lot of the relationships in our market. This idea of spot goes up and volatility goes up, that's a little mind-blowing for someone like me who's been in the market when that's not true. But there is that hesitancy. I do think as we kind of cross out of earnings, maybe into midterms, you start getting more overall correlation and pickup risk, maybe some more geopolitics that does start to change.
So, I don't know. I mean, I'm thinking about this, Lori. Are there sectors here? I got to get away from the AI trade at some point. Where do I go? I mean, do I buy financials, healthcare?
Well, look, it increasingly, AI is penetrating everything.
That's true.
Back at our energy conference in June, I went to one day of it and heard a lot about how the energy companies are powering data centers. I mean, but look, I do think that if you look outside of tech, we've been overweight financials for quite some time. We've been sticking with that, reiterating that. The valuations still look reasonable. I wouldn't say they're cheap. Earnings revisions are very strong. And look, last week, I was sort of responsible on the team for reading the financials companies. And I was just really struck by all the innovation that's coming out of certain companies, not necessarily just the big banks, but seeing companies talk about things like prediction markets and how that appeals to their client bases. Seeing the retail brokerages talk about this new retail investor and how we've really changed who's participating in the market. There's a lot of really interesting stuff going on in financials besides AI right now.
And Amy, the people that you talk to, like the difference here is they all drive Maseratis, and fancy cars like that. Lori's talking to people, they got, they got the Range Rover. There's a difference here in terms of cars. The fancy people you talk to, like Coop, who's on Your Friends and Neighbors on TV, are they in the market now, or are they cruising through the summer? What's the intensity right now?
I would say, prior to maybe 2 weeks ago, there was kind of a positioning clean out, and a lot of people felt like that shakeout was good coming into earnings because it gave people a clean slate. Now I would say when you look at the flows, people are fairly involved. And I guess one warning signal for me is that both credit, both fixed income, both rates, they haven't been flagging the same awesomeness that you've seen in equity. You really see that in CDS spreads against equity puts
Exactly.
And that always makes me nervous as an ex-fixed income person. I don't know, Tom, you decide who's smarter, but the signals in the market, they're currently not telling you the same things, but people are fairly all in on equity.
No, I totally take that. So there's leverage pulled back because they're starting to see whispers in the fixed income market?
Yeah, I mean, I would say they're not even whispers. They've been fairly loud for quite a long time. People in fixed income are not happy about the debt issuance. You see that in the widening CDS spreads. You see that in the change in rates volatility. And obviously Wednesday, we got a big one in terms of what Warsh will say, even if nothing occurs. So I think that might reprice a few things.
Tom, your SpaceX has got a 110 bid pre-market, Tom. So I know you're not happy about that. I think you bought that a little bit higher.
Lori saved me. She called me up. She said, don't take the 8,000 shares.
Lori, what's the market? Just generally speaking, when you see a big monster deal like SpaceX come out, trade up initially, but boy, it's been really heavy since then. I mean, we got Anthropic presumably going to come public in the fall. As a strategist, what's that tell you about just the new issue market and what that tells you about this?
So look, I would say for me, I sort of relate this question to market froth. And when I think about, and unfortunately I just can't really get into the IPO dynamics, but if you go and look at like a lot of different gauges, we see some evidence that the retail investor has looked a little bit frothy. If you look at the Conference Board data point on stock market optimism, but if you look at things like AAII, if you look at things like CFTC, futures positioning, we're not seeing those same signals. So I understand the concerns people have, but I'm not seeing reason to panic across a wide variety of indicators.
Lori Calvasina and Amy Silverman with us, a special treat in the studio together. I mean, they have to. I think President Mr. Carney of Ottawa is involved as well. They can't be in the same room together.
This is a treat
this is
right
like,
here.
Pretty cool treat.
Amy, we've got a lot of people that have been telling me for a long time that election year's dicey. You got to be careful here. Are you seeing people maybe, do you think you're going to see on your desk people trying to buy some hedging going into these elections? Is that typically what you see or not so much?
I would say yes this year. I'll tell you, Lori and I have been doing quite a few marketing sessions together. And one thing that has been coming up in terms of sentiment change is essentially this worry that midterms isn't going to be about gas prices. It's not necessarily going to be about inflation. It's going to be about anti-AI. I remember in one meeting we step in and the first thing the client asks is, what do you think of this data center moratorium? What does that mean? And so the point I'm trying to make is, look, what if anti-AI sentiment becomes more than just an election story? It becomes a market story. That's something to me that can really reflate correlation in the market because it touches all aspects of the market. It's the surge protector plugged into itself, right? Like we know a lot of these things have tentacles, and that's something that we're watching quite closely.
So talk to Lori now and our audience worldwide, Amy Silverman. What do the left and right tails tell you right now that redound over to Lori's world of long-term investment?
So one of my favorite Lori charts in the whole world is her 4 tiers of fear. And I can tell you that the left tail
That's just to have the children to go to bed.
Yeah, well, that too. But we're not pricing in tiers of fear on that left tail, and we're still pricing in kind of exuberance on the right tail, in particular when you look at some of, not semis specifically, but when you look at the hyperscalers that haven't changed that much. And to me, it's interesting when you see that start to flag, then I think that sentiment changes.
So, Lori, as Barry Eichengreen would call it, the financialization of the system, the Amy Silverman slice and dice tranches and all that. The foundation is still America's nominal GDP over to inflation and that. When you talk to the derivative crews, what do you tell them about the foundation of our economy?
So we do kind of go to this tiers of fear page, and it's basically tier 1 is 5 to 10% garden variety pullback, tier 2 growth scare, Tier 3, recession, interest rate shock. Tier 4, we don't talk about those. We all know what those are. And, you know, we saw this back in March. We did a round of marketing together, and we kept putting that table in front of people. And I said, look, if you don't think recession is on the table, you're sticking to Tier 1. If you think it's a recession near miss, this was, you know, when the Iran war was still escalating and markets were still falling. I was like, look, if you think it's a growth scare and we're going to fear recession but not actually have one, you go to Tier 2. If you think it's actually a recession, you go to Tier 3. And the hedge funds kept pointing to Tier 2 and saying, I think at worst it's going to get to this, but we're probably in Tier 1. And that was probably the most valuable thing we learned in March, was that people were nervous. They were watching the market fall, but the fast money was not looking to bake in recession. And that helped us, you know, sort of really understand when the pivot happened that it was really the pivot.
I don't know, either of you two are both. Are hedge funds net long today, or are they net short, do you think?
So I would say there was this clean out prior, maybe like a week and a half, 2 weeks ago. And then I think in terms of flows, most folks have gotten back in. And there's a little bit of tentativeness right now because we have a big concentration week. But there was sort of a clean out, I would say, a week and a half ago where people had taken a lot of risk off the books.
Really?
Yeah.
I think in my world, right, you know, the long only space, you're always invested, right? It's a question of whether you're up quality or down quality. I think it's very funny because I do think, you know, as I've been out on the road talking to the long onlys, everybody's kind of talking their book. So the people who need rotation to work are in the pro-rotation argument. And the growth funds who are really more all in on the AI trade, you know, are more sort of talking about that's going to bottom out pretty soon, sound a little bit more like the hedge funds. But I do think, you know, kind of going back to the midterm conversation earlier, it's just coming up in more and more meetings, and I'm not getting a sense of what trades people want to do yet, but they are starting to want to talk about it after a year of not wanting to talk about stuff like that.
I hope we can do this again. I'm seeing like post-Labor Day. This would be fabulous. Lori Calvasina, Amy Wu-Silverman, together from the Royal Bank of Canada, and really appreciate that. RBC Capital Markets. They lift the market. I got green on the screen on S&P just fractionally. Dow up nicely, up 392 its earnings season points. And the VIX flat, 18.81. With our news in New York City, here's Michael Barr.
Thank you very much. Mediators are said to progress in efforts to bring the United States and Iran back to negotiations and prevent an all-out war in the Middle East. Bloomberg meteorologist, Middle East correspondent, Abir Abu Omar.
So President Trump says that Iran had reached out both directly and through surrogates to have a conversation with the United States, Iran, through the foreign ministry, saying that while they could be sending messages through mediators and delegates, there's no substantial or substantive negotiation happening with the United States. So we're getting this back and forth in the statements yet again. We've seen this happening throughout the course of the war since late February, really.
Bloomberg, Abir Abu Omar. Neither the U.S. nor Iran have claimed any strikes for days. The late Senator Lindsey Graham's funeral service is set to take place in Washington, D.C. today. Graham returns to the Capitol one last time, where he'll be recognized with a special ceremony in the Rotunda, followed by a funeral at the National Cathedral. President Trump will be among the speakers. Also today, President Trump will meet with Israeli Prime Minister Benjamin Netanyahu and Ukrainian leader Volodymyr Zelensky. Seattle Mayor Katie Wilson said police detained a 15-year-old suspect after a Sunday shooting at a food festival that left 3 people dead and others wounded.
Police continue to look for a third possible suspect. And please, we're still seeking more information. So if you have information, call the tip line.
Mayor Wilson says at least 2 people exchanged gunfire at the event, and one of the shooters, age 19, is among the deceased. Federal agents seized the mobile phone and computer of Los Angeles Dodgers owner Mark Walter last September in a wide-ranging probe into the financial dealings of the billionaire's businesses. According to people with knowledge of the matter, the FBI carried out a search warrant on a private plane at a Chicago airport where Walter was traveling. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr. This is Bloomberg. Tom, Paul, Alexis.
Michael Barr, thanks so much. Strong dollar, Paul Sweeney. Euro showing me a 113.65. That's a weaker euro off the Lagarde press conference. But yen really gets my attention. We got the 163.99999 on July 23rd, 24, the weekend. 27, and here we are again. looking at 164.
I know. So
weaker yen.
Yeah, weaker yen. Wonders kind of what the Bank of Japan is thinking these days. We've seen them come in here around these levels before. I'm not sure if they do it again here, but boy, this is a currency that just can't really find its footing here. So keep an eye on that one. And the DXY index higher a little bit today.
Well, to see on that futures up 2. Excuse me. Yes, 2 futures up 2. Dow futures up a ginormous 394. I mean, I'm. What do you think?
I'll take a look at that. I'm not sure who's driving that. We can go to the IMAP function, or that'll tell you what's going on. But I follow the yen closely because my number 4 offspring is over in Tokyo, so I see the charges coming through daily.
It's booming. I just read an article on this, and it's a changed Japan.
Yeah, it's
like booming.
He tells me it's incredibly vibrant. Lots of tourists, he says there. And I just said, just speak only Japanese. I don't want to hear you speak in any English for what I'm paying.
Well, we'll have to see on that. On oil here, we pulled back down $1.87 handle on Brent crude. West Texas Intermediate, 81 as well. So there's some subsidence there. It doesn't really feel yet like a Wednesday Fed meeting. Let's wait and see until 2 p.m. in the press conference afterward. But we're getting there rapidly. And of course, all that wrapped around, it is tech earnings season. It's Bloomberg Surveillance.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
8:24 on Wall Street. I'm Alexis Christoforous. This Bloomberg Business Flash is brought to you by Golden Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k, tax and penalty free, go to goldencrestmetals.com/guide. That's goldencrestmetals.com/guide. Stocks are mixed as investors rotate out of chip stocks and into sectors that have delivered the highest percentage of earnings beats. We're talking real estate, materials, and utilities. Right now, S&P futures in the green by 3. The standout, though, here in the pre-market, Dow futures up 438 points, or 0.8%. NASDAQ 100 futures, though, down about 217 points, or 0.75%. Shares of the consumer goods company Unilever rallying more than 7% this morning after it bumped up its full-year outlook and said quarterly sales volume surged to more than a 16-year high. Also, Mercedes-Benz cut its annual sales guidance, but otherwise reported quarterly earnings that weren't as bad as feared. That's boosting shares of Mercedes-Benz and other European automakers this morning. Barclays is down more than 4%, posting a rise in second quarter profit, but reporting higher than expected credit impairments. The British bank is also moving to pay its bankers more like Wall Street firms do, offering higher variable compensation and lower fixed pay. We'll see how that goes for Barclays. Taking a look at oil right now, Brent crude at 86.85 a barrel, down about 1.75%. WTI crude 81.35 a barrel, down about 1.5%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now wherever you get your podcasts. I'm Alexis Christoforous. That's a Bloomberg Business Flash. And send it back to Paul and Tom.
All right, Alexis, thank you so much. We appreciate that. Tom Keene, Paul Sweeney, live here in our Bloomberg Interactive Broker studio, streaming live on YouTube as well. One of the many reasons why we like our next guest, because he does not mince words. He does not pull punches, particularly when it comes to the Federal Reserve. Take this sentence as an example. It would be incredibly stupid for the Fed to raise rates this year. That's our friend Jay Hatfield, CEO, founder, and portfolio manager at Infrastructure Capital Partners. So I guess, Jay, tomorrow you're not expecting the Fed to raise rates, or you don't think they should, and why or why not?
Thanks for having me back, Paul and Tom. Well, what we have right now is essentially the polar opposite of what we had in early 2021. So then the interest-sensitive sectors were exploding with inflation, 20% year-over-year increases, rents up 10%. Reported numbers, too, because they're massively flawed. And the Fed did nothing and claimed it was transitory. Here, we have the situation where rents are flat, housing prices are flat, the 30-year Treasury is at 6.80. There's no inflation coming from the interest-sensitive sectors, and we just have solely inflation coming from energy. And we completely 100% reject the expectations theory of inflation. Really, expectations are deflationary because they raise long-term rates and tighten financial conditions. So we think the Fed is living in the past, at least those that are supporting increases.
You're the first paragraph I've seen that actually think these task forces can get. First of all, we're surprised Jay Hatfield isn't on a task force.
Yeah, exactly.
Let's start with that.
Expecting that.
But you're suggesting that they can actually change the way the Fed interprets inflation. There's a lot of people that don't agree with that statement.
Well, I would be an extraordinarily bad bureaucrat, so that's a good reason I'm not on those task forces. But the main thing that needs to be done is to reform these horrible, horrible indices that get put out that are complete fantasy. They believe that portfolio management inflation is 22% year over year. That is just complete nonsense.
Okay, to review this, folks, this all happened in 1947, was codified across the 50s and the 60s, and we're living 40 years on, to your point. And you want to see very present sensitive inflation statistics, right?
Which you can easily get. There's other services that do. We put out just adjusting for the complete nonsense, and that's really low. It was 2, now it's a little bit above 2. But there's even ones that come from pure internet data that are absolutely real time. There's no reason to do surveys that are 6 months delayed. It's completely incompetent. It's as if you gave market updates that were 6 months old. I mean, how long would you last?
Be careful now. We do that.
So your S&P target You got a range between 8,000 and 9,000. What's driving that differential there?
It's very simple, and it's all in the numbers. So earnings estimate, and I get them on the terminal, and you should get them on the terminal because that's consensus. That's the defined consensus. Have gone up 15% since the beginning of the year. So we seem like we've been inconsistent because we started with an 8,000 target, we raised it to 9. But I remember now I got a C+ in Iranian studies. So I didn't realize the IRGC would fire missiles at the ships right after the peace agreement. I thought we would kick the can down the road and not agree on the nuclear side. And so that's why we normally don't have 2 targets, but we're at 8,000, which is a 20 multiple, and consistent with treasuries being sort of here, like 475. Every 25 basis points from a theoretical perspective increases or decreases the theoretical multiple. So you're at 23 times 9,000, 20 times 8,000 roughly. It's actually 22.5 now. But so you kind of pick your poison, but earnings estimates are continuing to rise. Right. They're very robust. And so it is a good market. But because of the war right now, we're just rotating instead of rallying.
Jay Hatfield with its infrastructure, capital, and management here around presumed economic data wrapped around a Fed meeting tomorrow, wrapped around an earnings season as well. I mean, there's, inventories, advanced goods. I guess I don't care. Case Schiller will be out here at 9 a.m. Paul Sweeney will have conference board data at 10 a.m. But, Jay, I'm looking at all this, and the answer is there's still Stimulus 1, Stimulus 2, Olivier Blanchard and others call it the Biden stimulus on the back end, and then further stimulus that we've seen with President Trump and company. Does that end? Does it ebb away?
Yeah, I wouldn't really call it stimulus because we believe in, unlike Keynesians, in crowding out. So it doesn't actually help economic growth. But there's going to be consistent fiscal irresponsibility. We have a track record of that since Bill Clinton was president. He was not, but since then. And so we assume 5% deficits on an ongoing basis.
Do you assume a 4% nominal GDP plus? The answer is yes.
Yes, if we get rates down to the neutral rate, which is 75 basis points lower. Should be able to grow at 4% a year.
In a previous life, you had a lot of experience in energy. What's your energy call these days?
We have been correctly bearish about oil prices. In fact, our target right now is 80 to 100, assuming the strait is closed. And it's like really closed right now, completely closed. But we're at the bottom of the range. And we had been, unlike most others, saying that if the strait reopened, we would rapidly rebuild inventories. And we can already see from the market moves, like the strait was open for 5 days and we got to $68. So we could get to 50 if the strait reopens. And that is super bullish for more of the 9,000 target than the 8,000 target, because then rates would start dropping to 4, start to price in rate cuts, and then you get flows into the market. It's kind of a frustrating market because one day it's chips, the other day it's the hyperscalers, the third day it's everything else, and nothing ever really happens to the overall averages.
I got to ask you, because it's in your notes, and Tom and I are fascinated. SpaceX. What do you make of it? I mean, you've been on the banking side. You've taken a ton of companies public.
Sort of infrastructure.
Yeah, I'm throwing that at you. I mean, what do you make of a company like SpaceX? The fact that it priced, it traded, and where we're trading today.
Well, the key insight is guess how you win IPOs.
Okay.
You pitch really high valuations, and then you jam them onto Wall Street.
Says the former banker.
And then, if you're really smart, you get convinced the NASDAQ to include it before the lockups come out. We added a lot of value in our QVol ETF because we didn't include SpaceX. So you should have a managed QQQ because they don't have a requirement for profitability. But so it's going to actually, they have great technology, unlike Tesla, which has sort of generic technology. And they are going to be a valuable company. We have a $100 aggressive target. And you have a catalyst, which is this lockup. Like, that's a ton of stock. Like, it's one thing to get the deal done. It's another to absorb the 1.5 trillion of stock. That's
come back tomorrow. Jay Hatfield with his CEO infrastructure with 9,000 on SPX. Really appreciate it this morning. Some really interesting insight there on a not normal Fed meeting tomorrow. Bloomberg Surveillance, it's brought to you by IBKR. For the past 3 years, Interactive Brokers individual clients They averaged 24.3% annually, beating the Standard & Poor's 500. Lower costs and access to 170 plus global markets. It matters. Visit ibkr.com/performance. Paul, this measurement of inflation is like the heart of the nerd debate right now.
Oh, totally. And it's a question of a lot of folks like Cam Harvey from Duke and Jay Hatfield here are talking about, you got to use the real-time data that's out there in the marketplace. And if you do, inflation's a lot lower than some of the Fed
and the
data
real
that
estate, it's a percent of what we're paying in our paycheck, and we don't see it up here. I mean, we had a fan email in from New Jersey yesterday, and they said, you guys are nuts. My property tax went up $8,000.
Yeah, exactly.
And that's like where we are, where it's a whole different picture across so much of America. The tape is improving fractionally. Futures up 6, Dow futures up a large 450 points. NASDAQ still giving me some substantial red. Bloomberg surveillance.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's coming up on 8:40 on Wall Street. I'm Alexis Christophorous from the Bloomberg Interactive Brokers studio. Our red headline crossing the Bloomberg terminal: Visa is cutting 7% of its workforce. That is about 2,600 jobs. And the news comes ahead of Visa's earnings report card due out after the closing bell. To Wall Street we go, and chip producers and other AI-related firms are extending their sell-off as worries about China's progress in advanced chip making weighs down sentiment. Investors instead rotating their money into real estate, utilities, and materials. As a result, we have got Dow futures now up better than 460 points. S&P futures are up by 6, but NASDAQ 100 futures down 220 points, or 0.7%. Brent crude down 2.25% at 86.42 a barrel, and West Texas Intermediate crude down 1.5% at 81.10 a barrel. As for some specific stock news, Boeing generated better than expected cash flow in the second quarter on continued strong demand for its aircraft, but the positive cash surprise was overshadowed by a fresh $280 million charge for the Air Force One program, which is still years behind schedule and billions over budget. Bitcoin now at 63,367. Yields are lower, and spot gold at 40.30 the ounce. That's a Bloomberg Business Flash. Tom and Paul.
Alexis, thanks so much. You get lucky. In the next hour on Visa, Meredith Whitney will join us. Truly encyclopedic on the history of that company. Again, that's a shock with the stock up 2-ish%, 7% out the door. Boy, Paul, does that say something
it says
about
the
end of 2026?
It does. It says about the consumer.
We get lucky in that regard, as we have Miss Whitney in the last hour. Joining us now, Robert Stark, who's wonderfully definitive on this phrase, asset management. It is Nomura Asset Management, and Robert Stark joins us right now as you build out that platform. I'm going to suggest Visa's OMG AI. What is AI going to, I mean, you went from McKinsey through a host of other players, including a small bank on Park Avenue, Nomura's dominant Japan asset manager. What's AI going to do to the biz?
Well, hopefully a lot of good things. First of all, I think AI, thank you for having me. I think AI is a great opportunity to do everything more efficient and better on behalf of our clients and shareholders at the end of the day. So we are embedding AI into our workflows already, how we look at stocks, how we analyze companies, how we embed transcripts, et cetera. And it gives us more information in a faster way, in a more concise way.
You live the Pacific Rim and the incredible competition there for wealth management. What's the distinctive factor forward for every shop?
So first of all, we have been around for 100 years. We serve more than 5 million households in Japan. We are the premier wealth management firm in Japan. So with that, we carry a lot of responsibility from that. We listen to clients, we understand what the client's needs are, and that brings us here to the States. We have also been in the US for 100 years, because a year after our founding in 1925, we actually founded our first subsidiary here in New York. So we're celebrating the second 100-year anniversary this year. And our commitment to clients is excellent client service, and really being a solutions provider, no matter what their needs are. We need to meet clients where they are at, and we don't want to throw products at them.
What's the view of Japan? When I was young in my career, you almost felt like you had to do a tour of duty over in Tokyo, which I did at Paine Webber. Then for 30 years, radio silent. Now it is back in a big way. Give us a sense from your perspective. Nomura, nobody's got a better feel than you guys do. What's driving the growth here in
Well, there's
Japan?
a lot of growth in the country itself. And one of the big initiatives by the government is how can we increase investment spending and investments per se for households in the country. So just to give you one stat, in Japan, deposits to GDP is over 250%. Wow. So we need to bring that number down materially. And so there's a concerted effort by the Japanese government and the regulators to invite foreign asset managers into the country. Nomura is a big part of that, working jointly with managers, with the government to increase the investment spent and bring down the deposit to GDP rates significantly.
Are Americans over diversified if we own 27 ETFs in our wealth management? I mean, I worry about that. This is like back to the 60s where you own 300 stocks. I mean, are we too busy in our wealth management now?
Well, I think like with any vehicle structure, we are way too busy of creating more of those same structures.
Thank you. You're speaking to the converted.
Mutual funds, ETFs, the next thing is SMAs, direct indexing, Tesla's harvesting. So I think you can see where the puck is going here. It's definitely not going to be more mutual.
Exactly.
Needs a German to teach you hockey.
Exactly. Exactly. So where do you guys see, and as you build your business here in the U.S., where do you see the best opportunity as an asset manager?
Yeah.
Because the fee pressure on you guys, on the industry is real.
Yeah. So first and foremost, I think we need to talk a little bit about scale and having a platform. So we have been, as an asset manager, we have been in the U.S. since 1976. So 50 years of understanding local markets, local client needs. That being said, we have predominantly been here as a fixed income manager, precisely in high yield. So we've been in these markets since 91, when Nomura was one of the largest banks globally by market capitalization. Now, obviously, times are very different now, but what we needed was a real platform that we can become a much better partner to our clients, whether it's institutional clients, insurance companies, pension funds, all the way down to intermediary clients. And we have just done that with our latest acquisition. So we now manage about 200 billion in assets for our clients across public and private markets here in the US, equities, fixed income, multi-asset, and private credit.
What's your private credit view here? Because obviously it's been such a growth story since the great financial crisis, but certainly some questions being asked. How do you guys view private credit?
Yeah, so first and foremost, private credit to us is probably a close to $20 trillion market. So all the noise that you hear, software companies, AI, that is mostly a corporate direct lending topic, especially in non-traded BDCs and traded BDCs. But that's a tiny fraction of the overall market. So we see the biggest opportunities in real estate lending, asset-based lending, and especially finance. So those are areas like real estate alone is probably $10 trillion across residential and commercial.
Big. All right. Robert, thank you so much.
Robert,
Appreciate
thank you so much.
Yep.
Thank you for having me.
Appreciate it today with Nomura Asset Management, Robert Stark. The markets looked very, very interesting here. Dow up 512 futures points. SPX puts it on fractionally, but we'll take it up all of 12 points. NASDAQ still showing some red this morning. The war news very quiet here now. It's 8:47 Wall Street time, and we'll have to see in the 9 o'clock hour on Mr. Zelensky. With our news in New York City, here's Michael Barr.
6 candidates will compete in a special election to replace the late Democratic U.S. Representative David Scott in Georgia's 13th congressional district. The contest could have an immediate impact on the balance of power in the U.S. House, where Republicans cling to a thin majority. Bloomberg government congressional reporter Zach Cohen.
There's going to be a caretaker special election, and we could see, his replacement sworn in the next couple of days if the winner comes out of this contest with an outright majority. Otherwise, it will go to a runoff in August, and that has some ramifications for House control. Speaker Mike Johnson has a very narrow majority and a big agenda for the fall as they're trying to move through other key priorities before potentially losing that majority in the November elections.
Bloomberg's Zach Cohen. The U.S. and Iran extended their pause in hostilities, with the focus turning to talks between Tehran and Oman over restarting traffic in the Strait of Hormuz. At least 4 tornadoes reported in the Midwest. In hard-hit Menasha, Wisconsin, it prompted the mayor to declare a local state of disaster. This resident headed for cover.
I headed down to the basement with my kitty, and when I come up, it's like a war zone here.
Homes and businesses were destroyed. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Tom, Paul, Alexis.
Thanks so much. The Visa story, it really gets my attention here, and I just love to flesh that out. Is that a direct AI thing, or is it just a pairing of it, or that? Paige Smith reporting on that, and just 7% is not 2 or 3 or 4%.
No, cutting 7% of its workforce, about 2,600 jobs. again, that gets your attention there. So, but I think we're going to see more of this. It just feels like.
I strongly, Lemon's off a cliff. They're all going to do it.
I think so.
They're all going to straighten it out. We'll have that. Again, Meredith Whitney joining us in the next hour. We'll lead off with that important Visa news. Futures up 12. The VIX backs up from 17, 18.56. Dollar flat. On YouTube, subscribe to Bloomberg Podcasts. Good morning.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney on Bloomberg Radio.
Good morning, everyone. We say good morning, red and green on the screen here. Looking at Visa, we'll have Meredith Whitney with us in the next hour. Stock Movers, it's a podcast, but usually we do it where we're airlifting people in.
Yeah.
It is an emporium. Good morning, West Caldwell, New Jersey.
Love it.
Sam's Deli.
Bagels and deli. That looks like my kind of pop.
Fresh hand-rolled bagels. It's Sam's Deli. We go to our bagel correspondent, Alexis Christoforous.
Yeah, they got us on there on YouTube. It says Sam's Deli.
They do it right.
They do it. I love it. I'll take a schmear. With little locks.
You have stock movers?
Yeah, I do have stock movers. Let's get to that. I'm on the bagels
movers?
now. All right, Coca-Cola. How about a Coke with your bagel? I don't know about that. No. It's up 4.2% here pre-market. It's been having a nice year. Coca-Cola up 20%, outperforming the S&P 500 here this year. Raised its full-year outlook, boosted by demand last quarter, while it was a major sponsor of the FIFA World Cup. So the company said that about half the 5-week World Cup tournament was part of that quarter. And in North America, where the World Cup was hosted, organic sales for Coke jumped 7%, much more than analysts expected. North America accounted for about 40% of total sales last quarter, the most of any region. So it really paid off for Coca-Cola, spending big on the World Cup.
Yeah.
Analysts are saying it continued to gain traction with shoppers with its sugar-free sodas, sports drinks, and water at a time when we keep talking about it, consumers are pulling back on those sugary drinks.
Yeah, I'm not a diet soda person, but the Coke Zero, you can put that in front of me anytime I want to drink.
I have never
Tastes
tried
just
it.
like regular. I don't know.
Dare I say I'm not a soda person?
Well, I've heard of you people.
Coca-Cola up 27% this year.
Yeah.
I mean, that's not a shabby return.
It's crazy.
No, I mean,
all right.
Is there an AI play there? I don't know.
I'm sure we could work it
Next.
in. PayPal. PYPL ticker symbol there, up 2% here pre-market, but down about 4% year to date. So PayPal reported second quarter earnings and revenue topping estimates, also raised its full year adjusted profit guidance. And CEO Enrico Lores commenting on takeover speculation, he said the company remains open to evaluating opportunities that could create superior value for shareholders. Remember, rival Stripe, private equity firm Advent, they offered $60 a share for PayPal. PayPal basically went, go back to the drawing board and try to do better. PayPal last closed at $56 a share. And want to get Hilton Hotels in here, another stock we're watching today. HLT is the ticker symbol. It's down 3% pre-market. Now, Hilton did report second quarter earnings that beat the street. Demand improved across a range of price segments, but Hilton lowered its expectations for net income, and it seems like that's what's tripping up investors. And also a key metric for the hotel industry, revenue per available room.
RevPAR.
Yes, RevPAR. Nice that you know that.
Oh, yeah, I'm all over that stuff.
You are all over it. It increased 3.9% worldwide. It also rose 5.4% in the U.S., where hotels charged higher prices during the World Cup. But RevPAR, or revenue per available room, declined by 30% in the Middle East and Africa, and a lot of that is due to the war in the region.
Yeah, that's brutal. But, talk about a cake-shaped economy. These hotel companies now, they have so many different brands. They've strategies.
I can't keep track.
You can't keep up.
But they've sliced and diced the market. They've got something for every part of the market. That's genius.
I think you have to.
To me, it's a blur. I mean, the airlines are bad enough, but they're nothing compared to the slicing and dicing, as you say.
Yeah, so you got to pick your company like and just
pick
go for
your
the ports.
company
Go for the point,
first.
whether it's a Marriott,
and find
a
out
Hilton.
if your rewards points can go across the different segments of the hotel. I think that's important too.
The kids know how to do that stuff. That's
We'll
for
have
sure.
to see. Stock Movers with Alexis Christoforous, brought to you by Sam's Deli, West Caldwell, New Jersey. They have olive smear.
Yeah.
Oh, I'll do
they have
that.
like 28 flavors.
28?
Jalapeno. Yeah, it's like
I can't
it's
think of
like
28
ginormous.
cream cheese flavors.
Pork roll, egg, and cheese.
Yeah.
That's
Bacon,
all.
egg, and cheese. Let's go.
Yep.
Yeah, there we go. Good morning, it's Sam's. Good morning across the nation, those brave enough.
This is Bloomberg Surveillance with Tom Keene and Paul Sweeney.
Do you just ignore all the noise that's out there right now?
We think about the tech as one monolithic kind of trade here.
With Alexis Christoforous on markets.
We're talking about inflation not really being under wraps yet.
And Michael Barr with news.
New calls to lower the temperature in the Persian Gulf.
The best in economics, finance, investment, and international relations. Bloomberg Surveillance on Bloomberg Radio, Bloomberg Originals, and the Bloomberg Business app.
Good morning, everyone. Tom Keene, Paul Sweeney, Michael Barr, Alexis Christoforous. Day before Fed meeting. Lots of good Fed chat today.
Yeah.
Not all on the same page. There's like 7 flavors of what are they going to do.
Yeah. You'll have it tomorrow for us, right? At 1:30?
We're having it at 1:30 tomorrow. We're all on speaking
Got the
terms.
gang
And,
back together.
We'll have some good voices in to talk about it. But it's, there's a mystery to it.
Yeah, there's a mystery to what Mr. Warsh wants to do here with the Fed and its communication, and we'll see how the task force...
Jay Hatfield had to be medicated.
Exactly.
I mean, he was fired up.
Yeah, he's got some strong opinions on the Fed.
We'll have to see. Futures up 5, the VIX 18.69. In this hour, I do want to point out, scheduled, Mr. Zelensky with the President of the United States. I do have an image up here on the surveillance TV wall. So maybe that's what that is. That's, it's an image. We won't need to take it right now, but I guess we're scheduled for that in this hour. Mr. Netanyahu, Paul and Scarlett have for you in the 11 o'clock hour as well. From the Interactive Broker Studios, the Bloomberg Business Flash, Alexis Christoforous.
Thanks, Tom. U.S. stocks are fluctuating as a deepening rout in chip makers was offset by investors rotating into sectors that have posted among the strongest earnings so far this season, including utilities and real estate. All of this on a week when we get a Fed decision on interest rates that happens tomorrow, and of course those mega cap tech earnings, including from Microsoft and Amazon. S&P futures up about 6 points right now. Dow futures racing ahead, 475 points, a gain of nearly 1%, but NASDAQ 100 futures are down 0.75%, or about 200 points. We have got oil pulling back once again today. Brent crude down 2% at 86.65 a barrel. West Texas Intermediate down more than 1.5% at 81.26 a barrel. The Bloomberg Dollar Spot Index up fractionally at 1222.66, and some weakness in the Japanese yen, now at 163.87 against the U.S. dollar. JetBlue's second quarter results, they beat the street as strong demand helped offset high fuel prices related to the Iran war. And we've got shares of Sherwin-Williams climbing 5%. The paint company boosted its adjusted earnings per share guidance for the full year. Still to come, Ford Motor Company. It's going to happen after the closing bell. We're also going to hear from Visa, but actually the payments company already came out with some news this morning. It's going to cut 2,600 jobs, or about 7% of the workforce there at Visa. That's a Bloomberg Business Flash. Tom and Paul.
Thanks so much. Laura Mayfield with us right now. We talk about granular.
Mm-hmm.
I mean, this is, folks, it's like econobabble, blah, blah, blah. Her notes are exquisite. Value perception is between choosing dining at Chili's rather than DoorDash Chipotle, or getting water instead of a Baja Blast Mountain Dew to wash down those $1 enchiladas at Taco Bell. How about that research you did?
Lettuce-free enchiladas.
Lettuce-free enchiladas. Are the kids asking for water? I doubt it. They want the Baja Blast.
They want the Baja Blast. I was going to bring you a Baja Blast freeze, but the machine wasn't up and running yet this morning.
That's okay. We're putting them into the food court. Here, I mean, the granularity you do is second to none. What does it tell you about the American consumer?
I think you have to have a granular look at the consumer when you're trying to understand what's happening. The aggregate data just doesn't tell the full picture. There are so many disparate storylines within the aggregate data. You have consumers overall, they are seeking value, but that means a very different thing to high income, middle income, low income consumers. And it doesn't mean they're not spending. We see in the data they are continuing to spend, but that thirst for value in this environment, it looks very different across the income spectrum.
How are people at the lower end? We talk so much about the K-shaped economy, and the lower end of the K seems to be more and more pronounced. How are they funding the day-to-day? Is it just paycheck to paycheck? Is it credit cards? How are they doing that?
I think it's all of the above. We're seeing a very scrappy, resilient consumer, as they always are.
Yep.
And they're using all available tools. We've seen an increase in adoption of buy now, pay later options, which, by the way, are a great payment method for consumers. They don't charge interest. The merchant or retailer covers the cost of that. So in some ways, it's a favorable alternative to credit cards for consumers. We're also seeing them, I think, use delinquency as a cash flow management tool. We're seeing a lot of borrowers, subprime borrowers in the auto loan space, fall delinquent, but then live in that state of delinquency. They can't afford to catch back up to current, but they're also not flowing through to charge off. So I think we're seeing a very scrappy, resilient consumer that's in problem-solving mode.
We are guilty. Paul's not guilty of this. I'm guilty of only talking la-di-da. You're talking about an America within the phrase flat on their back. What percentage of America is micromanaging the boneless meal deal for two at Wingstop?
I think it's probably more than you might expect.
I agree strongly with that. Half of America?
Maybe. I think when you look at the increase in energy costs, when you look at the Bloomberg's got this great data series on very granular real-time consumer spending. And when you look at weeks where gasoline spending has increased just because of the volatility in prices there, you see a direct impact on other categories that are going down, whether that's clothing, sometimes even grocery spending. I've seen offset the increase in gasoline spending. I think the consumer, a lot of the consumer is they're doing okay, but they're really they're problem solving on a day-to-day basis.
So in your world of asset-backed securities, where do you see that?
We see it across, there are prime consumer receivables in our market. There are subprime consumer receivables in our market. We see it a lot in the subprime data. We see servicing practices have an outsized impact on loan performance across pools. Some of the higher touch consumers require more servicing to get that cash flow to come through because those borrowers, they're choosing which bills to pay and which ones to let slide past the due date.
Laura Mayfield with us, just exquisite here at Port Washington Investment Advisors. Granular research like nothing I've seen. The phrase paycheck to paycheck. There's like the way we perceive it, and there's even paycheck to paycheck of people making six figures. Discuss the emotion of paycheck to paycheck.
Yeah, I think, again, it comes back to consumers trying to solve for the priority of payments, which I think has evolved over the years. If you remember back to the GFC, we saw consumers prioritize car payments over home payments. And the notion was you can live in your car, you can't drive your house to work. But I think, with the increased cost of living across the board, whether that's housing affordability, rent increases, car expenses, childcare, every category just about has raised the threshold of what it means to live on a paycheck to paycheck basis.
The labor market, I guess, if we're a fully employed economy. So, I mean, that's a big part of consumer behavior, consumer spending. I guess that's the good news out there as it relates to the consumer.
Absolutely. And I think that's the critical piece that has helped encourage the consumer to continue spending in aggregate. That conference board data, which is more a labor force metric, has been stronger relative to the University of Michigan conference
I got like
data.
10 other questions. You got to come back soon. Laura Mayfield, thank you so much. Securitized Products, Port Washington Investment Advisors, incredible granular data. I mean, granular data like we just don't see. I mean, I get it like Taco Bell, and like Sarah Wolf is at Taco Bell, Paul, like 3 nights a week, joining us now. Not from LaBelle to Talk. Sarah Wolf joins us with Morgan Stanley here. Sarah, I just to follow on from that incredible conversation, we're all guilty of only talking about the fancy people. Does Chairman Warsh have an understanding about the people out there micromanaging paycheck to paycheck?
I think this gets at a real conundrum that the Fed is facing. And we heard this from Governor Waller last week in his remarks, where there's a really unevenness to monetary policy. For half the economy, monetary policy is already tight. Lower middle income households are dealing with a real income statement problem and are under a lot of pressure. We're seeing similar things in earnings statements and in the data, where lower to middle income households are having to play games with their different credit cards to make sure that they don't fall into 90 plus days delinquent. And then on the other side, you have this really strong AI CapEx spend. You have wealth effects that are fueling high income spending. And so it creates an issue where if you raise interest rates, is it really going to slow the parts of the economy where demand is actually strong, or just put more pressure on these areas that are already under pressure?
As you mentioned Governor Waller, I mean, cut to the chase here at Morgan Stanley and the history of fractious, wonderful debate at Morgan Stanley. How divided is this Fed into this nascent Fed meeting?
I think we're seeing a very divided Fed. On one hand, I think there's serious concerns about some of these software prices that are rising, that the re-escalation in the Middle East, we're going to start to see those second round effects of gas prices again, that the labor market looks steady enough for them to focus their attention on inflation. But then you have another cohort that are worried about these other parts of the economy that are already under a lot of pressure. And so, I mean, as War said, there's going to be some family fighting among the FOMC to figure out the future path of rates, and then add on to it that Warsh likely doesn't want to adjust policy until the task forces have come back with their findings, and that's not going to be until the end of the year.
So, Sarah, I'm looking at the bond market. I mean, boy, you got a 10-year at 463, the 30-year at 512. I mean, it seems like the bond market's telling the Fed, we're not waiting for you. We're moving rates higher.
Yeah, the bond market, I mean, it's surprising. Going into the meeting tomorrow, we have a nearly 40% probability of a hike. I mean, that's pretty high going into the day before Fed meeting. We haven't seen something like that really in years. And so we are seeing a much more hawkish bond market. They're worried about all the fiscal spending and what that's going to mean for interest rates. They're worried about the re-escalation tensions in the Middle East. But on the other hand, we still have got a really good inflation print that we got for June. And so that's going to buy the Fed a little bit more time to see more data in our view.
So again, what do you expect to hear from the Fed tomorrow?
I think the bar to hike is going to be high, but they're not going to be complacent. Warsh has really doubled down that inflation is a big problem that they need to tackle. But he has also said that supply side factors driving inflation higher, like oil prices, are not going to be changed by higher interest rates, and that software prices, AI data center prices are not necessarily also going to be cooled by hiking interest rates. And so I think that he's going to be firm in bringing inflation back to 2%, but I do not think we're going to get any type of definitive answer that the next move is a hike.
So, Sarah, I did this exercise yesterday. Paul Sweeney taught me FOMC Go, which is the calendar. I have September 16, October 28, December 9 to get to the end of the year. At the Morgan Stanley team, when you're sitting around the desk arguing each other, I know that Sarah's not on speaking terms with Ellen Zentner, as an example. Sarah, when you're looking at this date calendar, when does the Fed act? Is it like coming right up on September, or does it fall into 2027?
I think if the Fed needs to hike, which is not our base case, it would be later this year. We already got a good inflation print for the June data, and there is a bar to hike in the inflation data in our view, something closer to this 0.3% on the month core PCE, but we would need to see a few of those prints. And so that buys us a bit more time to get closer to the October, December meetings if the Fed does need to hike.
We're going to get a bunch of tech earnings this week, starting tomorrow, Sarah. What's kind of the Morgan Stanley view here of how we should be thinking about tech and AI? Because I don't think there's a consensus out there. People are concerned about CapEx. Is it a good thing? Is that not a good thing? How do you guys think about that?
Our view is that now is the time to broaden your investments in the AI story, that if we look back a few years, it was the AI models and those companies that were really driving the AI narrative in markets. And then the last 2 years has been heavy in this AI infrastructure story and all these hyperscalers that are committing, trillions in CapEx. Now we're thinking that this is the time to broaden into the AI adopters, right? These are where the real tailwinds to the economy and to company profits more broadly outside of these infrastructure companies will come from. And you're seeing a healthy amount of skepticism in this AI infrastructure story on how capital intensive these software companies have become. When will they get a return on their investment? And so we need to start to be very critical on where do we look for the next leg of AI, and we think it's adopter companies.
Sarah, I got to go to breaking news. Please, please, please stop by the studio as you can. Sarah Wolf, senior economist, Morgan Stanley. Futures up 8. There's a constructive tone to the tape. With our news in New York City, Michael Barr.
Thank you very much. The U.S. and Iran extended their pause in hostilities, with the focus turning to talks between Tehran and Oman over restarting traffic in the Strait of Hormuz. Zach Cohen, Bloomberg government congressional reporter.
Specifically on over how to restart traffic in the Strait of Hormuz, which is essentially ground to a halt and has increasingly been an issue in terms of global energy markets. And sources are telling our colleagues that reopening the Strait of Hormuz, getting those carriers, those ships back through that key waterway could open up other parts of negotiations as Washington and Tehran look for some sort of peace deal, some long-term slowdown to the hostilities.
Bloomberg, Zach Cohen. Israeli Prime Minister Benjamin Netanyahu meets with President Trump today. The president also meets today with Ukrainian President Volodymyr Zelensky just hours ahead of Senator Lindsey Graham's funeral. Both Zelensky and Netanyahu will attend the service, and President Trump will give a speech. The Pima County Sheriff's Department in Arizona says the investigation into Nancy Guthrie's disappearance nearly 6 months ago remains active and ongoing, though without a significant development. It comes as the Today Show host, Savannah Guthrie, released a new video pleading about her 84-year-old mother.
It has been months since our mom was taken from us. Our family is in agony. We are in a nightmare that will not end. Nothing about our situation has changed.
Investigators are still trying to trace the items worn by the masked men on Nancy Guthrie's doorstep and run a DNA test on hair found at the home. Brian Koberger, after pleading guilty to the murders of 4 Idaho college students, is now proclaiming his innocence. The self-confessed killer is now seeking to withdraw his guilty plea, claiming he was coerced into the admission. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Tom, Paul, Alexis.
And Michael Barr, thanks so much. This is out just moments ago and will be on the desk of every government in Europe and indeed in the United States as well. This is the incredible team of Alex Kocherov, Becca Wasser, and Dina Esfandiari at Bloomberg Economics. They have become definitive on the economics and the statics, the dynamics of this war in the Eastern Mediterranean. It is a bombshell report and says that Ukraine's reported strike July 25 in the Caspian Sea marks a potentially significant escalation. They go down below, Paul, within a lengthy note to say Ukraine has steadily expanded its long-range strike campaign to locations around the Caspian. The latest strikes confirm, quote, that Kyiv sees the Russia-Iran logistics corridor in the Caspian is a legitimate target. Paul, I can't say enough about the impact this crew is having with international relations. And that is like, you know, to borrow the phrase from Disney, it's a whole world after all.
Yeah, it is. I mean, I think you have to hand it to the Ukrainians for their ability to, after this many years, to continue to go up against Russia. And they've largely defined drone warfare. And I think even countries around the world, including the U.S., are paying attention. Because out of just necessity, that's one of the key tools for them.
They say Iran is likely to respond, quote, primarily through asymmetric means, but they go up here, and this goes to the meeting that we're scheduled to see here at some point in the hour. The operation carries diplomatic risk if Washington concludes that Ukrainian actions in the Caspian Sea complicate U.S. efforts. I got to get out the map on this.
I'm looking at it right now as we speak, Tom. I'm trying to figure out.
Landlocked,
yep,
east of the Mediterranean.
Yep.
But I only got half a score because I misspelled Caspian.
Oh, okay. Yeah, it's right there. So, but again, I think their drone warfare, their missile warfare, has taken Russia by surprise, certainly, and I think taken the world by surprise here. So we'll see what Mr. Zelensky can get done here in the U.S.
Kucherov out of London with Becca Wasser and Dina Esfandiari, just definitive for Bloomberg an analysis of the war. That I'm sure will go worldwide here today. The Caspian Sea, get out the map and, like the rest of us, learn where we are. The map for us is the data here, 10 minutes away from the market opening. Red and green on the screen. The VIX a little bit of tension, 18.61, but I don't want to oversell that. Bitcoin comes in a solid, my eyes are failing me here. That's in $1,500, right?
Wow. Yep.
Yeah, that's a wow. Okay, that gets my attention. On oil, down $1.72 on Brent, 86.60 on Brent crude. West Texas is an 81 handle as well. Yields come in a little bit, sort of a soggy feel to it. Even the dollar pulls back here. But yen's still weaker, remarkable, 163.86 on yen. That sort of gets you to the market opening. I would say all in all, it's like a beat earnings season.
Yeah, it's been a really good earnings season, and first quarter was outstanding. Second quarter probably going to come in even better here. The guidance is pretty solid. I think a lot of companies are calling out inflation yet again, but maybe if we can get some resolution in the Iran, that'll get that energy aspect of it to come back.
Apple 336 handle, printing 339 year pre-market. We'll have to see. I think I did the math. It's like 341, 342 is bingo, $5 trillion.
Oh, nice. Yeah, their strategy. We're just going to wait. We don't have to be first.
I just need to do my first share. I'm just like,
do a fractional.
Bloomberg Surveillance. Good morning.
On Bloomberg Radio.
Good morning, everyone. Into the market opening. We'll do that. Meredith Whitney following on Visa. Also, Meredith Whitney on the state of earnings against this economy, this juggernaut, into the Fed meeting tomorrow. Right now, it's partly July into August, and there's serious flood warnings in the Northeast. There is drought in France, for example, just as one of the newsmakers right now. Different weather. Rob Carolyn is expert at this. He's, to say Bloomberg News meteorologist, barely describes the science behind his work. Rob, are these just normal storms with normal flooding in the Northeast?
No, they're going to be a little bit bigger than what we normally get in the afternoon, say late July or early August, Tom. The problem is we've got an area of low pressure that's coming out of the Ohio River Valley that's going to get captured by an upper-level low-pressure system. That upper-level low-pressure system is developing downstream from the big high that's got all the heat in the western United States, causing all those heat advisories. And what it's going to do is something we normally see more in the fall or the spring. It's going to cut the system off from the jet stream. And that's going to mean that it's going to be moving very, very slowly. So these showers and thunderstorms that are going to get into the district, into New York City, into Boston over the next 24 to 48 hours, they're going to have a lot of moisture associated with them, and they're going to be moving very, very slowly. So we're very concerned with tropical downpours leading to flash flooding. We had it happen about a week and a half ago. The BQE turned into a pond, and we're worried that, especially in urban areas where the runoff isn't great, some of these storms are going to produce several inches of rainfall over a couple of hours and could lead to some localized flooding.
And then in the Midwest, Rob, we've got this tremendous heat dome there. Talk to us, give us the update there.
We do. What's happening is we're seeing a response, Paul, to the El Nino that is raging in the Pacific. It's producing some very warm water off the coast of California and Baja California. That in turn is leading to high pressure, which is going to be building not only across the central United States, but also over the southern part and central part of California, Arizona, and New Mexico as we head into August. So we think the heat is not only going to be concentrated in the central United States, but it's going to start to spread into parts of the Southwest and into California.
Rob Carolyn, the clashing that we're seeing of these systems, whether it's El Nino, whatever. But like I see, here's an article on tornadoes in Wisconsin. Can you predict like more violence like tornadoes or a more violent hurricane season into the autumn?
Well, the hurricane season is going to be different than normal, Tom, because the El Nino mitigates it in the Caribbean and in the main development region in the Atlantic because of strong winds in the upper parts of the atmosphere. Where we get concerned is areas north of where we normally see development. So the northern Gulf, areas off the Georgia, Carolina coast, that's a problem. Because we've got all of this hot weather in the central United States, that's helping to fuel the jet stream further to the north. That's why we've been seeing strong storms in parts of southern Canada through the Great Lakes region. That energy is what's going to help develop some of the storms we're going to see in the tri-state area over the next 24 to 48 hours.
Paul, remember when this was easy?
Yeah. Well, I'm just like, hey, Rob, I've got a weather app on my phone like everybody else, and it seems like we're much better at predicting this stuff. Like it says rain in here in New York City is going to start at 2 o'clock. I'm going to set my diary to that. I'm going to get stuff done, get my errands done before 2 o'clock. Is it much more accurate than it used to be?
Well, the computer modeling is much better than it used to be. When I started in the business over 30 years ago, we could not give you a forecast with really a lot of accuracy out more than 3 days. Now we can tell you a good 7-10 days out what we think is going to happen. And the short range models, the ones that handle the next several hours out to 12 and 18 hours, they've gotten very sophisticated. They see a lot of data and they do really, really well in telling us what's going to happen over the next 12 to 24 hours.
Rob, your next project is to figure out predictive weather patterns before baseball games so parents don't go the whole wad on the tickets and the game's called in the third inning.
That would probably be a good moneymaker.
That we'll have to work on that. Rob Carolyn, exquisite. He's our Bloomberg News meteorologist. I can't say enough about science over hysteria with Mr. Carolyn as well. And seriously, Michael Barr will have more reports on this and Charlie Pellet to the morning. But the flooding here is Mr. Carolyn said, not normal, to say the least. It could be somewhat substantial. Paul, we get to the market opening before Fed meeting, and you know, I'm sorry. I guess I'm overwhelmed by the earnings just being, you know, you and I talked about it. Sprightly nominal GDP boom beat,
Yep.
essentially.
And I think for the marketplace, the next couple of days, Tom, are going to be really important with some of these big tech names coming out with their numbers. And for a lot of them, it's going to be a question of showing the return on the AI CapEx. You know, you think about the Amazons of the world and the Googles and so on and so forth. I mean, that's going to be a key issue. So we'll see how that plays out. And Carol Massar, Tim Stenovic, they'll be all over it.
Headline just out from Bloomberg News. We'll have further reporting on this. FIFA explores outside investment with $20 billion vehicle.
Sure.
Why not? The news flow just keeps coming from Bloomberg News. Please stay with us. I got futures up 2 here. The VIX 18.61. The market launcheth on a Tuesday. Here's Alexis Christoforous.
Thanks, Tom. And that rotation out of chip stocks and AI-related companies continues as investors pour their money into places like real estate, materials, and utilities. And that is part of the reason why we've got the Dow Jones Industrial Average up 376 points out of the gate, a rise of 0.7%. S&P 500, little change to start the day, but the NASDAQ Composite in the red by 115 points, down 0.4%. Brent crude at $86.33 a barrel, down 2 1/3%. WTI crude now at $81 a barrel, down 2%. The Bloomberg Dollar Spot Index up fractionally at 1222.61. Some weakness for the Japanese yen at 163.87 against the U.S. dollar. Yields are lower across the board. The 2-year yield 4.29%, the 10-year 4.62%, and the 30-year yield at 5.11%. Bitcoin taking it on the chin today, down 2.5% below $63,300. Spot gold down more than 1% at $40.30 the ounce. And want to call out Coca-Cola up about 3% after better than expected earnings. That's your Bloomberg Opening Bell Report. Tom and Paul.
Alexis, thank you so much. Where are we here? Red and green on the screen. Dow up 300 points, but you know, who's keeping score? Meredith Whitney with us right now. We're thrilled to have her in here, and I should say shockingly well-timed as well. Meredith, I'm going to go back. You were in school back then, 2008, but I look at Visa here, and I'm sorry, people don't understand. Back almost 18 years, it's up 21.6% per year. And I remember you in your youth standing up on a table screaming, "Buy Visa." What is the Visa history and management now where they say we got to lay off 7% of the people because the rules have changed?
Well, I mean, Visa's been a great demutualization story, right? So the banks owned it, they spun it off. There was a lot of operating leverage it could achieve, and it's just the whole process of cash to plastic conversion. But like any large company, you've got to right size, and I think a lot of companies that hadn't right sized, that had overhired during COVID, have to face the reckoning that. The only way to achieve operating leverage now is to get rid of is to downsize. And I think you've seen everybody do it. The banks haven't really done it, but every tech company's done it.
Yep.
That's certainly they're not an outlier in that.
I remember the early days of fintech. Maybe it was you. Somebody told me, you want to play fintech, just buy Visa, MasterCard. I mean, all this stuff's got to ride on those platforms at some point.
They were the OGs of fintech way back when.
Exactly. I'm looking at JP Morgan, all-time high today. I mean, what do these banks, and all their stocks have been ripping. I'm looking at the year-to-date and the trailing 12-month performance. Stocks have had great runs. What do bank stocks do? What do banks do when their stocks are trading at or near all-time highs? Do they return cash? Do they buy stuff? What do they do usually?
Historically, pre-Great Financial Crisis, remember the 90s, 2000s, when bank stocks valuations were trading at all-time highs, they would do transformational deals. Yep. There was massive M&A, massive consolidation. This cycle, since the crisis, once they got out of, effectively regulatory prison, they started buying back shares. They increased dividends to a certain extent, but their favored route was buying back shares. And you would think that makes sense in low, when the stocks are trading with low valuations. But the banks have still bought back shares at high valuations, close to 3 times. And it's not as if, the brokers used to, you remember the days, they used to buy back shares to offset their stock compensation. They've done that at exponential levels to their stock compensation. So historically, you'd think, wow, at all-time high valuations, price to tangible book, they would do some type of M&A. And I say they're just pussyfooting around with buybacks and dividend increases. I think the one outlier, the one bank stock that has the temerity, the one bank and one CEO that has the temerity actually do a deal is none other than Jamie Dimon.
So frame an example deal. Example deal.
I think when people thought that Jamie Dimon would retire with their new headquarters, that time came and went. He wants to do something big, and by big, I don't mean State Street, Northern Trust. I think he does something fintech, but major fintech, which is over $115 billion valuation of Revolut.
Okay, of Revolut is an example. Okay, what you do, folks, the way we rock, on YouTube you can see this. When Meredith Whitney walks in the studio, I use the HP 12C.
Yeah.
Apple just hit $5 trillion. I went back to the beginning of the boom, after, Jobs and all that, just the long Tim Cook log boom. Of course, for Meredith Whitney, I went logarithmic. And even one standard deviation below the long-term trend, in June of 2028, it hit $6 trillion. We don't extrapolate like that, do we? We're so wrapped up in the day-to-day, go to cash and all that. We just don't do simple extrapolations of Visa or Apple, do we?
No, or the all-time greatest stock is Microsoft, right? In terms of the all-time greatest compounder, which is Microsoft. I mean, I think that we're all so short-term, and the short-term, I took a long-term view of the banks. I took over the last few weeks to see what their real earnings power was and how they were growing or how they weren't growing tangible book. And most of the earnings growth has been through share buybacks. So if you look at Citi, for example, their tangible equity is below what it was before the great financial crisis. They've just been buying back shares. Otherwise, they would have negative earnings growth. Wells Fargo has barely grown, so 10% in terms of tangible equity. JP Morgan, again, an outlier. These guys aren't growing. Now, the outliers are by comparison to a Microsoft or an Apple that have genuine, real earnings growth. The banks just haven't had it, and so they can get it through some transformational deals, but you're sitting on your hands.
You're predicting basically that the roll-up continues.
Well, I'm thinking that the other banks don't have. I will be a lady here. They don't have the chutzpah to actually lead and do a deal, whereas I think JP Morgan is the only bank, followed by probably PNC, that has the real confidence of the board to lead doing deals, and then others may follow.
Where are the banks in terms of getting out of the doghouse that they found themselves in after the great financial crisis? Are they completely out? Or are we back to kind of pre-financial crisis in terms of their ability to return capital, make acquisitions, just from a regulatory perspective?
Yeah, I think that this is a whole new world. This administration is a whole new world. So JP Morgan and Goldman Sachs got out of the doghouse in 2010 and started buying back. They were the first. And then Bank of America, Citi, Wells, that was 2015. But they've been slow. And I think, Wells just got out from under its asset cap. Yep. So I think they're out, but I think they've got PTSD. I mean, the M&A that occurred during the financial crisis and right after that financial crisis left a lot of the banks with PTSD. So you look at Washington Mutual and Bear Stearns, traumatic for JP Morgan. Countrywide, traumatic for Bank of America, and Green Sky, just an egg on face for Goldman Sachs. So, and Morgan Stanley, great E-Trade acquisition, but it's still digesting.
Mm-hmm. With the bank, we got to go here, but Meredith, within the Meredith Whitney 5 years or even 10 years, do the banks have the profit and free cash flow to still raise dividends and deploy cash to shareholders.
I think if they do the right thing. I mean, I think that if J.P. Morgan is an outlier, but if it does something big, which I think it will do, absolutely.
Will the government constrain them?
It's up to I think it's more the EU allowing that deal to go forward than I don't think the U.S. government's going to constrain them. And by the way, this administration, with just barely 2 years, just over 2 years left, the time is now.
Yep. We got to run. This has been fabulous. Meredith Whitney, thank you so much for joining us today. Meredith Whitney at Group here. Really, really interesting on the banks always. And a major shout out to her call on Visa. Literally a decade and a half ago, that has been a juggernaut winner for here. Dow up 290 points. I got some red on the screen as well. From the Interactive Broker Studios, the Bloomberg Business Flash, Alexis Christoforous.
And Tom, Wall Street traders driving a rotation out of high-profile chip makers and into a broader category of companies, now improving growth prospects with most stocks rising amid strong corporate earnings. Let's begin with the Dow Jones Industrial Average, which is up more than 300 points or 0.5%. Being led higher by Coca-Cola and Sherwin-Williams after both companies posted better than expected quarterly profits. We have got the S&P 500 down by 13 points and the NASDAQ Composite now off 223 points. The NASDAQ 100, by the way, is down about 403 points or 1.5%. Of course, it has that concentration of those chip stocks and AI-related companies in that index. Also have to talk SpaceX. The stock is down now more than 5%, trading at around $107 a share. So this means it has now sunk 20% below its IPO price and has erased $1.2 trillion from its peak value. Let's move on to Apple, which has surpassed $5 trillion in market value for the very first time today. This is ahead of its earnings report out on Thursday. Apple's also preparing to launch new devices and software for the smart home market, including a hub device with the new Siri AI assistant. Let's get you some oil quotes. Brent crude, 86.22 a barrel, down 2.5%. WTI crude down 2% at 80.96 a barrel. And Bitcoin now sitting below $63,000. That's a Bloomberg Business Flash. Tom and Paul.
Thanks so much. A moment of silence here in cheer for Dan Ives and Gene Munster. Paul, you and I did a joint show with them ages ago. And both of them, each in their own way, were piñatas among the Apple doubters.
Yeah.
There people who would say, no, Dan, you're overdressed, you're too bright. No, Gene Munster, you're too boring. But the haters really piled on at one point.
Yeah, I mean, even calling into question, is it time for Tim Cook to kind of move aside and let somebody new come in for this AI story? And stock up 25% year to date, Tom.
This is the way we segue here. When you can go from Meredith Whitney to Barry Ritholtz, that's a good and wonderful thing. Mr. Ritholtz has a modest book out, which has done better than good about what not to do in investing. There's a beach issue. It's like nice. It's got a cover that if you put the can of Bud on it, it won't ruin the cover.
Nope.
Barry, we talked to Meredith Whitney about a log extrapolation of Apple hitting $5 trillion. And even if you're conservative and go one standard deviation under a 20-year trend, it's a $6 trillion company in, I think, the summer of 2028. I'm just guessing here, folks. Don't web me to that.
Which is right around the corner.
Yeah, but Barry, the bottom line is there's all this emotion and stuff, and people listen to Bloomberg Surveillance and they criticize me about the short-termness of it. We just have to extrapolate these winners to figure out how to create wealth, right?
No, but let's unpack that a little bit. And by the way, by coincidence, over my shoulder, the top of that pile of books is David Pogue's History of Apple, which is delightful beach reading as well. Look, the problem with any model we deal with is the built-in assumption that the future will look like the past. And the fascinating thing about Apple, and I say this as a Mac head for 40 years, which is kind of horrifying, is Wall Street took a long time to figure it out. And I don't think it was until Buffett jumped in that the rest of Wall Street that operates on a Microsoft platform finally came around and realized, oh, this entire Mac ecosystem, this entire Apple ecosystem, from the MacBook Air to the iPod eventually to the iPhone is a walled garden, and they make their clients happy enough that they don't look anywhere else, and they spend a ton of money on everything from the earbuds to various services to web storage. There's really no other company like it. There's no competition in the tech space, and the concern was that they're failing the AI race. Siri has always been a debacle. And now it kind of looks sort of clever. Wait, you guys aren't spending $500 billion on AI? You're just going to build it in and buy other people? That suddenly looks savvy.
And, I guess, Barry, the next couple of days, Wednesday and Thursday, we're going to hear from a lot of those big tech companies themselves. And that is likely to set kind of the stage here, set the table for the coming weeks and maybe months as it relates to this AI trade. What are you going to be looking for?
So I want to see the continuation of ongoing earnings, either meeting or beating all the estimates. The old joke is earnings didn't miss estimates. Estimates were set too high. But the big takeaway anytime we have a massive technological pivot, it doesn't matter if it was railroads or broadband or now AI, is the sector is a giant winner. Best of luck picking the winners within the sector. Is it NVIDIA? Is it SK Hynix? Is it going to be Intel? Is it, we rotate through all these different names, and it's really challenging to tell who the winners are going to be in advance. You can tell who's won the past 5 years. I can't tell you. I happen to favor Claude over Chat, but I don't know who's going to be the big winner. Is it OpenAI? Is it Anthropic? I don't know who's going to be the winner.
As Mr. Riddles mentions, when Mr. Buffet first bought Apple, spring of 2016, it's delivered 27.1% return from the first quarter of 2016. If your book was in the hands of Warren Buffett, Barry, what's the number one thing you'd suggest to Warren? Which chapter to read?
I dedicated the book to the two Charlies, Charlie Ellis and Charlie Munger, Buffett's partner in crime. And I don't know if there's anything he would read in there that he either didn't know or didn't teach me.
So what's the key point?
Anytime you have the ability to recognize how little you know, I can't believe I have to go back to Socrates to quote this, and understand how important having some humility when you're building a portfolio, not to say, here's what I think is going to happen, I'm going to build my portfolio in that direction, but rather say, here's the universe of things that can happen. I'm going to build a robust enough portfolio to withstand all these unknowns. Hey, a pandemic, a war, a terrorist attack, your portfolio needs to be diversified, and that means you're trading off short-term gains for stability and long-term growth.
So rare things like the Mets win 3 in a row.
Happens, it happens. Listen, I don't want to be on the other side of any trade from Steve Cohen, and so if he's the owner of the Mets, all right, they've had a rough couple of years, but I don't want to take the opposite side.
It's called doing the Tigers. Barry Ritholtz, thank you so much. Can't say enough about the book, folks, how not to invest. I got green on the screen. Apple, after that $5 trillion move up, way above 340s, pulled back 338 right now. With our news in New York City, here's Michael Barr.
Senator Lindsey Graham will be eulogized in Washington. Graham's remains arrived at the U.S. Capitol, where the Republican served for more than 30 years. Later, a funeral service will be held at Washington National Cathedral. A special election is being held today in Georgia. Bloomberg's Amy Morris is in Washington.
6 candidates are competing for the seat, and the winner will serve out the remaining few months of the late Senator David Scott's current term. That could have an immediate impact on the balance of power in the U.S. House, where Republicans have a thin majority. Under Georgia law, the 4 Democrats and 2 Republicans will appear on the same ballot, and any of them could secure the seat. But if no candidate wins a majority, there will be a special runoff election on August 25th with the top 2 vote-getters. In Washington, Amy Morris, Bloomberg Radio.
In Michigan, a debate was held last night between the two Democratic candidates for U.S. Senate seat. Former public health official Abdul El Sayed vowed to be independent from corporate interest, including utility DTE.
I am the most competitive candidate to take on Mike Rogers. But it's also this, that you've got to have something you're fighting for. Ask yourself, if DTE funds both Mike Rogers and Haley Stevens, who wins? DTE wins. And Blue Cross and Big Pharma and Big Tech and APAC, all funded by the same people.
Representative Haley Stevens name dropped a powerful ally, two-term Governor Gretchen Whitmer.
Look, Governor Whitmer, Attorney General Nessel, the chair of the Michigan Legislative Black Caucus, Amos O'Neill, they all agree that I will be Michigan's workhorse, that I will stand up for us on day one, that I will beat Mike Rogers just like I have beat Republicans 4 times over.
Audio courtesy of Fox 2. The Michigan primary is August 4th to replace Democratic incumbent Gary Peters, who is retiring. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Michael Barr, and this is Bloomberg. Tom Paul.
Michael Barr, thanks so much. 3 days ago, SpaceX 1030 hit the bottom. 2 days ago, SpaceX 1030 hit the bottom. 1 day ago, SpaceX 1030 hit the bottom. We're not up to 1030 yet, Paul. 107.55.
Yeah, that's tough here. Again, the IPO price 135. The first print 150. The 52-week high was 225. So any way you look at it, tough.
SpaceX trying to find a bid. Good morning.
You're listening to Bloomberg Surveillance with Tom Keene and Paul Sweeney on Bloomberg Radio.
Good morning, everyone. I'll be quick here. Emily Graffeo's in the studio. We want to get to her. The news flow extraordinary. The President of the United States is meeting with Zelensky of Ukraine. Of course, that was front and center in an important Bloomberg story of an hour ago, which was on this new linkage across the Caspian from Ukraine east to the Caspian Sea and down to Iran. Becca Wasser and others leading our coverage there. And of course, speaking of Iran, he was a huge supporter of the president at the beginning of this war. Lindsey Graham, in a moment where his casket is moved to the Capitol. The image there of the military moving the senator from the Carolinas casketed after his tragic death here a number of days ago. We'll have a lot of coverage on this forward. Paul Sweeney, Scarlett Fu, and then on to Joe Matthew as well, particularly on events in Washington. I didn't know this, Emily Graffeo, but in your world, the NFL has a balance sheet.
They do.
And it's very bondy.
It's very bondy. In fact, my sources tell me that the only place that the National Football League goes to get debt funding is the private placement market. This is a market where it's mostly life insurers, institutional investors lending money. This debt is not syndicated in public markets, and you don't have to file with the SEC if you want to raise debt here. So the NFL, huge organization, biggest sports league in the world. They made, over 20 billion in revenue the last time that they reported those numbers. They don't want their finances spilled out into the world. So they go to this market. They raised more than 600 million just in the last month through two different subsidiaries.
Do we know what the use of proceeds is? Do they have to disclose that?
Working capital, they don't.
And general corporate purposes.
Yeah, essentially. I mean, they disclose it to
the 3 a.m.
Yeah, exactly.
They disclose that to the investors. Maybe they could disclose that to me as well.
Do they disclose who the buyers are of this transaction or no?
No, I mean, not publicly.
Yeah.
No.
Okay.
Yeah.
All right.
Yeah. But I mean, our understanding is that it's institutional investors.
So in big sport, we've got the Seattle Seahawks, and they're taking a stub out to private equity.
Yeah.
And then on top of that, the NFL, separate from the owners, and Paul, as you've mentioned, they will have TV rights to beat the band.
Oh, yeah.
Do we have any visibility on how profitable the machine is?
Not necessarily. That is a good question, though, for Rander Williams, our Business of Sports reporter.
There was a time when I pitched this to go public, the NFL, and we pitched NASCAR to go public as well.
I remember NASCAR.
Yeah.
I remember that.
Yeah, I don't think we're going to see that anytime soon. But I think it is interesting that, they were able to get this done. A+ rating on these notes. The private placement market's been, I'm told, fairly slow this summer, but there's been a ton of volatility in the public bond market, and this, kind of went through with no issue.
I mean, we got to run here, but this headline of, I think, this time is flying, half an hour ago, FIFA explores outside investment with $20 billion vehicle.
Yep.
That's
institutional
amazing.
money. I mean, institutional money coming into sports. It has to be institutional money. The numbers are just getting too big. It used to be a game. I'm saying the NFL. It used to be a game for millionaires. Then it became billionaires, and now it's becoming institutional money, institutional investors, equity, debt. The only ones that can really fund some of these major leagues, whether it's the NFL or FIFA or whatever.
Paul had a total cow.
Yeah.
Emily, Paul had a total cow like early this morning. He said, "Tom, you never play Springsteen anymore. You don't love me." So we've been playing Springsteen. Can you just listen to Tunnel of Love? It's his album.
I'll put it on.
No, but can you go home and listen to the whole album?
Yeah.
He made it in his house. It's like the ultimate divorce album. Okay, which is why it's a favorite in this room. Emily Graffeo,
It's not as relevant to me, but
tougher than the rest. I think it was about a divorce lawyer.
I'm Sherry Preston. Inside the Capitol Rotunda right now, a ceremony being held for longtime South Carolina Senator Lindsey Graham. The funeral service is set for this afternoon at the National Cathedral. Among those invited, Ukrainian President Volodymyr Zelensky, who's been meeting with President Trump at the White House. Here's ABC's Jay O'Brien.
Graham was instrumental in just the final days of his life of pulling together the support in the Senate for a sweeping Russian sanctions bill that the Senate is expected to take up as soon as today. That bill now bears Graham's name. Also in attendance here, Israeli Prime Minister Benjamin Netanyahu. Graham, who is known for his hawkish foreign policy, was a fervent supporter of Israel and wars in Gaza and then later Iran, and he long pushed the U.S. to take military action against the Iranian regime.
A pause in the airstrikes between the U.S. and Iran overnight as diplomatic efforts take center stage. Today is the start of the 6th month in the war. At least 4 tornadoes reported in the Midwest. ABC's Alex Perez is in Menasha, Wisconsin.
In nearby Appleton,
Oh, my God.
debris sent flying as a tornado moved through.
Debris in the air!
AccuWeather storm chasers tracking the destruction on the highway.
There's massive debris flying in the road.
Cars mangled in sheet metal.
I hope they're okay.
The storm exploding transformers.
Oh, that is good.
Down power lines, leaving more than 500,000 without power across the region Monday as the storms rolled through.
In Japan, the southern part of the country, a major earthquake.
A 6.8 magnitude quake hit just off the southern coast around 4:30 in the afternoon. That was followed by at least 2 smaller quakes. This is about 500 miles southwest of Tokyo. Remote cameras from the area show how strong the tremors have been, and they went on for some time.
ABC's James Longman. In France and Spain, more than 300,000 evacuations because of those fierce wildfires. You're listening to ABC News. For a dozen years, Walmart has been the biggest company in the world. However, it appears it's not anymore.
At least not according to the Fortune Global 500 ranking released this morning. Amazon is number 1 this year, with revenue surging 12% and surpassing $700 billion. Behind the online retailer is former number 1 Walmart, followed by China's State Grid, United Healthcare Group, and Saudi Aramco. Apple comes in as the world's 6th largest company by revenue.
ABC's Jim Ryan. The man who's already pleaded guilty to murdering 4 University of Idaho college students now says he didn't do it. Brian Koberger seeking to withdraw his guilty plea, claiming he was coerced into making a confession.
Koberger, a former criminology student, had researched false confessions just months before the murders, writing a paper focusing on procedural injustice in the American system that has produced many false confessions. Critics suggest his paper could show that Koberger always planned to claim a false confession to manipulate the system. Either way, legal experts say withdrawing a guilty plea after sentencing is unlikely to succeed.
ABC's Hannah Battah. Singer Ariana Grande is suing dozens of hackers for leaking her previously unreleased music and for personal information on the dark web for profit. She says she's been the victim of years of cyber scams and hacking. Here's hoping you're not flying today. 1,300 cancellations, 1,700 delays at the nation's airports due mostly to the weather. Sherry Preston, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, originals, and the Bloomberg Business app.
Good Tuesday morning from the Bloomberg Interactive Broker Studio in New York City. To our worldwide audience, we're streaming live on YouTube and streaming live at Bloomberg.com as well. We got red and green on the screen here today. It's Scarlet Fu and Paul Sweeney. This is the Bloomberg Intelligence Program. Coming up, we're going to check in with Elena Shirletieva. She's a senior U.S. economist at the Conference Board. Get her thoughts on some of the consumer confidence coming out and what we might hear from the Fed later on this week. Rob Carolan's going to join us, Bloomberg meteorologist, get the update on. Got some pretty nasty weather coming up into the East Coast, and we'll get the latest there. Plus that crazy heat in the Midwest. It seems like all the way from the upper Midwest all the way down to Texas, just brutal. Mandeep Singh, Global Head of Tech Research, he's coming on. He's at Bloomberg Intelligence. We're going to get a preview from some of the big tech earnings coming out tomorrow and Thursday. And Christina Hooper, Chief Market Strategist at the Man Group, get her thoughts on these markets here. Jody Lurie, Bloomberg Intelligence Credit Analyst. She follows all the fun stuff like the all the leisure stuff. So we'll get her thoughts on some of the Hilton earnings and maybe what we can expect from some of the cruise lines and that kind of thing. So a lot coming up here. Let's kick it all off with John Tucker and a Bloomberg Business Flash. John.
All right, thanks, guys. This flash brought to you by IBKR. Trade election, climate, and economic outcomes with IBKR prediction markets right alongside your stocks and options. Earn interest on your position and receive $1 per contract if you're right. Learn more at ibkr.com/predictions. So the semiconductor sell-off deepening, and investors continue to rotate into the more economically sensitive sectors. An index of the semiconductor stocks, the SOX, down 5% this morning. So from its June peak, this index is down 25%. And just because I got bored, I was graphing the NASDAQ, and from its peak, let's see, the high was on June 2nd, and right now from there, it's down close to 9%. So, technical correction, not too far off. Information technology, again, the worst performing major industry group in the S&P 500. Now, reflecting that rotation, the consumer staples and healthcare best performers. And in the Dow, paint. Sherwin-Williams, paint, the leader in terms of the index points. It was up about 7 points after beating estimates, also raising its forecast. Meantime, Cam Dawson at New Edge Wealth says, the semiconductor stocks could have further to fall.
Effectively, these stocks got so overbought by the time you got to the middle of June that even though we've seen things like a 40% drawdown in something like SK Hynix, you're technically not oversold yet. So if you look at a name like Micron, yes, it's down over 20%, but it's still 40% above its 200-day moving average.
Well, Nasdaq Composite Index down 269 points, a 1% decline. S&P 500 down 14 points. The Dow up 384 points. There's just too much stuff to keep track of. Now we got to know about DUV, not the DMV, the DUV. Immersion deep ultraviolet lithography machines. So this is a technological breakthrough. It could accelerate the growth of China's computer chip industry. They use ultraviolet light to etch microscopic circuits onto silicon, and that's like the reason for the latest sell-off because competition from China with this new technology.
So DeepSeek, Kimi 3, and now what is the acronym again?
Immersion Deep Ultraviolet Lithography Machines, DUV. So put that in your pipe and smoke it. We check the markets view all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right, John Tucker, thank you so much. A little bundle of joy there. John Tucker joining us.
I wasn't being negative.
No, not at all.
Scarlet Fu, Paul Sweeney live here in our Bloomberg Interactive Broker Studio. Streaming live on YouTube as well. As John was just reporting, got some red and green on the screen here. Let's get a look and see what's happening out there in the world with some stock movers. We can do that with Bailey Lipschultz from Bloomberg News. Bailey, what are you looking at here?
Yeah, let's start with the green, Paul. Coca-Cola, ticker KO, right now up 6.6%, trading at an all-time high. If it closes there, the best day since February 2009.
Wow.
So quite a long time. Beating expectations really across the board, raising their guidance for the full year. The big thing analysts are calling out is the fact that this was a volume-driven beat, so you're actually selling more goods. It's not, peak pandemic when these companies were raising prices.
I love the smaller cans.
Oh, you're a small can guy?
Yeah, absolutely.
Why? Because you don't want to drink that much Coke, and this limits it?
I don't. In a typical sit-down, I don't want 12 ounces. Maybe
Mexican Coke or?
I love the Mexican Coke, but I don't want to pay the premium. Except when I go to Chipotle, I'll get it there.
He likes the smaller
Cokes.
They mix better with the rum.
Thank you, John Tucker.
There you go.
Let's get down to the facts here.
Brass tacks. All right. What else you got here?
Yeah, looking at the weakness, JT mentioned chip makers under pressure again. The Philadelphia Semiconductors Index down 5.6%, on pace to close at the lowest level since early May. Again, down more than 25% from its peak, but still year-to-date up 55%. This does come amid concern around China's progress on this advanced chip making, also just circular financing, which we saw yesterday with that NVIDIA OpenAI contract. And let's be honest here, a risk-off sentiment move. So we are seeing Micron down 10% today, ticker MU. Coherent COHR down 14%. Lam Research down about 10%, ticker LRCX. So a lot of pain in high-flying companies across the ecosystem of AI and chip makers.
All right, and last one.
The secret AI company, Scarlett, Corning, ticker GLW, down 19%. Oof. If it closes there on a closing basis, because this is where the numbers get fun, worst day since July 2002, which I think was the last time we had a bubble. Corning, I'm pretty sure, but 08 happened, I guess. Corning third quarter sales outlook shy of what analysts were looking for. Again, this is a company that makes glass and fiber optic cables, components that can kind of power the AI build out. That's why they've been a big winner on a 12-month basis, still up 110%, though the stock from a June 29th closing high, as I wait for my terminal to load, down 55%. And Corning, Paul, if you remember, is still about $100 billion market cap. So it's a big company.
And it's doubled over the past 12 months. So I'm a glass half full guy. Yeah. So, and Corning, I don't know what came first, Corning the company or Corning the town in New York?
Well, they're based in Corning.
That's what I'm saying. Which came first?
JT, is it named after it?
Yeah. Well, no. No, I think I don't know. But they made the mirrors for all the famous telescopes, like Mount Palomino.
Okay.
There's the other stuff part of it.
Exactly. Bailey, thanks so much. Appreciate that. Bailey Lipschultz with our Stock Movers. And for more conversations like this, subscribe to Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Let's go to Yelena Shuliatieva. She is the senior economist at the Conference Board. Yelena, what are you looking for with our Fed this week here? What are you looking for from Mr. Warsh?
Well, I'm looking to hear some reaction function explanations, hopefully at the press conference. There will be little information probably in terms of the rates action. We expect no change in interest rates. But what will be really interesting to see is how they voted for the decision, how many dissents, if any, will be in the policy statement. So these are the key things that we will be watching in order to understand what to expect at the next upcoming meeting in September.
Yeah, we'll see just how extensive this family fight that he keeps talking about might actually be. Yelena, we also want to get consumer confidence, the Conference Board's latest gauge of confidence, unexpectedly falling to 90.8. What does that reflect, given that for the most part, a lot of people thought in July that, the war had been coming down and was no longer an issue?
Well, it was more nuanced than this. So remember that the previous number was revised up slightly, but overall consumer confidence moderated slightly in July, continuing a general downward sloping trajectory since late 2021. If you look at the labor differential, it was still depressed. Consumers continue to assess labor market conditions as there are not that many jobs available. So there's nothing really much changed in this perspective. But you mentioned gasoline prices, and the report really highlights how sensitive consumers are to gasoline prices. So on average, in July, gasoline prices are still 10 cents lower than they were in June. And consumers took a note of that. If you look at spending plans on services, they picked up slightly, and consumers were planning to spend a little bit more on going out, on traveling. So consumers definitely took a note of that. It's just not reflected in the headline number.
Elena, thanks so much. Appreciate getting a few minutes of your time. Elena Shulatieva, she's a senior economist at the Conference Board. Lots of crazy weather out there for sure. In the complete central part of the country, it's under that heat dome. Just crazy numbers out there. And here on the East Coast, we're going to get some pretty heavy rain over the next couple of days. And there's some New York City is facing some flooding risk as well here. Rob Caroline joins us. He's Bloomberg's meteorologist. Rob, talk to us about what's happening here on the Atlantic coast here, kind of the mid-Atlantic coast over the next couple of days.
Certainly, Paul. We've got an area of low pressure which is moving across the Ohio River Valley right now, and it's going to team up with a line of showers and thunderstorms that stretch from Pennsylvania into the eastern part of New York State, though to the west of the Hudson River Valley in the city right now. That system's going to coalesce, and what's going to happen is kind of an unusual event. It's something we usually see the fall into the winter and spring. The upper level low is going to cut itself off from the jet stream. That's going to delay the storm moving offshore. So it's going to leave us several rounds of showers and thunderstorms, some of which will develop this afternoon from Washington up through New York and towards Boston. And then we'll see more later tonight, tomorrow, and during the day on Thursday. Big problem when you get a cutoff storm this time of year, you're dealing with tropical moisture coming up out of, say, the Gulf or out of the southern United States. So some of these storms are going to produce an awful lot of rain over the period of time that they're occurring. And we're worried about flash flooding. We had some issues in New Jersey and also on Long Island a couple of weeks ago. And we're worried about a similar setup, particularly from southern New Jersey up through New York City and then into western New England.
Are there threats of tornadoes this time around? And I ask because it feels like when I was growing up, tornadoes were not a thing in the New York tri-state area. Now it very much feels like it's become something we need to watch out for.
No, we're not concerned about tornadoes with this round of thunderstorms, Scarlett. The issue is it's a much slower moving system. The energy isn't going to be moving quickly in order to get tornadoes. And we've been seeing some this year. It's been due to very strong weather systems diving down from the Great Lakes, a lot of energy in the upper parts of the atmosphere moving through swiftly, and the winds change in direction from the surface as you go up in the atmosphere. This system is going to be very sluggish. So it's not going to have the ability to spin up tornadoes. The big problem we really do think is going to be tropical downpours. We're going to have thunderstorms that are going to be like what we see in Florida in the afternoon with that, they're moisture laden. They put a couple of inches down over several hours. And especially in the urbanized areas with the concrete where it doesn't run off well, we are really concerned about the problem with that water accumulating and piling up and causing issues for commuters.
All right, Rob, thanks so much. We really appreciate a few minutes of your time. Rob Caroline, he's Bloomberg meteorologist, and we all have here in New York City images from storms past of the subways getting flooded and water coming from all parts into the subway. That's always a fun time for the commute. Red and green on the screen here, led by the NASDAQ, off 1.4% today. This is Bloomberg. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. Let's start off with the NASDAQ Composite Index. Now down over 9%, below its June high, so that's closer to correction. It kind of touches on the whole theme of the risk-off with technology. The semiconductor stocks, again, leading this risk-off sentiment. The semiconductor index, the SOX, down over 6%. This kind of follows the clobbering that the Kospi took overnight in South Korea. The new added worry is that China's using new technology to advance its chip industry, so there will be a lot of competition there. S&P 500, 19 points lower. The NASDAQ Composite Index, 322 points lower. That's down 1.3%. And then you have this rotation into, I don't know, what do you call it, old economy stocks. So that's reflected in the Dow, up close to 400 points, 52,606. Visa eliminating about 2,600 jobs. The CEO there trying to make the firm more efficient. Apple becoming just the second company. So that's not all bad news from John Tucker. The second company ever to achieve the $5 trillion market valuation. iPhone maker shares rising today, pushing the company's market cap to above $5 trillion. Let's see, if it closes above 343 cents, it'll cross that threshold. Right now, 337.87. So, we'll see. S&P 500 again, 21 points lower. And we check the markets for you. Too much?
No.
Okay.
Keep it up.
All right. I can't. We check the markets for you all day long. Right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
All right. Thank you so much, John Tucker. And of course, he gave us the headline about Apple and that $5 trillion market cap, which is, for the first time for that company, pretty incredible. We want to get to the tech headlines overall, because the one that catches my eye, Paul, is the NASDAQ 100 heading for a correction, a 20% drop from its peak. The AI worry.
10%.
10%. Excuse me. Yep. Bear market is 20%. Yep. Oh, boy. Okay. Nevertheless, almost down 10% from its peak. And this, of course, right before the heart of earnings season from the rest of the hyperscalers.
Yeah. We're going to get Microsoft, Meta Wednesday, Amazon Thursday.
Okay, so let's bring in Mandeep Singh. Mandeep is our global tech research head here at Bloomberg Intelligence. Mandeep, is this just nervousness, positioning ahead of the earnings, given what we heard from Alphabet, kind of resetting people's expectations?
I think it's more of a recognition that all of these hyperscalers are going into negative free cash flow territory now, and it's going to happen for everyone. So it's the market expressing its nervousness around that negative free cash flow, and really not enough ROI to justify all this increase. There is ROI. We saw that in Alphabet's print, but the market didn't feel like this was enough to give them a pass and, for the stock to go up. I think, at the end of the day, this is a multi-year technology spend, and you are going to see phases of nervousness around, are we spending too much right now? Mm-hmm. But overall, everyone feels they have to invest. There is no way out of it. And, this is another one of those phases where you will see a correction, but it's not going to be meaningful.
So you and your team, you've got all your little financial models out there. How long are you forecasting negative free cash flow for the Metas, the Amazons, the Googles, the Microsofts? And if so, for how long?
At least through this build-out phase through 2028, 2029, where we will see CapEx increases. And we are talking about an annual CapEx of $1 trillion from these 5 hyperscalers starting next year, which is going to grow at least, low teens for the subsequent 2 or 3 years. So through 2030, there will be negative free cash flow.
That's what I signed up for.
That's exactly it, right?
Yeah.
That's
free
exactly
cash
it.
Flow, recurring
yes,
revenue.
Right. I mean, it's causing a rethink of the tech sector completely, because, as Paul said, this is not the profile of these investments. What kinds of tech companies in the past have had negative free cash flow and done well?
Well, look, the tech model has been asset light for the most part. So your largest companies like Google and Meta didn't have an asset heavy model. And so from that perspective, it is slightly new territory for these tech companies. But with that being said, they are growing top line 20%. So when you look at the likes of Alphabet at a 400 billion plus top line growing 20%, if anything, their top line growth will accelerate going forward. So that's the basis for why people should have an appetite to fund this, because we have never seen these kind of companies before that will have top line of 500 billion compounding at 15-20%. And these companies are becoming stronger and stronger. There is a reason why they are able to self-fund this build out, because of the strong balance sheet. And everyone feels like once they taper their capex, which there will be a digestion phase eventually, they will be printing. If tomorrow, let's say Alphabet and Meta and Microsoft decide they want to scale back their capex, they will start generating free cash flow of 150, 200 billion. That's not a problem. But then does that position them well in that AI race where we are competing globally with everyone now with Chinese models?
Yeah.
No. And so that's what everyone is after, is that price of AGI, and where do you stack up in that race?
Once again, as he usually does, John Tucker confused me today with one of his stories. Some Chinese BUV. What is
DUV.
that? DUV.
Yeah.
What is it? What do I have to worry about that now?
It's, look, across the board, there is competition. So we are talking about how open rate models can have a bearing on the Anthropics and OpenAI's in terms of their outlook. Then you have the semi-cap equipment companies like ASML right now that have a monopoly in terms of how TSMC has to rely on ASML to get their equipment. Well, China is able to produce a portion of what ASML sends. That's the DUV machine, where they have developed their own machine. And we know the Chinese approach is just flood the market with the lowest cost. That's what they're trying to do with the open weight models to reduce the token costs. It's the same thing with the semi-cap equipment, the DUV tools that we're talking about here.
Oh, I'll wait for the movie.
I think we have no choice but to wait for the movie. Very quickly before we let you go, the big earnings that come out on Wednesday, Thursday, what's the one company that you'll be laser focused on?
Meta. I mean, to me, even today, the news we saw with BlackRock, they want more of the stuff to go off balance sheet. They want to develop a cloud business. They don't have one. So the ROI question is the most prominent for Meta because they don't have a model. They don't have a cloud business.
All right, good stuff. Mandeep Singh, thank you so much. Mandeep Singh is our global head of tech research here at Bloomberg Intelligence. And on that note, with earnings coming up, let's bring in Christina Hooper, who joins us in studio. Hey, Christina. She's the chief market strategist at the Man Group, joining us to give us her take on the markets overall. We've got a super pivotal week. We've got central bank meetings galore. We've also got these big tech earnings. What will set the tone here for the third quarter?
I do believe a lot of it is going to be set by the Fed because there are so many unknowns. This will be the second FOMC meeting for our new Fed chair. So he is still very much putting his imprint on the Fed. And so I think that will be an important part of setting the tone for the third quarter.
What should he say? What do you think he will say? Or will he say nothing?
Well, he'll certainly say less than Jay Powell. Okay. We know that, right? So the radical transparency of the Powell years is over. Okay. And we're going to get something less. I do think he will articulate concerns around inflation because so many FOMC members are concerned about it. Before that blackout period, we heard from a number of them. And while there was something of a reprieve when there was a ceasefire, that, of course, has largely ended. And I don't see, and I'm sure many of them don't necessarily see an end in sight anytime soon. And so that's a concern, as well as AI, CapEx-driven inflation, as well as tariff-driven inflation. So there's a lot to be concerned about.
There is a lot to be concerned about. And of course, it's not just the U.S. that's holding a central bank meeting. We've got the Bank of Japan and the Bank of England as well. I mean, the Fed obviously matters more than those other two institutions for investors in the U.S. But how do you think they will influence each other, if at all?
So I actually think the ECB will have some influence because they came out last week and essentially gave us a hawkish hold. Mm-hmm. And I think that's what we're going to get from the Fed. And I don't think the Bank of England is as concerned about inflation and doesn't need to be, but we'll likely get something akin to a vigilant hold from them. Now, the Bank of Japan is something of a different entity in that it has this longer-term goal of normalizing monetary policy. And so it's going to be trying to incrementally hike rates in a way that's not disruptive while this entire inflation backstory plays out.
While the Fed waits and sees, maybe the bond market's not. Yields have been rising here. How much of a headwind is that for the stock market just in general?
I think it's a significant headwind, especially for tech, because that's the long duration or longer duration equities, right? And especially now when we have tech companies that are going to be waiting on pretty significant revenues coming from their AI investments. That, I think, makes it a longer duration stock than it was just a few years ago, or stocks than it was a few years ago. And so anytime we see rates go up, especially on the long end, that tends to exert downward pressure on those longer duration equities in particular. So I don't think it's good for the stock market in general. It's particularly bad for tech, especially the AI related. Now, we've been talking a lot about AI. Keep in mind that Bain came out not too long ago with a forecast saying that these companies, the hyperscalers, will need to get to $2 trillion in AI-related revenue by 2030 in order to make this essentially sustainable. I mean, that's a pretty significant hurdle if they need to get anywhere near that.
And that's kind of coincides with what Mandeep was saying in terms of the CapEx spend. Yeah, it's not just this year. It's not just next year. It's
2028, 2029. I mean, we're going years down the road. So that being the case, higher rates for now doesn't sound like it's going to discourage these hyperscalers from borrowing money in the debt market. They need to get this money one way or another.
Well, I mean, it certainly does beg the question, will we see some kind of strategy change? Will we see some of the U.S. Hyperscalers adopt more of a Chinese approach, which has been invest less, invest thoughtfully, look for ways to cut corners, essentially, have less expensive technology. And keep in mind that so much is so expensive, particularly chips, right? We saw Apple just a little while ago raise prices on its laptops because chip costs had gone up so much. When you're a hyperscaler, you're buying a lot of chips. So think about how much more you're spending to get the same kind of build out that you got last year. And of course, these GPUs, there's so much that can become rather obsolete quickly. So we might see a more thoughtful, measured approach to AI investment in the future. And certainly that would coincide with more in the way of not in my backyard movements, pushing up against it because of electricity usage. There are all kinds of forces that could conspire to change AI investment strategy.
Christina, thank you so much. Always a pleasure and great seeing you in studio. Christina Hooper is Chief Global Market Strategist at the Man Group, joining us in our Bloomberg Interactive Broker studio. We have red on the screen. I was almost going to say green. That's the case if you're looking at the Dow, but the NASDAQ and the S&P 500, big declines, especially when it comes to the NASDAQ, down 1.2%. This is Bloomberg.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. So the rotation from tech and other market stuff, that continues. The Dow green with stocks like Sherwin-Williams painting the picture there. Their earnings pleasing investors. Then the semiconductor stocks getting pummeled again. All sorts of worries there, including competition from breakthrough technology being advanced by China. Also makes for a pretty tough setup as we head into earnings from a bunch of the mega caps. So you got Microsoft and Meta Platforms, that's tomorrow. Apple and Amazon, they report on Thursday. I got to pick on SpaceX just because I can. Those shares have now erased 1/5 of their value since their market debut. And of course, the Fed, starting the two-day policy meeting today, Terry Weissman at Macquarie says they are on the path to tighter policy.
I do believe they're going to be raising rates. I believe it's going to happen at the latest in October. There's a tail there to maybe moving it into September. The only reason I would even I am entertaining October is because the personal consumption price index revisions are coming out in late September.
So you got to wait for the data. S&P 500, 9 points lower right now, 7403 on the index. The Dow up 358 points, 52,569. And the Nasdaq Composite Index, 231 points lower. That is down 0.9% right now. Oh, there's an auction of Harlan Sanders stuff. Who? Colonel Sanders, the founder of Kentucky Fried Chicken. You can bid on his pressure cooker and also a 1964 personal planner with handwritten herbs and spices recipes. So the Colonel sold Kentucky Fried Chicken in 1964 to a bunch of investors, but he retained the
original
title.
recipe?
No, he remained kind of the spokesman, the goodwill ambassador
The IP.
for the company. He served in the U.S. Army as a young man, but the Colonel title, that comes from the governor of Kentucky, who conferred upon him the honorary title of colonel.
So he's not a colonel in the military.
No, it has nothing to do with military rank. I think it was like the Kentucky whatever. That was in 1935. So
okay, more news you can, I guess, use. I don't know.
But then, of course, I immediately thought of Christopher Walken's portrayal of a colonel on SNL. You'll have to go look that up because I can't explain it. I'll get fired if I explain it on the air. Anyway, we check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash, Scarlett and Paul.
Hey, John Tucker, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and Bloomberg.com as well. Some of the leisure companies reporting some numbers today. Royal Caribbean, Hilton. Let's break it down with Jody Laurie. She is the senior credit analyst at Bloomberg Intelligence, following these companies. Let's start with Royal Caribbean, Jody. Some pretty good numbers, I think, from Royal Caribbean, right?
Yeah. Paul, I mean, I think that it was not so surprising, but at the same time surprising. I think a lot of people were sort of anticipating that the Middle East would have a much larger, more pronounced effect. It's not saying that it doesn't. It's been, I think, well televised, plus the fact that you benefit from the fact that Carnival reports a month before. And so I think a lot of people have time to digest that and expect Royal to perform a certain way. We are seeing that bookings are strong. We're seeing that consumers continue to spend. And I think what's so interesting about Royal is they're leaning into the loyalty credit card arena, and they've been sort of talking about how that's been positive.
When you look at the cruise space, where does Royal Caribbean fit in with Carnival, with Norwegian Cruise Line, with Viking? I mean, walk us through in terms of loyalty, in terms of the kinds of consumers they attract, and in terms of the scale that each of them can achieve.
Right, Scarlett. So Carnival's the largest in terms of number of ships. Royal is second to that, and Norwegian's a bit smaller. Viking's a little unique in that they focus primarily on river cruises, although they do have some ocean cruises. Royal is actually entering into the river cruise space as well, and they've seen some good traction in terms of bookings. But I think what's so interesting here more than anything is that you have different types of consumers. You have the consumers that will cruise no matter what the company is.
Okay.
They just like cruising and they base it off of the destination and type of ship and what they're feeling that day. You have the consumers who are really dedicated to a specific brand and won't go outside that brand. I think the cruise line's goal is first to sort of attract consumers who wouldn't necessarily cruise into cruising, and then once they have them there, sort of get them dedicated to their particular brand. Now that we have much more digitalization, much more AI, I think a lot of what the companies are trying to do is extract as much personalized data so that they can really pinpoint to the customer what they think that they want to achieve with their vacation.
All right, I'm going on a Viking cruise in the fall, and I will report back on that river cruise in France. I lost a bet, let's be honest.
Are you going to expense that?
Yes, exactly, on my expense account.
It's no kids. No kids.
Yeah, exactly. Just switch gears and look at Hilton Hotels. I thought the numbers were good, but I see the stock trading off today. Tell us about Hilton. What's going on in the hotel business?
So Hilton actually, it's interesting because I thought that it was relatively strong, all things considered. You didn't see as much of a bump necessarily from the World Cup. They did say that they expected third quarter to see a bump as well. What's particularly interesting is if you look at occupancy rates, the ones that were negative this quarter were actually the highest end. And so that sort of speaks to perhaps the highest end earners either not traveling this quarter or maybe perhaps trading down. Hilton sort of hinted at that conversation on the prior call, talking about how consumers might be looking to sort of shift down a little bit in terms of their preferences. And I think we're starting to see that play out. What is interesting, though, is that they said that the AI boom is going to help middle and lower income consumers. And that's something we haven't heard in a while. Lower income consumers have gotten beaten down on quite a bit. And for obvious reasons. We have inflation pressures. We have a lot of sort of factors that are feeding into lower income consumers, pulling back on vacations.
Yeah.
But Hilton sort of hinted at that actually not necessarily being the case as much, which I thought was kind of interesting.
Yeah, I don't get how that happens. And have we heard that from other companies, that the AI boom will help these two cohorts?
I mean, I think, Scarlett, it's more of a function of, the same thing how last year we talked about how the pareback of government spending was going to negatively affect a lot of hotel companies. You now have these projects, these larger projects, and these potentials for expansion into other regions, perhaps attracting individuals to work there or to be there. And so I think that's sort of the concept behind it is anytime you have project booms that can kind of help hotels, at least temporarily, potentially. But it will be interesting to see how it sort of translates and if that's really the case. Now, I will say that for both companies, the Middle East, Royal and Hilton, the Middle East was clearly the area that was the weak spot and certainly something that they touched on. Not surprisingly, and it's certainly something that's been a lagger for both the companies and has extracted some value away from what they've done.
For the hotel industry, is the industry adding net rooms, or are they still building new hotels and stuff?
They are, Paul. They are. I mean, the industry is still very much growing. It's still expanding. You have the large brands like the Hiltons, the Marriotts of the world, but you also have a lot of independents. Now, there has been some consolidation. You've also seen some independents teaming up. We have some companies out there like Mr. and Mrs. Smith, which Hyatt bought, which is sort of helping to sort of expand access into independent hotels. And I think what we're sort of anticipating or what we're sort of watching for is whether traditional hotels kind of get a little bit more growth or momentum in them as Airbnb seems to be not as popular as it once was. You also have some areas that have taken back from Airbnb or allowing it. And so I think that if that continues, you might see traditional hotels do well.
All right, Jody, thank you so much. Appreciate that. Jody Lurie, she's a senior credit analyst. She follows all the leisure industries, think hotels and cruise lines and casinos and all that kind of good stuff. She does that for Bloomberg Intelligence.
Aren't you going on a cruise at some point?
Yes, in the fall.
Yes.
October. So, yep.
And Viking.
France. Viking.
So this is a new thing for you because you've never been one of these cruisers.
I never did been on a cruise, so I've been told you have to crawl before you can walk, and a river cruise is kind of like the crawling part of the analogy. We did get the all booze included package. You're darn right we did that.
Yes,
Paid up for
smart.
that, to be honest. More coming up. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Good morning from the Bloomberg Interactive Brokers Studio in Midtown Manhattan. Paul Sweeney, Scarlett Fu, and John Tucker with you on Bloomberg Intelligence. It is earnings season, not just in the U.S., but around the world. And a big titan of the luxury industry, luxury fashion industry, luxury apparel industry, reported earnings this week, LVMH, based in Paris. And the surprise here was that the fashion unit, the biggest unit, home to Louis Vuitton and Dior, reported sales growth, returning to growth for the first time in 2 years. So let's bring in Deb Aiken. She is our luxury goods analyst joining us from London. Deb, what happened that allowed LVMH's biggest unit to return to sales growth when you've got China still as a source of stalled demand and also a lot of issues in the Middle East with the conflict, perhaps calming some of the buying impulse there?
Mm-hmm. The US is what happened, so that's a nice story. The US is on fire, and particularly so fashion and leather goods, the area that you're questioning. It's the biggest by far in terms of profitability and sales. So it's 47% of the business for sales. It houses so many brands, big brands that we know, like Louis Vuitton and Dior, Celine and Fendi, others. And so the US, as we've seen actually with Richemont, particularly with jewelry, with other competitors which have started to report across this sector, the US is on fire. And it's been so for about 3 or 4 quarters. So we will ask later on, what about the state of the high-end consumer in the US? Well, for us, it's just really pushing ahead. But other than that, there were parts of Europe, there was Japan, and particularly Asia, where the whole fashion and leather goods business did better than expected as well. And I think that it's on the icons, it's on more creativity, and Dior is really helping out with Jonathan Anderson's first collection there, and that's doing well across soft leathers, footwear, and also the apparel side of the business. Women's wear doing very well too. So that's how we get to Q2 return to growth and an expectation for a better second half for fashion and leather goods.
Talk to us about the Middle East, because we all have, whether it's from TV shows or movies, all the fast money in the Middle East and spending wildly on luxury items. Talk to us about the Middle East for a lot of these big luxury companies.
So the average luxury goods exposure to the Middle East is 4 to 5%. And the expectation leading into 2026 was that we were looking for 6.5% growth coming from the Middle East region. Bigger than that, though, would be tourism, particularly to Europe from the Middle East. And that's what we're missing on the Europe number. So all of the numbers we've seen coming out generally would see Europe a little bit softer than it had been on the tourism side, but local growth is still solid. And the idea is that actually within these numbers, we would have got 4% constant currency sales growth in the Q2, but we came out for the group with 3% because 100 basis points were swept away because of closures in Q1, and on the half 100 bips also, a little bit of closure in the Q2. But I would say with around 50 to 60% capacity reinstalled locally in stores. So that gets us to the minus 100 basis points at group level for Middle East. If we carry that forward, we would say 100 basis points for the full year, and that's what we put out initially when the news broke in March, and with everything that's happened since.
Gotcha. Deb, you had mentioned Japan and how it had seen quite a bit of growth in the quarter. Japan up 14%. There's a separate Bloomberg news story about how shoppers in Japan are driving up luxury jewelry sales to a record because consumers are seeking a haven from inflation and the weakening yen. I think that's so fascinating. Do we have a sense that from LVMH that was the dynamic?
I think Japan overall is 8% of sales, and actually Japan was mentioned across several of the categories as being strength and growth. So fashion and leather goods, also the selective retail side, which houses Sephora, did very well there. And the idea is actually that it's local shopping as well as jewelry, of course, high jewelry in particular. Tiffany doing very well, Bulgari doing very well, and doing very well across different regions. But it's about local demand, but also we are starting to see tourists back to Japan also on the back of the yen. They came in 24, they went away in 25, and they're back in 26. So there are some acute and interesting purchases also taking place, benefiting from a weaker yen.
Deborah, about 30 seconds left. Are Chinese tourists, are they traveling to London's High Street, to Paris, Milan, New York? Are they out and about spending money?
It's really interesting, and it's a good read across actually for tourism. So what we see is the Chinese, what we call the Chinese cluster, buying at home on the mainland, across Asia and elsewhere. They're flat if we look sequentially and year on year, but actually there's less now being spent as compared in this quarter locally on land and more being spent off land, including coming to Europe. And we also have a lot more Americans coming to Europe as well. So they are traveling, they are spending, they're being more refined in the types of products that they're looking for.
All right. You get the euro down to parity by October, and then we'll be in good shape. Deb Aiken, thanks so much for joining us. Deb Aiken, she's a luxury goods analyst. Yes, we have a luxury goods analyst because there's lots of big public companies out there, and we like to cover them right now. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. More BI coming up right now.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
This is Bloomberg Intelligence. Good morning from the Bloomberg Interactive Broker Studio in Midtown Manhattan. We are streaming live on YouTube. Paul Sweeney, Scarlett Fu, and John Tucker with you for the second hour of Bloomberg Intelligence. We have a lot to get through this next hour. Of course, we have President Trump talking up Iran diplomacy as the negotiations zero in on the Strait of Hormuz. We're going to check in with Dan Williams. He is our reporter based in Jerusalem. Ken Shea is our senior consumer products analyst. He'll help us recap Coca-Cola's earnings. We're also going to check in with Chris Merrill. He is the global CEO and co-founder at Harrison Street Asset Management on private equity. George Ferguson is our senior aerospace defense and airlines analyst. He will talk to us about Boeing's latest results as well as JetBlue's latest earnings. But before we get to any of that, let's check in with John Tucker for our Bloomberg Business Flash.
Yeah, we're mixed. The major averages right now, Scarlett. Investors leaving tech, rotating into the more economically sensitive parts of the market, which is why the NASDAQ is selling off. The Dow higher from its June 2nd high. The NASDAQ 100 down just about 10%, what we usually define as a correction. Leading declines again, the semiconductors today. The index of semis, the SOX, down 4.9%, just about 5%. This is actually coming off the worst levels of the session, believe it or not. Apple up 0.3% right now. The market cap now, let's see, 4.966 trillion. By the end of the day, we could see just the second company to reach a valuation of $5 trillion for Apple. It did reach that earlier this morning since pulling back. Meantime, Lori Calvasina at RBC Capital Markets says it may be time to pick up some bargains.
Well, we actually did recently upgrade the tech sector, so I think on a longer-term basis, we're already, fishing around in this space. I think we also need to watch very closely the rate of upward revisions in the semi space, which has continued to be very, very strong.
Right now, the S&P 500 down just 2 points, 74.10 on the index. The Dow up 385 points. The NASDAQ 100, 382 points lower. That's a decline of 1.3%. So hardcore marathoners and runners are spending more to look better when they run. Sales of running-specific apparel have increased to almost $1 billion in the past year. This is according to figures compiled by Circana. The offerings include a $140 T-shirt covered in holes. They call it Moth Tech. The Moth Tech.
There's no technology there.
From a moth's perspective, I guess. Truly innovative. The Moth Tech cotton top made by the luxury running brand Satisfy, and this is how they describe this shirt. Quote, it's inspired by cotton that's been in dialogue with time. I love it. With laser cut openings to enhance cooling across heat zones. And you can pair this with Satisfy's $180 nylon Spaso shorts, which have punched out micro perforations for speed and breathability.
I think this just goes to show how much money there is, how much money is sloshing around, and how much discretionary income some people have.
Yep.
Well, for runners specifically, but
a certain cohort of runners.
I'm reminded of Calvin Coolidge, his speech when he said, "I choose not to run." Anyway, we check the markets and other stuff.
Different kind of running.
Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash.
All right, John Tucker, thank you so much for that, for the other stuff. Let's bring in Judy LaGrue. She is here with us in studio. Oh, yes, that's right. God, Thank you, Paul.
Yeah,
Thank you for
there's
saving
some
me.
bad weather coming here.
Yes, absolutely. Bad weather coming up. Another horrible commute on the way home tonight, right?
Yep.
Oh, great.
Rob Carolan, he is our Bloomberg meteorologist, giving us a weather update. What time should New Yorkers and those in the tri-state area expect the rain to start coming down?
Probably, as Paul said earlier this morning, Scarlett, after about 2 o'clock, we're already starting to see some storms pop up in southwestern Connecticut, but they're moving away from the city. But the atmosphere is becoming more unstable, a lot of moisture to the west, and that is going to feed into the area. I think it is a rough commute home tonight, and it's also probably going to be an interesting commute in tomorrow morning, since we'll be dealing with the after effects of the showers and thunderstorms that we pick up this afternoon and this evening. Again, the area under a flood watch through Wednesday evening. Some areas are going to see in excess of 3 inches of rain over the next 36 hours.
And again, is this going to be a fast-moving storm, or is this going to be one of those that lingers?
It's going to linger, Paul. It's with us probably through Thursday evening. The system is out in the Ohio River Valley. It's going to take its time developing. It'll hit us today, hit us tonight, again tomorrow evening, and then there's the chance of more rain on Thursday, though I think Thursday's rain won't be quite as heavy as what we're expecting later this afternoon and into the evening, and then early tomorrow morning.
All right, well, at least there's that to look forward to. Rob, thank you so much. Rob Carolan is Bloomberg's meteorologist with the latest on these thunderstorms sweeping into the tri-state area here. All right, let's get to Judy LeGroux now. She's been patiently waiting. Sorry about that, Judy. I can't read the rundown, obviously. Give us the stocks on the move that you're looking at right now.
Sure, Scarlett. First, I'm looking at Palantir, ticker PLTR. The shares are tumbling as much as 10.4%, and the company is on track for its worst day in over 5 months. And for the first time since I've done this segment, I really am stumped as to why this movement is happening. But there are a couple hypotheses that we've got. First and foremost, Palantir expects to report their second quarter earnings on Monday, August 3rd, after market close. Oppenheimer analysts particularly are quite bullish and positive on what they expect will be a second quarter revenue beat, an 85% year-over-year increase, and a raise of their outlook as well. So I think maybe perhaps there's a lot of sort of momentum going into that. But what I found to be really quite interesting on the terminal is that there is an article currently about sort of what's happening with Palantir and the French government. So in June, the French Prime Minister, Sébastien Lecornu, got on Instagram and talked about how France needs its own tools and really put it out there that the country was going to look into severing its ties with Palantir. So understanding sort of the international implications of what that sort of does in terms of other entities looking at Palantir differently is something that we're looking at as well.
Okay, how about Sherwin-Williams?
Sherwin-Williams, paint.
Yeah.
Paint. Ticker SHW. Shares are climbing as much as 8.6%, and the shares are on track for their best day since last October, and they are currently on pace to close at the largest increase since April 2022. And this is coming after the company posted adjusted EPS and revenue that beat Wall Street estimates, and they also raised their EPS guidance for the full year that came in above estimates. Now, what's interesting here is that the company boosted their outlook despite what they themselves called no meaningful improvement in demand. However, Mizuho analysts noted that the sales beat was driven by growth in auto refinish and industrial painting. So not necessarily sort of the home painting that maybe a lot of us assume may be behind their revenue as well. So that is what we're looking at for sure for Sherwin-Williams.
All right, and last stock?
Sure, Coca-Cola. So Coca-Cola definitely on everyone's mind today. Ticker KO. The stock is trading higher as much as 7.2% on the day. The stock is currently trading at an all-time high for its best day in almost 6 years. So this is, again, another earnings-based move after the company raised its organic sales outlook for the full year. And the company also now sees organic sales growth of about 5%, which came in above analyst estimates. And a lot of this is driven by sort of the sales demand that came as a result of the company serving as a major sponsor of the FIFA World Cup. Yeah. So Bloomberg analysts really pointed to Coca-Cola's dominant market share as what drove the beat, but warned that achieving the new forecast may require the company to step up on product innovation and marketing. So looking at analyst comments on this as well.
Judy, thank you. Judy, thank you very much. Appreciate that. Judy LeGroux. For more conversations like this, subscribe to our Stock Movers Reports. Listen for 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. Right now, we want to get down to Washington, D.C. Dan Williams, he is a Bloomberg News reporter based in Jerusalem. He is in Washington, D.C. at the White House. Dan, we know Prime Minister Netanyahu is in Washington for the funeral services for Lindsey Graham. And presumably he'll have a meeting with the White House, or has had a meeting with the White House. Can you give us the latest on what's happening in D.C. from your perspective?
The Prime Minister has now arrived at the White House. Unlike previous meetings when we might have expected him to be greeted at the door in full view of the press, perhaps for him and his host, the US President Trump, to answer questions by reporters there or in the Oval Office, this was a rather subdued entrance by Netanyahu, as it was by the Ukrainian leader Zelensky before him. Zelensky's also here for those observances for the late Senator Graham. I think the obvious reason for this is that the solemnity of the day would dictate that they should not be joshing with the press, perhaps keeping a solemnity, a degree of grayness around their meetings in accordance with the national mood, certainly the mood on this grey day in the US Capitol. There may be other reasons, however. The Israeli Prime Minister did not bring press with him on his plane from Israel. He may not want the press asking questions about the course of this war in Iran, which appears to be at a juncture, and a juncture which may be dividing the allies, him and Trump, although they launched it together, this war, exactly 5 months ago today. We're waiting readouts, we're waiting comments from either side about what was discussed. For now, there's very little comment. The leaders prefer to keep public attention on paying respects to a senator, a Republican senator, much loved in Israel as he was in Ukraine. Toward the end of the day, however, as this visit by the Israeli Prime Minister progresses, he's due to return to Israel tomorrow. We may hear more about what transpired in that Oval Office behind closed doors.
Very quickly, Dan, what is the number one point that Prime Minister Netanyahu wants to make to President Trump?
Keep your eye on the ball being Iran's nuclear program. Trump definitely seems to be aboard above this. It would appear that the more grandiose hopes of achieving a regime change indirectly through this war have been abandoned. The Israelis worried that a new ceasefire in Hormuz might distract Trump from the prize, which would be the uranium enrichment facilities and stocks still in Iran. It would appear that he's hoping for an agreement on a means of continuing to monitor that, to pressure Iran into ultimately giving up those capabilities. And to judge by comments that Trump made to Fox News this morning, it would appear that he's in agreement.
Dan, thank you so much. We really appreciate it. Dan Williams, he's a Bloomberg News reporter. He is based in Jerusalem, but today he is at the White House in Washington, D.C., covering the visit by Prime Minister Netanyahu to Washington, D.C. Let's switch gears and get back to the market and earnings. We've been talking about Coca-Cola all morning. They put up some better than expected results, perhaps helped by the World Cup. Let's check in with Ken Shea. He's a Bloomberg Intelligence Senior Consumer Products Analyst. Ken, break down Coca-Cola's numbers. They seem pretty good. The stock's up 6% to a 52-week high today.
Yeah, hi, Paul. They certainly were good. We're talking about a mature consumer products company. We're not talking a tech stock here now, Paul. So, 7% sales growth, beat the 5% estimates, comparable EPS up 11. These are good numbers. Consensus was a little bit below that, and a lot of it's because consumer sentiment in a lot of big markets, including the U.S., continue to be subdued. And so there was some hesitation going in, although we kind of knew World Cup was going to give them a lift, and it did, a really nice lift. So it was a high-quality performance. It was very much volume-driven, wasn't so dependent on price as it had been in the past few quarters, and balance sheet got stronger. It was just hard to find any fault in this quarter.
I'm curious about the portfolio of drinks that Coca-Cola now has, because it's not just Coca-Cola or the slim version of it that Paul likes so much, but there's also sugar-free soda, sports drinks, water, because this younger generation seems to not like the sugary soft drinks as much as others in the past. What is the fastest growing part of that beverage portfolio, Ken?
That's a good question, Scarlett. Coke would say to that, Part of the benefits of the FIFA World Cup sponsorship is that it gets them close to the consumer and it hears about trends, in real time, gives them a pulse of what's going on in the market. And so what they said today is look in the second half for Coke 00 to get a higher level of promotion. What is that? Well, their very successful Coke Zero, reformulated, is going to have a no caffeine version. That's not exactly novel to the soft drink industry, but it's been probably under-marketed, under-promoted for people like me. I can't drink caffeine after noon or I can't sleep. This is going to be kind of front and center for them in the second half. But to your point, Scarlett, functionality, getting more from your beverage than just hydration is still very key, in terms of consumer demand. They want more protein. Fairlife is a leader, and it was up 18% sales in the quarter. It's really strong numbers. Advanced hydration, that's Powerade. That's getting more marketing muscle now in the second half, so look out for more of that. And I'm sure the company has more innovation up its sleeve, didn't want to share today, but at least those three products, we can look for a higher level promotion in the second half.
So, Ken, do investors and analysts, do they even look at market share anymore, Coke versus Pepsi, or is that just a thing of the past?
Oh, they certainly do, we get it here at Bloomberg Intelligence by virtue of Circana. Now, got to remember that, Circana, it's really predominantly a U.S. tracking. And Pepsi would argue, we're more than just soft drinks. PepsiCo, I think, has probably a wider portfolio of different categories than Coca-Cola does. Coke's still 75% sparkling, 75% brand Coca-Cola. But they're branching out, beyond that. But Pepsi would say, hey, be fair, we're more than just cola.
Yep.
But Coke is gaining share in virtually all of its categories.
Ken, we mentioned how the World Cup was definitely played a role here, but how does a company like Coca-Cola build on that momentum generated by the World Cup, which is, a one-time event as far as, earnings impact is concerned?
It is a one-time event, but Coke went out of its way to say this morning, look, the consumer engagement that we got from the World Cup, they had a lot of activities beyond that. Innovative packaging, they had games and events outside the stadium going on. They had digital interactivity. They had a lot going on that they feel that there's going to be benefits resonating beyond just the immediate. So we'll look for that. But like I said, Coke's engaged with its consumers, and I think that pays dividends.
All right, Ken, thanks so much. Appreciate it. Ken Shea, consumer products analyst for Bloomberg Intelligence. You have a strong preference, Coke, Pepsi, or you're not?
I don't drink soda.
You don't drink soda?
Right. I will drink seltzer. So soda water.
Okay.
Yeah, but I don't like the stuff that's like dark brown and got too much sugar.
Okay. JT?
Sprite.
Okay. That's a...
And by the way, just a fun fact, you can mix vodka and Fanta orange because we ran out of orange juice in Paris once and
right,
had
and
vodka.
that did the trick.
Oh, yeah. We call them Fatal Fantas. How's that for marketing?
There you go. Very good. News you can use, presumably. S&P up 7 points. The Dow up 460. The NASDAQ down 110 points. We got more coming up. This is Bloomberg Intelligence. Good morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is Bloomberg Business Flash.
And I'm John Tucker, the Bloomberg Newsroom with this Bloomberg Business Flash. NASDAQ 100 falling for a fifth day. The Philadelphia Semiconductor Index, that is sinking 5%. Information technology, worst performing major industry group, home to the semiconductors. So that's the big story today. Where are investors going? Rotating into stuff like consumer staples and healthcare. Corning, the worst performing stock in the S&P 500. GLW, the ticker there for glassware, down 18%. Third quarter revenue guidance was just below expectations. This is kind of a derivative play on AI because they make, among other things, fiber optic cable. And the leader in the Dow Jones Industrial Average, paint, Sherwin-Williams. Those shares up close to 8%. Positive results for that company. Right now, the S&P 500 has turned higher, up 20 points, 7433 on the index. The Dow Jones Industrial Average of 559 points, and the NASDAQ 100, 231 points lower. That is down 0.8%, but off the worst levels of the day. Love the story on the Bloomberg. So Cisco and Cisco, two different companies. One is the network services company. The other is the food services company. They've long been confused with each other because of their similar names. Employees of both companies have to explain to people they work at the company with the C or the S. So there was a recent meeting, and it happened that Cisco's chief people officer was there, and Cisco, with an S, the global head of customer experience, he was there. This all led to a LinkedIn post. Two of them with their arms around each other. So now, because of this, the two companies say they may collaborate, actually, on a joint technology project. Cisco,
that's not going to be confusing.
Yeah, Cisco and Cisco getting together. Completely different areas, but anyway, it's a great read on the Bloomberg if you get the chance. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Scarlett and Paul.
All right, John Tucker, thank you so much. Appreciate that. It is Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. We have some earnings coming out of the payments and fintech space today, and break it down. We're going to go to Diksha Garrett. She's a senior fintech and payments analyst for Bloomberg Intelligence. She's out there in San Francisco. Diksha, let's first talk about PayPal. I know they reported some numbers that beat estimates. We can talk about that. Talk to us about the strategic opportunities potentially for this company, because I'm not sure if it's in play or not in play, but people are interested in it. Talk to us about PayPal.
Yeah, hi, Paul. Great to be here with you as always. I think the results beat was interesting. 9% adjusted EPS beat shows that the business is executing better than was feared in this tough environment. Volume was strong, transaction margins were decent. Branded checkout growth also stabilized around 2%. And the company's reaffirmed its 1.5 billion savings target, and they've said about 400 million run rate savings by the end of the year. So things seem to be on track, but I think the key issue that remains with PayPal is the core profit driver, which is the branded PayPal button that has seen single-digit growth. And the context around that is digital wallets like Apple Pay, like Shop Pay, card autofills are all capturing checkout mindshare. So I think the focus needs to shift. Whatever management does, those old days of milking the branded button are never going to come back. So they need to find alternative ways to monetize the network. And that said, the biggest catalyst for the stock right now is the Stripe and Adyen bid. They've made a $53 billion joint offer to acquire PayPal. The board officially hasn't responded to, but one way or the other, it forces the market to value this company appropriately now.
Do you expect the board to have any issues with this deal?
So here's the deal, right, Scarlett? Why does Stripe want PayPal? Stripe dominates the developer-first merchant-side payment infrastructure, but what it lacks is a two-sided consumer network. So the asset that PayPal has, which is its 400 million consumer wallets, the Venmo and distribution that it has, and now the stablecoin and agentic AI rails, all of these are valuable assets, and management is in so many ways communicating that. So the board has shown that this wall offer isn't where they see the company's true potential. If you pay attention to the words in Enrique's commentary today, the message is clear. They're open to a deal, but it needs to reflect the true franchise value. And management said that they feel confident about the turnaround execution with fast lane or with margin expansion, and they think that'll yield higher long-term shareholder value. And they are willing to do the hard work or at least go down trying. So these comments are likely reflecting in the share price more than the earnings itself today.
How credible is this buyer? Can you tell us about who this buyer is and who this bidder is and kind of how credible they are?
So Stripe is a very large competitor and a direct competitor for PayPal. They're a private company, and which is why, like, strategically, this asset makes sense for Stripe to kind of acquire. It's just that the offer was a lowball offer. This asset gives Stripe direct consumer relationships. So they do the merchant side of the processing. They have all the AI native companies. They have a wonderful new modern tech stack. But the PayPal's two-sided network where they have all the consumers and the merchants, that's something that that's Stripe's envy. That's what they want. A consumer wallet, something like a Venmo, which has become a verb instead of a company asset, right? So when I say, okay, let me Venmo you, you understand what I'm talking about. So that's something that Stripe would like to acquire.
To turn its brand into a verb.
Yeah, like Kleenex.
Yes.
I like Venmo. I think it's...
Or Q-tip.
It's yeah, exactly right. All right, Diksha, thank you so much. We appreciate that. Diksha Gera, she's the Senior FinTech and Payments Analyst for Bloomberg Intelligence. This is Bloomberg.
Now on Bloomberg Intelligence, private markets in focus.
All right, folks, this private market segment is brought to you by Franklin Templeton. Franklin Templeton harnesses the combined private markets expertise of Benefit Street Partners, Clarion Partners, and Lexington Partners. Learn more at ftprivatemarkets.com. Let's check in with Christopher Merrill, Global CEO and co-founder of Harrison Street Asset Management. Christopher, just give us the lay of the land on private equity today from a fundraising perspective, from a deal activity perspective, from an exiting perspective. How is business?
How much time do we have?
You got a good 6 minutes.
It's great to be here. Look, and I think the industry is evolving just rapidly. You're seeing big theme, big consolidation right now in the industry and in the private assets world. You're seeing investors want fewer relationships. They want fewer managers. They want managers to bring them as many solutions that they can. Once an investor gets comfortable with the culture, the business, the operational due diligence, it really is on that manager to become more relevant. And so you're seeing a great consolidation in the industry. Our business, we're a $100 billion real assets business, real estate equity, debt, infrastructure. Certainly seeing a rotation out of a lot of sort of other private asset classes into real assets, just given the durability of cash flows. So certainly a lot of positive undertones and good tailwinds within the real assets markets right now.
In the real assets market, which sector or which theme do you have the highest conviction in at the moment?
For us, we've always been, for over 20 years, really focused on sort of demand-driven assets, need-based assets around education, healthcare, storage. Really not trying to time cycles, but really looking for things where these assets are needed in good and bad times. So we're very bullish in the education sector, working on off-campus student housing throughout North America and Europe, as well as on campus with many universities that have deferred maintenance issues, and where we can set up public-private partnerships. We're also very, very bullish on healthcare. We're very bullish on senior housing right now. We've been doing that for over 20 years as well. And there is just a unbelievable demand for space right now and such a shortage of supply. We're seeing 80,000 people turning 80 every month, and really the supply is not there. And, as people age, health needs, memory issues, very hard to take care of a loved one with those issues. And so we've got a tremendous shortage of supply. But then also we're seeing a lot of things around digital infrastructure, data centers, renewable energy. So again, demand-driven assets, resilient cash flows, low volatility. That's really where we're focused, and we're seeing a lot of capital interest from our investors around the globe.
Chris, is the AI build cycle, Is it overhyped?
It's interesting. I mean, I think the obviously the demand for data is off the charts and growing. When you look at the end user, what the real issue is when we look at data centers and how we invest, it's really the access to power. And that's going to be the challenge. I mean, power is going to increase, 2, 3, 4 times here in the next 5 to 10 years. And really accessing that power is challenging. And so that's the big issue that one needs to focus on. When we think about how we invest in data centers, we're really looking for good infill locations, access to power, great offtake agreements with some strong hyperscalers. But again, that need for data and what we're seeing again is robust, and it's not going anywhere.
You had mentioned this rotation into private real assets, and it's coming out of corporate private credit. What is the sentiment like on corporate private credit right now? Do people feel like the worst is over? Do you feel that the worst is over?
Well, it's a tough one because it really depends on where are you investing within that asset class. Are you in software companies? Are you in industrial companies? We're certainly seeing a rotation into infrastructure and real estate, just given the durability of the cash flow, the tangible asset class. When we look at asset classes around education, healthcare, we've seen how these asset classes do through the GFC, through the pandemic, just very consistent, resilient asset classes. And the challenge really has been the lack of distributions out of privates right now. And that's been a challenge for folks to raise capital. And so when you've got this sort of demand wave, you've got this enrollment increase at public universities, you've got this aging population, this need for space, supply's been just choked off because hard to access capital, hard to get debt financing. So you've got these amazing tailwind right now in these sort of demand-based assets. And I think that's what a lot of people see, right? Inflation protection, resilient cash flows, ability to reprice. And that's where we're seeing a big level of interest and a lot of demand.
All right, Chris, thanks so much for joining us. Really appreciate it. Christopher Merrill, he is the global CEO and co-founder of Harrison Street Asset Management. And one of the areas that he mentioned was university housing. I went to a college where all 4 years housing guaranteed. Didn't even think about it. My 4 kids, it was a disaster. Because
maybe
they all
the
went
first
to
year was
schools.
covered, right?
First year covered.
Yeah.
And then it's good luck.
Yeah.
And you got this 20, 50, 100,000 kids all looking for apartments in Boulder, Colorado.
I know,
or
where
in
they're
State
competing
College,
with professionals, with families for any kind of housing.
So finally, after like the first kid, I realized I'm not getting involved. It's your job. You figure it out. You go get all your stuff,
You write the checks. That's how you're involved.
Yeah, exactly. So they learned quickly. But so one more year of
You're almost done.
2 more checks to write and I'm done. I've been writing college tuition checks for 12 years now. Unbelievable.
You've seen the heart of the inflation go up.
Crazy. S&P up 24, Dow up 570, the NASDAQ down 15. The markets are rallying here as we close out the morning session. We'll have more coming up. This is Bloomberg.